Welcome to CMA Inter Financial Accounting Marathon. So this is our marathon for our June exams, which are going to be conducted in few days. So I'm hoping that all your preparations are going good. So let's have a quick revision of our entire subject, financial accounting. It's going to happen today, tomorrow, and day after tomorrow at the same time. That is 8:30 in the evening till 12:30 in the night, which is literally early morning. Clear? So if you have studied the entire subject, this will be a quick boost up, and whatever required, wherever we tend to go wrong in the exams, we'll try to cover all those things in this particular marathon. Clear? So today we'll start with the first chapter, that is accounting fundamentals. Roughly it has a weightage of around 14 marks. Usually they ask 14, sometimes even more than that also. So someone is asking about, is this recorded video or live? Live. We are here live 8:30 and today's date is June 1st. So you know now that it is not recorded. Yesterday RCB won. So you know, completely live guys. Yes. So please stay with us on this live so that you can also quickly revise the entire syllabus. Okay. And mostly what I'm going to focus on is first the concepts. Entire concepts will be discussed of every single chapter. And then as soon as we finish the concept of a particular chapter, we'll go into the last 5 PYPs, that is December 23, June 24, December 24, June 25 and December 25. 5 PYPs, we'll discuss that in detail, every single question that has been asked from that particular chapter, and chapter wise we'll go further and we'll see how it goes. Clear? Yes. So let's begin with the first chapter, that is accounting fundamentals. Accounting fundamentals. Now, let's go into certain concepts, accounting concepts which we need to know, which will be used in different places in accounts, which we need complete knowledge of, because where it will be tested, we don't know. It can be tested as a theoretical question also at the end, because sometimes, you know, theory also pushes us forward to the next level. So don't skip theory as well. So first one is entity concept. Entity concept. Entity concept means what? Business and business person are two different entities. Some people also call it as business entity concept. Two distinct entities. So if we have a business, Shalini and company, and there we have an owner who is called as Shalini, these two people are two different entities. That is why, because of this concept itself, because of this concept only, we have capital account. We have capital account. Why? Because of this concept. Otherwise, what is capital? Owner has contributed money into the business. Owner's money, business money, same, no sir. No, but it is same, but different. Clear? So capital account. What happens in capital account? Just remember, capital account means owner gave money to the business. For the business, this capital is liability. For owner in their books, this for owner, this is an asset because they have invested somewhere. Clear? And drawings, what is drawings? Owner took the money from the business, because owner has taken money from the business. For owner, it is an owner has taken money, so no problem. They got cash and cash equivalent. For the business, it is an asset because it is receivable. For owner, returnable, so it is payable. Clear? This is the situation. You guys are going to stay till 12:30. Sit. We can extend. No problem. You'll have. You're writing the June attempt. Yes, sir. Okay. Studied. Yes. Okay. So this is entity concept. So business is different. Business person is different. Next concept is accrual concept. What is accrual concept? Transactions are recorded as and when they happen. Okay, not necessarily when cash is received or cash is paid. When the transaction happens, we are supposed to record. Even if cash is not received or cash is not paid, we are supposed to record this. Okay, because of this concept only, we have the concepts of outstanding expense. We have the concept of prepaid expense. We have the concept of income accrued. We have the concept of income received in advance. All these concepts are there. Yes. Next, we go forward to something called as periodicity concept. What is periodicity concept? All transactions of a particular period should be recorded in that particular period only. So whether you receive or not, whether you pay or not, if it is related to this particular period, it should be recorded in this particular period itself. Okay. Periodicity concept. Next, money measurement concept. Money measurement concept. That means record transactions that are measurable in terms of money. If it is not measurable in terms of money, then it's very difficult to record that. For example, if there is this person Abdul and he hires this person called as Santosh and he pays him 5,000 per month as salary. Okay, that is recordable in terms of money, so you'll record it. And imagine he hires one person called Akash and nothing, no salary, nothing. He's just going to work. So even though this fellow is performing services over here, because it is not measurable in terms of money, it's not going to be recorded. Clear? Going concern concept. What is going concern concept? Whenever we start a business, whenever we run a business, we always run it with the mindset that it is going to continue forever. That means there is no indication or there is no intention to shut the business. There is no indication or there is no intention also to shut the business. YouTube people are telling great timing, sir. Amazing timing, right? Akhilesh sir is in America. That's why he's streaming live at 8:30 p.m. Hey, you don't know. Just now we came from LA, man. LA, you know, Los Angeles. Okay, over there full betting that this and all will be happening. Just now we walked in from there only. Now we are shifting into our studies mode. You guys stay in studies mode only. You don't go to LA. Huh? Our casino is institute only. Correct? No. We are betting with institute. We will write, please give us the marks. Yes, going concern concept. Now, matching concept. What is matching concept? One person is wearing blue shoes, blue glasses. Is that what is matching concept? Matching concept simple. If you record expense, record the relevant income as well. Okay, income and expenses should be matched. If income is recorded in a period, expense that is incurred to earn that income also should be recorded in that period only. Now, for example, matching concept, you see, I sold goods. And to sell those goods, I had to purchase goods, but I didn't make a single rupee payment for my purchases. But still purchases will be recorded. That is matching concept. Clear? Dual aspect concept. What is dual aspect concept? Dual aspect concept is nothing but our double entry system of accounting. Double entry system of accounting tells that for every debit, there should be an equivalent and opposite credit. Now, it doesn't mean that in our journal entry, there should be one debit and one credit. There can be multiple debits, there can be one credit, or multiple credits and one debit, whatever it might be. Compound effect can be given, but it should always be equal. Online. All chapters will be covered, sir. Yes, that's the goal. We are trying to cover all the chapters. Not today, obviously, but over a period of 3 days, we'll try to cover maximum possible. Sir, you are late. I completed old marathon of December 25. I'm tired of waiting. Oh, sorry. What do we tell? Direct critic. Okay. Where it is happening? It's happening in Chennai, guys. If you want to walk in, you can walk into the academy. It's happening in Chennai. Yes, dual aspect concept. For every debit, there must be equivalent credit. Realization concept. Realization concept means what? Any income must be recorded to the extent it is going to be realized. Any income. That means imagine we made a credit sale. And when I'm making the credit sale itself, no, that time only I got to know that this person will not pay. He just left, took the goods and left. That time I got to know that this person might not pay. I got doubt at that time only. There is no point of recording the sale and then passing entry for provision for doubtful debts. Don't record the sale itself. Clear? So this also is covered in one of the accounting standards, but just remember, when you are having income, how much you feel you are going to realize or how much you feel that you are going to get, that much only should be recorded. Now, cost concepts. All assets must be recorded at cost when purchased. So we have assets, it will always be shown at cost when it is purchased. After that, it will start depreciating. There will be depreciation effect. That is also part of our syllabus. Now, conventions. We'll go to the conventions. First one is conservatism, which is also called as prudence. What is conservatism? All expected losses of the future will be recorded today itself. But if you see income from far, don't record it. Wait for that income to arrive. Clear? Let's not worry about this. Go and all. Let's continue. Consistency. Now, consistency, all rules and concepts followed must be applied consistently over a period of time. So if you choose some accounting policies, those policies should be applied consistently over a period of time. You can't keep changing over the policies because then it becomes tough for the reader also to understand and compare previous year to current year. Okay, full disclosure concept. Full disclosure means what? It is like you going and telling truth to your parents. Okay, how much all info that is required for reader must be disclosed. Okay, according to our knowledge, whatever we know, we'll tell. That's it. Okay, so this is a full disclosure concept. Materiality. Materiality means what? You can't stuff all the information to the reader. Disclose only that information that is needed for the reader, which you feel that it is relevant for the reader's decision making. You will disclose all those things. Clear? Sir, message did not come whether students are there. Sir, every chapter will be covered. Yes, 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 guys, yes. Over 3 days. Okay, they are only replying to each other. Someone told yes, over 3 days. Okay, capital and revenue expenditure. This, you might feel it is very, very silly. But in exams, they are asking this. They're giving list and tell capital or revenue expenditure in exam. And I think it's there in, if I'm not wrong, in December 2025 exam also it is there. Now, impacts, capital expenditures are usually the ones which impact balance sheet, and revenue expenditures are the ones which impact the trading account or P&L account. Okay, revenue is usually short term, okay, and it is recurring. Capital is long term, non-recurring, and it gives you extra benefit. Usually that extra benefit point is very, very important. Now, for example, extra benefit, you see, if any expenditure gives me benefit for more than 12 months, it is going to be capital expenditure, and any expenditure is giving you benefit for less than 12 months, that is revenue expenditure. So this is how it is going to work. Now, for example, if I tell you, I'm constructing a building and I will demolish this building after using for 3 months. Is it going to be capital or revenue? It will be revenue. But imagine I construct building and usually you use building over a period of time for many, many years. That time it will be considered as capital expenditure. Clear? Now examples we'll see. Few examples. Building purchased by computer dealer. Building purchased by computer dealer. Main business is not real estate, it is computer. So this will be considered as capital expenditure. Building taken over on rent. You are going to pay rent for 12 months only. Usually if you pay for more than 12 months, it goes into lease category. We have that chapter. Okay, this will be considered as revenue expenditure. Building purchased by real estate dealer. Okay, real estate dealer, his intention is to buy building and sell building. So it's going to be revenue expenditure. It's going to give you benefit within 12 months, or at least the planning is that we have to get the benefit within 12 months. Now I might have purchased the building thinking that I'm going to sell within 12 months. But it remained in my stock for more than 12 months. That is not the thing. When I'm purchasing the building, what was the intention? To hold it for, less than 12 months. Clear? Computer purchased by computer dealer, revenue. That is their main business, stock it is. Computer purchased by real estate dealer. Now, real estate dealer will purchase computer and he will have a plan of using it for more than 1 year. So, it will be considered as capital expenditure. Repair to building or machinery. Repair to building or machinery, just remember this. If that repair is going to give you extra benefit, then it will be capital expenditure. No extra benefit will be considered as revenue expenditure. So basically understand this. You have one building over here. Okay. There was a lightning which struck and this part of the building fell down. And when it fell down, no, you repaired the building. As you are repairing, no, you are going to construct one more floor. Now, is it capital or revenue? It is capital expenditure. You are just repairing the building to its existing state. That is going to be revenue expenditure. Same with machinery also. Imagine you have a machine, one part got spoiled. And by replacing that part, what number of units you were manufacturing before, same number of units you are going to manufacture even now. So that time it's going to be considered as revenue expenditure. When that part got spoiled, you found out that there is a new part in the market and you put that part. When you put that part, no, earlier it was giving you 10 units. It was giving you 10 units per hour. Okay, now it is starting to give you 12 units per hour. So can you see that you are getting extra benefit over there? That is going to be considered as capital expenditure. Now, plant and machinery purchased. If it is asset, capital expenditure. If you are a dealer of plant and machinery, that also would go into the category of revenue expenditure. Installation charges of plant and machinery. Now, this is one more extra point you have to remember when you go into capital and revenue. Now, imagine one thing is capital. Along with that, there is a chain reaction of expenses. All that will be considered as capital. You constructed building. You decided to purchase building, purchasing machinery. This is capital expenditure. Along with that, you have other expenditures. Freight, installation, loading, unloading, all those things came as a chain reaction. Because you decided to purchase the building, these expenses are also there. That will also be considered as capital expenditure. That is why in our depreciation chapter, we always see asset is purchased. And along with that, they tell that there is the installation expenses. Installation expenses are just added to that itself. Clearer? Now, next. We have seen all this construction of building, capital expenditure. Now, building, we are already in building point. Let's quickly illustrate one thing. Now, imagine you have a building. You purchased one building. Building was already there. Okay. 5 years old, 6 years old, whatever, one building. You decided to purchase that building. After purchasing that building, no, you decided to paint it blue. You were Mumbai Indians fan that time. Full blue painting. Okay. Just now you purchased and you painted it blue. Now tell me, is it capital expenditure or revenue expenditure? Is it capital or revenue? It is capital because you just purchased the building. At that time, you made all these changes. that is making the asset ready for its intended use or sale. You're making the asset ready for its intended use. You don't want it in the existing color. You don't want to start your business in that existing color. So it is making the asset ready for your intended use or sale. Now, after some time, what you decided to do, you removed, okay, a couple of years passed away, and then you decided to paint it fully red after 2 years. Now you made, when you made it red after 2 years, now tell me, is it capital expenditure or revenue expenditure? Revenue expenditure, because now you are doing it for maintenance purpose. Okay, now if you are doing it, it should give you extra benefit. By painting it red, it's just for maintenance, keeping the building in a good state. So that will be considered as revenue expenditure. One more thing, it might be covered later, but we'll cover it here itself. Now I am constructing a building. Okay, I'm constructing a building. When I'm constructing building, I need people, right? To construct, I need workers. Workers will be working day and night. That time what I will do, here I will construct one temporary hut for them to stay. Now this temporary hut for them to stay, is it capital expenditure or revenue expenditure? Capital expenditure. Why did this come? Because this was there. Because this was there, this also came into existence. Okay, capital expenditure. Now I decided after the building is ready, I don't need the temporary hut anymore. Workers will go away. Why do I need one temporary hut next to my building? I'll demolish this temporary hut. Is it capital expenditure or revenue expenditure? That is also capital expenditure, because until you demolish, your building will not be in its required state. So you're making the building ready for its intended use or sale. Clearer? Same way, if you, same way, if you are going to make a shed to store all the material during the construction time, that is also capital expenditure. After construction, you are going to demolish that particular shed. That is also capital expenditure. Clear? So just remember those points. Yes. Construction of building, capital expenditure. Preparation of site for construction. The land look like this. Okay, you are filling the mud and all and level, making the land level. That is also capital expenditure. Demolition of old building. In the land, no, there is already one old building standing over there. You demolish that entire building and started constructing new. That is also capital expenditure. Temporary huts for workers. We discussed this. Temporary huts demolished. All that is capital expenditure. Now, after the building is ready, you decided to call one celebrity. Okay, one celebrity you decided to call. Okay, now you decided to call, let's say now, just now, few new CM Vijay. Okay, CM Vijay you decided to call. Okay, and you told we'll do one inauguration by CM Vijay. Now whatever you are paying for, imagine now he's a CM, so he might come for free also. Before he was actor, that time he would charge some amount. No, now whatever you are paying to CM Vijay, let's assume you are paying some amount. Okay, a particular amount you are paying. That amount, is it capital or revenue? It is revenue. You know why? Even without the inauguration, you can still start your business, because building is ready for its intended use or sale. You called one celebrity because it's like a marketing expenditure. If celebrity comes, people will come and they'll get to know more about this particular thing. So inauguration of new factory, okay, is revenue expenditure. Advertisement expense. What about advertisement expense? Advertisement expense is going to be considered as revenue expenditure. That we know. Now, sometimes institute might try to confuse you. They might tell that advertisement expense is given, advertisement expense is paid, and this ad will run for 5 years. It will run for 5 years. Now, what happens? It is actually revenue expenditure, but because it's going to give you benefit for 5 years, you can treat it as deferred revenue expenditure. You're going to spread it across for 5 years and you're going to record it. Clearer? Now, let's go further. Okay, let's quickly read what these people want to talk. Whether students are there? Yes, guys, yes. We have a huge full class of students here. No place. You should be on time, then you'll get little place to sit. Admit cards just got released. I forgot to download mine. Okay, I will download it tomorrow and I will send it to you. For CMA Inter, sir, insurance claim, hire purchase, everything will be covered, guys. Don't worry. Just sit and follow. If you want to specific topic, follow old marathon, capital revenue, workers, hut is capital. Yes, sir. This covered in AS10. Yes, it's covered in AS10 also, because AS10 talks about PPE. Okay, AS will be the last topic that we are going to discuss, but AS also covers a lot of marks in the exam, and direct questions, direct. If you see, this time we won't have time to cover all the model test papers, but model test papers, it's repetitive. From one model test paper to another model test paper, from there to one more, it will just keep getting circulated. So let's go further. Now this is our accounting process. Let's quickly go into our accounting process. We start with journal or subsidiary books. What is journal? What is subsidiary book? This is the primary book where we are just first going to record the transaction. Okay. Subsidiary book is what, if at all we have too many transactions of a particular nature, instead of writing journal entry 1,000 times, what we can do is you can use your subsidiary book. So you can record it all together. From journal, you go into ledger. From ledger, you move into trial balance. This is called as unadjusted trial balance. If there are adjustments which are given in the question, you pass those entries. When you pass those entries, trial balance will change. That time it will become adjusted trial balance. After that, you go into trading account, P&L account and balance sheet. Clear? This is our accounting cycle. Now, journal and ledger. Journal is also called as primary book. MCQs and all this can be tested. Primary book, and ledger is called as secondary book. Now, journal, alternative, what do you have for alternative? Alternative for journal, what is it? Subsidiary books. Now, all transactions are recorded in journal. Journal usually follows chronological order. That means date-wise. You always record date-wise. You won't tell that I'll keep it pending. I will record all purchases together, all sales together. We won't do that. We record it in date-wise. Secondary book, all transactions are posted. Posting means what? Transferring the debit and credit items from the journal to the ledger to the right side. That is called as perfect side. That is called as posting. Ledger is always in analytical order. What is this analytical order? Based on analysis. That means all purchases together, all sales in one sales ledger, all cash items in cash ledger. Now, let's go further. Journal. We have two approaches. Traditional approach as well as modern approach. Traditional as well as modern approach. Now, traditional approach, it divides things into three categories: real account, personal account and nominal account. Okay, what happens in real account? All non-current assets. Real account is usually all the non-current assets which are there. Personal account is natural person, artificial person and representative persons. Okay, nominal, what is natural persons? Us, we people who are talking over here. Okay, natural persons, artificial persons, companies, partnership firms, trusts, all these are artificial person. Representative person is usually the owner's representation, that is capital, drawings, those are representative personal accounts. Nominal account, you have expense, loss, income, gain. Now, rule of traditional account is what? Traditional method is what? Debit what comes in, credit what goes out. That is for real account. And here for personal account, it is debit the receiver and credit the giver. And in nominal account, you have debit all expenses and losses, credit all incomes and gains. Clear? Now we go into modern approach. Modern approach, it's actually easier compared to traditional approach. There are like hardly any confusions which are there. If you are learning new, then modern approach. Otherwise, what you have already learned, stick to that itself. Don't go to change now. Assets, liabilities, expense, income, and then last one is capital, or it's also called as owner's equity. Now, simple rule: asset increases, debit; asset decreases, credit. Liability increases, liability is opposite of asset, so therefore liability increases, credit; liability decreases, debit. Expense and asset are all same. You know why? Because the revenue expenditure is considered as expense, capital expenditure is considered as asset. Expense increases, debit; expense decreases, credit. Incomes increases, credit; income decreases, debit. Incomes and expenses are opposites to each other. Capital is also a liability, so same treatment as liability: increase credit, decrease debit. Is this clear till here? Yes, let's go further. Now we are into this very important part. This table or this box will also help you in final accounts. Usually we have these adjustments in final accounts, NPO and all those chapters. We usually tend to get confused. Let's have a quick reference over here. Outstanding expense. What is an outstanding expense? That means amount supposed to be paid but I haven't paid. This is a liability. This is a liability. Okay. Liability, because of accrual concept, because of periodicity concept, even if I haven't paid, I am supposed to still record this. So expense account debited, if I have to record it, expense should be debited. Have I paid it? No. If I had paid it, I would have passed the entry expense account debited to bank account. Expense account debited to bank account. If I would have paid, I would have recorded it this way. Okay, but I have not paid, so expense account debited. Because I have not paid, it's a liability for me to outstanding expenses. Clear? Now, prepaid expense, opposite. This time I'm a good person, I paid early. So prepaid expenses, asset, prepaid expenses account debited to expenses account. Now, the person who is passing the entry, no, when the amount is paid, they wouldn't have thought about it. They would have just passed everything into expenses. Now what I'm doing, I'm reversing from expense and I'm telling this is not this year's, it is next year's. So I'm treating it as asset. Because it is next year's, I'm removing it from expense. So expense reduces. Whenever expense reduces, it is credited. Clear? Now income, if I'm talking about income, income accrued. Income accrued means what? Income receivable. I have done my work, but I have still not received the income. Income receivable. Any receivable is always asset. So income accrued account is debited. Clear? And income account is credited. Why? Whether I receive or not, accrual concept, periodicity concept, I am supposed to show that as income. So income accrued account debited to income. Now you have to remember one thing over here. If I had received the money, I would have passed the entry like this. Bank account debited to income account. Bank account debited to income account. If I would have received, because I did not receive, I am treating it this way. Income received in advance. That means next year's income, I already got it this year only. Does it mean that if I have received next year's income this year, I can take it as income directly? I cannot take it as income because we follow periodicity concept. So what I will do, income received in advance is a liability. So I'll remove it from income. That means I'll reduce the income account debited to income received in advance. Income received in advance is a liability. Okay, more detailed things of this or application of this will be seen in our NPO chapter. NPO chapter full game only is about outstanding prepaid income received in advance. Okay, so let's go further to the next topic, that is cash book. Okay, cash book. Records, obviously when we are telling cash book records what? All cash and bank transactions. It records all cash and bank transactions. Now, cash book if you have, you don't have to prepare cash account again because cash book has the structure of cash account itself. So you have receipts and payments in cash book. So you don't have to prepare cash account. If you have cash book, balance will directly go to trial balance. The cash balance, bank balance will directly go into trial balance. No cash ledger, no bank ledger. Clear? Now you have multiple types of cash book. One is single column, double column, triple column, 2-column cash book, 3-column cash book, and so on. Now, in single column cash book, what we have? We have cash column or we have bank column. We usually think that it's only cash column, but no. Imagine a company is there or a business is there who does not have cash transactions at all. Then we will have only bank column. Okay, double column cash book or a 2-column cash book. That is cash and bank column, cash and discount column, or bank and discount column. Based on the needs of the business, they will prepare it. Triple column cash book, everything. Cash, bank and discount column. All 3 columns are there. Now discount treatment is little important. Now discount we have to understand before we understand how the discount column works. Now all these things might seem silly, okay? Hey, sir, nothing is there, sir. Discount column, what is a big deal? We know how it works. You know where it will be tested? The chances of them asking cash book might be little rare. Cash book might come as BRS question where they will ask adjusted cash book directly. Now where it will be tested is directly in rectification of errors. They'll tell entered here, not entered there. Or they'll tell entered in the discount column, not posted. Now we are supposed to know where it is entered and what is the impact of that. Clear? So in discount, we have 2 types of discount. One is trade discount, another one is cash discount. What is trade discount? Discount at the time of trade, at the time of buying and selling. When I'm buying and selling, I have had a discount. For that, there is no entry at all. I went to the market, I saw the product at 100 rupees. I told him, boss, will you give it to me at 80? They agreed to give it to me at 80. This 80, what he gave me, 20 rupees, what is gone, this is called as trade discount. At the time of trade itself, I have negotiated and I have taken this particular price. Trade discount. Now, when I go home, I will not write the entry at 100 and then reduce it to 80. Directly, I'll pass the entry at 80 itself. That is why for trade discount, there is no entry. Clear? Cash discount. What is cash discount? 80, but I told him I'll make the payment tomorrow. So tomorrow when I go there, I am going to pay him 75 and he's like, okay, let's leave it at 75 only, I'll take it. So you had already recorded the transaction at 80. So if you're paying less or for that person, if he is receiving less, that is always going to be considered as cash discount, and discount at the time of payment or received. Cash discount has to be recorded. You cannot ignore cash discount. It has to be recorded. Clear? Now, cash discount, you have discount allowed, discount received. Discount allowed, you have to remember one thing. Discount when receiving money. Discount allowed means when you're receiving money, you are giving discount. When you're paying money, you're getting discount. Clear? It goes in the opposite directions. So discount allowed is discount received when receiving money, discount allowed when receiving money, and discount received mean discount when paying money. Obviously, discount allowed, you gave someone discount, so you got lesser amount. That is going to be expense. You received a discount from someone, that means it is benefit for you. It is income. Clear? Now discount allowed entry, you see discount allowed is an expense. So expense will be debited to To whom you gave this discount? To debtor. Debtor is a receivable. Receivable was asset. Now he is not going to pay that amount. So that amount has to reduce. So to debtor. Clear? Income. That is discount received is income. Creditor account debited. Why creditor account is debited? Creditor, we are telling creditor, boss, we are not going to pay, and he agreed. So creditor is a liability. If I am not going to pay, liability will decrease. So liability decrease, creditor account debited. Okay, to discount received account. To discount received account. Clear? Now we are looking at single column cash book. How does it work? Simple. Date, receipts, amount. Date, receipt, payments, and amount. Now single column cash book will be only cash or bank column. Obviously in single column cash book you will not have discount column there. Okay, because how can you have only discount without receiving money or paying money? Okay, next, two column cash book. You have two column cash book, that is date, receipts, cash, and bank column. It can be cash and discount, it can be bank and discount, anything. Three column cash book, date, receipt, discount, cash, bank. All three are there. You can write it in any order, but don't write discount any other place other than this particular place. This cash and bank can be interchanged, no problem. They are not going to cut marks for that. Now here in three column cash book, I would like to highlight one more thing. Imagine cash is deposited, cash is withdrawn. Now debit is also happening here, credit is also happening here inside the cash book. If debit and credit happens inside the cash book, okay, that time such transactions are called as contra entries. Contra entries. So in the LF column, you will go and write contra. Clear? Now note, this is one point that can be tested in our BRS as well. Check received and deposited. Check received and deposited. Now imagine check is received. Okay, check is received, but it is okay. We'll take the regular one. Check is received and deposited. Naturally, when I see X gave me check, so what I will think? I will think directly bank account debited to debtor. That is a natural assumption. Now check received on one day, but deposited on one more day. That time what will you do? Check in hand account debited. You will take it as check in hand account debited to debtor account. Check in hand to debtor. You will not pass the entry bank account debited. You will pass it into a temporary account called as check in hand, and deposited on another day. When you deposit, what happens? Bank account debited to checks in hand account. So you're just keeping it in a temporary account because it has not gone into bank yet. If you directly put into bank and next day you're preparing BRS, there will be a mismatch. So to avoid that, we are doing this. Next we go into petty cash book. The chances of petty cash book being asked is very, very rare. Okay, but don't skip it. You never know. An MCQ can come there. Okay, usually imagine there is one company here, Karthik Limited, and there is a cashier. The cashier is Bambani there. Now, cashier, what he has done, he has too much work. So he has appointed one more person as petty cashier. So what he has done, petty cashier over here, he told cashier has given 5,000 rupees and told whatever expenses are there less than 5,000, let the people not come to me. Let them come directly to you and you make the payment. Okay, if they have to test you on petty cash, if I was going to test you on petty cash, I would have asked you, okay, now 5,000 is the limit. 3,000 rupees expense is there. Who is going to make payment? Cashier or petty cashier? Petty cashier is going to make the payment. Small sale we made, small sale, and 3,000 rupees we received. Who is going to receive the money? Cashier or petty cashier? Cashier. Not petty cashier. Petty cashier's job is only to make payments. So even if 1 rupee is received, it will go straight into cashier only. And major thing that you have to remember, petty cashier will get money only from cashier. Petty cashier will get money only from cashier. Now, petty cash. Normal we have and impress system we have. See, petty expenses are paid by petty cashier. Only petty expenses. Petty receipts are not written over there. Petty cash, normal as well as impressed. Normal means what? Every time period, same amount is given irrespective of the amount spent. Let the amount be spent anything. Any amount might be spent, but still we are going to give you same thing. For example, this week I gave you 500 rupees. You spent only 5 rupees. Next week again I'll give you 500 rupees. You spent only 5 rupees. Next week again I give you 500 rupees. Now you spent 1,200 rupees because you had previous week spending. Still I'll give you next week 500 only. This is normal system of petty cash. Impress system is what? This week I gave you 500 rupees. This week I gave you 500 rupees. You spend nothing. I give you nothing. You spend nothing. I give you nothing. You spend 200 rupees. That time I will give you 200 rupees to take your balance again to 500 rupees. and you spend 300 rupees, I'll give you 300 rupees to make your balance again 500 rupees. So in Impress system of petty cash, whatever amount you spent, that amount will be reimbursed to make the balance back to its original balance. Any amount spent by petty cashier is reimbursed by cashier. Clear? Petty expenses are paid by petty cashier. That we already saw. Petty cash book format, just you can have a look at it. Okay, if at all it's asked, you know what to do. Let's go further. Next major topic, I think almost a couple of times or 3-4 times they have asked this, BRS. Not many questions are there on BRS in the study material, but exam consistently they are going to ask. Someone is telling petty cashier gets pocket money from cashier. I think they saw this new Google Pay ad. You know that new Google Pay ad is there. Vaibhav Suryanshi is there in that. I think they saw that and they are telling petty cashier is getting pocket money. So students are allowed or not? You are allowed, sir. Allowed, guys. If you are in Chennai and if you are wanting to attend the marathon face to face, you can come from tomorrow. Today I think it's too late, so don't leave from your place and attend. Tomorrow you can come. Consolidated marathon session. Yeah, once this is done, obviously the videos will be merged and it will be there. Sir, can I get these notes? Now it's a little difficult. Okay, at the end of the class, we will ensure that it's put in the description. Sir, give us some tips at the end of the session, how to present answers in exam. Yes, if any break for this session, nothing is confirmed as yet. Okay. Hello, sir. Hello, sir. If any break in this session, that guy again and again is putting this. Right now, we don't have any break. Okay. It is live. If you want, you can take break. Then you can just scroll back and watch from there. Okay. I don't know why I have to give break for that. Okay. Don't worry. Let's focus. Few days left. No break and all. Don't ask me break. Not regular class. Okay. BRS, bank reconciliation statement. Now you know if it is BRS and if there is bank reconciliation statement and if the question comes in the exam, you just, if you are feeling stressed, just look around in the class. See around. Everybody will be doing Bharatanatyam like this. Correct? Everybody will be doing Bharatanatyam. You see them and different steps they will be doing. You will feel little relaxed and then you start your own Bharatanatyam. Okay. Now, bank reconciliation statement. Statement showing difference between cash book and passbook. Statement showing difference between cash book and passbook. Now here we have bank column. Okay. When we are talking cash book and passbook means, sir, cash book, what cash book? Cash column or bank column? Ignore cash column. Ignore cash column. We are only going to focus on what? Bank column. It is going to show the difference between bank column of cash book and passbook. Okay. Who is going to prepare this bank column? It is maintained in books of accounts by you. Who is going to prepare? You. So it is maintained in books of accounts by you. And for you, bank is what? Asset. For you, bank is what? Asset. And maintained by bank. What is maintained by bank? The passbook is maintained by bank and it's called as liability. For you, it is, for bank, it is liability because bank has taken money from you. And whenever you go and stand in front of the ATM and tell, give me money, they have to give money. Clear? Sir, how many chapters will be covered? Sir, take AS first. It's not possible. The concepts have to be revised. No, for AS. Otherwise, AS will be like bouncer only totally. We need AS. We will have AS. Don't worry. We will have AS. In these 3 days, we will have AS for sure because that also comes in the exam. Now, books. Let's focus on books now. Cash book. If it is cash book and you tell normal balance is also called as favorable balance. Favorable balance means debit balance because for you it is asset. And in passbook, if it is normal balance, favorable balance, that means it is credit balance because for bank your liability. So in their books, it will be credit balance. For you, bank is asset. So it will be debit balance. Clear? Now books, if it is OD balance is liability. That means you have taken more money than what is there in the account. They have given you that facility. So you have taken it. This will be considered as credit balance because for you it is liability. In passbook, if it is OD balance, that means what? For bank it is good. They are happy if you have taken more money because you will give interest to them. So therefore for them it is debit balance because it is asset. Clear? Now movement of balance. This movement of balance is very important when you are passing entries, when you are recording and all. You should know which direction the balance went. Clear? Now money comes in. money comes in, whether it is normal, money comes in, just remember it will increase, it will decrease. What does it mean? If money comes in and it's normal balance, if it is normal balance, balance increases, balance decreases. Now, all of you students, usually you don't have OD facility with the bank. You have normal balance only. If your friend sends 500 rupees to your account, what happens to your bank balance? It will increase. And you send 50 rupees at the chai shop, what will happen to the balance? It will decrease. Clear? Now, OD. Just remember this OD thing. OD is opposite. You already have to pay bank 500 rupees. When you have to pay bank 500 rupees, if your friend sends 100 rupees, what will happen to the balance? Balance will drop down because now you have to pay bank only 400 rupees. Now already you have to pay 500 rupees to the bank. When you have to pay 500 rupees to the bank and again you took 200 rupees and made one payment. So now you have to pay the bank what? 700 rupees. So just remember, if it is OD, if money comes in, OD balance decreases. If money goes out, that time OD balance increases. Clear? Now, right hand, left hand. Now don't look at the screen and decide your right hand, left hand. You know which is your own right hand, left hand. If you look at the screen and see I am moving one side, you are also moving that side, that is actually your opposite side. Correct? So therefore, remember, right hand you always take it as starting point. And left hand you always take it as the end point. Clear? End point means what? Now in the question, the OD balance is given as per passbook. Now you have to start with passbook only. Now you will end with cash book. Okay? If you start with cash book, you will end with passbook. Now just remember one thing. Right hand will always be your start point. Left hand will always be your end point. Now just remember one thing. Whatever happens with your right hand, you reverse it. Right hand moved up, you bring it down. Right hand moved down, increase. Clear? Left hand, whatever happens with your left hand, if imagine left hand moved upwards, don't go to do anything with that left hand side. Okay, move your right hand to match it. Clear? So right hand is something that will move to match the left hand always. Left hand is something that will remain stagnant. You passed an entry in the passbook. Passbook is your right hand. Let me illustrate this. Passbook is your right hand. Let's assume passbook is your right hand. Now, you passed an entry. Impact was only in the passbook. Passbook balance increased. Passbook is right hand. So what will you do? Decrease it to match with the cash book. Now, you entered something that impacted only cash book. Cash book is your left hand and cash book balance increased. Because cash book balance increased, what you have to do? You cannot change that now. Move your passbook to match with that. This is the logic, or this is the most commonly used method. Actually, if you do practical BRS, you don't have to worry about this. You'll see the cash book, you'll see the passbook, not there here, you'll do it. Clear? But in exams, you can follow this particular methodology. Okay, entered here means what? Start point, that is right hand, reverse it. Okay. If it is not entered over here, that time what will you do? You will enter it. Okay. Don't worry about this. This we already discussed, so we don't have to worry. Common differences we'll see. Common differences. These are some of the common adjustments. It doesn't mean that these only will be there in the exam, but most commonly asked. Check deposited, not credited. Check deposited, not credited. Remember, just understand this point. Okay, how it is going to work. Your friend gave you a check. You took that check. Okay, went and deposited into bank. Because you deposited, you passed the entry in your books. Bank will take some process, maybe 1 day, 2 days, it will take some time. Now bank, what they will do, they have not given you that money yet, you just deposited. So whenever check is deposited, you did your part, you recorded it. So that means entered in cash book, not entered in passbook. Sir, please questions also. Yeah. First, let me finish the full topic of chapter number 1. Then all questions of PYPs will discuss. Check issued. Check issued, not presented. That means you gave the check to somebody. You gave check to somebody, so you have already recorded it. But that person has not yet gone to bank. So because that person has not gone to bank, that is not presented to bank. So from bank, the money has not gone. Entered in cash book, not entered in passbook. Clear? Now, bank charges. Bank charges. What happens to bank charges? Bank will not call you and tell, no boss, I'm going to cut the money. Please, can I cut the money? Bank will just take the money. Entered in passbook, not entered in cash book. If you have not seen the message which the bank has sent or any other statement or something, that time you will not know about it at all. Now, interest and dividend received. Interest and dividend received. Bank got the money, they put it into your account. Now it's up to you whether you see the message or see the statement. So entered in passbook, not entered in cash book. Now remember one thing. If at all we are talking about BRS, whatever they tell no, those are the items which are causing difference only. If at all they have told something in the question, it is causing difference because they tell these are the items on scrutiny we found. Clear? So these are the items which are causing difference. Now, difference between cash book and passbook can be two types of differences. One is timing difference, one is errors. Timing difference is what? I recorded in cash book today, they will record in passbook some other day. I recorded in passbook today and cash book we will record some other day. This is timing difference. And then errors. I made mistake in cash book, bank will not make the same mistake. Bank made mistake in passbook, I will not make the same mistake. Clear? Now BRS, two types of BRSs can be asked in the exam, that you have to see the question and then decide. If nothing is told, it's only BRS. If it is adjusted cash book, they have to ask you to prepare adjusted cash book. Clear? Now, without adjusted cash book means what? Enter all differences in BRS itself. Adjusted cash book means what? What is adjusted cash book? Change the cash book for things that are under your control. Things that are under your control means what? You entered passbook, they didn't enter. That's not under your control. Okay. Passbook they entered, you did not enter. Under your control. Enter it, no difference only. After that, there is no difference. Okay, that is one thing. Passbook they made mistake, you did not make mistake. So are you going to make the mistake to match it? No, you'll just put it in BRS. You made mistake, passbook they did not make mistake. So you correct the mistake, so you and passbook will be matching. So adjust cash book for items not entered in cash book. Not entered in cash book, what you're going to do? Enter it. Okay, then for errors in cash book, what you're going to do? Rectify it. That time the difference will automatically be resolved. You don't even have to bother about your BRS that time. If everything can be sorted, you don't have to prepare BRS. Bank reconciliation statement is not required. After that, prepare BRS. Okay, for the differences which you could not reconcile. Okay, through this adjusted cash book, you are going to prepare BRS. Clear? TB, trial balance. Now, asking trial balance might be like too silly at inter level, but what they can do is always give a wrong trial balance and they can tell you to prepare the correct trial balance. Now, list of all ledger accounts it is. Format, you know the format, we are not going to discuss. Okay, how you should just remember that all assets have debit balance, all liabilities have credit balance, all expenses have debit balance, all incomes have credit balance, all capital has credit balance, and all drawings have debit balance. Okay, this we already know. Next, we go into depreciation. That is also part of chapter number 1 only. So we'll go into depreciation. What is depreciation? Decrease in the value of tangible asset. Decrease in the value of tangible asset. Sir, what about decrease in the value of intangible asset? It's called as amortization. Now, intangible asset amortization. So imagine you have a car. Akash is there having his car with a few of his friends. Okay, reasons. Wear and tear. First reason of depreciation is what? Wear and tear. Wear and tear means what? I'm using this continuously. I'm using this continuously. When I'm using this asset continuously, what happens? It will tend to get spoiled, and if it gets spoiled or if it is used continuously, it will reduce its value. Passage of time. Passage of time means what? I did not use the asset at all. Nicely, I have parked the car and I'm taking care of it. Every day I'm cleaning it. Okay, still the model becomes old. Okay, that time the value decreases. Technological changes, which is also called as obsolescence. Okay, what is this technological changes? I bought one beautiful petrol car. Suddenly government has put some rule that only on 15 days in the year, 15 days in the month, you can use petrol cars. Other days you're supposed to use EV on the road. Now suddenly what happens? Because of the technological change, value reduced for my car. Or one more thing that we can think of, imagine you have a car and there is a situation where because of new technology, new car came with same features, lesser price. So automatically the value of your car goes down. Passbook is like institute. If something wrong or missed in passbook, follow it. If we make mistake, correct it. When exams are coming close, no, new creativity will come out from us. After exams, if you think of any creativity like this also, no, mind will not work at all. Okay, depreciation. Computation we have to learn and accounting we have to learn. Computation, it's very simple. You have different methods. SLM, straight line method, WDV, written down value method, sum of digits method, which is rarely used. I don't think they are ever covering that also. Machine hours method, production units method, and depletion method. Major focus is on this accounting. You know how to compute, how to account it. That is a major thing over here. Now SLM, straight line method, or it's also called as original cost method. It's also called as fixed installment method. Now one thing we have to remember in straight line method, depreciation is going to be same every year. Every year it's going to be same. Depreciation formula, cost minus scrap value divided by useful life. Cost will be given, scrap value will be given, useful life will be given. Clear? Now, if I take an example, cost is 1 lakh, scrap value is 10,000, useful life is 3 years. What will you do? 1 lakh minus 10,000 divided by 3 years, you're getting depreciation as 30,000. WDV, written down value method. WDV, when we are following under written down value method, you have to remember one thing. First year, no, there is no WDV. First year starting, where is WDV? Written down value. That means balance carried down. Now, first year you have cost only. Cost is given, depreciation rate is given, multiply. You will get the answer. From year 2 onwards, what you will do? You will apply the depreciation rate on the WDV. Now, cost is 10,000, 10% rate, 10,000 into 10%, first year depreciation done. Second year, what happens from 10,000, 1,000 goes and you'll get 9,000 as the WDV on that 900 and so on and so forth. It will just keep continuing. Now, here you have to understand one thing. Sometimes in the exam, what they will do, depreciation 10% SLM. Depreciation 10% SLM. So what you will do, apply the 10% directly on the cost itself. Every year you apply it on cost. If they tell 10% WDV, that time what you will do, if they tell 10% WDV, you apply it on WDV every single year. Balance carried on whatever is there before depreciation, apply on that. Sum of digits method, which they are not including also, depreciation is number of years remaining divided by sum of digits of useful life, including current years. Number of years remaining means including current year. If I'm telling 5 years and I'm in the second year, if I'm telling I am in the second year, that means including second year, second, third, fourth, fifth, 4 years you're going to consider. Okay. Divided by sum of digits of useful life. Sum of digits of 5 years useful life means if it is 5 years, 5 plus 4 plus 3 plus 2 plus 1. Or you can always use the formula n into n plus 1 divided by 2. So if it is 5, you can do 5 into 6 divided by 2. You will get 15 as the answer. Clear? And into cost minus scrap value. Into cost minus scrap value. Don't multiply just into cost minus scrap value. Okay, you can see this example. It's not, what I say, I'm just leaving this example for like 5 seconds on the screen. You can just try it out. They have not asked a single question on the sum of digits method. Technological change and passage of time is not same, guys. Okay, someone is asking, technological change and passage of time same answer. No, technological change and passage of time is not same because no technological change. I keep it for 2 years, value will go down. I purchase it within 1 week, there is a technological change, value will go down. Okay. Production units method. Production units method, units produced divided by total units into cost minus scrap value. These are all cousin methods. Machine hours method, depletion method, all similar to each other. Hours used divided by total hours into cost minus scrap value. Quantity extracted divided by total quantity into cost minus scrap value. Clear? Now accounting. This is the most important part. Accounting is the most important part and we make a lot of mistakes. Even though it is easy, we make mistakes over here. Now, accounting, first one, reduce from cost of the asset. That means there are only 2 methods for accounting. One, what is the first method? Reduce the depreciation from the cost of the asset. What is the second method? Treat the depreciation as provision for depreciation. Keep it separate. Reducing from cost of the asset, you see. Asset purchased. What should be the entry for asset purchased? Asset purchased entry. Asset came, so we got asset account debited. Money went to bank account. Asset account debited to bank account. Here I don't have to tell you. Along with this, installation charges, freight, whatever is there, everything you go on adding, that will be your asset cost. Asset account debited to bank account. Now, depreciation. What will happen to depreciation? Depreciation account debited to asset account. Someone is asking, sir, is there change of depreciation method? Then in such way, how to account it? If there is change in method of depreciation, what will you do? Till today you followed straight line method. From tomorrow you are going to follow WDV. Then no problem. Till today you follow straight line method. From tomorrow you apply the WDV on whatever written down value is there. Same thing for vice versa also. Okay, depreciation account debited to asset. Why depreciation is debited? Because it is an expense. Why asset is credited? Because depreciation makes the asset value reduce. That's why it is credited. Create provision for depreciation. If you are going to create provision for depreciation, asset purchase entry will not change at all. Now, depreciation account debited to not asset, it is going to be depreciation account debited to provision for depreciation. Provision for depreciation account. Clear? In both the methods, you have to remember one thing. In both methods, depreciation is 100% expense only. So depreciation will go to P&L, whatever it is. Now you could think how the method is going to look. It is going to look like this: depreciation account debited to asset account. Depreciation account debited to asset account. Instead of asset, it is depreciation account debited to provision for depreciation account. So either you are going to reduce the asset directly, or you are going to put the value on the opposite side of the balance sheet, that is on the liability side. That time automatically the net effect of the asset reduces. Clear? Now, sale of asset. When the asset is sold, what will you do? First, if you are following first method, then we will see the second method later. First method is what? Reducing the value directly from the asset itself. If asset is sold, bank account debited. Why bank account debited? Because money comes in, you're getting money. Bank account debited to asset account. This will be at what value? Sale value. It will be directly recorded at sale value. Then you have to calculate profit or loss on sale. How are you going to calculate profit or loss on sale? Simple. If sale value is more than the WDV on the date of sale. What is WDV on the date of sale? Value in the books on the date of sale. So imagine you sold the asset in the middle of the year. If you have sold the asset in the middle of the year, what will you do? You will still calculate depreciation till there, and that you will compare with the sale value. If sale value is high, that means you sold at a higher value. That is going to be profit. That is profit on sale. Profit should be credited to P&L. So what will you do? You'll debit asset and you'll transfer it to P&L account. Now, loss on sale. If sale value is less than the WDV on the date of sale, that is going to be considered as what? Loss on sale. So what will you do? P&L account debited to asset account. P&L account debited to asset account, sale value less than the WDV on the date of sale. Always, that means moral of the story. First thing what you're supposed to do when you see sale, you have to calculate depreciation till the date of sale. And you have to find the WDV on the date of sale. From there, you can proceed further with profit loss calculation. Now, if it is second method, asset sold. If asset sold and we are following second method, what we are going to do? We are going to open one new ledger called as asset disposal account. New ledger called as asset disposal account. So what you will do? You got money? Simple. You got money. What will you do? You take this money and keep it separate in a separate account called as bank account debited to asset disposal account. Now, when the asset is sold, the cost of the asset will be sitting where? Cost of the asset will be sitting in asset account, and whatever depreciation you have calculated till date, it will be sitting in provision for depreciation account. Cost is not required, which is sitting over there. Remove it, transfer to asset disposal account. Provision for depreciation not required, which is sitting over here. Remove it and transfer it to asset disposal account. So asset disposal account debited to asset account, removing the cost and transferring it to asset disposal account. Provision for depreciation account debited to asset disposal account. Provision for depreciation account debited to what? Asset disposal account. This is the way you are going to calculate. Now what you do? How much depreciation you are going to remove? Are you going to remove all the depreciation that is sitting in the books? No, you are going to remove total provision for depreciation on assets sold. How much provision is there on this asset till today? On whatever asset you are selling, you are going to transfer the total provision to disposal account. When you put everything into disposal account, no, automatically in the disposal account, balancing figure will be profit or loss only. Okay, transfer the profit to P&L, transfer the loss to P&L. If at all balancing figure you are not happy, you can also use this formula. If sale value is higher, profit. If sale value is lower, that is loss. This is in brief your depreciation situation. Clear? Now, this is one of the major things that we make mistake. You know what? What happens in exam? New asset purchased. Simple. From that day till end of the year, I have to calculate depreciation. Asset sold, no problem. From starting of the year till the date of sale, you will calculate depreciation. Where the major mistakes are done, in the exam, calculating depreciation on the old assets which were used entire year. Calculation of depreciation on the old assets which are used entire year. You know why? Because WDV of all assets at the start point, in that even the asset sold is there. In this WDV, even asset sold is there. From this, we are supposed to remove the WDV of the asset which is sold. Asset which is sold. That time you will get the WDV of the assets which are unsold. On that, you are going to calculate depreciation. I'll tell you why it is problematic. The reason why it is problematic is, let's say WDV on 1/4/2022 is 1000. Now I am telling one asset which had WDV of 400 is sold at 600 on 110 2022, 110 2022, middle of the year. So now what you have to do, depreciation rate, if I tell you 10%, now what you will do is you will directly take 400 into 10% into 6 divided by 12. That is 400, that is 40, 20. 20 is the depreciation. This is the depreciation till the date of sale. Now what you will do after that, okay, asset value was 400. 400 minus 20, that means 380 is the WDV on the date of sale. You will compare it with the sale value. Sale value is 600. That means 380 WDV. We sold for 600. You will be happy that 220 is profit. Clear? This is simple. Now the problem is what? What you sold, you calculated depreciation till the date of sale. What you did not sell. What you did not sell. Now you know what you are supposed to do. 1000 minus 400. Now don't tell 1000 minus 380 because 380 is the WDV on the date of sale. This 1000 is the WDV at the starting of the year. So starting of the year WDV of all assets, from that minus the WDV of the asset which is sold. Okay, when you have to see the WDV at the starting of the year itself, from that when you subtract, you will get 600 as the WDV. That 600 remaining WDV was used for the entire year. On that you apply the depreciation. Is this clear? This is one thing that you have to understand. 3 types of depreciation only you will find. Depreciation on asset which is purchased. That will be from the date of purchase till the end of the year. Depreciation on the asset which is sold. That will be from starting of the year till the date of sale. Third thing, depreciation on the asset which is not purchased also, not sold also. That is old asset which was there for the entire year. That what you will do, total WDV which was there in the beginning. From that you will remove the WDV of the asset which was sold during the year. Opening WDV only you will remove that. You will get the remaining WDV that was there for the entire year. On that you calculate depreciation. Clear? This is one thing that you have to understand. Next, in our chapter number 1, we have something called as adjustment entries. Based on this also, they are sometimes asking questions. If they don't ask questions on this directly, nothing to worry. It will directly be asked in your final accounts. This adjustment entries they are teaching over here, so that when we are doing rectification also it becomes helpful, and also it will be helpful when we are going to go to final accounts. Clear? And they also ask this chapter. They also ask this question calling where what they'll do is they'll give you a trial balance and they'll tell you prepare a trial balance after adjustment. That means adjusted trial balance. Pass the entry, new trial balance you'll get. Clear? Now, entry that is passed at the end of the financial year to record the transactions which weren't recorded. Now you saw your trial balance, in school and all, you should have this trial balance. Outside the trial balance, a list of things were there. Those are unadjusted items. When you pass entries, those all will go inside the trial balance and will become an adjusted trial balance. Now adjustment, first one, closing stock, most common one. Closing stock, what is going to happen? Closing stock account debited because it is asset to trading account. You credit the trading account. Clear? And in balance sheet, you're going to show it as asset. Drawings. Drawings, if I just tell you the impact of drawings, what? Impact of drawings is just minus from capital. But what are the entries for drawings? If drawings is in cash, what will happen? Drawings account debited to cash account. Drawings is an asset for the company because it is receivable for the company or receivable for the business, and cash goes, so cash account credited. If it is in goods, goods means what? Whatever goods they were trading in, that only he took it for his personal use. So drawings account debited to purchases. Drawings account debited to what? Purchases. If it is in asset, means what? There was one computer which was supposed to be for office use. He took it for his personal use. Drawings account debited to asset. Clear? So whatever happens, whenever there is a drawings is debited. Clear? Now free samples. What is this free samples? What is it? Advertisement expense. Why do we give free samples? Take this free samples, like the product, then after that you have to buy the product. Correct? So advertisement expense account debited to purchases. Imagine you are manufacturing chocolate or something. Okay, somebody came, you gave that chocolate to try. You are like, eat it. If they eat it, they might buy 2 more bars of chocolate. Okay, that is the logic. Whenever you give free samples, it is advertisement expenses. Advertisement expenses account debited. But what went? Your goods went. So always credit the purchase. Okay, next, donation. Donation can be in cash. Simple donation account debited to cash account like any other expense. But donation also can be in goods. Now imagine you are having chocolate business. Okay, somebody came to you and told, boss, we want some money for our next, we are giving some free scholarship to kids and all. So for that we need money. So you told, okay, take. 500 rupees. Donation account debited to cash. You told do one thing. You give scholarship, take money from somebody else. When you're giving scholarship with every certificate, give my chocolate to them. Okay, donation account debited to purchases. Clear? Possible. Now, free samples given to employees. This is the bouncer. If the institute asks, no, this is the bouncer. Free samples given to employees, not adjusted with salary. Adjusted with salary. Not adjusted with salary means what? Advertisement expense account debited to purchases. If it is not adjusted with salary, giving the free sample to you or giving the free sample to some outsider, it's all the same. So you'll treat it as the same way. If it is adjusted with salary, then instead of giving you salary, I gave you goods. So salary account debited to purchases. Clear? Now abnormal loss. What is abnormal loss? So abnormal loss, does it have a brother also? Called as normal loss. Now what is the online people telling? What are they telling? Sir, corporate accounting marathon, please. Financial accounting marathon going on. Okay, let's think about corporate accounting marathon after that. Important component of the machine was replaced, will be added to the machine value or not in depreciation. Important component of the machine is replaced, then it will be replaced. Yes, so new component will be added. Then again you have to think about AS10 also. In sole proprietor, this will not come. When we go into company accounts, that time in AS10 we will discuss this particular part. Now abnormal loss means what? Loss which is under your control. You could have avoided this, but you did not. You could not avoid this, but you did not. Is that abnormal loss? Is it abnormal loss? Unavoidable loss is abnormal or avoidable loss is abnormal? Unavoidable loss is normal. Unavoidable loss is normal loss. You could not avoid it. Okay, it is not under your control. Imagine you are manufacturing some chemicals for medicine. Okay, you manufactured the chemicals and kept. And when you kept, you went for lunch and came back, 100 ml chemical evaporated already. It was not under your control. Okay, but you kept the chemical. And then when you just put it down like this. That is abnormal loss. Okay. It was avoidable, but you did not take the care that was required. Abnormal loss is always debited because obviously it is loss. Debited to purchases. Abnormal loss account debited to purchases, or also you can usually find it on the trading account. In final accounts and all, directly what you do, abnormal loss account debited, and in trading account you'll write by abnormal loss. This by abnormal loss, you know why we do? We do it just for removing the goods from the trading account. For removing the goods from trading account, we write by abnormal loss. That means we reverse the goods which are sitting in trading account. Once we reverse it, now you have to think, these goods gone forever or somebody will give me money. Who is that somebody? Insurance compensation will be there. Sometimes insurance company will give me. If it is somebody is going to give me, then insurance company account debited. Why? Receivable. Insurance company account debited because it is receivable. To abnormal loss account. To abnormal loss account. So removed from the trading account and somebody is going to give me. So it is offset over there. If nobody is going to give you, that is your loss only. So P&L account debited to abnormal loss. Clear? So again, why we are writing by abnormal loss in trading account? This is to remove the goods which are there on the debit side. To remove it, we are passing this entry. Once it is removed, if somebody is going to give you the money, no problem. Insurance company account will be debited. If nobody is going to give you money, then it is a problem. Then what you are going to do? P&L account will be debited. Is this clear? Yes. Now stationery stock. Business is not stationary, but some stationery is there at the end of the year. What will you do? Stationery account debited to trading. Just like any other stock, you'll put it there. Goods in transit. Goods in transit. They sent the goods. We are yet to receive it. So we will show it as goods in transit account debited to trading account. If we would have received it, then it would have been closing stock account debited to trading account. Bad debt. Small, sweet and simple concept. Bad debt. Okay, amount not recoverable. Now it might feel like small, sweet and simple only, but in final accounts it will play a very crucial role, this bad debt thing. Okay, amount not recoverable. It's a loss. Bad debt account debited to debtor. Why? Bad debt is a loss. Losses are debited. Who is not going to pay the money? Debtor. Debtor balance reduces. Next, provision for bad and doubtful debts. Provision for bad and doubtful debts. I know a lot of wrong answers are given for this provision for bad and doubtful debts. Just remember, it's always P&L account debited to PDD. Why P&L account debited? You're taking the profits and keeping it aside. So when you're taking the profits, P&L has to reduce. PBD, that means you're creating a liability, you're keeping the money aside, telling that if at all there is expense, no, I'll adjust with this provision. So whenever you create a provision, Okay, P&L account debited to provision for bad and doubtful debts. Now you have bad debts. Now this gammat you see. Bad debt is there. If PDD exists, you kept money aside telling that if bad debt is there, I will utilize this. And if PDD is there, utilize that PDD that time. So PDD account debited to bad debts. Are you getting this? If there are bad debts, and if earlier you expected or anticipated this bad debt, so you had created provision and kept it aside. When bad debts actually happen, don't go and put that bad debt to P&L. You adjust it with this provision. So PDD account debited to bad debts. Clear? If you did not have bad debts, if you did not have provision for bad debts, that time what will you do? No PDD, P&L account debited to bad debts. P&L account debited to bad debts. Clear? Now, example. Sir, if goods lost by fire shown separately in trading account or what, or other possible entry? No, shown separately in trading account. Goods lost by fire is also an abnormal loss. Separately, you will show it in trading account by goods lost by fire. If somebody is going to give you money, then insurance company account debited to goods lost by fire. If nobody is going to give you money, P&L account debited to goods lost by fire. Clear? Avoidable is abnormal. Yes. Unavoidable is always normal. Sir, in this class, will you discuss problems for practice? I am discussing only the previous year papers. If that is practice question for you, yes. If you are talking about the practice questions which are there at the end of the study material, no. Okay. With few days left for exam, we can't do that. We are only going to discuss the previous year papers. What I'm doing is chapter wise. As each chapter gets over, at the end of the particular chapter, we'll solve the last 5 PYPs. Clear? Now there only, if at all, when we see that, if we feel that we can add what ifs, what if this would be there, what if that would be there, we will discuss that there. Okay. Now debtor is 1 lakh. Bad debt is 10,000. What will be the entry here? Simple. Bad debts account debited to debtor. Simple. Clear? Now after this, in the balance sheet, the debtor will be shown as 90,000 straight. 90,000. Already it got reduced. What if PDD balance was 12,000? If there was a PDD balance of 12,000, then PDD account debited 10,000 to bad debts. Remove the 10,000 bad debts from PDD. Therefore, still you have a PDD of 2,000. If no PDD, what will you do? You have to debit it to P&L. It's a loss. So P&L account debited to bad debts. P&L account debited to bad debts. Clear? What if PDD was 8,000? Then it is not sufficient. How much is sufficient? How much is there? You'll take it from there. So PDD account debited 8,000. P&L account debited 2,000 to bad debts. Clear? Yes. Now, how much provision to create? Major golden question in final accounts chapter. How much provision to create? Provision required, you see. How will you get provision required? In the question, no, in the adjustments, they will tell you, maintain provision at 5%, create provision of 5%, use that percentage, see the debtors, on that apply the percentage. This is the provision that is required. Existing provision balance, you see. Now what you should see, existing provision balance, not which is there in the trial balance. Which one you should see? In the trial balance, there is an existing provision. And from that, you, while doing the adjustments, you have removed the bad debt. After that, what existing provision is there, that one should be taken. Is it clear? This is going to be your balancing amount. PDD opening balance minus bad debt. See, existing provision is what? PDD opening balance. What is there in the trial balance? Minus the bad debts which you have adjusted. That is your existing provision balance. This you compare with the provision required. Imagine provision required is here and PDD balance is here. What will you do? You will create provision. When you're creating provision, what will you do? P&L account debited to provision for doubtful debts or bad debts. Imagine provision required is over here and provision balance is sitting higher, which is also a rare event, but it is there. So now what will you do? PDD account debited to P&L. You're reversing the provision. Clear? Yes. Provision for discount on debtors. This also they can ask. Sometimes they have asked in the exams. P&L account debited to provision for discount. Any provision you're creating, it's always P&L account debited to provision. P&L account debited to provision for discount on debtors. Clear? This is the situation. Discount allowed. Discount allowed. When there is a discount allowed, you'll pass the entry discount allowed account debited to debtors. Then same thing what you did for provision for bad debt, you'll do it. If there is provision for discount to discount allowed. If there is no provision, P&L account debited to discount allowed. Now there might be a small question that you have to worry about. Here the problem is, sir, in what order? Some people will be like, sir, in what order? There is already debtor in the question. Debtors are there in the question. Clear? From this debtor, this is there in the trial balance. From this debtor, I will subtract the bad debts I will subtract the bad debts which are there in the adjustments. I will not subtract the bad debts which are there in the trial balance, because the bad debts in the trial balance came into the trial balance because they already passed the entry. Clear? So here what we have to understand, do not subtract the bad debts in the TB because it is already subtracted. Then from this what I will do, minus bad debts I already subtracted, minus, when I get this I'll get one amount. From this I will subtract minus PDD maintained. What is the PDD to be maintained? That I will subtract. That time I'll get a resultant figure. On this amount, provision for discount is to be created. On this amount, provision for discount to be created. Logic is simple. Who did not pay, remove them. Whom you have doubt, remove them. After that, who are there, they will pay. But even if they are going to pay, they will ask for discount. So create provision for discount. Is this clear? This is the order in which you are going to record. No, it's okay. I have this. What is that? Watermelon juice. Wow. Where did you get this from?
That's why I did. So, provision for bad debts already given in the trial balance, also in adjustment contribution.
If provision for bad debts already given in the trial balance, also in adjustments. Okay. Now, imagine I have a trial balance, okay? And in the trial balance, I have debtors, which is sitting at 1 lakh. Debtors are sitting at 1 lakh. And in that trial balance, I already have PDD, which is sitting at 20,000. Not 20,000. Let's say it is at 5,000. I have a PDD which is sitting at 5,000 already in the trial balance. And in that trial balance only, I also have a bad debt of 500. Now my question is this 500 already subtracted from the debtor? It is already subtracted from the debtor. Clear? Now, what I will do, first of all, this bad debt is a loss. This bad debt should go to P&L, but I have a provision sitting there. Why will I take it to P&L? So this I will adjust over here, and my provision comes down to 4,500. How much provision is there? 4,500. And now in the adjustments, they said maintain provision at the rate of 8%. They said maintain provision at the rate of 8%. So what I will do, I will check 1 lakh into 8%. I am getting 8,000. This is the provision required. This is the provision required. And I will see what is my existing provision. Existing provision is 4,500. You know what mistake students will do? Directly take 5,000. No, this got adjusted already. So existing provision is 4,500. So we have 3,500. Balance is 3,500. This is provision to be created. This is the provision that is to be created. Now when there is provision to be created, this one will be debited to P&L. 3,500 will be debited to P&L because this you are creating now. Now my question is, in the balance sheet, okay, from debtors are 1 lakh only, no? From debtors, how much you will subtract? 8,000 you will subtract. 8,000 you will subtract. You know why? 3,500 you created. 4,500 was already there. Existing provision. What you will subtract is created provision, existing provision, both you will subtract. What you will debit to P&L? Only created provision. Why? Because that you just created. No, that you will debit it to P&L. So just remember, in balance sheet, created provision, existing provision, both will be subtracted from debtors. In P&L, only created provision will be debited. Only created provision will be debited. AS10 PP important component record. It is like a component accounting, like asset is separate and component is separate. Guys, we will see that in AS10, guys. Don't worry. Component accounting is basically one full car can be broken down into parts and it can be depreciated. Tire will have 2 years useful life. The engine will have 10 years useful life. You are going to break down the asset and going to charge depreciation. 3,500 required provision. Yes, that's correct. Did you understand this? Now, this will get little more twisted. If I would tell over here, additional bad debts 400. If I would tell this, now I'm going to strike it out just for understanding. If I would tell that, no, what would happen? From this 1 lakh, 400 would get subtracted and there would be only 99,600. Then from this provision, 400 would get subtracted and here there would be only 4,100. After that, everything continues like that itself. In the balance sheet, from 99,600, whatever provision you have created, that will be shown. And in the balance sheet, when you're calculating provision on 99,600, you will apply 8% now. Clear? Yes, that should be it with that particular thing. Let's proceed further. Yeah. Next, bad debts recovered. Bad debts recovered. Bad debts recovered entry has nothing to do with bad debts account. Rule number 1, remember, bad debts recovered entry has nothing to do with PDD also. Bad debts recovered is treated as income. So the entry will be bank account or cash account debited to bad debts recovered account and bad debts recovered account debited to P&L account. Awesome, sir. Okay, sir. Thank you so much. Please stay tuned in. Yes, provision for discount on creditors. Sir, can you explain this with example of December 2025 4th MCQ? Guys, we'll go to exam questions. Don't worry. We'll go to exam questions and that time we will see. MCQs also we'll try to handle. That time you tell me which MCQ you want to see. Provision for discount on creditors, which is a very rare question. Okay, if it is asked, remember one thing, that is the bouncer. Because nobody would have thought of provision for discount on creditors. Now, creditors also, I have to give discount. I have to get discount, right? I am expecting the discount. This is little rare. You know why? It will go slightly against the concept of conservatism. But in the question, if it is asked, you can't tell it is against conservatism and ignore it. Clear? So imagine this happens when you have one creditor. Okay, creditor is there. Every 30 days, you have to make payment to that creditor. If at all you make payment in 20 days, that creditor will give you discount. Now you have already decided in your mind that you are going to pay in 20 days. Because you are going to pay in 20 days. Now what is going to happen because you are going to pay in 20 days? You know you are going to get the discount. Make a provision and keep. So provision for discount on creditors account debited to P&L. Ulta of the normal provision entry. Discount when it is received, you'll pass the entry creditors account debited to discount received. And if provision is there, adjust that with the provision. Provision is not there, transfer the discount received to P&L. Normally what we see, which is little rare, this one. If it is asked, you just be ready for it. Now we go into very small, sweet and simple topic. That is rectification of errors. With that, actually, the concepts of chapter number 1 will be completed. After that, we'll be going into the PYPs and we will be discussing the PYPs. Clear? Now, rectification of errors. What are the types of errors that we have? The types of errors that we are going to have. Sir, treat bad debts first, then do adjustment for provision. Thank you, sir. Awesome clarity. Okay, thank you. Okay, first always bad debts, then you go ahead. Yes, rectification of errors. Error of omission, error of commission, error of principle. Error of omission, error of commission and error of principle. Error of omission means what? You missed something and that something that you missed is part of your accounting process. We are talking about the accounting process only, journal to ledger or subsidiary book to ledger and from ledger to trial balance, from trial balance the final accounts. Clear? So you have missed something. It can be partial omission or it can be complete omission. If it is partial omission, trial balance will not tally. If it is complete omission, trial balance will tally. Clear? Now error of commission. Error of commission means what? You have passed the entry or you have done the accounting process, but something in that accounting process you have missed. You have done, but you have done it in a wrong manner. It can be one-sided error. Error of commission can be one side you made the mistake, trial balance will not tally. Two-sided error, that means debit also you made a mistake, credit also you made mistake, trial balance will tally. Error of principle. Error of principle is what? Wrong accounting rules. That means your accounting principles only are wrong. So instead of treating it as capital expenditure, you treated it as revenue expenditure. Machinery purchase, you went and put it to P&L as purchases. That is what will happen? Usually error of principle, trial balance will tally. That means instead of something, you have done it, but into the wrong ledger. Now, compensating error. What is this compensating error? Yes, guys. Yes. We'll continue in the same flow. You just have to stay awake. That's it. Someone is telling, sir, it is going in a good flow, sir. Please continue. Yes, we will continue. You have to stay awake, very much awake. Keep your eyes fully awake, okay? Yes, compensating error. Compensating error means what? You made one mistake and you made another mistake. You made one mistake where that mistake was in debit. You made one more mistake where the mistake was in credit. Now what happened? These two compensated for each other and that made the trial balance tally. Clear? Now rectification. Now usually this is the flow of events what we are going to follow when we are going to do rectification. Correct? Correct entry, wrong entry and rectification entry. Correct entry means what? Ignore the error, focus on the transaction and pass the entry. Pass the entry for the transaction. Wrong entry means what? Focus on the error and see what mistake they made, pass that entry. Pass the entry for the error. Compare the two, automatically you will get the rectification entry. Compare the two means what? Correct entry, something is debited. Here it is not debited. Remove. It is debited. You debited. Correct entry, something is debited. Here it is debited more. You have to remove the debit. Whenever you want to remove the debit, you have to do the opposite, that is credit. In the correct entry, something is credited. Here you have not credited it. Credit it. In the correct entry, there is a credit. You have credited less. Credit the difference. In correct entry, there is a credit. You have credited more. Remove the credit. How will you remove the credit? By doing the debit. Is it clear? Now, I think I have written it here. Debit missing, debit it. Credit missing, credit it. Debit less, debit the difference. You have debited less, debit the differential amount. Credit less, what are you going to do? Credit the differential amount. Debit more, then credit the differential amount. Debit more, so you'll do the opposite now, credit the differential amount. Credit more, what will you do? You'll do the opposite, debit the differential amount. Debit instead of credit. Debit instead of credit if it is the same amount. Instead of debit 100, you have credited 100. That means what will you do? Double it. Okay, credit double. Why you are crediting double? See, I wanted 100 over here. Instead of this 100, I have put 100 over here. Now what I will do? I will put 100. That time this gets nullified. Then I will put one more 100. That time I will get the effect. Clear? This double thing you can do only if the amount is same. Imagine I wanted 100 over here. I put 10 over here. Now I can't do double. What I should do? First I should put 10 to nullify this effect. Then I will put the 100 to get the effect. So 110 will be the debit. Clear? Instead of credit, if you do debit also, same thing. You'll just put the opposite and double it. Stage of rectification is very, very important. Where are you rectifying? Where are you rectifying? Now you can rectify. Simple, no? You are doing the accounting. When you are doing Isala exemption namde, someone is telling. Yes. Okay, guys. IPL is over. Now our IPL is going to start in few days. We'll focus on that. Otherwise, we might get traded. Okay, in the off season, we might get traded and the trade will end up in next attempt. We don't want that to happen. Okay, we'll focus on exams. Anyways, we should focus now on that small kid. Vaibhav Suryanshi took 5 awards and went. We are like, ayo, what are we doing in life? Okay, so now stage of rectification. Don't worry. If at all your parents give this dialogue, no. See that 15-year-old kid, that fellow is taking all these awards. What are you doing in life? You just give this dialogue back. See that 43-year-old Dhoni still playing IPL. What are you doing in life? Over. Nullified. Set off. After that, you might be out of the house. I am not responsible for that. That's it. Okay. Now, stage of rectification. Before preparation of trial balance. That means you didn't prepare trial balance yet. Journal entries you passed, ledger accounts you prepared, and you were about to prepare the trial balance. When you were about to prepare the trial balance, before that only, when you were doing something, you found the error. When you found the error, what you are doing? No suspense account. Because only when trial balance is prepared, when trial balance is prepared, that time suspense account comes into picture. So, no suspense account. How will you rectify this? By writing a statement usually. Just writing a statement. What you missed, go and do it. Debit was not done, debited. Credit was not done, credited. Debit was extra, removed. Credit was extra, removed. This is what you are going to do. Is this clear? So now after preparation of trial balance, if it is after preparation of trial balance, what are you going to do? Usually if it is two-sided errors, if it is two-sided error, debit also mistake, credit also mistake, there won't be suspense account only. Suspense account comes when there is one-sided error. That means trial balance, debit is there, credit is missing. That time suspense account will come into picture. If debit and credit both are there is not going to be any suspense account over here. Clear? Now here you have to understand one thing, two-sided errors. If there are two-sided errors, pass entry without suspense account, because when you rectify also, it is two-sided. If it is one-sided error, pass entry with suspense account, because when you rectify, only one-sided rectification is going to happen. Clear? In the next accounting period, if it's in the next accounting period, what you're supposed to do? Suspense account rule will be applied same way. But along with that, one new thing will come, that is P&L adjustment account. This is prior period item. P&L adjustment account to be used for expenses or incomes. Now, simple guys, simple. Just keep it very simple. If you're in the next accounting period and you're rectifying, in your rectification entry, you have any income or expense. Now, if you put this income or expense, what will happen? Your this year's profit will get affected. We don't want this year's profit to be affected for last year's mistake or previous year's mistake. So instead of writing that expense or income in that rectification entry, you write P&L adjustment. You write P&L adjustment. This is the logic of P&L adjustment. Suspense account is what? Debit is there, no credit, suspense. Credit is there, no debit, suspense. Suspense account rule is same thing what was happening over here as well. Is this clear? Very, 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 very important, this P&L adjustment part. Now, sir, how we will know in the exam, where are we, in which stage of rectification we are? They will tell in the question. They will tell in the question, after preparation of trial balance, following errors were noticed. That means we are in the second stage. They will tell that errors were noticed in the next accounting period. Next year, they notice these errors. That time it will be in the next accounting period. Is this clear? Yes, that should be it, guys. Bills of exchange is the next chapter. With that, we are done with chapter number 1. All the concepts. Bills of exchange is next chapter. No, after that, consignment, joint venture, all those things we have. Now, we'll go into questions. We'll take a 5-minute break. What? 5 minutes. 5 minutes. Yeah. Only 5 minutes. 5-minute break we'll take, and we'll. Huh? Yeah. Yes, guys, welcome back. Let's continue. We'll go into the examination questions. We'll discuss first one, December 2025. This is from chapter number 1. Okay. Now, on 31st March 2025, Sandeep's cash book showed a bank OD balance. Cash book showed a bank OD balance of 2,50,000. On comparing with the passbook, following differences were noted. So now first what we are going to do, go to the end of the question and check. You are required to ascertain the amended cash book balance. Then prepare BRS. That means they want you to prepare adjusted cash book. Okay, then you're going to prepare BRS. Now here you have to remember one thing which is very, very important. First you have to prepare adjusted cash book. Then only you can proceed further. Otherwise you can't calculate anything. Now first thing, what is the balance over here? 2,50,000. That means your OD balance. Go to the adjusted cash book. Can you see credit side by balance brought down? Clear? Now after that, cash and checks amounting to 26,800 were sent to the bank on 27th March. But checks worth rupees 4,600 were credited on 2nd April, and one check of 900 was returned by them dishonored on 4th April. Now what has happened over here? Checks are sent. Have you done your work? Okay, everything you have done. So this will go straight into what? BRS. It will go into BRS. You can't put it into adjusted cash book. Now, during the month of March, Sandeep issued checks worth rupees 33,400 to his creditors. Out of these checks, 27,400 were presented for payment on 5th April. That means you have done your work. You have sent the check and you have recorded it. This will also be entered in BRS. Clear? Now, according to Sandeep's standing orders, banks have made the following payments during the month. Bank made the payment, you did not record it. Life insurance premium expense. So what will you do? Life insurance premium expense account debited to bank account 3840. Can you see 3840 sitting over here? Okay, personal. That's why they have written it as drawings. Next, television license fee. So that is also drawings. 2,400, 6240 is credited. Clear? Next, after that, Sandeep's bankers have collected 3,000 as dividend on his shares. Collected, who has collected? Bankers have collected. That means we can record it and set off the difference which is there. Bank account debited to dividend on shares. Clear? Next, after that, you have interest charged by bank. Interest charged by bank, expense again, interest account debited to bank account 2,500. Next, after that, a bills receivable of 2,000 discounted with the bank in February 2025 were dishonored on 31st of March 2025. Dishonored. Dishonored, whenever bill is dishonored, debtor account has to be debited and bank account will be credited because it was discounted. Because it was discounted, bank will take the money from me now. So here you are going to write by debtor account 2,000. Clear? Done. Question got over. That's it. 7 marks. They are asking this particular question. Okay. And two things will go into BRS. But before we go to BRS, now what you are going to do, all the things are noted over here. So you are going to calculate the balance carried down. Balance carried down. What is the balance carried down? 257, 740. Okay. Now this balance will be used for your BRS. And BRS you are going to start bank balance as per cash book. Bank balance as per cash book. But what balance is this? This is OD balance 257 740. 257 740. Is this clear till here? Now what you are going to focus on? You are going to focus on the two things which we wrote as BRS and kept no. Now here, checks amounting to 26,800 were sent to bank. Sent to bank means deposited into bank. That we don't want. 4,600 was credited in on 2nd April and 900 was dishonored. But anything, whatever happened, it happened in the next month. So these two did not give effect in this month. So 4,600 plus 900, you have 5,500 over here. Now, right hand for me is cash book. Right hand is cash book and it is OD balance. OD balance, checks deposited. What happens to OD balance when you deposit check? Balance will reduce because it is OD. Because it is reduced over here. Now what you are going to do? Right hand only, you are going to reverse it. Add it back. Can you see 4,600 and 900 being added back over here? Then after that we are going into next one. Checks issued 33,400 to his creditors. Checks worth rupees 27,400 were presented for payment. So 33,400 minus 27,400. That means 6,000 was not presented for payment and we really need to focus on what is not presented for payment. What is not presented for payment will create difference over here. Now not presented for payment. Right hand is what? Cash book OD. If it is entered in the cash book, if you have issued the check, you have entered in the cash book OD. If you take more money, check if you issue, what will happen to the OD balance? It will increase. If it has increased, right hand has increased. So what will you do? Reduce it. So 6,000 checks issued but not presented for payment. Oh, okay, sorry. Our bad. 6,000. See, 27,400 were presented, but presented when? On 5th April. Okay, presented on 5th April. So 27,400 is the one which has gone into next month. Now imagine it was just written 27,400 presented. That means 27,400 is what is presented in this month and remaining went into next month. Okay, correct. 27,400. So 27,400 minus, you will get this answer, balance as per passbook. Now one more thing I forgot to tell you that time, bank reconciliation statement. When you're doing this plus minus and if you get negative figure, you started with OD, you got negative figure. That time, see, you started with cash book, your ending will be passbook only. But you started with OD and you got negative figure. That time this is positive. That means opposite of OD now. It will be normal balance. You started with normal balance and you got negative figure. That means it will be opposite of normal balance. That will be OD. Clear? Done. 7 mark question which was asked in December 2025. 1 second. Sir, please waiting for your CAA marathon, corporate accounting marathon. Please waiting. Exams are getting near. Ayo. Now the problem is this only I was telling. When we put financial accounting marathon, no, then someone will come and ask for corporate accounting marathon. Someone will ask for the CMA final marathon. When I put corporate accounting marathon, someone will come and ask for financial accounting marathon over there. Now, best part was I put one CMA final video. There, someone came and asked for corporate accounting marathon and financial accounting marathon. If you put all three, no, someone will ask for CMA foundation marathon. That also they keep asking CMA foundation marathon. Okay, guys. Okay, we'll try our best. We'll try our best to do corporate accounting marathon. Okay, for this attempt. Exams are coming near, I know. Now, B. The B point which was there, that also came from chapter number 1 only. So 7, 7, 14 marks. Usually they try to keep the trend or the structure of the question same. If chapter number 1 comes in question number 1, it will be like that only usually. Sometimes they flip. That's why they said. Okay, let's go further. Now, classify the following items as capital or revenue expenditure with proper reasoning. Now, an extension of railway track in the factory area. Extension will give you extra benefit. Expenditure incurred on extension of railway track in the factory area should be treated as capital expenditure because it will yield benefit for more than one accounting period. Clear? Next, after that, wages paid to machine operators. Machine operators who are operating the machine. It is revenue. Okay, so wages paid to machine operators should be treated as revenue expenditure as it will yield benefit for the current period only. Will the machine operator leave our employment? No, he will be there next also. But that time I have to pay him salary that time. Clear? Next. Installation cost of new production machine. Installation cost of new production machine. Machine is installed. Machine will give you extra benefit. Installation cost also will be capital expenditure. Installation cost of new production machine should be treated as capital expenditure because it will benefit the machine for more than one accounting period. Next. Materials for extension to foreman's office in the factory. Extension of foreman's office. When you are extending it, it is going to give you benefit for more than one accounting period. So that material will be treated as capital expenditure. Should be treated as capital expenditure because it will benefit the business for more than one accounting period. Next, after that, you have rent paid for factory. Rent paid for factory will give you benefit only that particular month, next month, whenever you pay. So therefore, this will be revenue expenditure because it will benefit only in the current period. Next, payment for computer time to operate a new stores control system. New stores control system. See over here, it is a revenue expenditure because it has been incurred only to carry normal business. This is the bamboo, which everything else seemed very regular. Now, payment for computer time to operate new store control system to be treated as revenue because it has been incurred to carry on normal business. What are they trying to tell? Computer time to operate new system we introduced. Then we have computer. Some operator is there who is operating the computer. That is revenue expenditure. That is day-to-day business. We are not talking about the computer. We are not talking about the installation of computer. It is just operation of that particular system. Now imagine I put one fingerprint scanner. Installing that fingerprint scanner would be there. Now if I am hiring one person, stand next to the fingerprint scanner and guide everyone how to use that operating. So that will be revenue expenditure. Wages paid to own employees for building the foreman's office. Wages paid to own employees, wages paid to outside employees, whatever it is, it will be considered as capital expenditure because it is for building the office. It will be capital expenditure because it will be benefiting the business for more than one accounting period. This is chapter number 1 in December 2025, which was asked for 7, 7, 14 marks. Then it is joint venture, lease, NPO, incomplete records, partnership, branch, insurance claim, accounting standards, partnership. So that is it with this particular. Okay, we are done. Now we are going into June 2025. June 2025. Now June 2025, can you see they just changed the order a little and first only they put AS10. So when we do AS, that I will look into that. Now here June 2025. Now, B. State briefly the difference between purchase day book and purchase account. Purchase day book is obviously the subsidiary book. Now, what is the major difference? Subsidiary book, you record only credit purchases and you record only credit purchases of goods. You don't record credit purchase of asset and all. So purchase day book simply records only credit purchase of goods, whereas both cash and credit purchases are posted in the purchase account. Purchase day book is part of journal, whereas purchase account is part of ledger. Why purchase day book is part of journal? Because purchase book, subsidiary book is an alternative for the journal. Purchase day book is not divided into debit and credit side, whereas purchase account is divided into debit and credit side, because purchase account is a ledger. It has debit side, credit side. Purchase day book is a subsidiary book. It does not have debit side, credit side. It goes in the format where we go on writing one below the other. This is 2B. I don't think that should be a problem. Okay, and in 2B we have one more. Rectify the following errors. Rectify the following errors. Credit sales to Barun 7,000 were recorded as 7,200. What is the entry for credit sales? You will pass the entry Barun account debited. Okay, 7,000 to sales account. Barun account debited to 7,000 sales account. Now what we have done? Sir, financial accounting, financial management marathon. Guys, whoever is asking for financial management marathon, please go on to this channel only which you are watching this video. Already financial management marathon has been put like 1 month ago. Please go and watch that. Live is not there. It is already there. Please go and watch that. Okay. All the very best. Now, Barun account debited to sales 7,000. Now they have recorded it as what? 7,200. 7,200. See over here. Sales account debited to Barun. You are just reversing 200 rupees because you put extra 200. Next, after that, credit purchase for Raman 9,000 was recorded as 9,900. Whatever happened with sales, that is only happening with purchase. What is the entry over here? It would be purchase account debited to Raman account. It should have been 9,000 and 9,000. What did you do? You put extra, you recorded it as 9,900. So you will reverse it and remove that 900. So Raman account debited to purchases 900 you are going to remove. Is this clear? Next, after that, you have goods returned to Chaya 4,000 were recorded as 4040. Goods returned to Chaya. Everything is extra thing they have recorded. First, you need to know the correct entry. Goods return. How can I return the goods? Only if I have purchased the goods. So purchase return it is. So Chaya account debited to purchase returns account 4,000. What did they do? They put extra 40. So what will you do? Purchase returns to Chaya. Reversal. Done. Next, goods returned from Paresh 1,000 was recorded as 1,400. Goods returned from Paresh. Goods returned from Paresh will be what? Sales return. Goods returned from Paresh will be what? Sales return. So you will pass the entry sales return account debited to Paresh account 1,000. But they have recorded it as 1,400. So what will we do? We will reverse that 400. Paresh account debited to sales return account. Easy. It is this plus that 7 marks should have been easy in June 2025. After June, we go into December 2024. December 2024, we'll go and see what they have asked. And we'll discuss that particular thing. Now, on comparing cash book of Shivam with bank passbook for the year ended 31st March 2024, following discrepancies were noticed. Okay. Prepare bank reconciliation statement. If the bank balance as per cash book is 182,500. Therefore, because they did not ask us to do anything with adjusted cash book, we are directly going into BRS itself. So therefore, what is your starting point? Balance as per cash book. Normal. Balance as per cash book. What balance is this? Normal balance. Okay, so you don't have to worry about anything. Yes, can anyone tell me, guys? Sir, can you solve set 1 model question paper of June 2026 along with this? That will do. Model test paper, we'll try to do it, okay, along with this. Only the one which is relevant to this exam. We will solve that model test paper. Now, if at all we don't get time today, tomorrow we will do it, okay. Now, what is our starting point, guys? Balance as per cash book. So right hand will be what? Cash book normal. Cash book normal. Money comes, money goes up, money goes down. Clear? Simple. Now, checks of 85,000 deposited into bank on 25th March. Check amounting to 25,000 were collected on 5th April. That means 25,000 went into next month. So, right hand is your cash book. You deposited. Cash book balance increased. So, what will you do? Decrease. How much will you decrease? 25,000. So directly you'll write 25,000 minus over here. Starting point is 182,500. Next, after that, checks amounting to 38,000 drawn, on which check for 8,000 was presented on 3rd April. Drawn means what? You wrote the check and gave. That means check is issued. 8,000 went into April. If check is issued, cash book balance reduces. So now what will you do? Increase it, because right hand was cash book. So therefore 8,000 is added. Next, a check for 4,000 entered in the cash book but omitted to be banked. Entered in the cash book but you forgot to put it into the bank. Entered in the cash book means what? And cash book balance increases. Now what will you do? Decrease it. 4,000 you will minus. Everything is cash book effect till now, whatever we have seen. Now bills receivable for 18,000 previously discounted. Discount was 90 with the bank has been dishonored, but advice was received on 3rd April. Now you have to understand one thing. Bills of exchange is actually our next chapter, next topic. Now bills discounted. If bill is discounted, you have to worry about one thing. If bill is discounted, they will take this 90 rupees and give you money. But when they are taking the money back from you, they will take the full 18,000. They will not they will not take only the net amount. They give you the net amount, but they take the full amount. Clear? So 18,000. Now what happened? Bills receivable dishonored. Bank has passed the entry. You received the advice. On 3rd April. Left hand is passbook. When they remove the money, what happens to passbook balance? Reduces. Left hand moved. What will you do with right hand? Right hand also will reduce. So 18,000 minus. Clear? Next, a check of 20,000 wrongly credited in the passbook on 29th March was reversed on 2nd April. Check 20,000 wrongly credited in the passbook. We made the mistake. So passbook balance, credit means what? Passbook balance reduces. In bank, credit means, credited in the passbook, credited in the passbook. So what happened to passbook balance? Increases. So what will you do? You can't make the correction in the passbook, so you will also increase it. Yes, correct. 20,000 will be added. Next, bank had wrongly debited 15,000 in the account on 31st March and reversed it on 10th April. Wrongly debited. That means bank took by mistake 15,000. Left hand moved downwards. So what will you do? Right hand also will move downwards. So minus 15,000. Then plus minus and all you know to do. We are not going to check the plus minus of that. You got 148,500. Okay, we'll not worry about that. Plus minus. Okay. Now 2A done. 2B. State with reasons whether the following are capital or revenue expenditure. 7 marks. This is what I'm telling. Not every attempt. Like right now we saw alternative attempt it came. Now it is so easy. Even if worst case scenario, we are not able to crack all 7. At least 5 will be able to crack. 5 marks easy. But with reasons they're expecting. Like a line of reason. That's it. Okay. Expense incurred in connection with obtaining a license for starting the factory. Starting the factory, that is capital expenditure. For that license will also be capital expenditure. So you can see over here capital expenditure. It is incurred for acquiring a right to carry on the business for a longer period. That means benefit more than one accounting period. Next, 1,000 paid for removal of stock to new site. Some people feel that this is capital expenditure, but it's actually revenue expenditure. You're removing the stock from one place and shifting it to another place. Is this going to give you any extra benefit? No. This will be revenue expenditure because it is not enhancing the value of the asset and it is also required for starting the business on the new site. It's just shifting from one place to another place. That's it. Next, rings and pistons of an engine were changed at a cost of 5,000 to get fuel efficiency. Fuel efficiency, that means you're getting extra benefit. Oh, my bad. To get full efficiency. Sorry. I misread it. If it was fuel efficiency, it would have been capital expenditure. Full efficiency means what? Because of wear and tear, the efficiency went down. Now by changing it, it will come back to its normal. It will not go above its normal and give me extra benefit. Full. Yes, correct. So therefore, this will be revenue expenditure because the change of rings and pistons will restore the efficiency of the engine only and it will not add anything extra to the capacity of the engine. Okay, this we had discussed. Now, next one. 2,000 spent as lawyer's fees to defend a suit claiming that the firm's factory site belonged to the plaintiff. The suit was not successful. Actually, the successful, unsuccessful part is irrelevant for us. We are defending a land which is belonging to us already. If we win, we will retain. If we lose, we will lose the land. So this is going to be 100% revenue expenditure. They have not given the reason. Reason is you are not going to get any extra benefit. Just like the previous point where they told it will come back to its full efficiency, right? Now see, I have a land. I'm using that land. Someone filed a case telling that this land belongs to them. Now I'm fighting that case. If I win the case, what will happen? Will I get one extra land, 1+1 free, nothing? No. I will retain the land, that's all. So therefore, it is not going to give me any extra benefit. 10,000 were spent on advertising the introduction of a new product in the market, benefit of which will be effective for 4 years. Now here, deferred it is. So revenue expenditure, they said as per AS 26, because they will talk, AS 26 is basically intangible asset, but we already discussed this. It is revenue. If you want, you can treat it as deferred revenue, but it is revenue. What can be treated as deferred revenue? Only thing which is revenue can be spread for many years. Clear? Now, a factory shed was constructed at a cost of 1 lakh. Sum of 5,000 has been incurred for the construction of the temporary huts. We saw it in our example, so obviously it is going to be capital expenditure. Both are capital expenditure. Now, pair of bullocks of 50,000 was killed by the lightning. Capital loss. Livestock is a fixed asset. Okay. Now, here nicely for fun they have written that it is capital loss. As per AS 10, livestock is not PP. As per AS 10, livestock, that means animals are not considered as asset itself. So here they said livestock is fixed asset. Luckily, they did not call it as PP, and AS 10 is applicable only for companies. So maybe sole proprietor has livestock. He is considering it as asset. Lost. So capital loss. Clear? 7 marks. Only the one thing was there which was little tricky in the exam. So 6 out of 7 would have been easily solvable. Okay, with that we are done with our December 2024 paper. Now we'll go into the June 2024 paper. Sir, is that okay to see 2016 syllabus question paper for 20 or 22? Just focus on 22. Don't focus on the 2016 syllabus. Okay, this will be good enough. These question papers and the MTPs will be good enough. Is this marathon enough for passing the exam? If you have studied well, then it is surely enough. Or getting 50 above, it is enough. 50 above, it's enough. You have to practice the problems, obviously. No, then, yes, sir. Okay. They are only talking. Guys, this is for revision purpose. Provided you have finished your study material, this will give you quick revision. Otherwise, you have to do study material only, no? If you don't do study material, don't even look at any other marathon. First, you do study material. From there, only questions are repeating here and there. Okay, so we'll go into this particular question. Okay, here they have asked depreciation. Here they have asked depreciation, and see how they have given in the suggested answer. Beautiful. One line, finished. 1, 2, 3, finished. Okay, they're improving actually. The recent suggested answers, if you see, they are giving full. Okay, old, they were lazy. Okay, we also, before we were lazy, no, now we are studying as the exams are coming closer. Now, question is given, you are required to calculate total depreciation to be charged in the P&L. Profit or loss on exchange of machine. Book value of machine in balance sheet as on 31st of March 2023. And many suggested answers and many MTPs will have lot of errors. Okay, like the study material. Study material also has lot of errors. Now, on 31st of March 2023, in the trial balance of Singhania Brothers, balance of the machinery account appears at 19,80,000. When is this? 31st March 2023. The balance was how much? 19,80,000. Firm follows rate of depreciation on machinery 15% per annum. WDV they are following. On scrutiny, it was found that machinery appearing in the books on 1/4/2022, starting of the year, at 4,50,000 was disposed of on 30th November in exchange for a new machinery costing 3,50,000. Okay, did you get it? Now, 1/4/2022, there is a machinery, and that was at what value? 4,50,000. It was at 4,50,000. Now, it was exchanged. It was exchanged for a new machinery costing 3,50,000. But when did it get exchanged? 30th of November 2022. That means 4,50,000, depreciation rate is 15%, into 15% November. That means into 8 divided by 12. Is it 30th November? So 8 divided by 12. So 4,50,000 into 15% into 8 divided by 12. 45,000 is the depreciation. Clear? 45,000 is the depreciation. This is the depreciation on what? Asset which is disposed. and we got a new asset. What is a new asset? New asset was costing 3,50,000. So 3,50,000 into 15% into 4 divided by 12. So 3,50,000 into 15% into 4 divided by 12, you are getting 17,500. Now we solved the asset which went and the asset which came. Now here we are talking about the asset which did not go, did not come. That means it is still there. So therefore, what was the total balance appearing over here? 19,80,000. What is the total balance appearing? 19,80,000. And 19,80,000 is on what date? 31st of March 2023. 31st of March 2023. Now tell me one thing. Yeah, 19,80,000 is the closing balance. This is what? The closing balance. From this 4,50,000 is gone. So 4,50,000 would have been gone. Correct? Would have been gone. So you don't have to worry about this 4,50,000. No need to add back and all. It is already gone. What is not gone now? This 3,50,000 is newly added. So this 3,50,000 you remove. 19,80,000 minus 3,50,000, 16,30,000. 16,30,000. What is the 16,30,000? This is the WDV of old assets. Is it the WDV of old assets? Are you getting this? No. There is one small catch over here. You have to understand one thing. 19,80,000 is at the end of the year. Usually they give opening balance and from there we have to adjust the values. 19,80,000 is at the end of the year. So this is closing balance. In this, asset which is sold is gone. Asset which is sold is gone. You don't have to worry about that. Asset which is purchased is there. But asset which is purchased is not now sitting at 3,50,000. It is sitting at 3,50,000. 3,50,000 got added. And from that, the depreciation got removed. What depreciation? The 4 months depreciation. So, you can take it like this. 3,50,000 minus 17,500. 3,50,000 minus 17,500. What is the value? 3,32,500. That is only remaining in the closing balance. From that, you remove 19,80,000. You are getting 16,47,500. 16,47,500. Is this clear till here? 16,47,500. This is the WDV of the assets which are there. And on that, if you are calculating 15% depreciation into 15%, you will be completely wrong. Why? 16,47,500 is after depreciation. Are you getting this? It's reverse working question. What are they talking? What are they talking? Oh. Can you tell the topics which I can focus because last sem exam I didn't prepare well. Last sem exam, okay, I don't know what you're talking about. I just need to pass in FA and BI, business law. Okay, BL, other subjects I will manage. Okay, important topics, guys. Okay, so many people are asking if you want just the important topics. Just remember, chapter number 1 comes for 14 marks. Final accounts comes for a huge amount of marks. With the incomplete records it is. And partnership comes for a huge amount of marks. These 3 only. And AS if you study, this actually covers a lot of area in the descriptive paper. But I wouldn't suggest doing selective study. If you're just asking important, that is what is important. Okay, guys. Yes. Now, WDV of old assets. Now, WDV of old asset which is there. This is on what day? End of the year, no? That means, can I take this as 85 so that I know what was 100? This is 85 after depreciation. 16,47,500 divided by 85%. 16,47,500 into 100 divided by 85. So actually the answer which is given down is wrong. Okay. So we are solving it the correct way. 1938, 235. 1938, 235. From that you remove 16,47,500. That time you will get 1938, 235 minus 16,47,500. You get 297,35. 297,35. And these two are also depreciation only. Plus 45,000 plus 17,500. 353,235. I'm guessing that the examination question had some incompleteness also involved in that. Okay, but otherwise, based on just this information, if you're doing reverse working, this will be the answer. 353,235. Then what is the next thing that they've asked? Profit or loss on exchange of machinery. Profit or loss on exchange of machinery shouldn't be a problem. 4,50,000. From that you are removing 45,000. So 4,05,000. 4,05,000. And this was exchanged. You gave this and you got new one what? 3,50,000. So therefore, how much is the loss here? 65,000. Sorry, 55,000 is the loss. They got it right. Then after that, book value of the machinery as on 31st of March 2023. See the fun over here. See the fun. Book value of the machinery is 19,80,000 only. Book value of the machinery is 19,80,000 only. No. So are they telling us that we have given you the values before depreciation? Are you getting my point? If you are telling me that the value is before depreciation, then 19,80,000. You're assuming that way, no? Because if you tell 31st of March, the trial balance, the balance of machinery account appears at 19,80,000. So are you telling that this is the trial balance before depreciation itself? Are you following this? This is actually after depreciation. Okay, so therefore that is why this question only was wrong in the exam, but no problem, they'll give grace marks whenever it is mistake. But if they are talking about before depreciation only, it makes sense. Otherwise, we already know it is 19,80,000 itself. Clear? So the assumption, see, they are getting 16,33,000. How are they getting this 16,33,000? 19,80,000 minus 2,92,000. 16,88,000. That also is not tallying. 16,33,000. Fine. Okay, let's ignore this. Till here we know. If we want to know the WDV, then basically whatever depreciation we have calculated, subtract it from the actual value which is there. Next. Chapter number 1. One more question is there on chapter number 1. Please give journal entries to rectify the errors and prepare suspense account. Prepare suspense account also they have told rectification of errors question. June 2024. Okay, at least journal entries and suspense account is there. So we don't have to solve this. We can discuss it from there. Trial balance of Rajesh Brothers on 31st of March 2023 did not agree. In order to close the books, the accountant placed the difference of 26,700 debit to suspense account for necessary adjustments in the next period. Necessary adjustments in the next period. On 25th April 2023, next period only we are in because balance sheet already closed on 31st March. The following errors arising to 22-23 last year was detected. Now 26,700. See suspense account 26,700. They put that 26,700 debit. If I have to ask you a very conceptual question, the credit was more in the trial balance or debit was more in the trial balance? Credit was more or debit was more in the trial balance? Which was more? Credit was more or debit was more? Credit was more. Debit was shortage. That's why they put the 26,700 in debit and now it is tallying. Clear? We don't have to worry about that. They have already told in the question itself. Now, 4,500 allowed as cash discount to a trade debtor was not debited to the discount account. Not debited to the discount account. Only discount account they said. So therefore, discount account should be debited. But discount account is an expense. Discount account is an expense. In next period, we can't write expense. So we will write P&L adjustment account debited. Only debit is there. So obviously credit will be to suspense account 4,500 and that will come to the suspense account also when you're doing the posting of the suspense account. Next, after that you have credit sale of 6,550 was posted to the credit of the customer's account as 5,650. Fun you see, people will focus only on the 6550 and 5650. They have not focused that first of all customer should not be credited only. Customer should be debited. So not only did they credit the customer, they credited the customer not with same number ulta, they put different number itself. So 5650 and 6550. So 5650 plus 6550, you will get 12,200. Now you have to debit the customer for 12,200. One, you are going to remove that wrong credit, then you are going to put the correct debit. So therefore 12,200 customer account debited. Only 12,200 customer account debited. Only debit is mistake. So that means other half will go into what? Suspense account. That is also sitting in suspense account 12,200. Now, machine purchased on 1st October 2022 for 50,000 in cash was posted to the purchase account in the ledger. Rate of depreciation was applicable. Machinery 15%. Now what is missing over here? Now first, what is the rectification entry that we have to do? First we have to pass the entry machinery account debited. Machinery account debited 50,000. Clear? They have put it to purchases. So you'll write two purchases, but I cannot write two purchases. I'll write P&L adjustment to P&L adjustment 50,000. Next, what did they tell? Rate of depreciation is applicable at 15%. When did they make this mistake? In the middle of the year. So that means half year depreciation is missing. So you have to pass the entry now. Depreciation account debited. I can't write depreciation. I'll write P&L adjustment. Okay, to machinery account. Okay, 15% of 50,000 is 6 months. 6 months it is 3750. 3750. Now if I have to pass net effect of this, machinery account 50,000 minus 3750, that will make it 46,250. 46,250. And P&L adjustment also, net effect will be 46,250. So you can see the entry over here, machinery account debited 46,250 to P&L adjustment account. I hope it is clear. You can pass two entries and rectify also in the exam. It will still give you the correct answer only. Next, sales book was overcast by 10,000. This is the most common error of rectification. Sales book was overcast means what? You put 10,000 more in the sales book. You put 10,000 more in the sales book. Now remove that 10,000 more. Only sales book was overcast. Sales book, only sales is more. So to remove sales, what will you do? You have to debit sales, and that will be debited to P&L adjustment account. That will be debited to P&L adjustment account, and there is no credit. So suspense account. 10,000 you're going to put into suspense account also. Then the last thing, oh done, no, that's it. Okay, now suspense account automatically closed. Suspense account. Now P&L adjustment account, you can see there is a balance in P&L adjustment account. How are you going to calculate this? This is debit. So I'm starting with debit. Debit of 4,500. Debit is 4,500 plus this is credit. So minus 46,250. Then this is debit. So plus 10,000. So you have 31,750 credit. 31,750 credit means 31,750 is your profit. So take 31,750 and transfer it to capital account. Take 31,750 and transfer it to capital account. Is this clear till here? Yes, this is the situation. This is the situation of journal entries. Finished. That was June 2024. 2 questions, 7 marks. We got it. December 2023. December 2023. Yes. 2A. Directly it is BRS. We can see it is BRS. You are required to prepare adjusted cash book and bank reconciliation statement as on 30/9/2023. Guys. People are talking about which college they are, which is your exam center, what time, evening shifta. Okay. Second year college. Nice. Bonding happening in chat box. Someone asking, sir, one word, from where to read? Kindly say from where to read. From study material first. First from study material, please solve all those questions. That is the most important thing. Okay, now on 30th September 2023, Sri Sachin Chatterjee's cash book shows that he had an OD of 400. on his current account at the bank. On checking the cash book with the bank statement, you find the following. Now, cash book has an OD of 400. Cash book, clear? Now, nicely, wait, did I take the wrong question? December 23, 100 to 500. Okay. What has happened is 2B correct? 2B, 2B, 2B. Okay, I think we have picked the wrong answer key, right? This is December 24's answer key. So we need the December 23 answer key, right? December 23, this is the same thing, but I don't think I have December 23 answer key. That's the problem. For 2 December 20, okay. This should be the one then. Yes. Yes, this is the one. I thought we had to sit and download again now. Yes, this is December 23 answer key. Yeah, now we can solve this. We can discuss this. Now, they have asked for adjusted cash book. So first, obviously, we are going to do the adjusted cash book. And there is a OD balance of 400. If there is OD balance of 400, sir, you have 2 December 23 answers. Yes. One is leaked paper, one is real paper. Okay. Now we found it. That I think naming was the problem there. Yeah, by balance brought down 400. By balance brought down 400. OD balance. First, we are always going to prepare adjusted cash book. Two mistakes that students always make in this kind of question is they prepare, either they forget to prepare adjusted cash book. That is major mistake. They prepare adjusted cash book. After that, they take the question what balance was there, that only for BRS. After preparing adjusted cash book's balance that you are going to take and prepare BRS. Now, checks issued 1,500 has been entered in the cash book but had been presented into bank as only 1,000. So how much is not presented? 500, but this we can't put anywhere, no. It has to go into BRS only because we have already recorded the checks. Dividend amounting to 150 had been directly deposited into bank. So that means we can now enter it in the cash book. Dividend received, dividend amount into 150 deposited. So bank account debited. So you will write bank account debited to dividend account. Clear? 150. Next, after that, bank had credited interest on bank deposit of 170, but the same had been debited in the cash book on 6th October. That means we missed where? In the cash book we missed. Bank credited interest means bank gave us interest. So bank account debited to interest account, bank interest account. Next, after that, bank charge of 50 shown in the bank statement, but the same had not been entered in the cash book. Not entered in the cash book, enter it. Bank charges are expense. So bank charges account debited to bank account 50. Next, a check is issued to NK Chatterjee for 50 was replaced when out of date. Check issued to NK Chatterjee for 50 was replaced. Out of date, it was entered in the cash book. No other entry has been made. Both the checks were included in the total unpresented checks shown above. Now what you're going to do? Is it under your control? Now here, we don't have to worry. See, can you see cash book? There is no problem at all. Ignore in the cash book. Later you remember this also has to go into BRS. 50 rupees check you have to remember when we go to BRS. Receipt side of the cash book has been overcast by 20. Receipt side is what? Debit side. Debit side you put 20 rupees more. So you are going to remove that by putting it on the opposite side, 20. Okay, then check of 20 had been entered as receipt in the cash book instead of payment. Instead of payment, we put it as receipt. So now you have to remove the receipt and then you have to record the payment as well. So 40, opposite side. Check drawn for 8 had been incorrectly entered in the cash book as 88. Drawn, that means issued. Drawn, issued, that means incorrectly entered in the cash book as what? 88. So what we are going to do? We have issued, that means we have put extra payment of 80. We have put extra payment of 80. We will remove it by entering it on the receipt side. Clear? Done. That means only BRS part is remaining. So now what we are going to do, you see the balance. When you see the balance, you got the balance on the credit side. If you got a debit side, that means the balance is still OD only. Started with OD, balance is still OD only. So overdraft balance as per adjusted cash book is 110. Overdraft balance as per adjusted cash book is 110. Now we are going to focus on this. Here how much is missing figure? 500. 1500, the check had been entered in the cash book but not presented to bank. That means check is issued. Check is issued. Entered in the cash book also. That means our OD balance of cash book. We started with cash book. Our OD balance of cash book when it is issued, balance increases. So what we will do? We will decrease it. Can you see that 500 in the less part over here? Less 500. Then one more is this check. Issued check is issued to NK Chatterjee, was replaced out of date. It was entered again in the cash book. No other entry being made. No problem. It was replaced. But both the checks were included in the total. One was extra. One is included. One extra check is also included. What was replaced? First time we included. Okay. That dishonored. That time we should have removed it. But both are there. Both are there means one extra now. One extra we have to remove. So 50 rupees check issued. Again same thing. Balance increases. You are going to decrease it. 50. This should be your balance. And when you did that, now see, take your calculator once. I want to demonstrate this part. 110 is there, no? 110 minus 500 minus 50. What you got in your calculator? Negative 440 you got. Obviously, the starting point is cash book. Ending point will be passbook only. But you got negative, that will become balance as per passbook. Not OD balance as per passbook. OD when it goes into negative, it is normal. Normal when it is going into negative, it is OD. Clear? So this is the situation. Easy question for 7 marks. Now, next question. From the following details, this is the last question from chapter number 1 and it is from December 2023. After that, we are going into the next part. From the following details, prepare an adjusted trial balance as on 31st of March 2023. That means we are seeing whatever we are seeing below, that is the non-adjusted trial balance. Clear? Now you can see purchases, carriage inward, wages, salaries, rent, rates and taxes, insurance, interest paid, sales, cash and bank, bills payable. Okay. Sundry creditors, plant and machinery, buildings, furniture, bills receivable, sundry debtors, capital, sundry expenses, opening stock. One thing we know, they have not given debit and credit in a sorted manner, mixed, jumbled up, everything is there. Okay. Now, salaries and wages due to be paid 2000 and 1000 respectively. So what will be the entry for this? Salary account debited 2000. Wages account debited 1000. To to be paid due. So to outstanding salary 2000. To outstanding wages 1000. So now we know when we prepare our new trial balance, no, 2000 and 1000 should be outstanding salary and outstanding wages. Outstanding salary 2000, outstanding wages 1000. Clear? Now what we have to do? Salary. How much is the salary in the question? 10,000. To the 10,000 I have to add this 2000. So salary should be 12,000. Okay, then wages. How much is the wages in the trial balance? 6,000. To that wages, what you will add? 1,000. So wages becomes 7,000. Clear? This could have had other adjustment also. Actually, nothing is this. So directly it is matching. Next, insurance was paid to the extent of 300 in advance. Prepaid insurance 300 to insurance account 300. So what you are going to do? Prepaid insurance should be shown in the trial balance as an asset. Prepaid insurance. Can you see over here prepaid insurance 300? Okay, then here insurance is already there. Insurance is 1500. From that we have to remove 300. So the insurance should be showing 1200. Insurance paid or insurance can be shown over here 1200. Clear? Next. a sum of 500 to be written off as bad debt out of sundry debtors and a provision for 5% to be created out of doubtful debts. Do we already have in this question, do we already have this thing over here, provision for doubtful debt? No, luckily we don't have, otherwise it would have been adjusted like the example. So therefore, first what I will do, I will first pass the entry bad debt account debited, that is 500, to debtors 500. Bad debt account debited 500 to debtors 500. So now go and check what is the bad debt in the question. Bad debt, bad debt, bad debt, bad debt, bad debt. Bad debt, bad debt, bad debt is shown over here, but I'll tell you why it is showing like that. I will just write this 500 now. 500. Clear? What is the debtor in the question? My debtor balance, where is debtor? 40,000. So from 40,000, what I will remove now? 500 bad debt I'll remove. I'll be left with 39,500. I'm left with what? 39,500. Sir, give tips for BRS. I think you joined this late. We already discussed the tips, guys. Okay, please watch that. 39,500. How much provision they asked to create? 5% into 5%. 39,500 into 5%. 1,975. 1,975 actually should be P&L account debited to provision for doubtful debts. What they have done over here is 1,000. Okay, 975, right? Do we already have any bad debts here? Bad debts, bad debts, bad debts. We don't have any bad debts. Okay, let's keep this pending. Maybe there is something else related to bad debts, because only 500. If you remove 39,500, you are not getting 1950. I think the provision that they created is 1950 in the this thing. We'll see the other points and come back to this bad debt point again. Sure, no, you didn't get 1950. 39,500 into 5%. No, 1975 only it is. Okay, let's wait for that. Now, sundry expenses include 2,000 spent for the personal purpose of the proprietor. Personal purpose of the proprietor will be what? Drawings account debited to sundry expenses. It is not in purchases, it is in sundry expenses. 2,000 and 2,000. How much is sundry expense in the question? Sundry expenses 5,000. From that you are going to remove 2,000. So in the question, wherever you find sundry expenses, yes, can you see sundry expenses 3,000? Okay, sundry expenses 3,000. Drawings is showing 3,500, but maybe there is one more drawings. Right now we are writing 2,000. 2,000 we know, other one we didn't find yet. Next, after that, sales for the period included 500 worth of goods, cost price, taken by the proprietor for personal consumption. Sales include goods which are taken for personal consumption. So he has also taken goods worth rupees 1,000 for personal consumption, which has not been recorded in the books only. What and all he is doing? Sales include 500 worth of goods which are taken by the proprietor. So now what will you do? It is included in sales. So 500 is taken in sales. So from sales we have to subtract. From sales we have to subtract, but sales will be debited then. Sales will be debited. Can you see 500? 500. Clear? Now, what is the sales right now? Right now in the question, sales is 95,000. Do we have any returns and all, anything that we have spoken about? No. Can you see sales became 94,500? Sales became 94,500. Sales. Now, other part of that, we will keep it pending, which we will see. He has also taken goods worth rupees 1,000. This is not recorded only. So, what we will do? Drawings account debited 1,000. Drawings account debited 1,000. This 1,000 will get added to the drawings which we have already kept over there. 1,000 will be kept over there. Clear? Then, two purchases. That means 1,000 has to be removed from purchases. How much is the purchases in our question? Purchases. 65,000. So now the purchases will become 65,000 minus 1,000. Something else also is there. That is showing some other random number. We'll not worry about that now. And can you see this 1,000? Okay, this 500 which is there, that is drawings. So now what will happen? 500 will get added to drawings also. Can you see the total drawings has become 3,500? Total drawings 3,500, it has matched. Okay, now the remaining part of 500 I'll explain to you, don't worry about that. Depreciation to be provided as follows: plant and machinery 10%. That's it, plant and machinery 10%. Now go and check how much is the plant and machinery. Plant and machinery 10,000. On that 10% will be 1,000. So the plant and machinery should be showing 9,000. Okay, that 1,000 depreciation. Where is our depreciation? Here. But everything total will be there. So 1,000 depreciation. Clear? Next, what they said, there is 5% on building. 5% on building. Go and check how much is the building. 5,000. 5% of building would be 250. So now building should be showing 4,750. Can you see 4,750 and add the 250 depreciation over here? Next, after that, you can see furniture 10%. Go and check how much is the furniture over here. 35,000. Sorry. My bad. Yeah. 3,000. 3,000 into 10% will be 300. So now what you will do? You will show the furniture at 2,700 and add the 300 over here. That time you will get your total depreciation of 1,550. Clear? Now, after that, you have one more adjustment, that is closing stock. Closing stock should be shown. See, can you see closing stock over here? 20,000. Closing stock 20,000. Usually the closing stock adjustment is in trading account. But if you are not preparing trading account, then how will you adjust closing stock? You will adjust it with purchases only. So from here only you are going to remove 20,000. Closing stock account debited to trading. Opposite side, you can't do that now because trading account is not yet prepared. So closing stock account debited to purchase, reduce the debit side itself. So 65,000 minus 1,000 minus 20,000, you're getting 44,000. What is that other 500? The 500 which was left blank over there. Can you see this sales account debited 500? Sales account debited 500 to purchase account 500. Why? Because it is included in sales. You remove from sales and you remove from purchases. So now what happens? 500 gets subtracted over here and that makes it 43,500 which we are looking for. All the adjustment parts we have seen, only the provision for doubtful debt is remaining. Now what we will do is remove all the other things. Carriage inward, direct it is, no adjustment was there. So directly carriage inward you can put 1,000. Clear? Then after that, rent rates and taxes 1,800, that also direct 1,800 you are going to enter. Then interest paid 1,000, no adjustment was there, directly 1,000, it is a debit balance. Then sales, we'll keep sales already done, I think 94,500 we had already entered it. So cash and bank, no adjustment, directly cash and bank 21,500. Bills payable, no adjustment, it's a liability, so 5,800. Then after that you have sundry creditors, no adjustment was a sundry creditors, directly credit 35,000. Then bills receivable 10,000, no adjustment for that also, directly 10,000. Then sundry debtors, obviously there is an adjustment, that one thing we'll leave it blank. Capital 66,000, directly capital 66,000, because capital account will change when you prepare your balance sheet at the end. Now no change at all. Okay, sundry debtors. One second guys. Yes. Now opening stock 21,000. Opening stock 21,000 is there over here. Only bad debts is remaining. Okay. Then the provision for bad debts is remaining and the debtor balance is remaining. Now entire focus should be on this particular point. Sales for the period 500 worth was taken by the proprietor for personal consumption. Taken by the proprietor for personal consumption. That means we took it as sales. Now, full twist is in that. You know why? Because you have not noticed. Okay, you have not noticed because I went with flow. We only have 1.5 adjustment over here. 1.5 treatment we gave. We didn't give 2 treatments. Are you getting this? Now, what did I do with this 500? Sales I minused. Purchases I minused. Drawings I took. Sales I minused. Purchases I minused. Drawings I took. Where is the other 500? Otherwise your trialmans will not tally. No. See, understand this. They have included 500 in sales. If they have included 500 in sales, then the entry they have done is debtor account debited 500 to sales 500. Clear? This is the thing that they have done. Now what we should do? This 1,000 you don't worry. 1,000 is already done. No drawings. This is the entry that they have passed. If something is included in sales, the entry is what? Debtor account debited to sales. Now, obvious, sir, why can't they record the entry as cash account debited to sales? Because cash didn't come only over here, only goods went. Goods went, who took it? Owner took. Instead of writing it as drawings, what we recorded? He recorded it as sales itself. Now, what I should remove? I should remove the sales. I should remove this. So, what will happen now? Sales account debited 500 to debtor account 500. That's why from sales 500 was subtracted. And the sales we reversed. Now we have to record the drawings. No. So the entry will be drawings account debited 500 to purchases account 500. Is this clear? So now what happened? This got reversed. Because this got reversed. From sales did you remove 500? That is why in the sales you are seeing 95,000 minus 500. Clear? Then, did you remove drawings? Did you add 500? That is why you added 500 over here in drawings and it got matched. Clear? Then, did you remove 500 from purchases? Yes, that's why we removed 500 from purchase and your purchases matched. What is missing over here? You haven't removed 500 from debtors. Now your debtors, whatever was there, no pending thing, that will get closed. So now your debtors will not be 39,500 because another 500 I have to remove from debtors. That makes your debtors 39,000. That makes your debtors 39,000. Now can you see it is not 1.5 adjustment. The 2 adjustments complete or 4 adjustments are completely done. 39,000. Now debtor is 39,000. Now you can go and check. Your debtor balance in the trial balance is 39,000. On 39,000, I have to create 5% provision. 39,000 into 5%. Are you getting the 1950? 1950. Usually for creating provision for doubtful debts, that entry is P&L account debited to provision. But P&L is not yet done, no. So what they have done, they've added that 1950 to bad debts itself. So 500 plus 1950, this makes it 2450. Debit should be done, debit is done. And provision is 1950. Is this clear? So the major adjustment is this particular twist which they gave in sales. I hope it's clear. It's a very important, nice question which they have asked. Okay, for corrected trial balance. It will test all your concepts at one particular place. With that, we are done with the adjustments or questions of chapter number 1. We go into the next chapter now. That is bills of exchange. That is bills of exchange. What?
The second entry is reversal entry.
Second entry is reversal entry actually. Yeah.
First entry is the correct entry, and the third entry is actually the
Third entry is actually the entry.
drawing we have taken for drawings. So
Correct.
it should be recorded as purchase, but it was recorded as sale.
Yeah.
So we are reversing.
It should have been reversed from purchases, but it is added to sales.
Ah.
Owner took the goods, but we treated it as customer took the goods. Yes, let's go for this. Bills of exchange. Next chapter. Now, there might not be constant questions which are asked from bills of exchange. So our past examination questions will get over fast. Every attempt they have not asked bills of exchange. So we have to check where they have asked, that we will solve. Okay, let's go into bills of exchange. If something is not asked for a very long time, that means you have to know one thing, that it can always be asked. It's due for asking. Okay, now we have one person called as Sriram, okay, who is the payee, and there is one person called as Shalini. Now, bill of exchange is what? Negotiable instrument. Along with bill of exchange, they can also ask one more thing, that is PM. What is PM? Sorry, not PM. PN. What is PN? Promissory note. What is the difference between bill of exchange and promissory note? Bill of exchange and promissory note, what is the difference? Bill of exchange, I am supposed to get the money. I draw the bill and give it to you. You accept it and give it to me. Clear? In promissory note, I am supposed to pay the money. I only will write the promissory note until I promise to pay you and give it to you. Clear? Now, this person sold goods for 50,000 to this person. Sold goods. When they sold goods, it is sold for credit. If it was sold for cash, no, we wouldn't even bother about this bills of exchange. It is sold for credit. When it is sold for credit, now this fellow is already having tension whether he'll get the money or not. So what he will do, he will draw a bill. He will draw a bill of 3 months for 50,000. He draws the bill. After he draws the bill, the other person will accept it and give it back. Accept it and give it back. So now bill is drawn and accepted. Clear? Now, this is the situation. How can you accept? Only by signing. You sign it and give it back. That is the acceptance. Now that time, this fellow becomes the drawer because he drew the bill, and this person becomes the drawee because it was drawn on them. And who is supposed to pay? This person. So this person is the payer and this person is the receiver. So it is payee. Clear? Now, let's go into the tenure of the bill. This can be tested sometimes silently in the question paper. Okay, 1/1/2024 is the date of the bill, and tenure is for 3 months. If it is for 3 months, what you do? It is given in months, no. Directly add 3 to the month column, it becomes 1/4/2024. Add 3 days grace, it becomes 4/4/2024. Here 1/1/2024, 1 month, it's told in month, no. Add 1 month directly to the month column, it becomes 1/2/2024. Add 3 days grace, it becomes 4/2/2024. 30 days. 30 days is written. Directly what you do? Don't worry, 1 month is not 30 days. Both are not same. They are same but different. Clear? So 30 days directly you are going to add 2. 1 over here. So it becomes 31/1/2024. Add 3 days grace. It becomes 3/2/2024. Here also it is written 30 days. Now I'll add 30 days to I'll add 30 days to the days column. Then I will get 31st of February, which is not even there. So what will happen now? I will add 28 days only to February. Now you're like, sir, 1 is already over. I cannot take 28 days. No, it is 24, 2024. 2024 was a leap year. 2024 had 29 days. 1 is over. I will add 28 days over here. Then 2 days will be in March. So 2nd March, add 3 days grace will become 5th March. Clear? 15/6/2024. 15/6/2024, 2 months. Directly add months to the month column. This will become 15/8, which is National Holiday, Independence Day, the Laddu Day in your school. So 14/8/2024. 3 days grace, you add 7 days. So now you know that National Holiday, previous day you will take, emergency holiday, next day you will take. Clear? National holiday, only 3 are there for recognition right now. That is Independence Day, 15th of August, Republic Day, 26th of January, and Gandhi Jayanti, 2nd of October. Clear? Yeah, on due date only. On due date only. You know why? No. It will be on due date only, because the date when you are supposed to make payment is due date. Actually, if somebody asks you, what is the date of payment? I know in journal entries and all, we write directly the maturity date only. But what is the date which you are supposed to use? The date is the due date. Why the date is due date? Because that is the date of payment. But because on date of payment, anything can happen. That is why we are telling that use the grace days, add the grace days. Sir, Vanakkam from Chennai, sir. We are also in Chennai, sir. But just that we are in class, you are at home. Okay, Vanakkam. Yes. That time again you will do -1. Yeah. Anything should not fall on that national holiday or emergency holiday. Now, bill drawn after date. There is a small concept called as bill drawn after date. Bill drawn after date means what? The tenure is there. No tenure. The time period of the bill will start from the date of bill itself. Bill drawn after sight means the time period of the bill will start from the date of acceptance. If nothing is told in the question, we always assume that it is bill drawn after date, and from the date of the bill itself, we'll add the number of days. Now, we'll try to understand drawer and drawee. Drawer and drawee. Now, we'll not use names because in the exam, the name might change. So, we will keep drawer and drawee. Now, drawer sold the goods. Goods sold. Goods sold, what will be the entry in the books of drawer? In the books of drawer, what will be the entry? The drawee, that is debtor account. I'll use the word as debtor account debited to sales. And for this person, it will be purchase account debited to creditor. Purchase account debited to creditor. Bill is drawn for 50,000. Bill is drawn. No entry. Why? Only when it is accepted, the entry is actually supposed to be passed. So bill is drawn and accepted. Bill is drawn and accepted. That time you will pass the entry. For this person who drew the bill, he got the bill. So bill's receivable account debited to debtor. Debtor is gone. Debtor is gone. For this person, creditor is gone now. Creditor account debited to bills payable account. Creditor account debited to bills payable account. Clear? During the tenure, what you can do? You can keep the bill in your pocket and wait. You can keep the bill in your pocket and wait. Hold the bill. No entry. For waiting, what entry to pass? Okay, then you can go to the bank and discount the bill. You want money early, you can discount the bill. Discount the bill with the bank for 49,000. That time you will get 49,000, bank account debited 49,000. 1,000 you did not get. That is discounting charges. Discounting charges debited 1,000. 2. Bills receivable 50,000. Bill went from your pocket and sat with the bank. What can you do? You can endorse the bill to your creditor. You have one creditor. To your creditor, you can endorse the bill. So your creditor is gone. Your bill is also gone. Creditor account debited to bills receivable. Three things you can do. You can keep the bill in your pocket and wait. You can discount the bill with the bank. You can endorse the bill to your creditor. Whatever you do during the tenure of the bill in the books of drawee, no entry. In the books of drawee, no entry. Sir, is this really live? Ayo. 11:31. Just became 32. Okay, and June 1st, I think that clarity you will not find. You might be able to see it, not that clearly. June 1st, Monday. Monday is also shown there. Okay, this is live, guys. I'll wait for 28 minutes, it will become June 2nd. Okay, then you will be left with only 9 days left for exam. Okay, now you know we are live. Okay, yes. Obviously, I cannot tell no, guys. If it was pre-recorded, I cannot tell that yesterday RCB won. Because that time I would not know, no. I should do time travel, see who won, then go back, record it. Sir, I thought it is Premier, sir. Oppo Photo to Samsung. What a changeover. No. This is some old student. I had Oppo phone before. So they are like Oppo phone to Samsung. What a changeover. God's grace. Okay, let's continue, guys. Okay, no entry. Why? Whatever the drawer does, drawee told, I will pay you after 3 months, 4 months, 5 months, whatever it is. After 3 months, 4 months, 5 months, you come to me that time. That time I will bother whether to pay or not. Okay, whether to pay or not. Now you don't ask me anything because even dishonor is there after this. So don't ask me anything. You do whatever you want. You keep the bill in your pocket. For me, no entry. You discount the bill with the bank. No entry. You endorse the bill. For me, no entry. You lose the bill. For me, no entry. Clear? Now, entire thing starts on due date. Due date. Okay. Entry. Actually, it's on due date. But always we pass the entries on what is our maturity date. Clear? Now, bill was held by the person. Bill was held. So now what happens if bill was held on the due date? No, only two things can happen on due date. What is that? Bill will be honored or bill will be dishonored. If bill is honored, you're getting money. So bill was in your pocket. You went and asked the money. You got the money. Bank account debited to bills receivable. You give the bill. You take the money. Done. If bill was discounted, you already got the money. Bill was discounted. Now where is the bill sitting? Bill is sitting in bank's pocket. Bank went to that person, took the money. Done. No entry for you. Bill was endorsed. Bill was endorsed. Who is having the bill now? Your creditor is having the bill. That person went and asked the money, got the money, done. Whoever came and asked the money to the drawee, whoever came and asked the money, when they asked, this person paid. So the entry will be bills payable account debited, liability gone to bank account. Can you see? Even if the debt, if this person who drew the bill went and asked, even if the bank went and asked, even if the creditor went and asked, whatever happens, bills payable account is debited to bank. Clear? Next thing is bill dishonored. Bill dishonored. Now bill dishonored, when by God's grace we got 2 RCB cups, sir, before GTA 6. Ayo, 9 days left for exam. Okay, now bill dishonored. Bill dishonored, understand this. Now if bill is dishonored and bill was in your pocket, bill was in your pocket. Now one shortcut I'll tell you. When bill is dishonored, no, always debit will be debtor. Who gave you the bill? Debit will be debtor. Can you see? Debtor debited over here, debtor debited over here, debtor debited over here. So that name of the person will come and sit on the debit. Now bill was in your pocket, so bill is gone. Bills receivable credited. Bill was discounted. Bank did not get the money. Bank will take the money from your pocket, so bank account credited. Bill was endorsed. That fellow did not get the money, so he will start asking you. So he becomes your creditor again. You will start asking that person, so that person becomes your debtor again. Clear? Whatever happens, you didn't pay, no. For the drawee, you didn't pay, no. Bills payable gone. Money did not go. Again, one creditor is back. Creditor is back. This was the entry which was passed first time when bill was accepted. That got reversed over here. That's it. Clear? Noting charges. What is noting charges? Now imagine this person did not pay. Because this person did not pay, can I go directly and complain in the court? Can I go and complain in the court? I can go and complain in the court, but court will tell your boss, you're wasting my time. You might be lying that this person did not pay. So you give me authorization of some person whom I can trust. So what you will do when the bill is dishonored, you will go to the lawyer. You will go to the lawyer. You will go and tell boss, see, bill is dishonored. This fellow did not pay. So what will you do now? That lawyer will cross check all your bank statement and everything. And then they will write, okay, noted that this bill is dishonored. Then you can go and present it. It becomes easy for legal formalities. That means noting charges is amount paid to notary public. Notary public is the lawyer who is there. Okay, every road you will find one notary board. No, for noting the fact of dishonor. For noting the fact of dishonor, you are paying this particular amount. Now, tell one thing. If bill was held in your pocket, if bill was in your pocket, who is going to pay the noting charges? You only will pay the noting charges. Noting charges account debited to bank. After paying this noting charges is expense. No. Will you go and put that expense on your head only? No. You will ask whom? That particular person. So you will write debtor account debited to noting charges. Clear? Now bill was discounted. Who will pay the money? Bank will pay the money. After paying the money, will bank keep quiet? No, bank will take from your pocket. So now you will go and ask the debtor. So debtor account debited to bank account. If bill was endorsed, who will pay the money? Creditor will pay the money, but creditor will start asking you the money. So what will you do? You will ask that person the money. So debtor account debited to creditor account. Clear? This is the noting charges. Now imagine for the person who is supposed to pay the noting charges, that is for the person who is the drawee. Drawee, what happens? Noting charges account debited by expense to, you are supposed to pay this expense to creditor. Now don't go and write noting charges account debited to bank account. You know why? Because the bill amount only they have not paid still. You can't tell right now noting charges amount they paid, bill amount they did not pay. So it will be noting charges account debited to creditor account and noting charges expense. So it will go to P&L. Clear? Now renewal of bill. Renewal of bill means what? Renewal of bill is time is bad, person is good. Are you getting my point? What and all they're telling Tala for a reason. Okay, Tala for a reason. Ajit Kumar and all has come into our chat. Very good. Okay, now time is bad. Renewal of bill is time is bad, person is good. That means person knows that he is not able to pay on the due date. So he will go and tell cancellation of old bill and new bill drawn and accepted. He'll go and tell, please, I cannot pay now. Please give me some more time. Now, some more time when they are asking, no, this person will tell, this person will tell okay, but will always have extra interest. I waited for 3 months. You did not make the payment. You want me to give 2 more months? No problem. I'll give you, but interest will be applicable. First, what you have to do? Cancel the old bill. To cancel the old bill, what you have to do? Same entry what you passed for dishonor. Dishonor entry only you are going to pass. Clear for both the parties. Then new bill drawn and accepted. New bill drawn and accepted. Two things can happen. Interest is there, right? Interest. I can tell, boss, you pay the interest now only. Remaining we'll see in the future. So interest paid now. Another thing what can happen? New bill will be with interest. New bill will be with interest. So now you see cash account debited or bank account debited to interest. I got the interest for this person. Interest account debited to cash account. They paid the interest. Here interest will be transferred to P&L. Here also interest will be transferred to P&L. For us interest is income. For them interest is expense. Sorted till here. Now what you are going to do? New bill will be drawn and accepted. New bill will be same as the old bill amount. Why? Because interest is already paid and settled. But if you're going into the next situation, here what is going to happen? You are going to write debtor account debited to interest. You didn't get the money. Here they are going to write interest account debited to creditor because they didn't pay the money. Then interest will be transferred to P&L. Then what you are going to do? Bills receivable account debited to debtor. This will be old bill plus interest. Here creditor account debited to bills payable, old bill plus interest. Is this clear till here? Someone is telling, sir, your manifestation in AS12 grants chapter CM Vijay came true. In AS12, no, we used to put CM Vijay, CM Vijay, CM Vijay. I think you were absent. Okay, CM Vijay. Current batch, no, from before I used to do it. I used to write CM Vijay, okay, because he had entered politics, no. So I used to write CM Vijay for fun, and that manifestation came true. So now people are telling, sir, please start writing PM Vijay. Then that manifestation also will come true. Okay. Now? You don't know, you are against that. PM medal, no chance. PM medal, no chance. No chance. Till there, it is not possible. Okay, retirement of bill. Retirement of bill means what? Time is good, person is good. You have money, why to wait for 3 months? You pay the money and settle. Now, when I was telling that I'll pay late, you told me you have to give interest. Now, when I'm telling that I'll give you early, actually interest should be applicable, but that interest is called as rebate. It is called as rebate. Clear? Bill closed early by the drawee. Now, bank account debited, rebate account debited to bills receivable. For the person who is getting money early, rebate is nothing but discount. Discount is an expense. For the person who is paying the money early, okay, for the person who is paying the money early, rebate is again discount only. Discount is discount received, that is income. Clear? Now, bills for collection. This can also be there. It's a very important topic. Bill sent by drawer to the bank for collection. Now I have many bills. I can't sit and keep track of all the bills. Now what I'll do? I'll take one full stack of bills and give it to the banker and tell, please boss, you keep track of the due date and give me the money whenever money comes. Okay. No entry in the books of drawee because drawee doesn't care what you do with the bill. Okay. Bank will charge bank charges. Obviously they are providing one service over here. They'll charge the bank charges. Now bill is sent for collection. Bill went to so the entry will be bills for collection account debited to bills receivable. And then when amount is received, bank account debited to bills for collection. If amount is not received, dishonor, bank will not take too much headache. Drawee account debited, that means debtor account debited to bills for collection. Clear? Now one topic is there, that is accommodation of bill. Now two people are there. They saw this entire bills of exchange chapter. No, then they thought, oh, we can use it like a loophole. What they did, one person told the other person, boss, you want money? I'll give you money for few months. Then later you have to give it back. Clear? So now no transaction between these two. No transaction means what? One person did not sell the goods, other person did not purchase the goods. Nothing. Now here this person has drawn the bill on this person. Drawn the bill and the bill is for how much? 50,000 for 3 months. Now this person has accepted the bill and given it back. Done. Sorted. Sir, simply why, sir, this pinky person is accepting the bill? Because this is a contract that they made. No contract, understanding that they've had. I'll draw the bill on you, you accept it and give it to me. Then we will get money. That time we will share the money. Clear? Now what this person did, he went straight to bank and he discounted the bill for 48,000. Bill was for how much? 50,000. How much you got? 48,000. That means how much is the discounting charges? 2,000. How much is the discounting charges? 2,000. And this 48,000 will be returned to, you will receive it. Now what you will do, it's up to you. Share the amount. Share the amount. Now the share the amount point is there. No, you have to search in the question. It can be 1:1, 2:1, 1:3, 2:3, whatever. They'll give the ratio in the question itself and they're going to share this 24,000. 24,000 is going to be shared. Here I've just taken it as equal. Now you have to remember one thing. On due date, please tell me who is supposed to make the payment to bank? Pinky or Dinesh? Dinesh drew the bill. Pinky accepted the bill. Dinesh went to bank, got the amount. On due date, Pinky is the person who is supposed to pay the amount. So Pinky has to pay the amount to the bank. Now tell me one thing. How much Pinky has to pay the bank? Pinky has to pay 50,000 to bank. Does Pinky have 50,000 with her right now? No, Pinky has how much with her? Only 24,000. Another 1,000 she is ready to put from her pocket because discounting charges was 2,000. Amount was shared equally. So this charge also will be shared equally. So she'll put 1,000 from her pocket. It will become 25,000. Now what Dinesh has to do? 24,000 plus he has to put 1,000 from his pocket. It will become 25,000 and that will be given to Pinky. On due date, Dinesh will return his share to Pinky. Share of each person is amount shared plus share of discounting charges. Therefore, amount sent by Pinky to Dinesh will be 24,000 plus 1,000, 25,000. Clear? Note, discounting charges to be shared in the same ratio in which the amount is shared. Of which bill? First bill. Now in these accommodation questions, many bills might come into picture. First bill was not settled properly, then this person will draw on this person. That and all can happen. So whatever ratio the first bill was shared, that amount only, discounting charges also will be shared. At the end of the question, no bills for accommodation. Prepare ledger of drawer and drawee. Why you are preparing ledger? To see what is the balance to be paid. What is the balance to be paid? Because finally they might tell this person became bankrupt, only 20% from the estate could be recovered. So prepare the ledger and put all the transactions what we have done. That time you will get the ledger balance to find the amount payable or amount receivable. This is your bills of exchange concept. Okay guys, okay. PM Vijay fan club is live on YouTube chat. Let's not worry about that. You guys are not Vijay fans, huh? Not in politics. Oh, in politics you are against Vijay. But movie you like Vijay. That is a good thing, no, actually. Entertainment is different, politics is different. Yes, now we'll go into questions. December 2025. I don't think there was any question from bills of exchange. There was no question from bills of exchange. June 2025. Again, June 2025. There is no question from incomplete records. After that, you have partnership, hire purchase. Yes, there is no question from consignment is there, but there is no question from bills of exchange. Then after that, we go into December 2024. December 2024, I can see one question here for bills of exchange. Okay, one question is there for bills of exchange 3A. And this is for 7 marks. And always bills of exchange question, as a tip I am telling you, 3A, 3A, 3A. Always the tip what you are going to do is read the question first, last line. Okay, you are required to pass journal entries in the books of Indra. Now from starting of the question, you know that you are only Indra. Okay, you are only Indra. Indra drew upon Chandra a bill of 90,000. Oh, sir, Chandra would have been better, sir. Okay. Indra drew a bill on Chandra for 90,000 on 1st April 2024 for mutual accommodation. Chandra accepted the same immediately on receipt. Who are you? Indra. What is the journal entry? You drew the bill. So bills receivable account debited to Chandra's account. So you can see over here, bills receivable to Chandra 90,000, 90,000. Clear? Now, on 4th April, that means 3 days later, Indra got it discounted at 6% per annum and remitted 1/3 of the proceeds to Chandra. Now, 90,000 into 6%. Wait. That is for full 1 year, no? But this is only for 3 months into 3 divided by 12. 5,400 divided by 3. 1,000. He told 5,400, 90,000 into. Wait. One third will calculate. Wait. Divided by 4. That gives you 1,350. Yeah? 1,350. This is the discounting charges. Total. First we have to discount, get the money, then we will remit. First we are discounting, right? So when we discount the bill, we got money, bank account debited. So what happens over here? 90,000 minus 1,350, we get only 88,650. Indra da, okay, Indra, yes. Next, discount on bills, discounting charges account debited 1,350. 2 bills receivable 90,000. 2 bills receivable 90,000. Is this clear till here? Okay, this is the situation. Now what happens after that? After that, you are going to remit. Yes, 1/3 of the proceeds to Chandra. How much is 1/3? 88,000. See over here, 88,650 is the amount. Now 88,650 into 1 by 3. 29,550. This much I am going to give to that person. But when I am giving, remember, if I am giving this much amount, the charges also I will put that much amount on their head. 1,350 into 1 by 3. I think that is 450. So totally I am going to take 30,000 from their account. So now Chandra account debited 30,000 to bank 29,550. To discounting charges 450. Discount on bill, discounting charges, discount, anything you can tell, 450. Now can you see what expense you incurred was 1,350. From that 450 when you reduce, only 900 remains. Only 900 is your expense. Remaining everything is that person's expense. Clear? Now we'll see what happens. At maturity, Indra was not able to send the required sum. 1/3 I gave to that guy. 2/3 I kept in my pocket, and 2/3 I had to return on the due date so that that person can pay the bank there. Okay, I did not return only. I told I don't have money today. Now what they did, and asked Chandra to receive a 2 months promissory note for 60,900, which Chandra did. 3 months are over. I was supposed to pay the money. That I did not do. After that, I am only writing, I promise that I will pay the amount to you. Are you getting this? First, I only gave this idea. I drew the bill, they discounted it. After that, sharing and all we did. In sharing also, I kept 2/3, gave only 1/3. Okay, now I am telling I have to pay you money. How much money I have to pay you? How much money I have to pay you? 60,900 actually you have to pay. How is that 60,000? Sorry, where am I? Here. How is that 60,900? Out of 88,650, 2/3 is mine. 88,650 into 2 divided by 3. 59,100 is mine. My share I kept with me. And out of 1,350 charges, 2/3 is mine. 900. That makes it how much? 60,000. That makes it how much? 60,000. Now if you see the question over here, I agreed to receive, promissory note of 60,900. Why am I mad? 900 is interest. I am asking for 2 more months. That means 900 will be my interest. Clear? So now Chandra told, okay, fine, no problem. Chandra got the note discounted. Very smart. Chandra is next level. Note also he went and discounted with the bank. But first of all, who is going to pay on the due date to whom? Who is paying to whom? Chandra has paid to bank. I was supposed to give my share to Chandra. Chandra was supposed to put his share and together they were supposed to pay to bank. But no, Chandra paid to bank because I did not give. Now what I am doing? Promissory note. I am giving the promissory note. So now what should be the entry over here? First, interest. Interest is an expense for me. Interest is an expense because I am promising to pay now. Interest account debited to Chandra's account. Interest account debited to Chandra's account. Then Chandra's account debited. Chandra's account debited to bills payable account For you, it is bills payable because you promised to pay. So Chandra's account debited to bills payable account. Clear? Then what happened? You see, Chandra got the note discounted for 60,000 and met his acceptance. Chandra got his money, paid the bank, all that is done. Indra became insolvent just before his promissory note. I told you, wish you would have been Chandra. Okay, finally you became insolvent over here. Indra became insolvent just because before his promissory note was due for payment. Only 25% was received from his estate. First, whenever it becomes insolvent, no, first your bill should be dishonored. So now for you it is bills payable which is getting dishonored. So you will reverse that entry, bills payable to Chandra. After that, remember 25% was received from his estate. So I am telling boss 60,900 into 25%, 6,900 into 25%, 15,225. Only I am going to pay that. Remaining I am not going to pay. What is this called? Bad debt is for the person who is not going to get. This we can't call it as good debt. This is what? Deficiency. This is called as deficiency. Clear? See over here, Chandra's account debited to bank 15,225. Balance everything is gone into deficiency account. They have given note also. Note entries to be supported with narration. Always, wherever you write journal entry, you should remember that narrations are absolutely necessary. Without that, it doesn't make sense at all. Clear? Now done. That's it. One bills of exchange question was there in December 2024. We'll go into June 24. June 24. We have consignment question. So usually if consignment question is there, bills of exchange will not be there. So that should be it. After June, we go into December 23. In December 23, we will check if there is a bills of exchange question. Yes, there is. There is a bills of exchange question. Question number, it was 3A. So you can see that there is actually consistency. If that is there, this is not there. If this is there, that is not there. And usually it's in almost the same question numbers also. Okay, now go to the end of the question. Give journal entries in the books of H. Who are you? Who are you? H. On 1st July 2023, G drew a bill for 80,000 for 3 months on H for mutual accommodation. Did you draw or did somebody draw on you? Somebody drew on you. He accepted the bill. Somebody drew on you. That means for you it is bills payable. For you it is bills payable. So you will write the entry G's account debited to bills payable. G's account debited to bills payable. Clear? Now, G had purchased goods worth rupees 81,000 from J on the same day. Who are you? H. Who purchased? G. From whom? J. What entry? No entry. G endorsed H's acceptance to J in full settlement. Who endorsed? G. To whom? J. Who are you? H. No entry. On 1st September 2023, J purchased goods worth rupees 90,000 from H. Who are you? H. Somebody purchased from you. For you it is sales. So you will pass the entry J's account debited to sales account. J's account debited to sales account. Is it clear? 90,000. J endorsed the bill of exchange received from G to H and paid 9,000 in full settlement. Now you have to understand this circus over here. Same bill, our bill only took one full circle in the market and came back to me only. Okay, now H gave one bill to G. How much was the amount? 80,000. J gave this bill to G gave it to J. G gave it to H. H accepted and gave it back. So for bills payable angle we are saying, okay, payable angle, supposed to pay to J, supposed to pay to G. G gave that bills receivable to J, and J what he has done? Endorsed it back to us only. But endorsed it back to us for how much? 90,000. For that he gave 80,000 bill. So now for that what he did? He paid 9,000 in full settlement. Okay, that means 1,000 rupees gone from my pocket. Discount. So now you see over here, it should be bills receivable account debited. You could have written bills payable only over here because your own bill came back, but no problem. You got bill, somebody endorsed the bill, so bills receivable account debited. Bank account debited because you got 9,000. Discount 1,000 gone. To J. J's account. J is out. Now this bills receivable is not anybody's. Your own bills payable. So bills payable account debited to bills receivable is cancelled with each other. Clear? Now, after that also you're doing something. We'll see what is that. On 1st October, H purchased goods worth rupees 1 lakh from G. 1 lakh. Purchases account debited to G's account. Purchase account debited to G's account. Now you're telling H paid the amount due to G by check. How much? You saw the answer. That's why you're getting 20,000. In the exam, you will think 1 lakh. I told you mutual accommodation ending will only happen if you prepare ledger. Who is going to give to whom now? Who has to give to whom? H has made the payment to G. So whenever mutual accommodation is there, you will prepare the ledger. Whose ledger you will prepare? H is you only, no? G's account. G's account you will prepare. First entry, can you see G is debited? 80,000 debit. Can you see here no G? Here there is no G. This is J. J is already gone. And here there is G. G how much? 1 lakh credited. 1 lakh credit. 1 lakh credit, 80,000 debit. That means credit is more. Credit is more means it is creditor. If it is creditor, we have to pay the money. Net amount is how much? 20,000. That's why G account debited to bank. Mutual accommodation can end only if you only if you prepare the ledger. Okay, then only you will get to know who has to pay. Otherwise, you saw 1 lakh, you'll be thinking 1 lakh only in the exam. Okay, done. That should be it with bills of exchange. We don't have any other questions for bill of exchange. Let's proceed. There is a lot of time. Don't worry. Consignment. Online guys, are you still there? No, till 2 we can't take. We have to get some sleep, right? Yes, consignment. Consignment. We'll start with consignment now. We'll try to finish consignment and then call it the day. Consignment should be the last topic for the day today. Tomorrow maybe we'll start with the joint venture, finish joint venture, then go into final accounts. Then it's all final accounts, NPOs, incomplete records, all that. Then partnership starts. Partnership is a small chapter. Okay, little only is there in that particular chapter. Now, consignment. Consignment. Now there is one person called as Dinesh from Chennai. There is one more person called as Bambani from Mumbai. Okay, this Bambani from Mumbai, you know, he has great contact with umpire and all. Okay, different person is. Now, Bambani from Mumbai. Now, Dinesh has sent goods. Dinesh's business is doing very well. He has business of selling coriander leaves. Okay, it is doing very good. In Chennai, it is doing very good. So now what he wants to spread his business all across the country. Now, can that one person go everywhere? It is not possible. So what they will do? They'll hire agents, and these agents are nothing but consignee. So this person will send the goods. This fellow is the principal. This fellow is the agent. So consignor, consignee. Consignor is usually the person who is sending the goods. Consignee is the person who is receiving the goods and selling the goods on behalf of the consignor. On behalf of the consignor. Clear? Now, who is the owner of the goods? Always consignor. Goods are sent. Okay, goods are sent. Stock is in whose godown? Consignee's godown. Even if it is sitting in consignee's godown, it will be still considered as ownership of consignor only. Ownership. Me, who is doing all useless things except studying. At least to tell that you came to the marathon video. No problem. Something related to studies you are doing. Imagine you would go on some random short or reel and you would put the comment over there. It would be very bad. Now at least okay, you're on the right track. Don't worry. Yes. Now goods are sent. Stock is in whose godown? Consignee's godown. Ownership is transferred. When is the ownership transferred? When goods are sold by consignee. Consignee will sell the goods to outsider. That time ownership will get transferred from consignor's name to the outsider's name. Consignee will never be the owner of the goods. Consignee is just the middle person over here. So there is consignor, there is consignee, there is outsider. Ownership will always be with consignor only. Then when it is sold, it will be directly transferred to consignee's name. Outsider's name. Clear? Now, consignor sends the goods. What will consignee send over here? Consignee gives something called as account statement. Consignor is giving something called as pro forma invoice. Why is it not invoice? Because it is not sale of goods. It is like a sale, but it is not sale of goods. So only pro forma invoice is given. Okay, and consignee every month end or every quarter, every half year, whatever it is, will give an account statement. In that account statement, consignee will tell how much goods I have sold, how much I have not sold, how much is sitting in my stock. If there is any loss and all, they will talk about that. Clear? So invoice given when consignee will give the invoice, consignee will give the invoice when the goods are sold to customer. Actually, whose invoice it is? Again, consignor's invoice only. Clear? Details of transactions of consignee will be mentioned in this account statement. Now, one of the major topics over here is closing stock on consignment. This only we end up making mistake. Closing stock on consignment. Journal entry and all, we didn't go to that yet. Now, closing stock on consignment means where is the goods sitting? Goods are sitting where? Goods are sitting in the consignee's go down. But even if it is sitting in consignee's go down, whose stock it is? It consignor's stock. So who will take it as closing stock in the trading account? Consignor will take the closing stock. Now, consignor, just understand this. This image might be extremely beautiful, but still understand it. Consignor is there, will send the goods in a truck, and then it will go in a ship. After that, it will reach the port. Whose port? That person's port. There he will pay some government duty, and then he will shift again to one truck. From that truck, it will reach where? Go down of the consignee. All these are the transportation expenses. Now, rent, salary, electricity, who will pay? Consignee. In the terminology of consignment, these are called as recurring expenses. And whatever we saw in the transit, that is called as non-recurring expenses. Because one time it is incurred, done. Now you're like, sir, every time carriage is there, but that is for different goods. Okay, this is called as non-recurring expenses. What is going to be paid continuously in the go down of the consignee, that is called as recurring expenses. Now, whatever, remember one thing, when you're calculating closing stock, whatever expense you have paid till it reaches the go down, till it reaches the go down, all these expenses have to be added to the closing stock. Now, you might have paid all these expenses for 100 boxes, but in the go down right now, only 10 boxes are there. So, expense also for 10 boxes only, you will take the ratio and you will calculate. Clear? Now, closing stock on consignment. Cost or invoice price of the goods. Cost or invoice price of the goods. To that, what you will do? Share of non-recurring expenses. Share of only non-recurring expenses. Expenses incurred till it reaches the consignee. Now, abnormal loss. This is one more thing that is very major calculation over here. Abnormal loss is nothing but avoidable loss. Avoidable loss. Now, abnormal loss, you have to understand one thing. It can happen at different stages. Abnormal loss can happen when it is going in the ship, only some boxes fell into water. Abnormal loss can happen when it was going in the truck, from the truck to ship, when it was going only it got lost. Abnormal loss can happen after it reached the port over there. There something, it caught fire. Abnormal loss can happen after from the port when it is going to the consignee's go down. There it got destroyed. Abnormal loss can happen if it is sitting in consignee's go down and there something happened. Now what you have to understand is simple. When you are calculating abnormal loss, all the expenses till the point of abnormal loss should be added. Till the point of abnormal loss. Now consignor is there. Consignor. Consignee is there. Goods are in transit. Goods are in go down. Imagine it got lost in transit. Till here whatever expenses are there you will add. If it got destroyed in go down. Till the go down whatever expenses were there, you will add that particular point. 1 second. Now, abnormal loss, value of stock which is lost, take that. Share of expenses till the point where the goods are lost. Till the point goods are lost, whatever expenses are there, add that. That time you will get to know actually what you lost. Accounting starts now. Accounting in the books of consignor. Whose books we are talking about? Consignor. Goods sent on consignment. Now it can be sent at cost also. It can be sent at invoice price also. If it is sent at cost. Now consignment account. You will prepare one account called as consignment. What is the purpose of preparing this consignment account? To calculate the profit or loss on this consignment. So consignment account will be debited because you just sent the goods. For you it is a loss. When you send the goods. Hi sir, hi sir. Someone is telling hi sir. Oh Rashid sir, hi, yes. He's awake and he's telling hi sir, okay. Yes. So goods sent on consignment at cost. If it is sent on consignment at cost, what will you do? Consignment account debited, because it's an expense for you when you give the goods to goods sent on consignment. Goods sent on consignment is like a sale. What will happen? Actually, it is not sale, but this goods sent on consignment, no, from your trading account, it will be subtracted from your trading account. So goods sent on consignment account debited to trading account. So basically from your trading actually is representing your trade. That means your direct sales. So from your trade, whatever is there, you're removing those goods and you're telling that you have given it to an agent. Now that agent is doing the trading on your behalf. Clear? Now at invoice price, if it is sent at invoice price means what? Cost plus some profit you're going to add. So consignment account debited to goods sent on consignment. Consignment account debited to goods sent on consignment. This will be at what? It will be at invoice price. It will be at invoice price. Now invoice price, how to calculate? It will be given. They'll tell 25% on cost or 20% on sales. All that they will tell. You need to know what percentage to take. Now removing the loading effect. Whenever it is sent at invoice price, no, simple. Record it at invoice price. Next entry only you will reverse it. What will you reverse? Goods sent on consignment account debited to consignment account. What will you reverse? Only the profit portion. Now you're like, sir, why are we even recording it if we are going to reverse it? Why are we even recording if we are going to reverse it? Just remember, we are recording it because now the consignment account, the person should know that it was sent at invoice price. Then if you reverse it, the person will know that it is sent at invoice price, but we got rid of the profit which was recorded. Clear? Now, expenses of consignor. Consignor paid some expenses when sending truck and all, he only paid. Freight and all, he only paid. Expenses. Consignment account will be debited because it's an expense. Money went so to bank account. Consignee paid some expenses. If consignee paid also, it is whose expense? Consignor's expense only. So consignment account is debited to what? Consignee, because we are supposed to pay. He paid from pocket. Okay, consignee is credited. Cash sales by consignee. Cash sales by consignee. He sold the goods. He got the money. But is it his money? Is it his money? It is our money. So what will happen? Oh, pencil also low, it seems. Okay. Okay, cash sales by consignee. So what will happen? It is our money. So consignee account debited. Why? Consignee has to give me money. To consignment account. Why consignment account is credited? Because it is income. This is nothing but credit sale entry. No. Credit sale entry. I didn't get the money. Debtor has to give me money. This is the debtor for me now. Sales account credited. Sales is sitting over here. Income is credited over here. Okay. Credit sales by consignee. He made credit sales. No problem. Still he has to give me money. Consignee account debited to consignment account. Income is recorded. Amount sent by consignee to consignor. End of the month, end of the quarter, whatever it is. They might send some money, right? So when they are sending some money, remember, bank account debited because we got it. Who gave us? Consignee. So to consignee's account. Now amount sent by consignor to consignee. Amount sent by consignor to consignee. He has some expenses and all, right? So we might give some money sometimes. So consignee account debited to bank. Abnormal loss. Abnormal loss we already calculated. We already learned how to calculate it. Abnormal loss account debited to consignment account. Usually abnormal loss account debited to trading account, but here consignment account, because from consignment account we are removing the goods. And P&L account debited to abnormal loss. Clear? Closing stock. Closing stock, you are writing consignment closing stock account debited to consignment account. You are removing from consignment. It might be at invoice price or cost. Okay, now remember one thing. For opening stock, what is the entry? Consignment account debited to consignment opening stock. Okay, usually opening stock entry in our regular final accounts is trading account debited to opening stock. So instead of that, consignment account debited to opening stock. Your closing stock entry is closing stock account debited to trading account. Here it is closing stock account debited to consignment account. Okay, stock reserve. Stock reserve is what? Unrealized profit. Now, when goods are sent at invoice price and closing stock is there in consignees go down. In that closing stock, there is a profit. But that profit, is it earned yet? It is not yet earned because it is not yet sold. So therefore, what will happen? You have to pass one entry for stock reserve. Stock reserve is just removing this profit which is already recorded. So now you will pass the entry consignment account debited. Only if you debit, you can remove the loss. You can remove the profit. So therefore, debited to stock reserve. And this stock reserve will be reduced from the closing stock. Clear? It will be reduced from the closing stock. Same way, last year on the opening stock also they have created. Last year's closing stock is this year's opening stock. In closing stock of last year, they have removed the profit. So now what will happen? Last year's unrealized profit is this year's realized profit. So what will you do? Stock reserve account debited to consignment account. This year's unrealized profit I am removing, consignment account debited. Last year's unrealized profit they removed from last year, but this year we are expected to sell it. So that is this year's profit, realized profit. Clear? Now commission. Commission payable to consignee. Commission payable to what? Consignee. Now, there are different types of commission over here. One is normal commission. Take the sales, multiply into the percentage, you'll get the commission. Now, in this case, bad debt is the loss of whom? Consignor only. Consignor only is going to bear the bad debt. Del Crader commission. Del Crader commission, what you're going to do? Again, sales into percentage only. But in Del Crader commission, bad debt is the loss of the consignee. In Del Crader, what we are telling, boss, you do one thing, you go on doing sales, no problem. I'll give you higher percentage. But loss will be on your head. Because just because you want to earn commission, if you go on doing credit sales and you don't recover it, I am under trouble, no. So I'm telling, okay, I'll give you Del Crader commission. What commission percentage you want, you tell, take. But if there is bad debt, that's on your head. Clear? You don't want to take the risk, then I'll give you lower commission. You are ready to take the risk, I'll give you higher commission. Is this clear? Now, overriding commission. Overriding commission is what? Up to 1% I'll give you normal commission. Normal sales into normal commission. Plus extra sales you make, you'll get extra commission percentage. Clear? Now, profit on consignment. If there is profit on consignment from consignment account, you will transfer it to P&L account, and loss on consignment from, you will debit it to P&L account and you will credit it to consignment account. Now, in the books of consignee, which is usually rarely asked, consignor only is focused on. Goods sent to consignee, no entry. You got the goods, it's not your goods, no entry at all. Goods returned, no entry. Expenses paid by consignor, no entry. Paid by consignee, entry is there. Consignor has to pay you money, so consignor account debited to bank account. Sales, cash sales, entry is there. Bank account, you got money, but you have to give this money to somebody, to consignor. Credit sales, what will you do? Credit sales, customer account debited. You have your customer account debited. You have to give this money now to whom? Consignor. Amount received, what will you do? Del Crader commission. No Del Crader commission. If there is no Del Crader commission, what will you do? Bank account debited to customer. Del Crader commission is there also, bank account debited to customer only when the amount is received. Bad debts. Bad debts, what you'll do? Del Crader commission is there. Del Crader commission is there. Bank bad debts account debited to customer, and this bad debts will be, see over here, it will be adjusted with the commission income. Your commission income is there now. With that, the bad debt will get adjusted. If there is no Del Crader commission, bad debt is not your responsibility. Consignor account debited to customer's account. Consignor will bear this bad debt. Commission, when you're getting commission, what will happen? Consignor is supposed to give you commission to commission income account. Amount sent by consignee. You are sending money now. You are sending money. Consignor account debited to bank. We saw all this in the other side. So this is just like a mirror image. Joint venture is our next topic, which we'll see later. Now we'll see consignment questions. Finish it. That's it for the day. Okay. Now, in December, I don't think there was a consignment question. There was no consignment question in December. June 2025, there was one consignment question, 6A. 6A was a consignment question in June 2025. Yes, let's get ready. Now, Ram of Patna consigns goods to Sham of Delhi for sales or sale at invoice price or above. Terms are given. Now, first we'll go and check. And what did they tell? Prepare consignment account, Sham account in Ram's books. Ram's books means who is Ram here? Ram is the consignor. Consignor's books only. Clear? So, consignment account, Sham's account. Goods sent on consignment account. 3 ledgers and some workings to calculate closing stock, that is blah blah blah. Okay. Now, commission to Sham is 5% of invoice price plus 25% on any surplus realized. Extra if you get, you'll get 25%. Ram draws a bill on Sham at 90% site for 80% of the invoice amount as security money. Ram is very smart. Not just giving goods. After giving goods, now what he's doing? He's drawing bill of exchange. Telling that, boss, if you run away with the goods, what am I responsible? Actually, if he runs away with the goods, no, bill also gone, no. What will you do holding that paper over here? Okay, now, Sham remits the balance proceeds after sales, deducting the commission by side draft. Okay, now, details. Goods costing 20,900 including freight invoiced at 28,400. Who sent the goods? Ram. So if you see, consignment account debited 28,400 to goods sent on consignment account 28,400. Done. But in this, do you agree that there was profit? How much was the profit over here? 28,400 minus 20,900. There is a 7,500 profit. Remember, removal of loading effect immediately. Reverse this only. So now what happens? Goods sent on consignment account debited 7,500 to consignment account. 7,500 got nullified over there. Next, after that, sales made by Sham. Who made the sales? Sham made the sales. What will be the entry? Sham has to give me money now. Sham account debited to consignment account. Sham account debited 26,760 to consignment account 26,760. Next, after that, unsold goods invoice price. Original cost including freight was 5,220. They told you the closing stock invoice price, closing stock. Now closing stock 6,920. So remember the entry, closing stock on consignment account debited to consignment account. But then what happened now? We have to create stock reserve. They have told the cost price also, no percentage and all. Directly they have told the cost price 6,920 minus 5,220. 1,700 is unrealized profit. So you'll create stock reserve. What is the entry for unrealized profit? Consignment account debited to stock reserve. Consignment account debited to stock reserve over here. 1,700. Clear? Now, after that, site draft received up to 31st December 6,280. Others are in transit. Okay. Now, understand one thing. What was the bill amount? 28,400. They told no, 80% we are going to draw a bill. So 80% bills receivable. Sham has to give me money now. Bills receivable account debited to Sham. 28,400 into 80% should give you 22,720. 22,720. Is this clear? Yes. Now after that, 22,720, yes. But then they also gave a draft. Draft is just like a check. So what they wrote over here, by bank account they could have written, but they wrote by draft account 6,280. They got a draft over 6,280. Clear? Now some other amount also is there. Everything they sent, but that is in transit. For that we have to first know what is the commission. If I know the commission, then I'll get to know what is the total amount. When I know the total amount, I'll be automatically able to calculate the balance which is in transit. Now, how to calculate commission? How to calculate commission? They told 5% on invoice price, 25% on any surplus that is realized. Now, here we have to understand one thing. Sales made is 26,720. Okay. Now, goods costing including freight, how much did we give? 28,400. Clear? What is the invoice price that is remaining? 6,920. 6,920 invoice price is remaining. Correct? Unsold goods. 28,400 minus 6,920. 21,480 sold. It is sold. But it's sold at what price?
26.
Yes, sold at 26,760. This much is the invoice price. On this, how much percentage commission I'll give? 5% commission. So 21,480 on that 5% commission, 1074. And for that extra 26,760 minus 21,480, that is 5280. On that, how much commission I will give? 25% commission. 1320. 2394 is the commission. Consignment account debited to Sham account. 2394. Now what happened? Whatever balancing figure is there over here, that is profit, got transferred. And here, whatever balance is there, now balance carried down 5536. Now what is this? 902 over here. Whatever balancing figure 902, whatever amount is there, no, he has to give the money. 80% he told, 20% he still, and balance 20% draft he told. So therefore balance 20% will be 902. Balance carried on 5536. Okay, balance carried on 5536. Is it clear? Are you following this? Okay, now after that what we have? Nothing we have, no. Prepare consignment account. How will you close this? Goods sent on consignment. Goods sent on consignment, 28,400 is there. This is reversed, and whatever amount is there, this will go to trading account. It will go to trading account. Clear? That should be it. That should be it. And they've shown the calculation for the commission also. And they've shown the calculation for 902. If you want the calculation for 902, that is also there over here. How will you get? Sales is given 80%, which we already calculated. Okay, security money of that particular amount 5536 less bills drawn is given. Commission amount also is given. Balancing figure, when you remove all the draft and all, you'll get your 902. That shouldn't be a problem. Okay, June 25 they asked. We don't know, there is no pattern, but they're asking. Okay, June 24, December 24. December 24, incomplete records is there. Consignment. I can't find any consignment question in December. No consignment, 3A not there. After that, you have June 24. June 24 branch accounts we can find hire purchase, consignment. Now, consignment account, Jatin's account, loss in transit account in the books of Kush. That means 3A, that means it is for 7 marks again. 3A. Okay, alternative solution and all they have given. Okay, we'll see. Now, let's start. Where did it go? June. Okay. June. Kush of Kanpur sent to Jatin of Jaipur a consignment of 400 electric sewing machine costing 24,000. Invoice value is 30,000. Now, first of all, consignment account, Jatin's account we want. Okay, in the books of Kush. So now, entry is what? Consignment account debited to goods sent on consignment 96 lakhs. How are you getting 96 lakhs? You will take 400 and multiply into 30,000. 400 into 30,000. I think that they have shown in alternative solution. They have taken here alternative solution. There they took it as cost only. They took it at cost. Now even if you take it as cost, what will happen? It will just get reversed, right? If you take it as invoice price, you'll just reverse it over here, so you don't have to worry too much about that. So therefore, what are they talking? Somebody is asking something. Law marathon, guys, no sir. It's already there on channel, I think. I don't think there is a law marathon happening in Chennai. Yes. Now, listen. Consignment account debited. Now here, instead of taking cost, if I take invoice price, then what I'll do on the opposite side, I'll put the loading effect, I'll remove. So we will look at this solution. Already we saw the invoice price solution in the previous one. Here, what we have to understand after that. After that, Kush paid freight. Who is Kush? Are you Kush? You are only Kush in the books of Kush. Okay, Kush paid freight and insurance of 96,000 paid. So consignment account debited to bank account. You paid 96,000. Consignment account debited to bank account. After that, Jatin spent 31,200 for clearance and selling expenses were 1,500 per sewing machine. So Jatin paid 31,200. So consignment account debited to Jatin's account 31,200. Jatin has to be paid for this particular amount. Now selling expenses we will be able to see only after we know exactly how much they are selling. So how much is the selling expense? They said 1,500 per sewing machine as and when the sale is made by Jatin. In transit, 10 sewing machines were stolen, for which insurance company paid 1,85,000 in full settlement to Kush. 10 sewing machines are stolen. Abnormal loss. So now you have to calculate abnormal loss. Abnormal loss. Okay, no calculation is showed. Very good. Now, how many machines are stolen? 10. 10 into, what was the value per machine? 24,000. 10 into 24,000, that gives you 2,40,000. 2,40,000. And it is stolen where? It is stolen in transit. In transit, that means this clearance, selling expense and all will not be applicable only. What is applicable? Only this 96,000 which was spent, because 96,000 was sending the goods. So 96,000 is for 400. 96,000 is for 400. But how many are stolen? 10 into 10 divided by 400. 96,000 into 10 divided by 400. 2,400. That means your total loss is 2,42,400. loss in transit. Can you see they have opened one loss in transit account? Usually we call it as abnormal loss. Loss in transit account debited to consignment account. To consignment account. Is this part clear? Now after that you have one more thing. Jatin sold 210 sewing machines at 32,000 per sewing machine. 210 into 32,000 gives you 67 lakh 20,000. Sir, calculator is feeling sleepy, sir, not giving the answer, sir. Okay. Next, then 130 sewing machines for 35,000. 130 into 35,000. 45 lakh 50,000. Trust issues. 45 lakh 50,000. Clear? Jatin was entitled to commission. Over. Forget it. 67 lakh 20,000. That means we have 1 crore 12 lakh 70,000 of sale. 1 crore 12 lakh 70,000. Clear? 1 crore 12 lakh 70,000. Jatin account debited to consignment account. Jatin account debited to consignment account. Now we know one more thing which we can calculate. Selling expense of 1,500 was there per machine. How many machines we sold? 210 plus 130, 340 into 1,500. 5 lakh 10,000. 5 lakh 10,000 is the selling expenses. Tell me what should be the entry? Consignment account debited 5 lakh 10,000. Consignment account debited to Jatin because Jatin would have paid the selling expenses. Clear? After that, they said that Jatin was entitled to a commission of 5% on the total sale value plus 1/4 of the amount by which the gross sales proceeds less total commission thereon exceeds the invoice value. This is a very regular adjustment of consignment. So now basically what we are going to do, Jatin's commission 300 and where is it? Wait 1 second. 340 or 340? 340 machines. Okay. But calculator on total sales value. Total sales value we know 1,12,000. I mean 1 crore 12 lakh 70,000. 1,112 70,000 into 5% on sales value plus 5%. How much are you getting? 1,112 70,000 into 5%. You got 5,63,500. This is one commission that you are going to get. Then after that they said 1/4 of the amount by which the gross sales proceeds less total commission thereon exceeded the invoice price. Exceeded the invoice price. What was the invoice price? 30,000. So how many we sold? Not 130, 340 I think we sold. So 340 into 30,000. 340 into 30,000. 1 crore 2 lakhs. So what you will do now? 112 70,000 minus 1 crore 2 lakhs minus 563 500 into what did they tell? 25%. 25% into 0.25 plus 563 500 690 125. Did you get this or should I show the calculation? Okay, everyone is sleepy. Fine, I will show it. No issues. Okay, now listen. Understand this language over here. Total sales value plus 1/4 of the amount by which this gross sales proceed exceed the total commission thereon. Now see over here. How much is my invoice value? This is my invoice value. I sold it for 112 70,000. So 1 crore 12 lakh 70,000. From this remove the invoice value 102 00000. 112 70,000 minus 10 lakh 70,000 extra sales. 10 lakh 70,000 extra sales. But out of that, 5 lakh 63,500 I already gave you commission now. I can't calculate commission on that only. That also minus 563 500. How much are you having? 5 lakh 6,500. 5 lakh 6,500. Sure? Yes, 5 lakh 6,500. I am going to give you 1/4 of this. I am going to give you 1/4 of this or 25% into 25%. 126 625. For extra sales I am giving you 126 625 and for normal sales I already told you I'll give you 563 500. 126 625, that means 690 125. Are you getting 690 125? That means consignment account debited to Jatin's account. Consignment account debited to Jatin's account. Clear? Now The final due amount was settled. That's all. Now what you're going to do? Consignment stock. Stock you have to calculate. Now stock only is the calculation which you have to be a little careful. Now if I can sneak it in here, I'll show it. 50 remaining. We sent 400, in that 10 got lost, 390, 390, in that 340 is there. 340 machines are there, 340 machines. In that the stock cost was how much? 24,000. 340 into 24,000. 81 lakh 60,000.
340 sold. 50.
We have to calculate only on 50, no? Good morning, yes. 50 into how much? 24,000. 12 lakhs. Correct? Now you have to just add the proportionate expenses. How much did Jatin spend? He spent, I mean not Jatin, how Kush spent 96,000. 96,000, forget this total and all. 96,000 into 50 divided by 400. 12,000, yes. After that, one more is there. What is that? Jatin spent 31,200 for clearance. Now 31,200 into 50 divided by, no, 390. Because Jatin received only 390. He cleared only 390. How much are you getting? 4,000. This only is the 12,16,000 which is sitting over here. Closing stock on consignment. Is this clear? Remember, goods are lost in transit. So he received only the remaining goods. So he cleared only the remaining goods. So only on the remaining goods he paid the customs or whatever the clearing charges. It is the 12,16,000. Closing stock on consignment. This is balancing figure. It will go to P&L. We don't have to worry. And they said everything is cleared. Like last question, bills of exchange, that this blah 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 was not there. So this amount fully he settled. Whatever balancing figure over here getting, he settled this. Whatever balancing figure you are getting here, it's profit, it's transferred to P&L. Now loss in transit, you have to be a little careful over here. They told that when the goods are lost, they said insurance company gave us 1,84,000. See over here, bank account debited to loss in transit 1,84,000, or usually insurance company account debited to loss in transit 1,85,000. Whatever balance is there, loss no, goes to P&L. Remember the entries again. Abnormal loss account debited to trading. Here we don't have trading. Abnormal loss account debited to consignment. Then after that, if insurance company is giving, insurance company account debited to consignment. Insurance company account debited to abnormal loss. Now whatever they are not giving, P&L account debited to abnormal loss. Clear? Done, done, done. This account is nothing but the same thing. You'll get the same profit. But what they have done is they have reversed it by creating loading effect. They have taken it as invoice price over here. There we have taken it as cost. Clear? That should be it with June 2024. One more we have December 2023. December 23 lease, bills of exchange. Because they asked bills of exchange, I don't think there is consignment. Yeah, branch accounts, they had asked bills of exchange. So with that, we are done with consignment also. So let's wind up for the day, guys. See you tomorrow. Bye-bye. Hello guys, welcome to day 2. You guys were not there yesterday. Where were you? You didn't know about it. Okay. But you were there online yesterday. Okay, so day 2 guys of marathon. So today the topics that we are going to cover, bare minimum we are going to cover. If we get time, we will cover even the next topics after that. So the topics that we are going to cover is joint venture, final accounts, incomplete records, NPO. These 4 minimum we are going to cover, and after that, if we get time, we'll start the next topic as well. Good evening, sir. Even though I don't have time or confidence to pass the exam, your teaching made my hope go higher to risk it and pass the exam. Wow. Yes. Just revise, guys. See, in all these professional exams now, the major thing is you should not give up till the last moment. So first only you should not decide that this attempt is gone. You should give it your best. You never know. Sometimes things can just go in your favor, especially with every subject having this 30 marks of MCQ, right? If something goes right, even with like 60 to 70% preparation also, you can still clear the exams. So do not give up. So let's start with first chapter for the day, joint venture. Joint venture, you have one person called as Pavan and one person called as Narayan Murthy. Joint venture is what? It's a temporary business. What is joint venture? Temporary business. So temporary partnership. Okay. Why do we call it as temporary partnership? Because here we are coming together for one particular purpose, and when that particular purpose is over, we are ending the partnership itself. Clear? Now, for example, imagine Pavan and Naran Murthy, they are entering into a deal for making a software for Tesla, okay, for Indian roads. So now once that software is ready, that's it. Then they will not have any relationship in their particular business. They'll go back into their respective business. Now, when the software for Tesla is ready, Pavan and Naran Murthy have no business relationship whatsoever. Clear? Now, we are going into accounting. Here, accounting, you have to be a little careful. There are multiple situations that we have to look into. First one, separate set of books are maintained. Separate set of books are maintained means what? For this particular joint venture, right? We will maintain separate set of books. We will not merge it with their regular books which they are already using. So there is joint bank account, there is joint venture account, and there is co-venturers account. To record all bank transactions, we use this. For recording the profit or loss, we use joint venture account, and to record the personal transactions, we use the co-venturers account. Then we have second situation, that is separate set of books not maintained. If separate set of books are not maintained, then what we will do? It is not maintained. We don't have a separate set of books, so somebody has to record it. Who is that somebody? Both co-venturers. Both co-venturers will record all the transactions in their books. All the transactions related to joint venture they will maintain in their books, or both co-venturers will record only their transactions in their books. Now what happens? If you are going to record only your transactions, if you are going to record only your transactions, then what you have to worry about is who will calculate the profit or loss. So just for calculating profit or loss, one extra fitting will be there, that is called as memorandum joint venture account. Why memorandum joint venture account? Because only if you put all the transactions, you will get the profit or loss. If you record only your transactions, how will you be able to calculate the profit or loss? Clear? So first situation is separate set of books are maintained, separate set of books are not maintained. And here we have both co-venturers who will record all transactions, and both co-venturers will record only their transactions. Clear? Now we go into the next situation. Separate set of books are maintained. What will happen? Now remember, what are the ledgers I told you which are there in separate set of books? Joint bank account, joint venture account, co-venturers account. Now whatever happens, the entry has to be between these three ledgers only. There cannot be any new thing that is going to make an entry over here. Now, amount contributed by co-venturers. Amount contributed by co-venturers. What should be the entry? They put money. They put money to start this partnership, which is a temporary partnership. Joint bank account debited. Bank balance increases to co-venturers account. Why we are crediting co-venturers? Because they gave us money. Someday the business has to return the money to them. So they become a liability for us. Next, expense of venture paid from the joint bank account. Expense of the venture paid. But from where we paid? The money that is contributed over here. From it, here it is paid. Clear? Someone is telling, sir, on the way, sir, on the way, sir. I think someone is coming to class and they're putting it over. Okay, come, no issues. What and all doubts these online people are getting. How, sir, in your tab, same time from the live till end. You can see that 9:41, that is some Apple default time. Whenever there is class, you will find that time only. That is the default time that Apple has created. I had read about it, why it is like that, but it's irrelevant to us right now. Okay, now, amount contributed done. Each co-venturer paid from the joint bank account, joint venture account debited to joint bank account. Expense of the venture paid by the co-venturer. Expense paid not from the bank account. It is paid from where? The co-venturer's pocket. So therefore, co-venturer has paid. The business has to return the money to the co-venturer. Joint venture account debited to co-venturer account. Joint venture account debited to co-venturer account. Now, income of the venture received. If you have received, what will happen? Bank account balance increases. Joint bank account debited to joint venture account. Because it is income, you are going to credit the joint venture account. Income of venture received by co-venturer. Income of the venture received by the co-venturer. We didn't get the money. Co-venturer got the money. He kept in his pocket. If he kept in his pocket, he is supposed to give the money back to us. So co-venturer account debited to joint venture account. Co-venturer account debited to joint venture account. This is credited because it is income. This is debited because it is receivable. Now, stock taken by the co-venturer. Stock taken by co-venturer, what you are going to do? Co-venturer account debited, because he took it, he is supposed to give us money. co-venturer account debited to joint venture account. If he has taken and that he has not given the money, but still we follow accrual concept, so income will be recorded. Now profit, if there is profit, joint venture account will have a credit balance. That credit balance you have to remove. Joint venture account debited to co-venturers account in their agreed ratio. If no ratio is given, just like partnership, you will take 1:1 equal. Loss, if it is loss, what you will do? You have to debit the co-venturer account debited to joint venture account. Now, balance in bank will be distributed to co-venturers. Balance in the bank will be distributed to co-venturers, not based on any profit sharing ratio and all, based on the balance in co-venturers account. Go and check the co-venturers account. One fellow is having credit balance of 300, give him. One fellow is having credit balance of 200, give him. When you give, no, automatically the bank balance also will become empty. Clear? Now, when separate set of books are not maintained, if separate set of books are not maintained, what will happen? Each co-venturer will record all transactions in their books. First situation is what we saw, that each co-venturer will record every single transaction. Now, joint venture account and co-venturers account. Joint venture account and what? Co-venturers account. Now I am taking an example. There is one person called as Santosh, one person called as Nishanti. So now what is going to happen over here? Both are going to record, but just see how it is going to be recorded. Goods supplied by Santosh. If goods are supplied by Santosh, now what Santosh will do? Joint venture account debited for him, it is expense. Okay, to purchase account, because goods went from his goods, so therefore goods went from his stock, so it is going to be credited to purchase account. And for Nishanti, what is going to be? Joint venture account, because see, for both, for the joint venture it is expense only, so both will be debiting joint venture in their respective books. But here Nishanti did not take these goods from her pocket. No, who gave these goods? Santosh. So Nishanti will be like joint venture account debited to Santosh, because that amount is payable to Santosh, because Santosh has contributed the stock. Next, expense paid by Nishanti. Now think of, whenever this situation is there, think joint venture debit or credit? Expense. So joint venture, both will be debiting joint venture. Clear? Now, did Santosh pay over here? No. So he will write to Nishanti's account, because we are supposed to give the money to her. Did Nishanti pay over here? Yes. So she will write to bank account. Clear? Next, sale made by Santosh and amount received. Who made the sale? Santosh. Now what you have to remember, first you see joint venture. Both are going to credit joint venture account, because for both it is a sale only, it's an income only. Now here bank account debited because Santosh has received the money. Here Santosh account debited because Santosh is supposed to get money. I mean, Santosh is debited because Santosh is the person now debtor for us, because Santosh is supposed to give money to us. Clear? For Nishanti, Santosh kept the money. For Santosh, money is already sitting in the bank account. Clear? Now, sale made by Nishanti and amount received. Now, what will Santosh do? She made the sale, but joint venture is both of us together. She made the sale. So, Nishanti has to give the money. Nishanti account debited to joint venture. And here, Nishanti received the money. So, bank account debited to joint venture. Stock taken by Santosh. Now, you are only Santosh. You took the stock. For you, it is stock account debited. You got the stock. But if you have taken something, you are supposed to give money. So therefore, you will credit it to joint venture account. Here what happened? Santosh took the stock. So Santosh has to give money, and Santosh account debited to joint venture account. If they have taken stock for the joint venture, it is income, but one person has to give the money. Now, stock taken by Nishanti. So what Santosh will do? Nishanti account debited. Why? Because it is amount receivable to joint venture account. What Nishanti will do? Got the stock account debited to joint venture account. Is this clear till here? Now, profit. If there is profit, what will happen? Which account will have credit balance? Joint venture account will have credit balance. So, joint venture account debited, remove that credit balance which is there, debited to P&L account. Our share of profit, we will put it to our P&L, and the other person's share of profit will transfer to their personal account, Nishanti's account. And same thing this person also will do. Loss, you are just going to reverse this entry. We don't have to discuss about that. Amount paid by Santosh to Nishanti. Now, end of the situation. Somebody has to give money to somebody. Two people are there. Some expenses were taken care by this person. Some expenses were taken care by this person. So therefore, one person has to pay the amount to other person. So therefore, you go and prepare the ledger. In Santosh's account, if you prepare ledger, you'll prepare Nishanti's account. And when you prepare this ledger, if at all there is a credit balance over here, that means credit side is more. That means amount is payable. If debit side is more, That means amount is receivable. Clear? So you'll pass the entry Nishanti account debited to bank account debited to Santosh account. It can be vice versa also if one person is supposed to pay to the other person. Clear? Now, separate set of books are not maintained. We have a next situation, that is each co-venturer keeps record of only their transactions. What are they recording? Only their transactions. So joint venture with co-venturer account. What you're going to prepare? Joint venture with co-venturer account. Only your transactions if you are going to record. That means you are only recording things that you are supposed to pay or things you are supposed to receive. You are not bothered about the profit and all. But in this case, what you have to do to compute profit, you have to do an extra fitting. That is memorandum joint venture account is prepared where all the transactions are recorded. Now the logic is, why is this called memorandum joint venture account? Why is this called memorandum joint venture account? Because this is a rough book. We are actually not preparing this ledger. Our goal is only to prepare this much. We are recording only our transactions in the books. But to get the profit, what I should do? I have to record all the transactions. Where will I record all the transactions? In a rough book. Whenever it is rough book, it's called as memorandum account. And here it is memorandum joint venture account. Now, in the books of Santosh. Okay, one person is there in the books of Santosh. Goods supplied by Santosh. Are you Santosh in this? Yes. Did you supply the goods? Yes. So you will write joint venture with Bhumika account debited to purchase account. Joint venture with Bhumika account debited to purchase. Because you gave the goods, for you it is receivable. You have to get the money. Clear? Goods supplied by Bhumika. No entry. Ignore. Because that person will pass the entries. Expenses paid by Santosh. You paid. So you have to get the money now. Joint venture with Bhumika account debited to bank account. Now, expense incurred by Bhumika, that person paid, so you don't have to bother, no entry. Income received by Santosh, income received, that means it is payable now. You have to pay that money back. Bank account debited to joint venture with Bhumika's account. Income received by Bhumika, that person received, no entry. Now, stock taken by Santosh. Stock is taken by Santosh, that means Santosh has to pay money for this particular thing. Stock account debited to joint venture with Bhumika's account. Stock taken by Bhumika, ignore. Profit, only Santosh share. Santosh share of profit is receivable or payable. It is receivable. So joint venture with Bhumika account debited to P&L account. If it is loss, ulta P&L account debited to joint venture with Bhumika's account. Amount received by Santosh. Now somebody has to give money to somebody at the end of the situations because two people are there in a joint venture. Net amount will be payable or receivable by either of the parties. Now amount received by Santosh, bank account debited to joint venture with Bhumika's account. If amount is sent by Santosh, it will be joint venture with Bhumika account debited to bank. With that will be done with the joint venture. Clear? This is the concept of joint venture. Not every attempt it is asked, but if it is asked, it's an easy question to lose marks on. Sir. Sir, today will you cover single entry? People who joined late, guys, today we are going to cover after this final account, single entry and NPO, all three topics. Then only we are going to sleep tonight. Okay. Sandia. Who is Sandy? Sir, can you explain how to present these to answer paper after class? Yes, we'll do that. We'll do at the end of the session. Let's finish the syllabus first. Okay, at the end we will discuss all these things, maybe 10-15 minutes. I'll tell you how to present and all that. Okay, first the most important thing is being able to solve, right? If you're able to solve, presentation little, that's why they said also, still will fetch us 80 to 70% of the marks. Okay, so don't worry about it. First we'll learn to solve. Let's go and check the question papers now. For joint venture in December 2025, they asked a question. December 25, there is a question from joint venture, 7 marks only. 7 marks only. Now what you're going to see, directly go and look at the end of the question. Memorandum joint venture account, joint venture with Sonu in Raj's book. That means which method they are following? Separate set of books? No. Not, are they having no separate set of books? Yes. But are they recording all the transactions? No. This is the third situation because they said memorandum joint venture account. Now tell me one thing. In memorandum joint venture account, what will happen? All transactions. Clear? Because we have to find profit. In joint venture with Sonu account, what will happen? Only, no Sonu, Raj. Only Raj's transaction. Because you are preparing in whose books? Raj's books. Only Raj's transaction will be recorded. Clear? 3A. Yes, this is the memorandum joint venture account. This is the joint venture with Sonu account. Now in the exam, no, presentation. People are talking about presentation, right? In the exam, you cannot sit. Okay, in the exam, you cannot sit and tell that first I will prepare memorandum joint venture account, then I will prepare joint venture with the Sonu account. You have to keep both the ledgers open. Now all the transactions will be recorded here. Here only your transactions will be recorded. Who is you? You are Raj in this particular case. Clear? So let's start. Raj and Sonu decided to work in joint venture with the following scheme, agreeing to share profits and losses in the ratio of 3:1. They guaranteed subscription of 5 lakh shares of 20 each in Rainbow Limited and to bear all expenses up to allotment. So what they said, they are going to ensure that Rainbow Limited shares are subscribed. This is the work that they are going to do together. In consideration, Rainbow Limited will issue 30,000 shares of Snow White Limited at the rate of 20, fully paid up, and 1% commission in cash will be taken by Raj and Sonu equally. For doing this work, what they are going to do, Rainbow Limited, they are going to issue shares in one particular company, and they're also giving the commission in cash. Now, Raj spent 16,500 as stamp charges. Who are you? Raj. So in memorandum joint venture account, obviously this will be there 16,500. You're going to write to Raj just to tell that who made the payment. And then in joint venture with Sonu account, obviously it will be there. Joint venture with Sonu account, what will be the entry? You are Raj, right? You are paid, right? You are Raj. You are paid. What should be the entry for this? Memorandum joint venture account debited. Joint venture with Sonu account debited to bank account. Can you see all the expenses are put together over here? Now, 16,500 is the first expense that you have paid. Next, after that, 15,000 as advertising. Who paid this advertising? Raj. So it will be there in joint venture, memorandum joint venture account, and it will also be with joint venture with Sonu. So you have paid 15,000. Clear? Next, after that, what you have done? 35,000 towards car expenses. So it will be there in joint venture with Sonu because it's all transactions should be recorded in joint venture with Sonu. And then you are going to show the car expenses of 35,000 here also. Receivable, that's why you are debiting it, is receivable for you. Next, printing charges, okay, done. Similarly, Sonu spent 13,000 towards rent. 13,000 towards rent, but you won't find it over here because it is their transaction. Then Sonu spent 10,000 towards legal charges. That will be there over here, but you won't find it over here because it is going to be recorded by Sonu itself. Next, application fell short by 20,000 shares and Raj introduced necessary cash for purchase of these shares. So our job is to what? To do underwriting work. What we are supposed to do? Underwriting work. Get the shares subscribed by the public. Now all the shares were not subscribed by the public. So now what is going to happen? 20,000 shares we have to buy. And to buy that, I don't have money. So who is going to introduce money over here? Raj. And per share, what did they tell over here? 20 rupees. So 20,000 shares into 20 rupees, that is going to be basically 4 lakhs. Who is going to pay this 4 lakhs? Raj is going to pay the 4 lakhs. So in the memorandum joint venture account, this should be there on the debit side because it's an expense. Now here what is going to happen? Who is going to pay? Raj. So joint venture with Sonu account debited to bank account 4 lakh. I think now when you add all this 435, 450, 466, 500. Yes. Total amount is 466, 500. Next, after that, what is going to happen? The guarantee having been met, Rainbow Limited handed over the shares as agreed and paid the commission in cash. Handed over the shares. All shares were subsequently were sold at 19 rupees per share and the co-venturers share the proceeds equally. All shares means how many shares we are getting? 30,000 shares we are getting in Rainbow Limited. 30,000 shares if we are getting and it is sold at 19 rupees per share. 30,000 into 19 rupees, 5,70,000 we got. Now what we are going to do with this 5,70,000? It is going to be shared equally. So 2,85,000 will be kept with Raj and 2,85,000 will be kept with Sonu. So now you can see here you will have proceeds from shares. 4,75,000. Yeah. Isn't it 19? Oh, 3:1 ratio. Sorry, my bad. 5,70,000. No, they said proceeds equally, right? 3:1 is profit. Proceeds are equally, right? Yes. See over here. In consideration, Rainbow Limited will issue 30,000 shares of Snow White Limited at 20 rupees each, fully paid up. But here they said it was sold at 19 rupees per share. So here, first what you're going to do, Rainbow Limited, 30,000 into 20. No, you're not getting 20, you're getting only 5,70,000. So basically, proceeds from share 4,75,000, 4,75,000. How is it 4,75,000? Three is to 1 only is the ratio. That is also not 4,75,000. Yeah, that's what. And have they shown any calculation? No. Now see, I hope you're getting what the mistake is. The mistake is, so see over here. Guys, how to present we will see at the end, guys. So many people are asking. Now see over here. They said over here that guaranteed subscription of 5 lakh shares. Don't bother about this 5 lakh shares. 5 lakh shares in which company? In Rainbow Limited. 5 lakh shares in Rainbow Limited. Now you cannot take 5 lakh shares into 20 and do any calculate. It will come to 1 crore. That is what we are telling. We'll help you get the 5 lakh shares. And for that, what you will give us and bear all the expenses up to allotment, what you will give us in consideration, you will give us 30,000 shares in Snow White Limited at rupees 20 fully paid up and 1% commission in cash. 1% commission in cash. So 30,000 into 20 if you do, you'll get 6 lakh. Okay, now we are not bothered about that 20 because later on we got the shares at 20. But if you see over here, all shares see, guarantee having been met, Rainbow Limited handed over the shares as agreed and paid the commission in cash. Shares were there, no. How many shares they gave? 30,000 shares. Now, this is sold at 19 only. 5,70,000 only. We got 5,70,000 if you divide into 2. 5,70,000 divided by 2, you are getting 2,85,000 and you are getting 2,85,000. This is the amount that we received. Correct? Sir, 50,000 shares. This is no. Yeah, there is one more shares, guys. That is what we missed. See over here. This 20,000 shares are also there. Now 20,000 shares are also there. No, we got 20,000 shares. Application fell short, so we bought that 20,000 shares. When we bought, we put money, but when we sold, what we will do? We'll just sell it off. Why will we keep those shares? 20,000 shares are also there, and those 20,000 shares, all the shares were subsequently sold. This is also into 19, so 50,000 into 19. I think now you should get the amount. Yes, 4,75,000. Now you'll get yes. 50,000 shares. Now, if you're thinking, no, this 50,000 and this 30,000 and 20,000, are they of the same company? They are not of the same company. One is of Rainbow Limited. One is of the other company, Snow White Limited. So therefore, 50,000 into 19, 50,000 into 19, 9,50,000 divided by 2, 4,75,000. 4,75,000. I think now it should match 4,75,000 and 4,75,000. And here you are going to put only one 4,75,000. Why only one 4,75,000 is put? Because we are recording only our transactions. That should be it. Now what you're going to do, one more thing that is supposed to be calculated is what? Commission of 1%. Now commission of 1% is to be computed. Now commission on what? The shares that we are getting subscribed. We are helping you to subscribe the shares. How many shares are there? 5 lakh shares. How many shares are there? 5 lakh shares into, what is the price? 20 rupees. So 5 lakh into 20 rupees, that is going to become 1 crore, no? 1 crore. On that 1 crore, we will get 1% commission, and that 1% commission is 1 lakh. This 1 lakh also will be shared equally. That is going to be 50k and 50k. In memorandum joint venture account, you will put both the 50,000s. But in joint venture account, what you will put? You will only record your 50,000. Now, whatever profit you get, this is not shared equally. This is shared in the ratio of 3:1. And what Raj will do? Raj will take his share of profit and enter it over here. 423.75. Now finally you see it's just a personal account. Just check which balance is more. Debit balance is more, credit balance is less. Therefore, Raj has to get money. So Raj is writing over here by bank account final settlement. Who is going to give the money over here? Sonu will give it to Raj. In case exam, they would have asked you to prepare the ledger in the books of Sonu, right? That time there it would have been a credit balance because Sonu is supposed to make a payment to Raj. Clear? But the balance will be 361,875 only. Yes, that should be it with that particular question. Now, again, hypothetical situation this is because 20,000 shares are of one company and 30,000 shares are of another company. Not this 50,000 over here, sorry. 20,000 of one company and 30,000 of another company. Now, what you have to remember is, but both the company shares ended up selling at 19 rupees per share only. Yes, that was in December 2025. Let's go and check June. June consignment was there. I don't think there is a joint venture question in June. After that, December 2024, hire purchase, incomplete records, partnership. Do we have joint venture anywhere? No, no joint venture. June 2024, hire purchase, incomplete records, branch, insurance claim. I don't see any joint venture there. Then finally, December 2023, incomplete records, bills of exchange, branch, insurance claim, nothing. So for all these attempts, they asked in this particular attempt, recent attempt only, they have asked joint venture. Now bills of exchange, joint venture, consignment, they shuffle and ask. All three they cannot ask in one particular attempt, so they shuffle that and ask. So with that, we are done with the very small topic, that is joint venture. Please go and revise. Okay, easy 7 marks if it comes in the exam. Now the next small topic that we are going to discuss is final accounts. Small topic it is. Now final accounts, you have to understand one thing. What are the three things that are there in this particular chapter as per the module? It is not just final accounts. There are three things put together. What are they? One is final accounts of sole proprietor. Another one is what? Incomplete records. And another one is what? NPO. All three together is one chapter actually. Now tell me one thing. You start thinking from the examiner's point of view, who is setting paper. If a person is setting paper, don't you think incomplete records only they will put? That them putting incomplete records is becoming easy for them. You know why? They want to test your trading account, P&L account, balance sheet. That is getting tested in incomplete records also. But in incomplete records, along with trading account, P&L account and balance sheet, they are also going to test whether you know to complete the situation which is incomplete. So basically, if they ask incomplete records, final accounts also gets tested and the other part also gets tested. But you have to prepare for both and go. Final accounts is actually a very common topic for commerce students, which we have been seeing from a very, very long time. Yes. Now, trading, manufacturing. Two things are there. Trading account, manufacturing account. If you're doing only trading, that means you're buying and selling. That time you will prepare trading account, P&L account and balance sheet. What is the purpose of preparing trading account? To find the gross profit. What is the purpose of preparing P&L account? To find the net profit. What is the purpose of preparing balance sheet? It is the position statement, seeing the financial position. Clear. Manufacturing account, if you're doing manufacturing, you will prepare one account extra, that is called as manufacturing account. In that, what will be there? What is the purpose of manufacturing account? To find the cost of goods manufactured. Trading account will look like this. Okay, very regular. We'll just run through this. 2 opening stock, 2 purchases, but here you have to remember purchases less returns. If there are returns, here only subtract it, then enter it over here. Then by sales less returns. Remember, sales return has to be subtracted. It will be there in the trial balance or wherever you find in the question, minus the sales return, then only you are going to record it. Clear? Direct expenses. Gross profit carried down to P&L or gross loss carried down to P&L. Closing stock, we saw yesterday in the adjustment part, where will closing stock be given? Either it will be there in the trial balance, that means directly you are going to put it to balance sheet. If it is there outside the trial balance, that means adjustment needs to be done. You will put it into trading account and the second effect will be into the balance sheet. Is this clear? Now, P&L account. In P&L account, what is going to happen? Whatever gross profit is there, it is going to be brought down. Whatever gross loss is there, that is going to be brought down. Then all the indirect expenses, that means the expenses or incomes which were not directly related to our trading activity, that will be there over here, indirect expenses, and here it is indirect incomes. Then net profit will be carried forward to P&L appropriation account. Even though it is sole proprietor, they sometimes ask you to prepare the P&L appropriation account. That is basically to show the distribution what you are going to do to the owner. Okay, it will be transferred. Your loss will be transferred to P&L appropriation account, and from there you will distribute the profit to the owner. Balance sheet. How are you going to prepare balance sheet? Do you have a specific format in a sole proprietor's balance sheet? No specific format, but just try to ensure all non-current assets you keep it on top, and the current assets will be written at the bottom of the balance sheet, and capital and its adjustments will be on top. Then non-current liabilities, that means loan and other things over there. Then current liabilities will be written down below. Clear? Now P&L appropriation account. Now you know in partnership very regularly you prepare P&L appropriation account. So here what you have to worry about, net profit is brought down. Net profit, usually you should not call it as dividend, but CMA Institute, they usually call it as dividend only. For that reason I'm writing over here. Otherwise dividend is basically company giving profit to its shareholders. Clear? They write dividend. Dividend is nothing but share of profit. Okay, distributing the share of profit to the owner. Then you transfer to general reserve. Usually sole proprietor doesn't prepare general reserve, all those things he doesn't do. Okay, but if they tell in the question 1/10, 2/10 and all, if they tell you have to transfer it, so to general reserve, and this general reserve will be shown on the balance sheet liability side. And to capital means this will be going to the balance sheet and it will get added to the capital in the balance sheet. Clear? 99% of the times we don't prepare this P&L appropriation for sole proprietor. All these adjustments are there. No, in the balance sheet on the liability side only we do it and we close it. Clear? Now, manufacturing account. Let's see how a manufacturing account looks. Trading account purpose was to calculate profit. Trading P&L account purpose was to calculate profit. Manufacturing account, the purpose is actually not to calculate profit. It is not to calculate profit. What is the purpose of manufacturing account? The purpose of manufacturing account is to calculate the cost of goods manufactured. Cost of goods manufactured. Now, opening WIP, closing WIP. Now, if there is a manufacturing account in stock, no, you will have three types of stock. That is raw material, work in progress, and finished goods. Clear? Raw material, work in progress, and finished goods. Raw material, okay, will go to manufacturing account. Work in progress will go to manufacturing account. Finished goods will still be shown in the trading account. But all the stocks, closing stock will go to balance sheet. It will go to balance sheet. Closing stock will go to balance sheet. So now can you see opening WIP, closing WIP. To opening stock by closing stock. Regular adjustment. Now raw material consumed you are going to calculate. Here opening stock of raw material plus purchase of raw material minus closing stock of raw material. Clear? This is your raw material consumed. This is your raw material consumed. Now what you are going to do after that? Direct wages. All the direct expenses, whatever is required to manufacture the goods, everything will be entered in the manufacturing account only. Direct wages, direct expenses, other expenses, whichever are there to related to manufacture, everything will be sitting over here. Then cost of goods manufactured, you will get on the you will get the credit balance over here. Credit balance means you will get the debit balance more. You will carry the balance down. Why you are going to carry the balance down? This cost will go to trading account. That means after I finish manufacturing with those goods, what am I going to do? I am going to start doing the trading. After manufacturing these goods, I'll transfer to trading account and then I'm going to trade. That means then I'm going to start our trading activity. So from here, once these goods go into trading account, the process is same. The process is same like what we used to do in regular trading account also. Now understand this, depreciation. On office building, if there is depreciation, it will go to P&L account. But on factory building, if you see depreciation, you'll put it into manufacturing account. On assets used for manufacture, that will go into manufacturing account. On other assets, it will go into P&L account if there is a depreciation. Salary will usually go into P&L account, but if you tell salary to supervisor and all that, it will go to manufacturing account. Now, repairs and maintenance. Repairs and maintenance of factory building will go into factory building or plant and machinery will go into manufacturing account because it is used for manufacturing. Other assets will go into P&L. Now, imagine you talk about rent. Rent of office building will go to P&L. Rent of factory building will go into manufacturing account. Is this clear? Yes, that should be it with that particular thing. Next thing is NPO. We'll see NPO later. Now what we'll do is NPO will keep it pending. After NPO, the incomplete records which is there. Okay, we'll finish that as well. Okay, we'll finish that as well. I'll tell you the reason why. Because when we are solving final accounts question, incomplete records, both we can finish solving at one shot. Then we can go and see NPO concepts and solve the NPO questions in another shot. Clear? No, no, no. What is that?
Grapes.
No, but it's okay. I'll drink water. That is aerated trade. What is the name of that brand?
Chennai soda.
Night we are taking class. YouTube live is happening, and YouTube people can only hear what is the name of that brand. We don't know what they will be thinking. Water, guys, water, aqua. Where are those two people? They said on the way, on the way. Them only, I think. So we will reach 6. Yesterday you all watched till 12:30. You are awake. You have vehicle, no, to go back later. To go back after class, you have transportation, right? Then rapid. Okay. It'll be there. Yes, accounting from incomplete records. Okay, incomplete records means what basically? What is incomplete records? In BCom and all, they call this as single entry. Okay, they call it as single entry. Now, accounting from incomplete records is simple. You know what is it? You had a very easy chapter called as rectification of errors. This is father of that. Okay, father of rectification of errors. In rectification of errors, what you were doing? You were following double entry system of accounting only. But what happened was, by mistake, instead of one debit, you missed one credit. I mean, you entered it as credit. Instead of debit 100, you have made it as debit 120. So you're making these kind of mistakes. Here, you have nothing. Here, you have nothing. Forget about making mistake in the entry. Entry only is not there. You just have some papers. Okay, you're like, oh, bank, you want to know the bank balance? I'll go to PhonePe and check the bank balance. You want to know what is the cash balance? I'll open the drawer and start counting. You want to know my debtor balance? I don't know. I'll ask the debtor how much money I have to get from them. I'll ask their ledger and check what is the debtor balance. Okay, you want to know what is the creditor balance? Then I'll go to creditor and tell, give me my statement. That means my ledger in your books, you show what it is. Then based on that, I'll get. Nothing is there. Basically, it's like small businesses, what they do, they don't know the importance of books of accounts and all. In one small notebook, they'll write, Ramesh has to pay me 500. I have to pay Suresh 200. They'll just write like this, literally. And they made, whenever they want money, right, it's all cash. Basically, their thinking is only about cash in and cash out. That's all. When they want to buy new asset, no, they'll say, how much is there in the bank? Okay. How much is there in the drawer? Everything will put together. They'll go and buy one new asset. So basically, they only focus on business. They don't focus on accounting over there. Now, there is one person manufacturing hair oil. Now, what he will do? Cash is in the pocket, count. Bank balance, check. Who has to pay him? Ask the debtors. Whom he has to pay? Ask the creditors. Now, can you see that we cannot actually get accuracy from this? But at least we can prepare final accounts. Okay, because now what happens? This person, if he wants to expand his business of this hair oil, no, then he will go to bank and ask for loan. When he goes to bank and asks for loan, no, bank will tell, boss, you give me one P&L and you give me one balance sheet. Now forget balance sheet. It doesn't have books of accounts only. So from this incomplete situation, you are supposed to prepare the P&L trading or trading P&L and balance sheet. Clear? Now, capital computation. One of the major calculations which we have to know, how to compute capital. Opening capital will take. Opening capital. Now just imagine how capital can go up. Extra money if they put, capital will increase. Additional capital will be increasing. Then drawings, if it is there, capital will decrease. If there is profit, capital will increase. If there is loss, capital will decrease. That time you will get your closing capital. Is this clear? Out of these two, both will not happen. Only one of them can happen. Now, next you have to learn how to prepare the debtors account. Almost a regular adjustment that you have to prepare debtors account over here. The reason for preparing debtors account is to find the credit sale. Now it might not be the only reason. Now I cannot give you, you know what, actually if I am talking, no, I should not be teaching you only incomplete records. You know why? In incomplete records, there is no steps and all. Now, if other chapters, I'll tell you this much, half an hour we are spending, okay, this is the concept, this can happen. In incomplete records, there is no concept actually. Any chapter, anywhere, whatever accounts you learned, it can be asked over here. It's like the balancing figure of all the chapters. Any chapter, anywhere. So now debtors account, I am telling you that usually debtors account is to find the credit sale. But there might be some other question where credit sale is given already. That means something else in the debtors account can be missing. So you need to know what are the regular things that will be there in the debtors account. Now, debtor is an asset, so opening balance will be debit. So balance brought down, and here it is balance carried down. Either it will be given in the question or you have to find it in some other way. Now, credit sales. Tell me what is the entry for credit sales? Debtors account debited to sales account. Debtors account debited to sales account. Now, if there is sales return, that time what will happen? Debtor has to be reversed. So debtor account will be credited, but what will be debited? Sales return account debited to debtors account. Clear? Now after that, you give discount to the debtor. Discount is an expense for you. Yesterday we saw in the basics of entries, discount allowed account debited to debtors account. If at all there is bad debt account debited to debtors account. Now you're like, sir, wait. This bad debt, no sir. It will go to provision for bad debt. Yes, after the bad debt is done, it will be removed from the provision. But bad debt entry is always bad debt account debited to debtors account. You are reducing from debtors. Then if debtor gives you money, he can give you in cash, he can give you through check. So cash account debited or bank account debited to debtors account. Then what can happen? Now the bills of exchange which we studied yesterday, that can make a guest appearance over here. So whenever there is debtors account and if there is bills receivable account, you have to prepare bills receivable account also. Now here first thing, bill drawn and accepted. What should be the entry? Bill drawn and accepted. What should be the entry? Bills receivable account debited to debtors account. This is what we were doing yesterday. Bills receivable to debtors. So here I am writing by bills receivable. Is it clear till here? Now after that, bill drawn and accepted. If they give money, no problem. No impact on debtor. If you discount it, no impact on debtor. If you endorse it, no impact on debtor. Now bills and debtor will have a connection again only if they don't pay the money. If they don't pay the money, that means if bill is dishonored, that time you will pass a dishonor entry. I told you yesterday in all the dishonor entry, debit was drawee. Drawee is nothing but debtor. So debtor account debited to bills receivable account. This can also be debtor account debited to bank account if the bill was discounted. Debtor account debited to creditor account if the bill was endorsed. Clear? This is the situation. Okay. What? If it is paid, it will be done. If it is paid, it will not come here. The bill won't come here. Because if it is paid, no, the entry is bank account debited to bills receivable account. Bank account debited to bills receivable account if it is paid. Now, total sales. How will you get the total sales? Total sales will be basically cash sales plus credit sales. Cash sales plus credit sales. Is this clear till here? Now, bills receivable ledger. If I have to prepare the bills receivable ledger, how will you prepare the bills receivable ledger? Bills receivable is an asset. It will have debit balance and balance carried down will be on the credit side. Balance carried down will be on the credit side. That doesn't mean that it has credit balance or anything. Balance carried down will be on the credit side. Now, one more thing that you have to understand over here. Sir. Sir, why do you prefer this timing, sir? What can I tell you guys? Forget it. This is the only timing we can take. That's why I prefer this timing. Otherwise, obviously, I would also have preferred some other timing. Thank you, guys. Thank you. Interest on capital is add, sir. Yeah, we didn't take the example of interest on capital because it's sole proprietor. But if interest on capital is there, that also will be added. While computing the capital comparison method, yes, if interest on capital is there, you will add the interest on capital because sole proprietor, no, little rare that interest on capital, interest on drawings, because interest on capital you will give yourself, interest on drawings you will charge yourself, so it's only 1%. Okay, now bills receivable ledger. Let's try to understand. Balance brought down, balance carried down. Clear till here, everyone? Now understand this one. Bill is drawn. Bill, whatever we studied yesterday, bill is drawn and accepted. What should be the entry? Bills receivable account debited to debtors account. Bills receivable account debited to debtors account. That's why you are having this cross reference over here. Clear? Bill, what can you do? Keep in the pocket and wait. No entry for that. Bill is discounted. What entry for the bill discounted? If bill is discounted, what entry? Bank account debited to bills receivable. bank account debited to bills receivable, but full amount you won't get. If it is 60,000 bill, let's say you'll get only 59,000. So where did this 1,000 rupees go? Discounting charges. Discounting charges account debited to bills receivable. Clear? Now, if it is endorsed, what is the entry? Creditor account debited to bills receivable. Can you see by creditor over here? Next, after that, what can happen? Two things can happen. Bill can be honored or bill can be dishonored. If bill is honored, what should be the entry? Bank account debited to bills receivable. If bill is dishonored, what should be the entry? Debtor account debited to bills receivable. Okay, by debtor over here. Then you'll get the balance carried down. Just carry the balance down. That's all. Finished. Creditors ledger. If it is creditors ledger, what is the usual purpose of creditors ledger? To find the credit purchase. But I'm not guaranteeing you that it's only credit purchase. It can be anything that can go missing over there. Balance brought down, that is the opening balance. Balance carried down, that is the closing balance. Why it's on the opposite side? Because this is a creditor, that means it is a liability. Liability will have credit balance. Now, credit purchase, what should be the entry for credit purchase? Purchase account debited to creditor. Purchase account debited to creditor. Then what you are going to do? If there is purchase returns, creditor account debited to purchase returns. If there is discount received, creditor account debited to discount received. Yesterday we saw one situation that imagine that we only become bankrupt and we don't have money to pay. That time it is not called as bad debt or good debt, it's called as deficiency. That time creditor account debited to deficiency account. Is this clear till here? Now think that bills of exchange, can it impact the creditor? Yes. How? When the bill is endorsed. So creditor account debited to bills receivable account. Creditor account debited to bills receivable account. Then other than that, anything cannot impact us over here. What we have to understand now, if amount is paid, creditor account debited to bank account. If we are accepting bill for somebody else, that time what will happen? If we are accepting bill, creditor gone. So creditor account debited to bills payable. And that bill, if I pay, no problem. If I don't pay, creditor makes a comeback. That time what is going to happen? Bills payable account debited to creditor account. Bills payable account debited to creditor account. Is this clear? Then finally you'll get your balance carried down. Just carry forward and put it into the balance sheet. Now bills payable ledger. Bills payable ledger is not as complicated as bills receivable ledger. You know why? Because when the person is going and endorsing, discounting, all that, the bills payable person is simply sitting. There is no entry only. Bills payable, there will be only entry on due date on maturity date, whatever the date is. Now, bills payable, you understand, opening balance, closing balance. Why opening balance, closing balance is sitting over here? Because this is a creditor, that means it is liability, and here the balance is carried down into the other side for the next year. Now you have to understand one thing. If new bills are accepted, creditor account debited to bills payable. And if this bill is honored, bills payable account debited to bank account. If it is dishonored, then come back. So bills payable account debited to creditor account. That should be it. That is the balance carried down. That should be good enough. Clear? Now, total purchases. You should remember all this. I know it's very obvious things, but you need to remember this. Total purchases, cash purchase plus credit purchase. Cash purchase plus credit purchase. Now, additional ledgers that you have to maintain. Additional ledgers that you have to maintain are. One second, guys. Yeah. Additional ledgers that you have to maintain. Additional ledgers that you have to maintain are cash account and bank account. So, if it is a full-fledged question, the working notes you might have to prepare are debtors account, bills receivable account, creditors account, bills payable account, cash account, bank account. So many ledgers you might have to prepare. Along with that, you might have to even prepare the opening balance sheet, which is called as statement of affairs, because you don't know everything. No, you can't call it as balance sheet because you don't have ledgers only to call it as balance sheet. So it's called as statement of affairs. Main goal is what? To prepare trading account, P&L account and balance sheet. To prepare trading account, P&L account and balance sheet. That is it, the concept of incomplete records. Now almost every single exam, this is there. Every single exam, this is one sure shot question. This and partnership like sure shot. From this chapter it will be there. Let's begin our small journey of solving few questions. Now you see. The fun you see now. Lease is the next one. Here they asked in December 25, they asked NPO for 7 marks. And they asked incomplete records for another 7 marks. Which looks very small. Okay, incomplete records you see. It starts in India. and it ends in Afghanistan over here. Okay, that's it. Very, very simple, small, sweet question. We will try to solve this now. Don't worry about it. This chapter is going to fetch you good amount of marks. If at all you are thinking of skipping this, don't do that. That's all I can tell you. Okay, now listen. Chandana Enterprises maintains their books of accounts under single entry system of accounting. What is there to tell that maintaining books of accounts under single entry? That means you did not maintain anything. Correct? Okay, did not maintain anything. The balance sheet on 31st of March 2025. See the hypocrisy of the institute. If they did not maintain, if they maintained under single entry system, from where this balance sheet came? Are you getting this? From where this balance sheet came? This is, you should tell thank you for that. You know why? Because at least opening capital we know. Otherwise, usually what we do, we prepare the statement of affairs to find that opening capital. Okay, opening capital is there. This is the opening balance sheet. Then summary of cash and bank book for the year ended 31st March 2025 is given. Summary of cash and bank book. Then they have given some additional information and all that we have to know. You are required to prepare trading account, P&L account for the year ended and also balance sheet on that day. All those things you are expected to do. Now, have they prepared trading and P&L account? Yes. Have they prepared balance sheet? Yes. Okay. Luckily, they have prepared even debtors account. Okay. And creditors account and other things. So, whatever we require, we can directly discuss. I don't think any working notes are required to be done from our side. Now, my question is, go in the order of the question always. Okay. You have to prepare trading P&L balance sheet. Keep it open. Keep the trading P&L balance sheet open. Presentation in the exam. Trading P&L balance sheet. Keep it open. Next page, no, wherever you want, start preparing one by one ledgers. Wherever you feel you need a ledger, start preparing the ledger. Now here, capital account. Are you going to prepare a capital account? No, capital account. Where will this go? This will go to the closing balance sheet as the starting point of your calculation. So 6,75,000. Can you see the starting point of your calculation there? Okay, done. Next, trade creditors. Where will this trade creditors go? Will it go to the closing balance sheet? No, it will go to the creditors ledger. Creditors ledger opening balance. So you'll go to the creditors ledger. Can you see buy balance brought down 7,57,500? Okay, now when you are revising this chapter, when looking at this video, right, you have to keep telling the entry on your own. Then only you will be literally doing the posting. Clear? Outstanding expense. Are you going to prepare outstanding expense ledger? No. What you have to remember, where will this outstanding expense go? I have to see the question once and finish solving once in one shot. Outstanding expense 67,500. Where should it go? In P&L, from whatever expenses are there, we will minus this. We will minus this because this is last year's outstanding. So it will be subtracted. This year's outstanding, if it is there, we will add it. So going into P&L, expenses, they have shown the working note. So here only I am writing whatever expense is there. From that minus, how much is the outstanding expense? 67,500. If you find this year's expense, you will add that. Clear? Now, after that, furniture and fixtures. Where will this furniture and fixtures go? It will go to the closing balance sheet, subject to depreciation and other adjustments. So in the closing balance sheet, you should find 1,50,000. Can you see the starting point of our calculation? Yes. Next, stock. Where will the stock go? This is opening stock. Last year's closing stock is this year's opening stock. So you'll directly put it to trading account as opening stock, 9,15,000. Next, after that, going in the order, trade debtors. Where will this trade debtors go? It will go to the debtors account, opening balance. Debtors account, opening balance. Can you see debtors account 3,12,000 is your starting point. Next, after that, prepaid insurance. What will happen? Last year prepaid means it is this year's expense. So we should add this 3,000 to the insurance. In our P&L, where is insurance? No insurance. Okay, that means just let's keep it aside over here. Prepaid insurance. I think in the sundry expense only insurance is also there. Prepaid insurance 3,000. Okay, last year prepaid 3,000. So this has to be added. Okay, plus. Now after that, cash in hand and bank. What is this cash in hand and bank? Opening cash and bank. Luckily they have given cash and bank together. Otherwise you have to prepare cash account separately, bank account separately. So 1,20,000 your cash and bank account. Is it prepared? Okay, it's not prepared because it's already given in the question here only. Okay, one more working note, reduced. Cash and bank is there. Otherwise, we have to prepare it. 1,20,000 opening balance. Now, cash sales, small amount, full black money. Cash sales, 1 crore 10 lakh 70,000 cash sales. Now, what will happen? Cash sales along with credit sales will be your total sales in the trading account. So, in your trading account, can you see sales? Cash is sitting over here. Credit sales we'll find later. Now, receipts from trade debtors. Receipts from debtors. Receipts from debtors. What is the entry? Bank account debited because you have debited it over here. Credited to what? Debtors. Debtors account is credited. 2775. Can you see this? Yes. Next, after that, payment to creditors. Entry. Creditor account debited to bank. You already have the half the entry because we are looking at cash book only. Creditor account debited to bank. Creditor account debited 124,83,000. Clear? Next, after that, sundry expenses paid. Sundry expenses paid 931,050. You will take that 931,050 and you will add over here 931,050. From that last year's you are going to subtract. Wait. There might be outstanding of this year also. Let's not do it. Let's complete everything later only. Okay, but it will go to P&L. But it will go to P&L. It is paid amount from this last year's prepaid or last year's outstanding will be subtracted. This year's outstanding will be added. Okay, now drawings 3,60,000. What is the entry for drawings? Drawings account debited to bank account. Then this drawing should be subtracted from the capital. Go to balance sheet and drawings 3,60,000 will be subtracted. Okay, now after that, cash and bank closing balance. Now what will this do? Directly you go to balance sheet, enter it over here, cash and bank 190,950. Clear? Can you see? You have to go in the order of the question in such a way that you don't have to go and look back at the question. Moment you leave something pending and you have to look back, gone. Is this clear? Next, after that, we are going further. Additional information. Discount allowed to trade debtors and received from trade creditors amounted to 54,000 and 42,500. What is the journal entry for? Discount allowed. Discount allowed account debited to debtors account. Debtors. So in debtors account, you will write here by discount allowed, and discount allowed is an expense. So it will go to P&L, and in P&L you can find discount allowed 54,000. Clear? Next, after that, discount received is 42,500. What is the journal entry for discount received? Creditors account debited to discount received. Creditors account debited to discount received. So you'll go to your creditors account and you'll write over here to discount received, and discount received will go to the P&L, and in the P&L you can find over here 42,500. Next, annual fire insurance premium of 9,000, which is part of sundry expense. That is what I told you. We didn't find it in the P&L. Annual fire insurance premium is part of sundry expense, was paid every year on 1st August for the renewal of the policy. Every year we are paying on what day? 1st August we are paying. Now here, did we find any fire insurance premium in the cash and bank account? Sundry expenses paid is there. That means in this sundry expenses, that insurance is also there. In this. So therefore, when we took it into our solution over here, sundry expenses paid, in this, the insurance which is there, that is also there. Now, the fun part you see. Don't you think this 3,000 we have to add? Last year prepaid. That means last year already paid. So you will add that 3,000 over here. But one more fun is, you have to see the situation here. They are paying every year on what date? 1st August. If they are paying on 1st August, that means you have paid till next year July end. April, May, June, July. First of all, have they followed calendar year or financial year? Financial year. So April, May, June, July. 4 months insurance is prepaid. When you paid this year, you paid for next year 4 months also. So 9,000, therefore 9,000 into 4 divided by 12. 9,000 into 4 divided by 12, you are getting 3,000. So this year also there is 3,000 prepaid. This year's prepaid will be minused. Last year's prepaid was this year's expense. So you added. So what you will do over here? Plus 3,000 minus 3,000. Plus 3,000 minus 3,000. Is this clear till here? Do we have any doubt? Next. After that, we'll see. After that, whatever is there, we will see together. Okay. Furniture and fixtures were subject to depreciation of 15% per annum on diminishing balance method. You go straight to the balance sheet. What was the furniture and fixtures? This is 1,50,000. Calculate 15% of that, 22,500. subtracted. When you got that, you got your closing balance also, put it on the outer column. Now, one more thing what you have to do, depreciation is an expense. Directly put it into P&L 22,500. Clear? Every single effect should be done, not leaving anything pending. If you leave anything pending, then searching for the difference will be a more time waste than solving this. Clear? Next. After that, you have following are the balances as on 31st March. Closing balance they gave directly like a gift they gave. Stock. What will you do? You tell me. Put it to trading account, then put it to balance sheet. So closing stock, you should put it to trading account over here, and then in the balance sheet, you're going to show 9,75,000. Then after that, trade debtors. What will you do with trade debtors? Closing balance of debtors you will do, and you will put it into the balance sheet as well. In the debtors account, you are writing by balance carried down, and in the balance sheet, you are showing trade debtors 3,43,000. Next, after that, outstanding expense 55,200 outstanding. Which year's outstanding this is? This year's outstanding. So what you will do? Go to P&L, add 55,200. Add 55,200. Then what you will do? Go to balance sheet, show it as liability. 55,200. You will show it as liability. Is this clear till here? That plus minus and all we'll do later. Okay. Wherever we'll finish the question, then we'll do the plus minus. Then after that, gross profit ratio is 10% on sale is maintained throughout the year. Gross profit ratio. So now what will you do? You will go and see what was the sale. We don't know yet actually. You can see the number over here, but we don't know yet. Why we don't know? Because credit sale was not computed yet. Now we'll keep this one thing. That is the last point of the question anyways. We'll keep it pending. Now what we can do? Go and close all the ledgers. Don't close the trading P&L. Go and close all the ledgers. What is the ledger we prepared over here? Trading debtors account. Take the debtors account. Total all the see everything is marked as red. That means we have discussed this. Total everything minus this. You're getting the balancing figure. What is this? Credit sales. Credit sale entry is debtor account debited to sales. And that sale should be shown in the trading account. Can you see 28,60,000? When you do that, you'll get the outer column number. Whatever this outer column number is there, no. 10% of that is our gross profit, which they told. 10% of that is our gross profit. Can you see that? Now, automatically, when you do that, automatically just take your calculator. 139,30,000 plus 9,75,000 minus 9,15,000 minus 13,93,000. Are you getting 12,59,7,000? The purchases was not given. Purchase is the balancing figure. Now what happened to purchase now? This is the total purchases. This is what? This is the total purchases. Now if you go to the question and check in our cash book, did we have any purchases? Anywhere did we have purchases? That means cash purchase was not there. So now what you're going to do with this total purchases? 12,59,7,000. You have to enter that over here also. 12,59,7,000. Okay, because if there was cash purchase in the cash book, there would have been a payment entry. There is no cash purchase. So everything is credit purchase. Now when you do that, you will automatically get the balancing figure of the creditors account. The balancing figure of the creditors account. If you see the question, no, they gave some closing balance. In that stock was there, debtor was there, outstanding expense was there, but in that creditor was not there. So you got the creditors closing balance. This 8,29,000, you transfer it to balance sheet. 8,29,000. Yes, 8,29,000 into the balance sheet. Clear? Next, after that, what you are going to do? After that, nothing. Trading account done. Okay, unnecessarily they have prepared one memorandum trading account and all. This is not required. Already things will be done in the trading account itself. Then trade creditors account is there. Trade creditors account also closed. Now our only job is to close the trading account. Can you see in trading account everything is discussed. So this gross profit will come down over here. Okay, then after that everything is discussed. Only thing that is there is that expenses. Now you can check the total of that expenses. 931,050 minus 67,500 plus 3,000 minus 3,000 plus 55,200. Are you getting 9,18,750? 9,18,750. This is just the balancing figure. Net profit, where will it go now? This net profit, transfer it to capital account. 440,250 into capital account. That time plus minus if you do, you'll get your capital also. Everything is done. Only thing that you can see without red mark over there. What is that? That prepaid insurance 3,000 of this year. That should be shown on the asset side of the balance sheet. Completed. Is this clear? You have to go in the order of the question. Even if it requires just opening one bracket and just writing one random minus number, no problem. Write it. because later on you can't come in search of any of the numbers. Yes, that was the question that was asked in December 25. After that, obviously, it's a partnership question for only 14 marks. Then branch accounts, insurance claim, AS, partnership, one more question at the end. So around 18 marks from partnership they have asked. That's it. Okay, June 2025. June 2025, insurance claim, branch accounts, incomplete records. Oh, it came for little marks, 14. It came for only 14 marks. That's what I told you guys. You have to think from the examiner's point of view. If he asks you incomplete records, didn't you just see that your trading P&L balance sheet got tested over there itself? You don't have to, actually, they don't have to ask you one more question on trading P&L balance sheet. Now, June 2025. Question number 4. Only 14 marks. It was asked. Online guys, good morning. I hope you are awake. Till we have to literally tell good morning, till that time we are going to be here only. See, like birthday and all. They wake you up now at 12 o'clock and tell good morning. Like that we will tell one good morning to you guys. Then we will nicely sleep. We will lose some sleep now, so that after the results we can sleep peacefully. Midnight motivation, guys. When in marathon and all, you don't need motivation actually, right? In regular class, no full motivation we require. Otherwise, we will feel demotivated. In marathon, all what to tell motivation? I have to tell in marathon, guys. You want motivation, guys? 8 days remaining for exams. That's it. Only okay. That much motivation is enough. That time heart will suddenly start coming out like this. Okay, that is enough. You know, once I was doing one marathon. Okay, not CMA Inter, some other subject. I was doing one marathon. That time, some students were sitting. Okay, and these were all actually repeaters, like who have written before. They were attending the marathon. There were some 30-40. One guy in the middle, sir. One motivation you give, sir. So I told him, you have written exam before? He said yes. Okay. Did you pass? I mean, obviously. He said no. Then I told, I'll give you one crazy motivation. He's like, yes sir, yes sir, yes sir. Full motivation. So I told him, you do one thing. Last time's marks card is there. No. Take the screenshot and set as wallpaper in the phone. That's it. Whenever you feel like going to Instagram, no, that marks card will be there only. Now see, motivation all, I don't believe only. Bakwas it is. Okay, because you know why? Whatever motivation, after that, after 10 minutes, no, you'll forget the things. Then you'll be watching one crazy reel. Crazy reel on Instagram you'll be scrolling. Then you'll be like, hey, this reel, same song, we'll see who and all have done. You'll click on that music and then you'll see who and all has done all the trending things. Huh? He'll be doing like that, huh? Your roommate is telling that he will do it, it seems. Yes. These Snapchat people are dangerous. Okay. YouTube and Instagram people are fine. Snapchat people are very dangerous. Because we don't know when they are clicking our snap and where and all it will go. We'll be simply there and then one snap will be circulated like anything. Yeah. Okay. Okay, guys. Good morning. Good morning. Yes, yes, yes. Good morning. Sir, continue till 4 o'clock, sir. Expectation versus reality. 12:30 is the max we can do right now at the current situation if we have to stay alive. Yeah. After 12:30, you can revise all the model test papers and other things. You can revise till 4 and you can sleep and get up maybe at 12 o'clock. Okay. There are people who study in the night. Okay. Now, 14 mark question, guys. 14 mark question. It will revise most of the topics when you see these 14 mark questions. Now, we'll go to the end of the question and we'll see what they asked actually. They asked nothing. They told everything at the starting only. Following information relates to the business of ABC Industries. Prepare trading account, P&L account and balance sheet for the year ended 31st March 2025 and balance sheet as on that day. Trading account, P&L account and balance sheet that we know already. go in the order of the question and only in the order of the question. No other technique is there to solve incomplete records questions. Now, assets and liabilities, they've given one table. Assets and liabilities. So basically in this question, they didn't give us that nice balance sheet of incomplete records. First line, single entry system. Next line, balance sheet. Okay, now 1/4/2024, 31st of March 2025. Now what and all you have to prepare, you tell me. Right now only we know trading P&L balance sheet. Along with that, you have to prepare opening statement of affairs. Clear? Now this furniture 60,000, tell me where will it go? Furniture 60,000 will go to opening statement of affairs, and it will also go to furniture, the starting point of furniture calculation in the closing balance sheet. 60,000. So now, can you see that 60,000 in the closing balance sheet? And then it should also be in the opening statement of affairs. Can you see balance sheet as on 31st of March 2024 or 1/4/2024? Okay, 60,000. Sorted. Now you don't have to come back to that 60,000. Now, then we are going into, I'm seeing all the opening balances first, then I'll go into the closing balances. Stock, where will I enter this stock? It should be there in the opening balance sheet, 80,000 stock. Now don't get confused. Yes, sir, they wrote closing stock. Yes, last year it was closing stock for them. For us, it is opening stock. Now 80,000. So what will you do with this 80,000? You'll also enter it into your trading account. Trading account opening stock 80,000. Clear? It's only a process of lengthy thing, but if you do it, you'll get 14 marks for sure. Now, 1,60,000 debtors. Where will you put this debtors? You will put it to the opening balance sheet, debtors 1,60,000, and you'll also go to the debtors account, and that will be the balance brought down. Debtors account balance brought down 1,60,000. Clear till here? Next, after that, you have sundry creditors. Where will you put the sundry creditors? In the creditors account opening balance, and then in the opening balance sheet 1,10,000. Sorted. Next, you have prepaid expenses 6,000. Where will this prepaid expenses go? It will be there in the opening balance sheet. In opening balance sheet asset side, you can find the 6,000. Right now only go to your P&L, and in P&L prepaid expenses, sundry expenses. What I am doing over here, I am writing plus 6,000. Why plus 6,000? Last year prepaid means this year's expense. Okay, then after that, outstanding expense 20,000. It will be there in the balance sheet of opening balance sheet, outstanding expense. Can you see 20,000 over here? Then what we are going to do? Outstanding expense. Last year outstanding means last year's expense. So what we will do? We will do minus 20,000. Minus 20,000. This year's outstanding will be added. Okay, done. After that, you have cash in hand and bank balance. Where will cash in hand bank balance go? It will go to the opening balance sheet as 12,000. Okay, after that, you have to prepare cash account, bank account. In that will be the opening balance. In that will be the opening balance. Is it clear till here? Okay, this should be it. Now you're going back into the question. Now you did everything related to opening balances. Every single opening balance was there. So now what you can do? Directly you can see that opening balance sheet, everything is sorted. What was the purpose of doing this? To get this opening capital. You got the opening capital, transfer this opening capital to closing balance sheet starting point. Okay, so 1,88,000 capital. Sorted. Now, over here, we'll look at the ledger balances at the ending over here. Furniture closing balance is 63,500 straight. Go and put it in the balance sheet, 63,500. Can you see you're getting 63,500? Okay, closing balance is there. That means something is missing. If opening balance is there and closing balance is also there, in middle something should be missing there. We'll find it. As we go further, you will obviously find it. Now, stock closing balance. What will you do? Trading account, closing stock, and in the balance sheet, closing stock. You can see the closing stock, inventory 70,000, and in the trading account by closing stock 70,000. Then after that, you have one question mark written for sundry debtors. That means sundry debtors closing balance is not given. That means that should be the balancing figure in that particular ledger. Okay, now you can keep that pending. You don't know only, it's not pending, you'll find it and then you'll transfer it. Sundry creditors closing balance. You'll go to the sundry creditors ledger and you'll write the balance carried down, and then you'll go to the closing balance sheet and enter the creditors on the liability side. Clear? Next, after that, you have prepaid expenses 7,000. Prepaid expense will go to the closing balance sheet into the asset side. 7,000. Then this year prepaid means next year's expense. So you are going to minus from sundry expenses 7,000. Is it clear till here? Next, after that, you have outstanding expenses. You'll go to balance sheet and write that outstanding expense as liability. This year outstanding means this year's expense only. So accrual concept, you are going to add that 18,000. You are going to add that 18,000. Is it clear till here? Next, after that, you have cash and bank closing balance. Go to the closing balance sheet, enter the cash and bank balance, then go to the cash and bank ledger, and there you are going to write by balance carried down. Sorted? Now, cash transactions during the year. Cash transactions during the year. Sir, we'll get motivated only in night. We'll forget about it during the morning. I don't know what you're trying to tell. Okay. Yes, let's continue group study, it seems. Now, cash transactions during the year. Now, cash and bank are together, so you don't have to worry whether it is cash transaction or bank transaction. Collection from debtors after allowing discount of 15,000 amounted to 5,85,000. On the way, we will not leave anybody. First, we will focus on this 15,000. So, discount of 15,000. What should be the journal entry? Discount allowed account debited to debtors account. So, in the debtors account, go and check debtors account. Can you see one discount sitting over here, 15,000? Don't skip anything. Now, this 15,000, finish the part. It will also go to P&L. In P&L, you will enter 15,000 discount. Can you see discount 15,000 over here? Yes, one more discount will come. We'll see. When it comes, we'll see that. Now, and we received how much? 5,85,000. So, bank account debited to debtor account. In the debtor account, you can find, where is our debtor account? Yes, debtor account you can find 5,85,000. And at the same time, in bank account also, you can find 5,85,000. It is cash and bank together. Cash and bank together. Clear? Next. Collection on discounting of bills of exchange after deducting discount of 1,250 by bank total to 61,250. We discounted the bill. When you discount the bill, what is the entry over here? Bank account debited, discounting charges account debited to bills receivable. To bills receivable. Now, first of all, where was bills of exchange? In the opening balance and all, did you have any bills of exchange? No, that means from where this bills of exchange came. Are you getting my point? Collection on discounting bills of exchange after deducting discount 1,250. So bank account debited. We know debit part. Where is the credit part? Discount bills was not there. Maybe later on we'll get more information about it. Right now we don't have anything. So you will go and write in your bank account. Sorry, you will write in your bank account debited to bills receivable account. So for temporary purpose, I'm preparing one bills receivable account over here and writing by bank 61,250. Clear? By bank 61,250. So there is no impact on the P&L. Huh? Discount. Yes. Discount is also there. And 1,250 is the discount. Discounting entry, what is that? Discount account or discounting charges account debited to bills receivable. So you'll write over here by discount 1,250. And discount is an expense. It will go to P&L. So in P&L, you can find this 1,250. That is how you got the total as 16,250. Sorted. So in the order we went, we don't know what happened to that bills of exchange. So we prepared one bills of exchange, bills receivable ledger and kept. Now after that, creditors of 4 lakh were paid 3,92,000 in full settlement. What should be the entry? Creditors account debited. Creditors account debited to what? Bank account. To what? Discount received. So you'll go to creditors account, and you can see over here 3,92,000 debited, 8,000 debited. But in bank account, how much you will find? You will find only 3,92,000. And the other 8,000 is a discount received, which is an income. It will go to P&L. In the P&L, you should find 8,000 discount received. Clear? Next, after that, freight inward paid. Freight charges paid. What should be the entry? Freight inward. Carriage inward will go to trading account. Carriage outward will go to P&L account. So the entry for this is freight inward account debited to bank account. In the bank, you can find this 30,000. Don't forget to put it into trading account. In trading account, you will enter this 30,000. Can you see that 30,000 sitting in the trading account only? Next, after that, Drawings 70,000. Can you tell me the entry for drawings? Drawings account debited to cash or bank account. So in the bank account, again, you will find one drawings over here. 70,000 in the inner column, because maybe something else also is there. We'll see that drawings 70,000 in the inner column, and then it should also go into balance sheet capital 70,000 plus maybe something else will come later. Now after that, payment for office furniture. What should be the entry? Office furniture payment. Furniture account debited to bank account. Furniture account debited to bank account. Therefore, in the bank account, you can find this 10,000, and this 10,000 should get added to the furniture. Go to the balance sheet, and 10,000 is added to the furniture. Clear? Now, next. Let's go further. Investment carrying annual interest of 6% were purchased at 95. 200 shares face value 100 each on 1st October and payment made thereof. How many shares did you purchase? 200 shares. Clear? Into how much did you pay? 95. Correct? So 200 into 95, 19,000. What should be the journal entry for this? For purchasing on investment. Investment account debited to bank account. Go and enter that into the bank account. Bank, 19,000. Can you see this over here? Now, immediately finish everything. Go to the balance sheet and enter that also, 19,000. Now, twist in the tail, you see. 6% interest, no. So, interest is accrued. Interest is accrued. So, what you're going to do? 200 shares into what? Yes, into what? Into 100. Into 100, not 95, into 100. Because always interest, dividend, all those things are calculated on face value. Face value is 100, 200 into 100 into 6%. So 200 into 100 into 6%, 1,200. 1,200. Correct? 1,200. Yeah. Sorry. Yeah. By into 6 divided by 12, because that has been purchased on what date? 1st October 2024. That means it is 600. 600 interest accrued. Please tell me what is the entry for this interest accrued? Interest accrued entry. Interest accrued means interest receivable. Interest receivable means interest receivable account debited. Interest receivable debited to what? To what? Interest. Interest receivable account debited to what? Interest. No, don't tell bank and all. I am telling receivable. There cannot be bank in a receivable entry. Interest receivable account debited to interest account. So therefore, interest receivable is an asset. Asset will be shown in the balance sheet over here. And then interest receivable, interest should go to the P&L, 600 sitting over here. Is it clear? Now you're like, sir, how do we know it is not received? Till now they didn't tell us, and usually if you purchase it in the middle of the year, at the end of the year, or maybe 1 year later only, you'll get that. Now, next, expenses including salary paid 95,000. Tell me what should be the entry for this? Expenses account debited to bank account. So in the bank I should find this 95,000 sitting over there. 95,000, and this expense should go to the P&L as well. Now P&L sundry expense including, so 95,000 plus. Clear? 95,000 plus. Wait, we'll calculate that later. 95,000 plus. Miscellaneous receipts 5,000. Bank account debited to miscellaneous receipts. You can see that 5,000 in the P&L, and you should find that 5,000 in the bank account as well. 5,000. Done. Next, additional information. So till now when they are telling this entire question and telling us that these are the cash transactions, that means after this whatever they are going to talk, that is 100% not cash transaction, no. Because till now they made a list and told cash transactions during the year. Then they are telling additional information. In additional information, most of the things should be non-cash only. So bill drawn 1 lakh. We were waiting for this bill only, no. Bill drawn 1 lakh. Of these 20,000 endorsed. Endorsed we'll see later. First bill drawn 1 lakh. Tell me the entry. Can you see you cannot solve this chapter if you skip bills of exchange? If you think that, sir, bills of exchange, sometimes it is asked, sometimes it is not asked. Now God always listens to my prayers. So therefore this time they will not ask. I asked God. But that bills of exchange will come and sit in incomplete records for 14 marks here now. So what is the entry now? Bills receivable account debited to debtors. Bills receivable account debited to debtors. So we'll go into the debtors ledger. You can see over here. by bills receivable account. And bills receivable account, I have, okay, they have created the bills receivable. We had created one temporary bills receivable. No, over here. Where was that? Over here, I've created one temporary down. Here. Okay, they have created the bills receivable. So I'll discuss it from here only. See, 61, 250 and 1, 250, what I wrote that time. And then 2 debtors, 1 lakh. Next, after that, they told of this 20,000 endorsed to creditors. Endorsed to creditors means what should be the entry? Creditors account debited. They should reduce to bills receivable. So here you are writing by creditors, and in creditors account you are going and posting it to bills receivable 20,000. These are all interconnected balance sheet item entries. That's why nothing is impacting the P&L or trading here. Next, after that, and an endorsed bills of exchange of 4,000 was dishonored. We endorsed it, it got dishonored. So we'll reverse this entry now. What will be the entry? Debtor account debited. Whenever dishonored, debtor will be debited. Debtor account debited to creditor account. So therefore, in your creditor account, you can find this 4,000 here, and in your debtor account, you can find this 4,000 over here. Clear? Now, goods worth rupees 9,000 used as advertising material. Yesterday we discussed this in the adjustment part. Goods used as advertising material or goods given as free samples. What was the entry? Advertisement expense account debited to purchases account. So therefore, in the P&L, it should be shown as advertisement expense. Can you see 9,000 over here? And from purchases, 9,000 should be subtracted. Can you see 9,000 minus over here? Yes. Next, after that, you have gross profit is always 20% on sales. It is always 20% on sales. So in your trading account, one thing is sorted, nothing is sorted, because we don't know sales only. Okay, so nothing is sorted yet. This 20% on sales, we have to remember later. Now, cash book difference treated as drawings or capital introduced. They said if cash book there is difference and money is more, then it is considered as someone took the money. If money is less, that means we consider it as somebody brought the money. Provide 2% for doubtful debts on closing debtors. Entry online, offline, everyone. Yes, what is the entry? Yesterday, so much we discussed. P&L account debited to provision for doubtful debts. Now, 3 things are there. This gross profit adjustment, cash book missing figure, and provision. Will the provision affect our cash book? No. So we can come in the reverse order and we can close the cash book. Cash book, can you see everything what is there we have marked? Can you see everything in red? That means one thing missing over here is what? Drawings, extra drawings. They said no, if there is missing figure, that will be drawings. When you calculate, you saw debit side more, credit side less. That means where did the money go? Somebody took it. What is that? Drawings. If credit side was more, debit side is less. That means somebody brought money. What would have that been? Additional capital. It would have been additional capital. So you are going to take 21,000 and your total drawings is 91,000. This 91,000 is there in the balance sheet as 91,000. Can you see over here? Okay, this 70,000 we had written that time. 70 plus 21, it became 91,000. Then after that, okay, cash book is closed. Bills receivable account, everything is closed, done in bills receivable account. Can you see this is just the balancing figure, closing balance. Where will you put this closing balance? 17,500. You will directly enter into your balance sheet. Bills receivable 17,500. Clear till here? Now you can complete one by one. Sundry debtors, everything is there in sundry debtors. No. Sales is also missing. Okay, and closing balance is also missing. So if closing balance was there, I would get the sales. Now we'll keep sundry debtors. We'll close the purchases now. I mean creditors. Creditors, can you see everything is there? Only thing missing is what? Purchases. Till now, anywhere in the question, they didn't tell us about cash purchase, credit purchase. Cash purchase and cash sales. That means everything is assumed as credit purchase and credit sales. 4,56,000. This is just balancing figure. You don't have to worry about that. That 4,56,000, you'll transfer it to trading account. 4,56,000. That time what happened? 4,56,000 minus 9,000, you'll get the purchases. Is this clear? Now from here, can I find a way to find the sales? How will I find it? Opening stock plus purchases plus direct expenses minus closing stock gives us something called as cost of goods sold. Opening stock is there over here, 80,000 plus purchases 4,47,000 plus direct expenses 30,000 minus closing stock 70,000. All this was given. So 80,000 plus 447 plus 30, how much?
4,80,000.
4,87,000. What is this 4,87,000? Not sales. That is cost of goods sold. They told the gross profit ratio is 20% on sales. That means it is going to be 20 by 80. It will be 20 by 80 on cost. So 4,87,000, okay, into 20 by 80. 1,21,750. Can you see that gross profit over here? That means if you add that gross profit plus 4,87,000, can you find 6,08,750 as sales? You found the sales, job done. When you got the sales, what you will do? You'll take this sales and put it into the debtors account. In debtors account, you will write debtor account debited to sales 6,08,750. That time you got the closing balance. That closing balance you will enter where? You will enter it into the balance sheet. And on that closing balance, how much provision they told you to create? They told you to create provision of 2%. So on that 2%, if you calculate 72,750 into 2%, are you getting 1,455? Yes, minus it and enter it over here 71,295. That provision, where will it go? Don't forget that P&L you have to debit that 1,455. Provision is debited 1,455. Clear? Now if you see in question, whatever was there, everything is completed. Now if you see, we'll go in the order, but one thing was missing, that is furniture opening balance, closing balance was given. If I show you furniture account, it will look like this: opening balance 60,000, closing balance 63,500, and they only told that they had purchased it 10,000. 60 plus 10, 70. It is not matching with the 63,500. That means 6,500 is depreciation for the year. Clear? That 6,500. See, they have written also balancing figure. You can prepare ledger also and calculate this 6,500. 6,500 is the depreciation. Transfer this depreciation to even the P&L. Okay, to even P&L. Everything is sorted. Only thing is this expense we have not calculated anything. Prepaid, outstanding and all was there. So 95,000 plus 6,000 minus 20,000 minus 7,000 plus 18,000. Are you getting 92,000? Clear? 92,000 is what? The sundry expenses. 92,000 expenses. Can you see everything done? This gross profit has come down. Then everything done. Only this net profit is there. This net profit will go and get added to balance sheet. All other items are marked in red. That means we have discussed those items. Done. Balance sheet will tally automatically. This is your nice 14 mark question which they asked in June 2025. Only 14. Uh, 30 minutes. And you can spend 30 minutes. No, you can spend 30 minutes. Comfortably you can spend 30 minutes. Provided 15 MCQs you have, no. 15 MCQs you should finish in 30 minutes. Which should be possible actually. 15 MCQs in 30 minutes if you finish. Then 2.5 hours you have for finishing your other 70 marks. Now 2.5 hours is actually what? 150 minutes. 150 minutes if you divide by 70 marks, you have little more than 2 minutes per mark. So if it's a 14 mark question, 28 minutes, 30 minutes comfortably you can use. And 30 minutes is more than enough to solve. Now, remember one thing. Don't sit and do date particulars, ledger, this thing, rupees in, amount in rupees and all for all those debtors account, creditors account. Ledger, you know how it is? That's it. Write the debtors account, that's it. Okay, don't waste your time. You can't afford to spend time. See, in this thing they have written particulars, debit, credit, all that. You can't do that. These are all working notes, no? These are all working notes. For the main solution, beautify it. Okay, not that much. If you don't have time, no, in the exam, you do one thing for this. This much only is balance sheet. This much only balance sheet. Draw T, write balance sheet and go on filling numbers. Later on, last 15 minutes, if you have time, no, come back, write liabilities, amount, assets, amount, all those things you write. But at least write the heading. Okay, balance sheet as that. They're like, we will leave this also pending, last we will fill. We don't know what it is that. That person correcting also will not know what is correcting. Okay, that much at least you write. And here also, particulars, rupees and all. Later you see, now you prepare T and leave the first lines to fill that later over there. Okay, maximum for not writing the format properly, they might cut 1 mark. At least 13 marks you are safe with, no. But instead of writing all this and spending so much time and beautifying the paper, later if you are not able to solve one last question which is of 14 marks, then 14 gone, no. In trying to earn 1 mark over here, By doing all this, you lost 14 over there at the end. So don't do that. Even like maximum, like what you say, extreme neatness is not required. It should be readable. That's more than enough. Okay, that is June. Now we'll go into December 2024. Incomplete records came only for 14 marks. Incomplete records came only for 14 marks. Clear? Fourth question of that particular exam, December 2024. That's it. CMA solutions. That's it. Trading account, P&L account, balance sheet. Working note are not there at all. So we will have to create working note. They are playing with their emotions. Now, let's go and see December question. Rahul does not maintain a proper books of account. However, he maintains a record of his bank transaction and is also to give the following information from which you are requested to prepare his final accounts for the year ended 31st March 2024. First, what did they tell? 31st March 2024. Can you see opening balance sheet is also not there? Okay, and solution has only trading P&L and balance sheet. So you have to prepare the first thing. Yes. So first thing what you have to prepare is statement of affairs. Statement of affairs as on what date? Opening 31st March 2023. 31st March 2023. Clear? Then we know that one more thing that is we can see over here, debtor account is there, creditor account is there, bank account is there. So bare minimum that we have to prepare is debtors account, creditors account, okay, and bank account. Debtors account, creditors account, and bank account. Trading P&L balance sheet is there in the suggested answers. From there only we will discuss that particular part. Now opening, can you see 102,500? Where will it go? It will go into opening balance sheet. So in opening balance sheet, I am going to write debtors 102,500, and it will also go to debtors account. I am going to write to balance brought down 102,500. Clear? Next, after that, you have creditors. One big question mark is put. We don't know the creditors. Therefore, in the opening balance sheet, I am going to write creditors. It is there, but we don't know how much it is. Then, in the creditors ledger, you are going to write by balance brought down. It is there, but we don't know how much it is. Clear? Okay, we'll find it. On the way, we'll obviously find it. Next, after that, stock. What will I do with this stock? I'll go to the opening balance sheet and I will write stock. How much is the stock there? 50,000. Stock is 50,000. Then you will go and write in the trading account opening stock. Can you see opening stock 50,000? Okay, next. Bank balance, opening balance is not there of bank. So you will go to bank balance and write to balance brought down. It is not there. It will be found out in some way or the other. And then you will go to the opening balance sheet and write bank. Okay, and this is also not found. Clear? Now, just go in the order of the question. You will find it on the way. Don't worry. Fixed assets 7,500. What will I do? I'll go to the opening balance sheet and I'll write over here fixed assets 7,500. And in the closing balance sheet, this should be the starting point of our calculation. Nothing is told. So I'm just writing 7,500. Plus minus might happen. Now, after that, we'll go into the closing balances which is given. Debtors closing balance is missing. So I'll go to the debtors ledger and I'll write over here by balance carried down. Okay, this closing balance is missing. Then what I should do? In the closing balance sheet also I should see. Closing balance sheet I will not be able to put right now. Later when we find out, we'll put it over there. Now, creditors 46,000. What will I do with this creditors? Go to the creditors ledger and write to balance carried down 46,000. And then what you're going to do? Go to the balance sheet, closing balance sheet and write 46,000. Can you see 46,000 creditors over here? Next, stock 62,500. Which stock is this? Opening stock or closing stock? Closing stock. So I don't have to do anything because it is already prepared. In trading account, you can find 62,500 and in the closing stock, you can see in the balance sheet, you can see 62,500. Clear? Next, you have bank balance 50,000. So in the balance sheet, you will find the bank balance as 50,000, and in our working notes, in the bank account, I'm going to write by balance carried down 50,000. Clear? Next, after that, you have fixed assets 9,000. Fixed assets 9,000, already they have given the closing balance. Okay, you can see already they have given the closing balance now, but opening balance was only 7,500. How it became 9,000? Maybe we'll get more information as we go further, proceed further. Clear? Now, if you notice, compared to the previous 14-mark question, can you see how small it is? But there are more missing numbers. There, everything was almost there. You just have to prepare the ledger. That's it. Details of bank transactions are as follows. Received from debtors, 3,40,000. Can you tell me the journal entry for this? Bank account debited to debtors account. So I'll write bank account debited to debtors account 3,40,000. And here in bank, I'm going to write, in debtors, I'm going to write by bank 3,40,000. Clear? Next, after that, they said additional capital introduced. Additional capital introduced. What should be the entry? Bank account debited to capital account. Bank account debited to capital account 5,000. Then that 5,000 where I will put? I will add it to capital. Can you see that 5,000 getting added to capital over here in the balance sheet that is prepared? Yes. Next, sale of fixed assets. Can you see this was one of the things missing in the fixed asset account? Sale of fixed asset 1750, but book value is how much? 2,500. Clearly we know that there is a 750 rupees that is a loss. That loss will be debited to P&L. Can you see that loss debited to P&L over here? Now that 1,750, I have to put it into my bank account. So I'll write over here by sale of fixed assets or fixed asset account, that is 1,700 and what am I doing? Wait. 2. Yes. We are selling, right? To fixed asset account 1,750. Clear? 1,750. Now, after that, what will be the impact on my fixed asset ledger? Fixed asset ledger, what will happen? Now imagine this is my fixed asset ledger. Opening balance is 7,500 in the fixed asset ledger. Closing balance is 9,000 in the fixed asset ledger. Clear? 9,000. What did they tell? By bank account 1,750, by P&L account 750. So sale we have entered. That means we surely know that there is a purchase which is missing, which is not told to us. Clear? Now after that, you can see that paid to creditors 2,80,000. Paid to creditors. What should be the entry for this? Creditors account debited to bank account. Creditors account debited to bank account 2,80,000. And in the bank account, I am writing by creditors 2,80,000. Next, after that, you have expenses paid. Expenses paid, what should be the entry? Expenses account debited to bank account. So in bank, I'm writing by expenses 49,250. Is it 49,250? Yes. And it should be shown in the P&L as expense 49,250. No outstanding, no prepaid, nothing was there in this particular question. Next, after that, you have personal drawings. Drawings account debited to bank account. So you're writing over here by drawings 25,000, and this 25,000 should be subtracted from the capital. Can you see that 25,000 getting subtracted over here? Yes. Then after that, purchase of fixed asset 5,000. So what should be the entry over here? Fixed assets account debited to bank account. So by fixed assets, you're writing over here 5,000. And in the fixed asset ledger, you have to write to bank account 5,000. Can you see now? I think your fixed asset ledger is automatically matching 7,500 plus 5,000 minus 2,500. No, it's not matching. No, it's coming 10,000. That means 1,000 rupees is depreciation. By depreciation 1,000. Now that 1,000, okay, after that 1,000 only, this became 9,000 over here. And here you can see that 1,000 depreciation in the P&L. Next, no cash transaction took place during the year. That means till now what they told was about bank transactions. Goods are sold at cost plus 25%. Cost of goods sold was 2,60,000. 2,60,000 plus 25%. 2,60,000 plus 25%. How much are you getting? 3,25,000. What is it? Sales. What is it? Sales. They told no cash transactions. That means no cash sales. In the bank ledger, there was no cash sales as well. So there is 3,25,000. What should be the journal entry for me? Debtors account debited to sales account 3,25,000, and this sale should be there in our trading account 3,25,000. Same way, the gross profit also should be there. Because gross profit we just added, no, 3,25,000. Okay, minus what was that cost of goods sold? 2,60,000. 2,60,000. You're getting 65,000 as the profit. Okay, 3,25,000 minus 2,60,000. You automatically got the gross profit over there. Clear? Now, a lot of things are missing. Obviously, a lot of things are missing. Now, did we finish the question? Question, everything is completed. Now, in the ledgers that we opened, debtors, everything is completed in debtors. Now, closing balance we will get of debtors. So, I'll take 102,500 plus 3,25,000 minus 3,40,000. 87,500 is my debtor. What will I do with this 87,500? Transfer it to the balance sheet. In the balance sheet, can we find 87,500 as the debtor? This had to be found. It was not given. Next, after that, creditors. Now you know everything about creditors. No. You don't know everything. Actually, you don't know purchases. But in our trading account, everything is done. Balancing figure is purchases, sales, gross profit, everything we found. This is actually purchases balancing figure. You can actually use the formula also if you want. Opening stock plus purchases minus closing stock. Why all that? Trading account already balancing figure. So you get 272,500 as the purchase. When you get 272,500 as the purchase, enter it in your creditors ledger. Purchases account debited to creditors 272,500. Now you should get 280 plus 46,000 minus 272,500, 53,500. In full hurry of the exam, don't put this 53,500 to the closing balance sheet. This 53,500 will go to the opening balance sheet. Statement of FS. Yes, 53,500 to the opening statement of FS. Clear? Debtor done, creditor done. Bank account. Bank account, everything is done, already discussed. Now what you will do, 280 plus 49, 250 plus 25,000 plus 5,000 plus 50,000 minus 340 minus 5,000 minus 1,750. How much are you getting? 62,500. What is this 62,500? That is the opening balance of bank. Go and put that opening balance also to the opening statement of affairs, 62,500. Now 7,500, 62,500 plus 102,500 plus 50,000 minus 53,500. How much are you getting? 1,69,000 is the capital balancing figure. Capital balancing figure. Now what will you do with this 1,69,000? 1,69,000, go and enter it into the balance sheet starting point. Balance sheet starting point. Now everything is sorted. Now what is happening? See, trading account, everything is finished. Gross profit will come over here. P&L, everything is finished. You get the net profit as the balancing figure. That gets added over here. Finished. This is the 14-mark question. This is actually easier than the question which was there in the earlier one. You know why? Because there you have to write a lot. Here missing figures many were there. But go in the order, it will finish. Sir, how to get PDF? Someone is telling GPay 200. Next level costing you are doing in the chat box. Writing in exam in 2 pages or single page. I think income records and all in single page is more than enough. You don't need 2 pages for this. Yes, done guys. December 2024, done. Next we go into June 2024. Incomplete records in June 2024 also was asked for only 14 marks. Only 14 marks. June 2024. I'm not concerned about the 14 marks. I'm concerned about how much they have presented. This much. Wow. This much. This is the one, no? Fourth question, no? June 2024. Only. Yeah, no. But if you prepare this much, they don't give 14 marks in the exam. This is just suggested, guys. Suggested. Like that, there are some 7-mark questions, no, in old suggested answer. 2 lines, they finish the answer. Now, can you write those 2 lines and expect the 7 marks there? No, this is just hint answers they have given. That's all. Okay, now we'll see what is the question first. You are required to ascertain Sohan's profit or loss for the year ended 31st March 2023. They didn't ask you to prepare trading account, P&L account, balance sheet, anything. Now, how will you prepare this? Sohan is a small trader and does not maintain his books on double entry system of accounting. They are bringing sympathy to Sohan so that you don't feel bad that you have to solve so much. Clear? Now the detail of his business are available as follows. 1/4/2022, 31st of March 2023. Cash in hand. This is zero, not question mark. Zero. That means there was no cash that time. Okay. Bank balance, 100 debtors, 100 creditors, stock, investment, plant, furniture, everything is given. Clear? Now what you have to do here, obviously, you need, it's one of the basic questions of incomplete records in the study material. In the study material, you have this question as a basic question. Now, what you will do is, I'll solve it in the regular methodology. I will not just directly jump into their solutions. What I'll do is, see, all these things are there. With this, I'll get my opening capital. All these things are there. With this, I'll get the closing capital. Clear? Now, so therefore, I am preparing opening statement of affairs. And then we have the closing statement of affairs. Opening statement of affairs and the closing statement of affairs. Now one by one, what is the first one over here? Cash zero. What is the next one over here? Bank balance. Now I'm not writing, okay, bank and all. You know which side it will go. Bank balance, but credit. Bank balance, yes, but bank balance credit. That means it is OD. It is OD. It will be on the debit side. I mean, sorry, it will be on the liability side. Then sundry debtors, 5,30,000. Asset. Then we have sundry creditors, 1,50,000. Liability. Then we have stock, 1,70,000. Asset. Then we have investment, 1,20,000. Asset. Then we have plant, 2,00,000. Asset. Then we have furniture, 14,000. Asset. Done. Use your calculator carefully. Are you getting 8,10,000? Yes. What is this? This is the opening capital. Now look at the solutions. In the solution, opening capital will be sitting somewhere. Okay. Random. I'll show you a better methodology. Instead of going in reverse order, we can go in the normal order only. If you go in reverse order, no, your plus minus will get jumbled up in the exam. So this is the opening capital, 8,10,000. You can do that. You can do that. In exam, you can do that because it's working note, no? Bhaiya, he's having his own time. He didn't expect that in his personal time also. We will interpret like this. This is actually his personal time, right? Talking to his family and all.
But he told, no, you are there. I can't.
Yeah, I told him actually, you can sleep. Later when we go, we'll wake you up and you just open the door and let us out. That's all. Okay, 1,000 is the cash balance. So 1,000 cash balance, you'll write 1,000 over here. Then 40,000, now it is debit balance. So 40,000 asset. Then here you have 8,80,000 sundry debtors. That is also asset, 8,80,000. Then you have 1,95,000 creditors. So 1,95,000 liability. Then you have 1,90,000 stock. So 1,90,000 is asset. Then you have 1,35,000 investment. 1,35,000 investment. Then you have 2 lakhs plant. So 2 lakh is again one more asset. Then you have 14,000 furniture. So this 14,000 is also asset. Done. You should get your closing capital. So it will become 1,000 plus 40,000 plus 880 plus 190 plus 135 plus 2 lakh plus 14 minus 195. 12,65,000. 12,65,000. Okay, 12,65,000. So this is the closing capital. You have the opening capital. Ready? Now how you will proceed is in normal procedure. So you will write opening capital 8,10,000. Opening capital is how much? 8,10,000. Then what you will do? Read the question now. Sohan has withdrawn 3 lakhs during the year. Okay, that means minus drawings 3 lakh. It should have been subtracted, no? Next, after that, you have he introduced fresh capital of 65,000 on 1st October. 1st October he has introduced. So you will add 65,000. plus fresh capital, additional capital. Okay, then a provision of 5% on sundry debtors is necessary. Provision of 5% on sundry debtors is necessary. Now, what is the debtor over here? 8 lakh 80. Okay, we'll keep that thing pending now for now, because it will impact a lot, few things here. Now, write off depreciation on plant and machinery at the rate of 15% and on furniture at the rate of 10% per annum. Interest on opening capital is to be allowed at the rate of 10% per annum. The manager is entitled to a commission at the rate of 10% on the net profit after charging such commission. All those circus things they have told. Now, here what we know? We want to know the net profit, right? Here what we know right now? Right now we know only few things. We only know what is the situation with this capital, that's all. Now, opening capital minus drawings plus fresh capital. Then what we have, other thing that is going to impact us. See over here. Drawings already done. Fresh capital already done. Closing capital is already computed. 11 lakh 89. Did we get 11 lakh 89 600? 12 lakh 65,000. Huh? $12,65,000. Provision is there. How much is the provision? Provision is 5% on sundry debtors necessary. How much is the sundry debtors? 8,80,000. On 8,80,000, if you take 5%, you will get 44,000. That is a provision that is required. Now, after that, okay, I don't think they have shown the calculation also of that 44,000 anywhere. See, provision for doubtful debt, 44,000 should be there. That is also not there. Then after that, there is depreciation. See this calculation, adjusted capital less capital as at the beginning, profit before charging interest and capital and manager's commission. So interest on capital is there, manager's commission is there. But what about the depreciation? The depreciation has to be done. No. How much is the depreciation? They said 15% per annum on plant and machinery. How much is the plant and machinery? 2 lakh. 15% on that will become 30,000. Okay. Then furniture at the rate of 10%. How much is the furniture? 14,000. On that it is going to be 1,400. 44,000 plus 30,000 plus 1,400. 75,400. I think now, yeah, 11,89,600. So basically, the capital, actually what you know, natural assumption is what? That the capital is after all the transactions only, the closing balance. But now they have given adjustment. So here what happens? 12,65,000. From that minus the PBD. From that minus the depreciation. That time you are getting 11,89,600. Clear? 11,89,600. So then what is remaining then? Only thing that is remaining is this is done, this is done. Only interest on opening capital is to be allowed at 10% per annum. Very clearly they said interest on opening capital to be allowed. Why you know? Because we had introduced one capital and that was during the middle of the year. Now opening capital was how much? We found the opening capital, that was 8,10,000. So add interest on opening capital 8,10,000 into how much we have to calculate there? 10%. 10%, no? 81,000. Now what you are getting? 8,10,000 minus 3 lakhs plus 65,000 plus 81,000. Are you getting 6,56,000? 6,56,000 is the situation. Correct. But what is the closing balance? 11,89,600. So minus 11,89,600. 5,33,600 is the part of the profit. Right now that is not the complete profit. 5,33,600. Till here we have reached. Okay, that means after calculating everything, what is remaining now? Only manager's commission is remaining. Manager's commission, what did they tell? Entitled to a commission at the rate of 10% on the net profit after charging such commission. So therefore, whatever you are getting, no, 5,33,600. Now commission you have to minus. Commission will be 5,33,600 into 10 divided by 110. If it was before charging, I would have directly multiplied 10%. 533,600 into 10 divided by 110, you'll get 48,509. So 533,600 minus 48,509, you'll get 4,85,091. That is your net profit. 4,85,091. Is this clear? So these are the things that you have to remember. This much solution is not enough in the exam. In the exam, what you have to prepare? You have to prepare opening statement of affairs, closing statement of affairs, and you have to show this minus and show how you got 11,89,600. But better to go in the normal order. Normal order means what? Start with opening balance, minus the drawings, add the fresh capital, add the interest on capital. You'll get one value. Okay, that you compare with the closing balance. That is a profit. But from the profit, what you're going to remove now? You're going to remove the manager's commission. That will get the final net profit, whatever it is there. Is this clear? This was also asked for 14 marks in the exam. Comparatively, it is less work than what we did first one, that big question which we had solved. Okay, that was June 24. We'll go into December 23. December 23, incomplete records. Only 14 marks. Only 14 marks they have asked again. Incomplete records. This is the last incomplete records question which we are solving. If you have seen, they never asked a final accounts question only. No, NPO they asked in, just now we saw, no. December 25 they asked. Yeah. NPO is there. Here and there it is there. So, let's go into that. We'll see what online people have to tell. Sir, which part out of the three should I focus in final accounts? Looking at the trend, you should focus on incomplete records. If not for 14, at least one 7-mark question is always there. But out of 5 which we saw, 4 papers, it is 14 only. 1 paper only, it is asked for 7. That is this paper, because they asked recent paper, because they asked NPO there. Sir, if any tips to study, to get exemption in all papers? Study guys, that's it. What will I tell? Study, that's it. But do little smart study, because especially the CMA papers, if you see, no, the trend analysis is working. You can see that, see, for example, question number 2 is from chapter number 1. Question number 4 is from final accounts. Question number 5 is from partnership. They are exactly telling you in this question, I will ask from this chapter only. So basically, just make some planning. Okay, theory, I don't know. Just check the theory papers, how to study. But practical papers, I think it is easily crackable. So last question from incomplete records, we have question number 4. Let's go to the end of the question and see what they asked. Oh no, starting only they have told. Rajesh does not maintain proper books of accounts. From the following particulars, prepare the trading P&L for the year ended and also the balance sheet as on that date. More than Rajesh, I am worried about the institute now. December 23, yes. Okay, luckily I think it's there. But what is there? Trading P&L balance sheet. What is there? Trading P&L balance sheet. So now what we have to do? All the additional working notes that are required, that we only have to do. Now, no, don't get fooled thinking that this is the answer key. This is what they are expecting in the exam. Looking at the suggested answer, this is just an answer hint that is suggested, that's all. Okay, but they are improving. If you have seen recent suggested answers, more detailed solutions they are giving. Old one only, there are these problems. So imagine 2022 syllabus this much. 2016 syllabus, did you see the suggested answers? How it was? Beautiful, huh? Very worse, right? So it's improving. Actually, last 2 suggested answers are good. Everything is there, even including working notes, everything is presented. Okay, so let's go into December 2023. We have to go in the order of the question. We know that we have to prepare debtors account for sure. We have to prepare creditors account for sure. And then summary of other transactions they have given. Cash balance in the beginning of the year they have given. So cash account also we have to prepare. So for now, I know one thing, that I have to prepare debtors account. Correct? I have to prepare creditors account. Then we know that we also have to prepare cash account. It might be cash and bank or cash account, whatever it is. Then we know that we have to prepare opening statement of affairs. That's it. Only that much. Now let's begin. Debtors 90,000 opening balance. What will I do? Go into the opening statement of affairs and quickly write debtors, and I'll write 90,000. Then I'll go into the opening debtors account and I'll write to balance brought down 90,000. Then stock 49,000. What will I do? I'll go to the opening balance sheet and I'll write over there stock 49,000, and then this stock should be there in the trading account as opening stock. So in the trading account, can you see opening stock 49,000? Clear? Next, after that, you're going to find furniture 5,000. Go to the opening balance sheet. You go and write furniture 5,000, and for our satisfaction, I'll prepare one furniture account also. Furniture account, I'm going to write to balance brought down 5,000, so that we know later on if there is any depreciation that is missing. Then after that, what do you have? We go in further. Creditors 30,000. Go into the opening balance sheet. Go to the opening balance sheet and write creditors 30,000, and then go into the creditors ledger and write by balance brought down 30,000. By balance brought down 30,000. That should be sorted. Clearer? Next, after that, you don't have any other things. Now we'll just go in the order of the question. I know there are some things which will impact the opening balance sheet also, but I'll not jump into that particular part. Debtors, there is closing balance. What will I do with this debtors closing balance? Go to debtors account and write by balance carried down. By balance carried down 1,25,000. 1,25,000. Clear? Once that 1,25,000 is sorted, I'll go and check whether in the closing balance sheet that 1,25,000 is there. Yes. Then after that, you have stock 66,000. Stock 66,000. Directly it will go into closing balance sheet 66,000, and in trading account 66,000. Then after that, you have furniture 7,500. In closing balance sheet, it should be there as 7,500, and in my furniture account, I will write by balance carried down 7,500. Next, we go into creditors 22,500. Go into the creditors ledger and write to balance carried down 22,500. 22,500 to balance carried down. Clear? Now, when we know this balance carried down 22,500, what I'm going to do is go and check whether in the closing balance sheet this 22,500 was there. No, it is showing 25,000. It is showing 25,000. I'm just writing 22,500, hoping that something is missing later. We'll see. 25,000 they have written, but what we wrote 22,500. It was written 22,500. Clear? Now, cash collected from debtors. Cash collected from debtors. Tell me what is the entry for cash collected from debtors? Cash account debited or bank account debited to, for my convenience, I'm making it as bank. So to debtors account. How much is that? 3,04,000. Go to debtors account and write by bank account 3,04,000. Clear? Yes. Cash paid to creditors. Creditors account debited to bank account. Creditors account debited to bank account. How much was that? 2,20,000. So you'll write over here 2,20,000, and then in bank account you're going to write by creditors 2,20,000. Sorted till there? Next, after that, salaries 60,000. What should be the entry for salaries? Salaries account debited to bank account. So I'll write over here by salaries. Okay, 60,000. Then go to P&L and check for that 60,000 to be there. Next, after that, you have rent 7,500. In bank account, I'm going to write by rent 7,500. Then go to P&L. That 7,500 should be there as rent. Then after that, you have office expenses. You'll write by office expenses 9,000, and that should be there in the P&L as 9,000. Then you have drawings 15,000. So I'll write over here by drawings 15,000, and in the closing balance sheet there should be 15,000. So whatever is the opening capital minus 15,000. We don't know the opening capital yet. Next, after that, you have additional capital introduced 10,000. So what should be the entry? Bank account debited to capital account 10,000. Then what I'm going to do? I'm going to go to the closing balance sheet and then here plus 10,000, plus 10,000. Next, after that you have cash sales 7,500. Cash sales at 7,500, that is going to be basically bank account debited to sales account 7,500, and this should be there in the trading account also. We don't know, but 7,500 plus the credit sales later. Then after that they said cash purchases. So you'll go and write in the bank account buy purchases. How much is that? 25,000. And then I'm going to show over here purchases 25,000 plus we'll have the credit purchase later. Discount received 3,500. What is the entry for discount received? Creditors account debited to discount received. Creditors account debited to discount received 3,500. But this 3,500 should be there in the P&L. Then after that, what do you have? Discount allowed. What is the entry? Discount allowed account debited to debtors. So you're writing by discount allowed 1,500, and that discount allowed should be there in the P&L 1,500. After that you have returns inward. What is returns inward? Returns inward is what? Sales return. So you'll write sales return account debited to debtors. So here I'll write by sales return 5,000. How much was that? 5,000. 5,000 was the sales return. Now I'll go to the sales, and from there should be minus 5,000. Sales return should be subtracted. Then you have purchase return, return outward. So what should be the entry? Creditors account debited to purchase return. Creditors account debited to purchase return. How much is that? That is basically, sorry, missed the number, 4,000. Yes, 4,000. So 4,000, and that 4,000 should be subtracted from our purchases 4,000. Clear? Then you have bad debts. We don't have any provision for bad debt, and also bad debt account debited to debtors. Bad debt account debited to debtors. So in my debtors ledger, I'm going to write by bad debt 1,000, and that 1,000 should be there in the P&L. Bad debt. Can you see 1,000 in the P&L? Done. Question is completed. They said he had 25,000 as cash balance at the beginning of the year. At the beginning of the year, so you'll go to the cash account and you'll write to balance brought down. How much is that? 25,000. And that 25,000 I will also write somewhere else. Where will I write this 25,000? I'll also write this 25,000 in my opening balance sheet. Opening balance sheet, I'll write cash 25,000. Now 90,000 plus 49,000 plus 5,000 plus 25,000 minus 30,000. How much are you getting? 1,39,000 is your opening capital. So in the balance sheet, what you will do? 1,39,000 will go to the balance sheet. So opening capital, I'll write over here. They have not shown anything. 1,39,000 minus drawings. I think it was 15,000 plus additional capital. It was 10,000. Wait. Profit has to come. No? We'll keep the profit pending. Okay. Now after that, what do you have done? So now if you look at the ledgers that we created, okay, debtors account, everything is there in the debtors account. What is missing in the debtors account? Credit sales. So therefore it will be 3,46,000. Sure. 3,46,500. This will be the credit sales. Now you'll go and check credit sales. You will add 3,46,500. So 346,500 plus 7,500 minus 5,000. You're getting 3,49,000 as the sales. Now after that, you have to close your creditors ledger also, where you need to write the credit purchases. So by purchases, this is going to be 2,20,000 plus 3,500 plus 4,000 plus 22,500 minus 30,000. How much you're getting? 2,20,000 is the purchases. So you'll go and write over here plus 2,20,000. 220 plus 25 minus 4. How much are you getting? 2,41,000. That is your purchases. Clear? After that, what ledgers we open? Nothing. Bank account. Bank account, what you'll do? Check the closing balance. 25,000 plus 3,04,000 plus 10,000 plus 7,500 minus 220 minus 60 minus 7,500 minus 9,000 minus 15,000 minus 25,000. How much are you getting? 10,000 I got by balance carried down. Are you getting 10,000? Yes, 10,000 should be the balance over here. Can you see cash balance 10,000? Yes. So what are we left with now? Everything is done in all these furniture. Furniture 5,000, closing balance is 7,500. How did it become 7,500? That means there should be one purchase. Correct, no? But did we make any payment for that purchase? No one told us. What? That means it is not paid. Cash payments, everything they have told. That means it is not paid. So it is going to be furniture account debited. Purchased furniture, but it's purchased on credit. So therefore it is going to be furniture account debited to creditors 2,500. This is the balancing figure. This is the balancing figure. Now this 2,500 which is there, no, it will be added to the creditors. Now this is different, okay? Don't worry about that creditors. Our purchase and all is same. That is creditors for goods. This is creditors for asset. So therefore we have 2,500 creditors for goods and we have 22,000. Where is our creditors? 22,500 that was given from the question only, right? See, 22,500 was given from the question only. That is creditors for goods and this 2,500 is creditors for assets. So total creditors that we have is 25,000. That is the 25,000 which we are having, which was not tallying that time. 2,500 plus 22,500. Clear? Creditors for assets. Done with that. After that, what you will do? Balancing figure is gross profit. That gross profit will come here. Gross balancing figure is net profit, and that net profit will be added 49,500. Remember, capital we have to just add the net profit 49,500. They have not shown the calculation, so you can calculate 139 matching up 1,83,500. Obviously, it should tally now. Done. This is the thing. Only this point you might have missed in the exam, if at all it would have been. But still your balance sheet will tally. You know why your balance sheet will tally? If you don't take that, you will take that 2,500 directly minus from bank account. You will tell that you have paid. You have paid. That time what will your bank balance be? It will be, no, it will be 7,500. Balance sheet will tally. Maybe you lose 1 mark for that particular step. Otherwise everything should be fine. So with that we are done with the incomplete records, guys. Only thing remaining in this particular chapter right now is NPO. So what we have to study is NPO. Then I think NPO, like hardly 1 or 2 questions only are there. That we should finish, and then we should see the time. Okay, we'll take a small break. 10 minutes break. And then we'll continue.
So bad.
Welcome back, guys. Let's proceed. Little time away from good morning. NPO. Okay, NPO is actually a big chapter only, but they are not focusing much. So we'll focus on the full concepts and then we will solve. A couple of questions are there. This attempt only they had asked NPO. So let's begin. NPO, non-profit organization or not-for-profit organization. Now you have to prepare receipt and payment account. It's nothing but a cash book only. Now just now we are coming from incomplete account, so it shouldn't be difficult for us. Now income and expenditure account is like P&L, and then we can't call it as P&L because it is not for profit organization. Then you have balance sheet, which is a position statement. Only thing is don't use capital over there, use the word capital fund. Next, receipt and payment account, you have an income and expenditure account. Receipt and payment account, there is cash system, and income and expenditure account, it is accrual system. Clear? Receipt and payment account, I told you, it's cash book. So you are going to follow cash system of accounting. Income and expenditure account, I told you it is like P&L, so it's going to be accrual system of accounting. All receipts, okay, all payments, whether it might be capital or revenue. That means in receipt and payment account, if I buy one building, it will be there. If I sell the building, it will be there. But in income and expenditure account, all receipts and payments will not be there. Only revenue transactions, will be there. Clear? Now, any receipt or payment related to any year, any receipt or payment related to any year will be there here. Now, if you are talking about receipt and payment account, 5 years ago, there was supposed to be one salary payment I paid today. It will still be recorded. Okay. And here, any revenue receipt payment only related to current year will be recorded. Depreciation will be there in income and expenditure account. Depreciation will not be there in income and expenditure account because depreciation is a non-cash item. Clear? Now, receipt and payment account is given in the question. This is a major thing. Now, entire question of NPO is all about outstanding, prepaid, income received in advance, income accrued. Now, receipt and payment is given in the question, and from receipt and payment, if I have to prepare income and expenditure account, from receipt and payment, I'm going to prepare income and expenditure account. Now, in income and expenditure account, I have to worry about whether it is related to this year or not. Whether I paid or not, you don't bother. Whether it is related to this year or not. Now, expense paid during the year, it will be given where? In the receipt and payment account. Now, what I will do? Outstanding expense of last year. Last year outstanding. It will be paid this year. No problem. Last year outstanding minus last year. Outstanding expense of current year. Did we pay it? No. We'll be paying in the next year. But it is this year's expense. Add. Prepaid expense of last year. Last year prepaid. It is already paid, but it's related to this year. Add. Prepaid expense of current year. That means it's related to next year minus. So in income and expenditure, what you're going to do, only worry about whether it's related to this year or not. That's all. Okay. Now, income, if I'm talking about income received during the year, income receivable of previous year, previous year's receivable. That means last year's income minus this year's receivable, this year's income, add. Received in advance previous year, last year received in advance, but related to this year, add. Income received in advance of current year related to next year minus. That time we'll get the income of the current year. Clear? Now you are going into income and expenditure account is, if income and expenditure account is given in the question and you are going to prepare receipt and payment account. Now you know what is the thought process? Doesn't matter. Paida, receiveda, enter. Which years? Don't bother. Now expense for the current year is given in the income and expenditure account. Outstanding expense of previous year. Outstanding expense of previous year is paid in the current year. Add. Outstanding expense of current year will be paid in the next year minus. Prepaid expense of previous year. Last year prepaid. That means it's already paid minus. Prepaid expense of this year. Next year's expense it is, but it's paid this year. Add. That time you'll get the expense paid in the current year in the receipt and payment account. When we are talking about income, what you're going to do? Income for the current year you'll take. Where will you get this income for the current year? In the income and expenditure account. Now, income receivable of previous year. Income receivable of previous year will be received in the current year. Add. Income receivable of current year will be received in the next year minus. Income received in advance of previous year it's received in advance already minus. Income received in advance current year, it is actually related to next year, but add it already received. Now they can also ask you to prepare ledgers. You should be prepared. Expense account. Now tell me one thing. Expense. If you pay expense, what is the entry? Expense account debited to bank account. Now this year's outstanding. This year's outstanding, what will you do? Expense account debited to outstanding expense. This year prepaid. What will you do? Prepaid expense account debited to expense account. Sorry, prepaid expense account debited to expense account. Last year's outstanding. Last year you passed the entry. This year you'll reverse that entry. So you'll pass the entry. Outstanding expense account debited to expense account. Last year prepaid. So you'll reverse that entry. Expense account debited to prepaid expense. That time we'll get the balancing figure. Balancing figure will go to income and expenditure account. Same way you will follow for income account also. When you receive an income, what is the entry? When you receive income, what is the entry? Bank account debited to income account. Now this year receivable. So you'll write income receivable account debited to income account. This year received in advance. So what you'll do? Income account debited to income received in advance. Okay, income received in advance. Then what you're going to do? Income received in, I think I told Ulta. Okay, this year receivable. So what you'll do? Income receivable account debited to income. Last year's receivable, if it is there, you'll reverse it. So income account debited to income receivable. This year received in advance. So what will you do? Income account debited to income received in advance. Last year, if it is already received in advance, you'll reverse it. Now, income received in advance account debited to income account. Balancing figure will be going to income and expenditure account as income. Donation received. You have to worry about this donation received. If it is general donation, always it will go into income and expenditure account as income. If it is specific donation, it will go to balance sheet and it will be shown as building fund and other funds and all that will be shown in the liability side of the balance sheet. If nothing is told, it will be added to the capital fund. Clear? If nothing is told only about donation, donation is always going to be assumed that it is a general donation. It is going to be assumed that it is a general donation. Entrance fees. What will happen to entrance fees? Entrance fees, balance sheet added to capital fund. Added to capital fund. If they tell you anything else, then follow. Otherwise, always entrance fees is supposed to be considered as a capital item and it will be added to capital fund. Sometimes they'll tell you 50% of entrance fees is capitalized. That means 50% is not capitalized. If it is not capitalized, it will go to income and expenditure account as an income. Clear? Now, renewal fees. Renewal fees, obviously, you have to do every year. That will be considered as income. Then honorarium. Honorarium is an expense. What is honorarium? Somebody you called to your trust or anything to give some speech there and you have given them some money. That is to honor their services. Income and expenditure account expense. Legacy. Someone died and that time they have done what they have done. They have written everything, all their property and all in your name. So therefore your name means the trust name. So balance sheet, it will be added to capital fund. Is this clear? Endowment fund. Endowment fund means what? Someone will give you money and they'll tell don't spend it. They'll give you donation. They'll tell don't spend it. You put this money into FD. From that FD, whatever interest comes, that you spend. So endowment fund is amount received, can't be utilized. Return from that amount invested, can be utilized. Okay, whenever it comes return, imagine somebody gave me money and told, we have one school, they gave money and told keep this for school day expenses. So that entire amount, let's say they gave 10 lakh rupees. That 10 lakh rupees I'll put it into FD. And from that, let's say I'm getting 80,000 interest. That 80,000 interest will be used for the school day expenses. But that FD will not be touched. Clear? Now, material consumed can be a adjustment which can be commonly seen. Material consumed should be shown in income and expenditure account. I do not care about material purchased. I do not care about what amount you pay to the creditors. What amount you pay to creditors should be shown in receipt and payment account. In the income and expenditure account, I only want to know what is the material that is used, that is consumed. How to get this material consumed? Opening stock plus purchases minus closing stock. How to get this material purchased? Material purchased, you will get it, okay, from this same formula as the balancing figure. Now, material purchased only will be taken as material consumed if there is no closing stock or opening stock. Note one more, club. Now there can be one small question. I think in the study material you see this. Club will be something. They are providing restaurant also. They are having other services also. For other services, you prepare income and expenditure account. For restaurant, you are going to prepare one trading account. And from the trading account, whatever profit or loss is there, that is transferred to the income and expenditure account. I think one or two questions are there at the end of the NPO chapter in the study material. That should be it. That is our only discussion that we have to do for NPO. Not too much time to be spent, but do not skip because this attempt only they asked. NPOC. 7 marks only. Oh, that is for the earlier one. Na? Okay. Then we'll put this 7. Okay. This is also 7 only. Now, remember, because this came for 7, no, this was the only attempt where incomplete records came for 7. Otherwise, back to back, every single attempt, incomplete records came for 14. Now, summary of receipt and payment of RR Clinic for the year ended 31st March 2025. Okay, summary of receipt and payment account. Additional information is given. You are required to prepare income and expenditure account for the year ended. They didn't ask balance sheet actually. They only asked you income and expenditure account. Okay. Now, you have to be a little careful. Not that simple also. Yes. Income and expenditure account. Only income and expenditure account, no balance sheet. If balance sheet was asked, no, you had to prepare the opening balance sheet, get the capital fund, bring it to the closing balance sheet. Same way what we used to do for our incomplete records as well. Now, let's begin. Opening cash balance. Do I care? Do I care about the opening cash balance? No, why? Because I'm preparing what? Income and expenditure account. Okay. Next, donation received including 50,000 for building fund. So what I have to do? Out of 1,55,000, 50,000 is a specific donation I cannot use that. So what I will take only 1,05,000. Only general donation will be taken, income and expenditure account, income side. Clear? Now, payment to creditor for medicine supply. Payment to creditor for medicine supply. I don't want that. I want what? I don't want payment to creditor for medicine supply. I want medicine consumed. They were just making you awake. Okay. There payment to creditor for medicine supply. Now medicine consumed I want. I don't want this. I want medicine consumed. Salary 70,000. Salary 70,000. You can go and check any outstanding prepaid they have spoken about salary. Nothing. No. So directly can I take this salary? Salary 70,000 into the income and expenditure account. Salary expense 70,000. Clear? Next, after that, you have purchase of medical equipment. If you purchase the medical equipment, do we need to bother about that? We need to worry about what? Depreciation. We need to worry about what? Loss or profit on sale if you have medical equipment sold. Medical camp collection 87,500. Directly you can put that 87,500. Now, usually one small tip I would like to give you for income and expenditure account. In income and expenditure account, what usually happens is, if you have one collection and you have one expense, net is done. Like for example, in study material, there are some questions where charity show collection, charity show expenses there. Net is done. But in receipt and payment account, you don't go to do net. You know why? Receipt and payment account is a cash book. Cash book is as per date wise. So you might have received on one day, you might have paid on one day. You don't go to do net, keep it separate. So therefore 87,500 we got it over there. Subscription received 3,50,000 subscription received. Obviously subscription is never direct. Never direct. Now here you have to understand subscription due 3 lakh. How much was that? 3,50,000. What are you preparing? What are you preparing? Income and expenditure account. Now, so because you are preparing income and expenditure account, remember one thing. What you are going to remember? Anything related to this year you will take. So subscription due of last year, that means minus. Subscription due of this year, that means you are going to add. It is this year's expense 15,400. Subscription received in advance last year. Last year received in advance, but it's related to this year 8,400. 4,900, that means minus 4,900. 3,58,400 will be your subscription. Subscription is an income for the NPO. 3,58,400. Clear? Now, after that, interest on investment 9% per annum. Do you have anything related to interest on investment here? Nothing. So interest on investment, what you are going to do? Investment is 9% per annum. They said 63,000. 63,000 is surely going to be income. Directly you will enter it over there. Nothing to worry about. Next, honorarium to doctor. Did they tell you anything about honorarium, outstanding honorarium, anything blah blah blah? Did they tell you? Nothing. So you're going to ignore that also. 1,90,000 directly you're going to enter honorarium to doctor expense. Next, after that you have telephone expenses, outstanding telephone and all, nothing they told. Directly 6,000 telephone expenses. Then medical camp expenses. Medical camp collection was there. From that only 10,500 is subtracted and you get the net amount on the outer column. Then you have miscellaneous expenses. Do you have any prepaid or anything? Nothing. No prepaid, nothing. Directly miscellaneous expense also will be entered over here. Is it clear? Now we are left with certain things. Subscription done. Stock of medicine we have. Stock of medicine. We want what? Medicine consumed. So medicine consumed will be opening stock 70,000 plus purchases. Did they tell us purchase of medicine? No, they said no. They didn't tell. They said payment to creditors of medicine supply. They are two different things. Purchase of medical equipment. Boss, X-ray machine if I purchase and medicine if I consume. Those are two different things. No, this is medical equipment. Now, what is the biggest mistake you people do is this is not purchase. This is payment to the creditor. So now what I have to do, just because I have come fresh from incomplete records, now I'll prepare the creditors account. Creditors account, go and see creditors for medicine supply, opening balance, closing balance. 63,000 opening balance, 91,000 is the closing balance. Sir, today partnership accounts or tomorrow? We'll be starting, guys. We'll be starting with the concepts of partnership today itself. Okay, maybe some part will finish and some part we will resume from tomorrow. So stay tuned. Now 91,000. So here what is it? Payment to medicine supply is 2,10,000. So what is it? Creditor account debited to bank account. So 2,10,000. So now what will you do? 63,000. Sorry, 2,10,000 plus 91,000 minus 63,000. 2,38. 37. No? 2,38. 2,38,000 is what? Purchase. 2,38,000 is the purchase of medicine. Purchase of medicine. Now what I'll do? 2,38,000 I will add to the purchase of medicine, and I have closing stock of medicine over here 1,05,000 minus 1,05,000. This is my medicine consumed. 70 plus 238 minus 105. 2,03,000. See, medicine consumed. Opening stock plus purchases minus closing stock. Purchases and payment to creditor is not different. I mean, not same. So you have to prepare creditor's account and find the purchase like how you do in incomplete accounts. Then you'll get the answer. Clear? Everything is done till there. Then only that purchase of medical equipment is there. Medical equipment, you see 147. I had a medical equipment 147. What did I do? I purchased one medical equipment for 105. 105. And what is the closing balance over here? 214,200. 214,200. 147 plus 105 minus 214,200. That means how much is it? What is it? Depreciation. That will go to income and expenditure account. 37,800 is the depreciation for medical equipment. Now what is the other one? Only one thing left, that over there. Building. Building is 350. It became 315. That means 35,000 is the depreciation on building. Total it, that time you'll get the total depreciation. Done, done, done. This is the surplus. They didn't even ask balance sheet. Okay, that should be it. They've shown the calculation for purchase of medicine, medicine consumed, depreciation, subscription, everything. If you are not comfortable with this plus minus, you can use this for medicine consumed and all. Otherwise, you can use a formula, or you can always use the ledger for the creditors. That should be more comfortable because you're coming from incomplete records. This is the only attempt that they asked NPO. Other than that, I think one small 2 mark or 3 mark at the end, somewhere it is there in some paper. Okay, that when we are solving other things, when we find it, we'll solve it off there itself. With that, we are done with our NPO discussion. And let's go further. NPO is done. Incomplete records done. On guys, welcome to a small, sweet and simple chapter called as partnership. Okay, small, simple chapter it is, partnership. Nothing is there. People will come, people will go. Some people will stay. They'll take profit and go home. That's it, no? What can be there other than that? Going, huh? Good night. Yes. Now, partnership. Let's start with partnership, guys. All the online people who are waiting. Sir, you're talking like doctor while putting injections, sir. Telling that it will not pain. But then we know, little will pain. Partnership 14 marks, every attempt. Every attempt 14 marks. In fact, some of the attempts 14 plus 4. Somewhere at the end, one more small partnership question also they give. So totally you have roughly around 18 marks from this particular chapter. Usually the questions are easy only from partnership because the concepts are so heavy. They don't try to twist it even more. 1 hour of partnership discussion. 1 hour. We'll focus on this. We'll see how much of the concepts we can try and cover. Whatever we can't, we'll cover it tomorrow. Partnership. Okay. What happened? Raining? Okay, partnership. Two or more persons join together for conducting business with an intention to earn profits. This is the definition of partnership as per the Partnership Act also. Now, partnership, what you are going to do? See, now you can see here only how much is there in this partnership. Little. See over here. Basics we have to cover. Admission we have to cover. Retirement we have to cover. Death we have to cover. Then sale or conversion of partnership firm into company, that we have to cover. Before that, dissolution we have to cover. Amalgamation of partnership firms also we have to cover. That means everything that can happen with partnership firm, everything is there over here itself. Let's go into the basics now. Partnership agreement. What is partnership agreement? Partnership agreement means rules. It is just rules. Those rules, when they are registered, focus on the rules. Don't focus on the couple here. Okay. Now, those rules, when it is registered, that becomes partnership agreement. Okay. It becomes partnership deed. So, partnership agreement, when it's registered with the registrar of partnership firms, it becomes partnership deed. Now, there are two people here, Ram and Anu, Pavan and Divya. Okay. Those formed a partnership. That's all. Nothing, no connection with the rest of the things. If not mentioned in partnership deed, this is an important thing that we have to remember. If not mentioned in partnership deed, profit sharing ratio will be equal, no salary or remuneration to partners, no interest on capital, no interest on drawings, interest on loan of partner, maximum 6%. Interest on loan of partner. Now don't tell that HDFC Bank gave us one loan and then we don't have partnership agreement, so therefore we will pay them 6% loan, interest on loan. They'll tell get lost. That's all. Okay. So this is the situation with our partnership deed. Now you have to remember one more thing is there which you have to understand over here. In case we don't have profit, we have insufficient profit, that time what you will do, interest on capital will be distributed in capital ratio. Now imagine I have capital of 1 lakh, I have capital of 5 lakhs. Two partners are there, 1 lakh and 5 lakhs. Interest on capital is 10%. So 5 lakh and 1 lakh, 6 lakhs. 6 lakhs on the 10%, I need 60,000 to pay them interest. Imagine if I have 60,000 profit, no problem, I'll give them 60,000. If I have 70,000 profit, I'll give them 60,000. Remaining 10,000 I'll distribute in the profit sharing ratio. But imagine if I have 40,000 profit, that time what I will do, I'll distribute that 40,000 to them in their capital ratio, not in their profit sharing ratio. Clear? That is one thing you have to understand and remember. Next we go into the topic of drawings. Okay, we go into the topic of, and you'll get decimal. Okay, drawings, and you have capital withdrawn. What is drawings? What is capital withdrawn? Drawings is basically in anticipation of profit. You know that end of the year the partnership firm is going to make some profit. You can't wait till the end of the year to get your profit share. You have your day-to-day expenses. So in anticipation of profit, what did you do? You took the money for your personal purpose. Amount related to firm taken in anticipation of profit. What is capital withdrawn? You had put money into the business, that you took it out. If you had put money into the business and you took it out, now what will happen? No problem. That is just amount withdrawn by the partner from whatever he had invested. So now you have to remember one thing which is very, very important over here. For drawings, interest on capital will be applicable. But for capital withdrawn, will there be interest on capital? For capital withdrawn, will there be interest on capital? You took your own money out of the partnership firm. There won't be any interest on capital. Only on drawings. Interest on drawings. Only on drawings there will be interest on drawings, not on capital withdrawn. Interest on capital. Interest on capital. What you are going to do over here? Capital into interest rate into months divided by 12. Capital into interest rate into months divided by 12. That's all. That's how you're going to calculate. Now some questions they'll tell you interest on capital will be on the opening capital, applied on the opening capital. Now let's take one example over here. Capital, Pavan has capital of 2 lakhs and Divya has capital of 1 lakh. Two partners are there. Now interest on capital is how much? 10%. Now 10%. Let's say capital introduced on 1/7, 50,000. Capital withdrawn 30,000. So what Pavan has done, he has introduced some capital also. He has withdrawn some capital also. Whatever capital was there at the starting, 2 lakhs, on that you see 10% into 12 divided by 12, 20,000 is the interest. Whatever capital was introduced on 1/7, on that you see 10% into 9 divided by 12, assuming that we are going to follow financial year, 9 divided by 12, okay, 3750. And whatever capital is withdrawn on 1/1, capital is withdrawn on 1/1, so on that you will calculate and you will minus the effect of that interest. You won't pay them interest for 3 months, so you'll minus that. You will get 23,000 as the interest on capital. That is the interest on capital for the partner who is called as Pavan. Okay, now we didn't take any example for Divya. One partner enough. Same thing, plus minus only will happen. Interest on drawings. Interest on drawings. There are many variations in interest on drawings. Okay, each variation you have to see. Interest on drawings, let's say 10% is taken as the interest on drawings. Clear? Now, Pavan, again, Pavan is the partner and Divya is also the partner. Now, drawings, only focus on Pavan now. Drawings, 1/6, they took 20,000. 1/6. 1/2, they took 15,000. That means on these dates, is there any pattern here? No pattern is there. Random dates, they have taken some money. So what will you do? On this into 10%. When did they take? 1/6. That means April and May done, 10 months remaining. For 10 months, you are going to charge interest. Here, 1/2. When did they take 1/2? Full year over, only February, March remaining. Here you will charge interest for 2/12 on 10%. You will get this amount. This is your interest on drawings. Is this clear how to calculate interest on drawings? Now, Pavan, drawings 1,000 per month on 1st of every month. You can calculate if you want, like how you calculated earlier also. 12 times you have to calculate. 12 times. It is just waste of time, right? So what you have to do, there is a formula, total drawings into rate into 6.5 divided by 12. Total drawings into rate into 6.5 divided by 12. So here what is going to happen? Total drawings, what mistake you should not make in the exam? You should not make the mistake of taking 1,000. 1,000 is not the total drawings. What is the total drawings? 1,000 into 12. 1,000 into 12, that is going to be 12,000. 12,000 into 10% into 6.5 divided by 12. Just memorize this formula, you'll get the answer directly. If at all the same thing was on 15th of every month, instead of 6.5, you will take it as 6/12. If it is on the first of every month, end of every month, instead of that, you will take it as 5.5 divided by 12. Only thing, remember, take total drawings. Don't take the drawings per month. Total drawings we want over here. Now, this is the 4 variations we saw. No, 4 variations. Yes. One, random dates, they have given the drawings. Another, what they have given? They have given the drawings, okay, with the proper format, that is at the starting of the month, middle of the month, end of the month, and same amount is there, same amount. Now, if nothing is mentioned, like for example, let's say they said Divya, drawings 6,000. Partner Divya, drawings 6,000. Now, what will you do? Is it starting of the month, middle of the month, end of the month? No. Now you are like, sir, simple, sir. For this, I will do 6,000 into 10%. Then you're taking the assumption that this person has taken the full 6,000 at the starting of the year itself. So therefore, whenever they tell only drawings in the question, remember this, you are going to take an assumption. It is supposed to be taken, that assumption is that drawings are evenly drawn during the year. If it is evenly drawn during the year, what will you do? Drawings into rate into 6/12. Drawings into rate into 6/12. Is this clear? This is how we are going to calculate. Sir, how to get the PDF? We'll share the PDF. Okay, we'll share the PDF by tomorrow morning. Always remember this 6/12. If at all you miss, okay, then you will be calculating double the drawings, interest on drawings, whatever would have been there. Now, next, small, sweet and simple topic, goodwill. Okay, this goodwill, how sweet it is that it will be there in every single topic. Every single topic, whatever you are going to study, in that goodwill will be there. Okay, you will never miss in any topic. Admission, retirement, death, goodwill surely is there. After that, it's amalgamation of partnership firms and all. Goodwill might not be there. Dissolution also, you will not have it goodwill, because if you had goodwill, you would not go into dissolution itself. Now, goodwill, reputation of business. Clear? Reputation of the business. What are the factors that are affecting goodwill? What are the factors that are affecting goodwill? Now, let's take an example over here. Now, imagine there is Santosh and there is Akash. What they decided? They decided to sell. One person, only one person was there. He decided to sell this heart-shaped balloon. Okay, heart-shaped balloon next to the college. Location of his business only. Location of his business only is the goodwill for him. Seeing that, one more guy called Akash, he also came and started selling this heart-shaped balloon. Heart-shaped balloon. That time what happened? This location got nullified. No, nothing to worry about the location part. Now what this person did, Santosh always has a smile on his face whenever he's giving the balloon to his customers. Now this Akash always is grumpy. So now who will have better customers here? Same balloon, same price, everything same. But still Santosh will have more customers because of the customer satisfaction. Okay. Akash also started smiling, nullified. Clear now. Reputation of owner. So what Santosh did? Santosh, he did one thing. He took Donald Trump only as the partner. Donald Trump only took as partner. Donald Trump is like in that balloon, I don't know which bomb he'll put and give, but still he took Donald Trump only as the partner and he told you, my partner is Donald Trump. Just because the partner is having reputation, don't you think business also will automatically have reputation? Partner is having reputation, business will automatically have reputation. Clear? Now, over here, this fellow got Joe Biden. Joe Biden, he cannot stand and all because he'll be falling. So in the chair he's sitting. Okay, so Joe Biden he got. So therefore, now both of them have nullified the complete effect of reputation. Technological advantage. Technological advantage. Now what Santosh did, he has created one crazy technology that with this balloon, if you gift this balloon to someone, as soon as you gift, no, it will give some fragrance. Because of that fragrance, no, they will have some positive impression about you. Okay, then after that, if you ask any question, they will tell yes only. Okay, so therefore, because of the technological advantage, now Santosh will have better sales or he will have more reputation. Now you can sell this thing balloon near Marina Beach also, no problem. No problem. Let's go further. Computation of goodwill. Now two things you have to learn: computing goodwill and accounting for goodwill. How to compute goodwill and how to account for the goodwill. Now first one, simple average profit method. Simple average profit method. Now in simple average profit method, how to calculate goodwill? Goodwill is equal to average profit into number of years of purchase. Average profit, how will you get? Total profit divided by total number of years which are given in the question. Now example you see, 2022, this is the profit. 2023, this is the profit. 2024, this is the profit. 3 years profit you have. Now what will you do? Divide, you will get the average profit. How many years purchase? They said 5. Multiply, you will get the goodwill. What is this number of years of purchase? Number of years of purchase means how many more years we are expecting to continue this reputation, or we are expected to have this reputation to continue. It's an estimate that they took as 5 years. 5 years they are expecting the reputation to continue. Clear? This is your average profit method. Now this 3 and this 5 has no connection. This 3 is the past performance. This 5 is the future expectation. Now goodwill, how much you got average profit? 83,333. 83,333 which you got, multiply into 5, you will get your goodwill. Clear? This is average profit method. One more we have is weighted average profit method. Now in the exam, if they tell weighted average profit only applied, usually weighted average profit is when there is an increasing trend or decreasing trend. But when they tell only you apply that in the exam, goodwill is equal to weighted average profit into number of years of purchase. Number of years of purchase has to be given in the question. Without that, we can't proceed. Okay, weighted average profit is total product divided by total weight. Now how will you calculate? See, profit is given for 3 years. Now most recent year which is there, no, I will give highest weightage for that particular year. 1, 2, 3. Most recent year, I'll give highest weightage. Most recent year is 2024. So I give 3. Before that, little less weightage. Before that, little less weightage. Why? Whatever happened in most recent year, the chances of that repeating is more higher. That's why highest weightage is given for the most recent year. Now multiply the profit into the weightage that is there. That will give you the product. That will give you the product. Total the product, total the weight. It will give you your weighted average profit. Now multiply into number of years of purchase, you will get the goodwill. Is this clear? This is how you calculate goodwill under weighted average profit method. If they tell you, you follow that. Otherwise, you follow simple average only. Now, highest weightage for most recent year. Now, if I tell you, guys, what is the profit? You know, it's like this: 1,10,000, 80,000, and 60,000. It is in decreasing order. What will be the weightage? It will remain same. It has nothing to do with increasing or decreasing. Highest weightage will be given for what? The most recent year, whichever is there. Okay, highest weightage for most recent year. Third, super profit method. Super profit method, what we are going to do? Goodwill is equal to super profit into number of years of purchase. Goodwill is equal to super profit into number of years of purchase. Super profit is what? Average profit minus normal profit. Average profit we just learned. How to calculate average profit we just learned. Okay, this you have to calculate. It won't be given in the question. Now normal profit, how will you calculate? Capital employed into NRR. Capital employed is the capital of the partnership firm, which will be given in the question. NRR is the normal rate of return. What is this NRR? If at all I invest money into this business in this industry, normally what is the amount that we are supposed to or expected to earn? That is normal rate of return. Clear? This will be 100% given in the question. So capital employed into NRR, you will get normal profit. Average profit is your profit. That means basically you are telling your profit minus normal profit. You are earning little higher than everybody else. That is your super profit, and super profit into number of years of purchase, you will get the goodwill. Okay, you can see the example for this. 2022, 2023, 2024. The profits are given 60,000, 80,000 and 1 lakh. Clear? 60,000, 80,000 and 1 lakh. Average profit already we know from our previous calculations, 83,333. Capital employed is 5 lakh. That means we are telling, okay, 5 lakh is my capital and 10% is the NRR. Anybody, if they invest 5 lakhs, they will get 50,000. How much I am getting? 83,333. That means with the same money where others are supposed to get 50,000, I am getting how much? 83,333. That means 33,333 is my super profit. Why I am earning this super profit when compared to others? Because of my reputation. 33,333 into number of years of purchase, you will get your goodwill. Now you have one more method which is not that frequently asked, which is called as annuity method. Annuity method, what happens over here? Goodwill is equal to sum of present value of super profit. Take the present value of the super profit. You're telling me that you are going to get super profit of 33,333 compared to others. But when are you getting that super profit? First year end, second year end, third year end, fourth year end, fifth year end. Next 5 years you are going to get every year 33,333 extra. But we are calculating goodwill when today. So take the present value of that goodwill. How to get this present value factor? It is, I'm taking the example as 10%. In the exam they can give 10%, 12%, anything. Take your calculator. 1 divided by 1.1 is equal to, you'll get 0.909. Press is equal to, again you'll get 0.826 is equal to, you'll get all the present value factors. This is for 10%. Imagine the percentage given in the question was 12%. What you would do? 1 divided by 1.12. If it was 5%, what you would do? 1 divided by 1.05, not 1.5, 1.05. Then you just multiply these numbers. You will get the present value of super profit. Total it, that is your goodwill. Clear? That is your goodwill. One last method of goodwill we have. That is basically your capitalization method. Capitalization method, what is going to happen? Goodwill is equal to normal value of business minus actual capital employed. Normal value of business minus actual capital employed. What is going to happen with your normal value of business? Normal value of business means what? Average profit divided by NRR into 100. You are earning this much. Based on that, what is the value of your business? So you're doing reverse. Earlier what you told, the value of your capital is this much. Based on that, how much profit I should earn? So average profit divided by NRR into 100. Actual capital employed will be given in the question itself. So now this is your calculations. You have your average profit already. Average profit divided by NRR into 100. To earn this average profit, how much capital anybody has to invest? 833,330. But how much did we invest? Only 5 lakh. That means we invested only 5 lakh and we are getting the profit what others would have got only if they would have invested 833,330. That means goodwill is 333,330. 333,330. Is this clear till here? This is your calculation for goodwill under capitalization method. Now you have goodwill share to be given by gaining partner to sacrificing partner. Remember, goodwill share will always be given by whom? Gaining partner to sacrificing partner. Goodwill share will be 100% given by gaining partner to sacrificing partner. Now sacrificing partner, now in what ratio we should give? Profit sharing ratio? No, it will always be given in sacrificing ratio. Now how to get this sacrificing ratio? old ratio minus new ratio. Take the old ratio minus the new ratio, you will get the sacrificing ratio. Now we'll take an example and we try to understand. Example, Pawan and Divya are there. Partnership, they are sharing profits in the ratio of 2:1. Partners, Pawan, Divya and Ram. Now Ram is a new entry into this particular question, and now they have given the profit sharing ratio as 4:3:2. Now what you do? Directly you calculate old ratio 2/3 and 1/3. This person 0 because Ram was not there before. New ratio 4:3:2. So 4/9, 4/9, 3/9 and 2/9. You'll take the LCM as 9. 3 3s are 9. So 2 3s are 6. 9 1s are 9. 4 1s are 4. So 6 minus 4, you are getting 2/9 as the sacrificing ratio. Here 3 3s are 9. Okay, 1 3s are 3. So 3. 9 1s are 9. 3 1s are 3. So 3 minus 3, 0 it became. Ram 0. 0 minus 2/9 will become minus 2/9. That means in this entire partnership of Pawan, Divya and Ram, Pawan is actually sacrificing and Ram is actually gaining. There is no sacrifice or gain for Divya. Is it clear? So if at all we are going to calculate goodwill, no, in this case, what will happen? Ram will bring money for goodwill, or Ram will give his goodwill share, and Ram will give his goodwill share to whom? To Pawan. To whom? To Pawan. Is this clear? Now, that means who is giving? Ram. So Ram's capital account debited to Pawan's capital account. Just remember one thing always. Just remember one thing always. The sacrificing partner who is there, the sacrificing partner who is there, his capital account should increase. The gaining partner who is there, his capital account should decrease. That means gaining partner's capital account debited to sacrificing partner's capital account. Gaining partner's capital account to sacrificing partner's capital account. Is this clear till here? Anybody has any doubt with this? Okay, now we go into next part, admission. Admission of a partner. In admission of a partner, what is going to happen in admission of partner? First, we'll calculate NPSR. What is NPSR? New profit sharing ratio. This might be given or you might have to compute. Clear? Now, next we are going to calculate sacrificing ratio, which we already know. Old profit sharing ratio minus new profit sharing ratio. Then we have goodwill computation. Goodwill computation, we learnt all those methods. Based on those methods, we'll compute the goodwill, or maybe sometimes goodwill will be directly given in the question. Then we are going to learn the fourth new thing. 3 things already we know. Fourth thing is what? Revaluation of assets and liabilities. Now, when an admission is happening, when a partner is coming in, we don't want that partner to enjoy the benefits what is created by the old partners, or the partner should not take the liability which is created by the old partners. So, increase in assets, decrease in assets, increase in liability, decrease in liability has to be done before the new partner is going to enter the partnership firm. Is this clear? Now, increase in assets. Increase in assets. Asset account debited to revaluation account. Asset account debited to revaluation account. So next, decrease in assets. What we are going to do? Revaluation account debited to asset account. Revaluation account debited to asset account. Now, increase in liabilities. Increase in liabilities, what we are going to do? Liability increase means loss. Revaluation account debited to liabilities account. And liability decrease means profit. Liabilities account debited to revaluation account. You can think of this from any angle if you get confused in the exam. If you are thinking from modern approach, asset increase, asset debited, therefore revaluation account credited. Asset decrease, asset credited, therefore revaluation account debited. Liability increase as per modern approach, liability should be credited, therefore revaluation account debited. Liability decrease as per modern approach, liability should be debited, therefore revaluation account is credited. This is one way you can think. Otherwise, you can think in the other way if you can't remember this in the exam. Asset increase, good for us, profit. Liability asset decrease, bad for us, loss. Liability increase, good for us, bad for us, loss. Liability decrease, good for us, it is profit. When you do all this at the end of the revaluation situation, you can have either revaluation profit or revaluation loss. Revaluation profit or revaluation loss. Now what will you do? Revaluation, if it is profit, that means revaluation account will have a credit balance. Now what will you do? Revaluation account debited to old partner's capital account. In what ratio? Old profit sharing ratio. Then if it is loss, old partner's capital account debited to revaluation account. In what ratio? Old profit sharing ratio. In what ratio? Old profit sharing ratio. Now next we go into a small concept called as memorandum revaluation account. Now how will we know it is memorandum revaluation account? Either they tell us directly or they tell a word like this or sentence like this. When after admission of partners, after admission, partners agree to show the assets and liabilities at original value. They will tell this sometimes in the question. What they tell in the question, they tell that revaluation, all they'll tell, 5-6 points of revaluation they'll tell. Then they tell that partners agree to show the assets at their original value in the books. That means what happened to the revaluation which we just did? Whatever revaluation which we just did has to be reversed now. So first you do the revaluation, share the profits and loss between the old partners. Then reverse the revaluation and share the opposite will happen obviously. Share the profit or loss between all partners including the new partner who is going to be admitted. Now value before revaluation. Okay, original values. You have to bring it back to original values. So first step is revalue assets and liabilities, share the profit or loss between the old partners in old profit sharing ratio. Then second step is reverse the assets and liabilities and whatever profit or loss is there, share among all partners including new partner in the new profit sharing ratio. Next thing is reserves. If there are some reserves kept, reserves means what? In the past we earned profit and we kept it in the side. That reserves belongs to whom? Who earned it? Who earned it? Old partners. So before the new partner comes, we will empty the reserves and transfer it to old partners. Share among old partners. Reserve is a liability. Liability decreases and we transfer to one more liability. Reserves account debited to old partners capital account in the old profit sharing ratio. Now we are ready for admission. Now we'll admit the partner. When the partner is admitted, now you have to remember one thing. Capital is introduced. When the capital is introduced, it can be capital plus goodwill share or it can be only capital. Now you're like, sir, what if it is only goodwill? We'll kick him out. Are you getting my point? Person without capital cannot enter only. No, at least they should get capital or they should get capital plus goodwill. Now imagine that person gets capital plus goodwill. His goodwill share, what we will do? We'll distribute to partners. Who partners? No, sacrificing partners. In old partner also sometimes one person might be gaining. Sacrificing partners. Now what you have to do after that, one more thing that you have to remember, very important point. After that you have to remember is, now new partner did not bring only goodwill but brought capital. Still we will take from his capital account and distribute to the sacrificing partners. Balance will be considered as capital. We'll remove the goodwill and distribute to the partners. Whatever is remaining, that is his capital. Now capital plus goodwill, only capital, amount brought by new partner. When he's bringing money, what should be the entry? For the partnership firm, we are getting money. Bank account debited to new partner's capital account. Bank account debited to new partner's capital account. Goodwill distribution. Goodwill distribution. Now understand this goodwill distribution. Always goodwill distribution entry will be same. What is the same entry? Gaining partner's capital account debited to sacrificing partner's capital account. Most of the times it is new partner, but some of the old partner also can be there. You always have to check based on the sacrificing ratio. Now, existing goodwill in the balance sheet. If there is already one goodwill in the balance sheet, what will you do? Write off. You will write off that goodwill. So what will you do? Goodwill write off means goodwill is asset. When goodwill is asset, you will pass the entry old partner's capital account debited to goodwill account. Old partner's capital account in the old profit sharing ratio. Making capital proportionate. Making capital proportionate. Making capital proportionate means what? Keeping new partner's capital as the base. They will tell like this. Keep new partner's capital as the base and make the capital proportionate. Imagine new partner is bringing 1 lakh and his share is 1/5. Then what we will do? That means total capital should be 5 lakhs and 5 lakhs should be in the new profit sharing ratio. Distribute the capital and see how much each person should have. Then go to the partner's capital account and see how much is there. Then how much is there you found out. From there you are going to remove. Okay, if there is extra you are going to remove. If there is going to be shortage, we are going to ask them to bring the money. With that we are finished with the admission. Till admission of a partner we have finished. We'll stop here and we'll continue tomorrow. Okay, retirement of a partner. Otherwise we will be like halfway there, not halfway here. So we'll stop here because little concepts at least we have to revise before we start problems tomorrow. So retirement and other things we will discuss tomorrow. That should be it, guys. So 12:04. So it is good morning. Good morning to everyone. See you tomorrow at sharp 8:30. Sir, I think we should continue tomorrow because you look so tired. Wow. Okay. Yes, guys. See you. Bye bye. Online, offline, everyone. Yes. Good evening, guys. Let's begin. Let's begin. Let's continue from where we stopped partnership last night. So, till admission we had finished. Let's continue with retirement of a partner. Once we know till admission, then retirement onwards, it's not that difficult. Same process will continue. Most of the processes will be same. Only certain things will be extra. Retirement of a partner leaving the partnership firm voluntarily. That means he only has decided to leave the partnership firm. First thing that you have to check again is NPSR, new profit sharing ratio. We need the new profit sharing ratio between whom? The remaining partners. Ratio among the remaining partners after retirement. Then we need the sacrificing ratio. Sacrificing ratio is what? Old profit sharing ratio minus new profit sharing ratio. Simple. Don't go to change the ratio and all and create one new ratio called as gain ratio and all. Use sacrificing ratio only. Old profit sharing ratio minus new profit sharing ratio. Use that ratio only. In that, if you get positive answer, answer is sacrificing ratio. If you get negative answer, that means it is gain. That partner is gaining, and the partner who is getting positive answer, that partner is sacrificing. Now then, goodwill computation. We learned yesterday that is average profit, super profit, and all those other methods. Goodwill distribution. Who will give to whom? In all cases, gaining partner will give to sacrificing partner. Gaining partner will be contributing the money to sacrificing partner. Revaluation of assets and liabilities. Same as before, what we had done in admission, same thing will be done. Revaluation of assets and liabilities even over here. Then profit or loss shared between all partners including retiring partner. Profit or loss will be distributed between all the partners including which partner? Retiring partner. Reserves. Reserves, what we are going to do, it is shared between all the partners including retiring partner. Reserves will be shared between all the partners including retiring partner. Now next one is goodwill. Okay, goodwill which is there in the existing balance sheet. You have to write it off. Existing goodwill, write off. New goodwill you are going to record. Okay, write off all partners capital account debited to goodwill account. Remove goodwill. Goodwill is an asset. Asset should be reversed. That means asset should be credited. So reduce, and all partners capital account is debited. Now JLP, SLP, joint life joint life policy and separate life policy. What is joint life policy? Life insurance policy which is taken jointly on the life of all the partners. Now partners are important to the partnership firm. No, if something happens to the partnership firm, that will affect the functioning of the partnership firm. Therefore, what we do? Therefore, joint life policy will be taken by whom? The firm. On whom? On the life of all the partners. Separate life policy means what? One of the partners is more important than the other partners. That time what will happen? Life insurance policy will be taken by the firm on the life of an individual partner. It will be taken on the life of one individual partner. Now, any amount received will be shared by all partners. Any amount received will be shared by all the partners. If partner dies, policy amount is received. If partner just retires, you will surrender the policy. So you will not get the policy amount, you will get only the surrender value. Imagine the amount is 1 lakh. Imagine the amount is 1 lakh. This is the policy amount. Now, policy amount is received only if any partner dies. Now, imagine the partner retires. That time you will not get the policy amount. What will you get? You will only get the surrender value because you will surrender the old policy and then you will receive the surrender value and distribute it to all the partners. Whatever you receive, that is policy amount is received or surrender value is received, it will be distributed between all the partners. Clear? Next, settle the retiring partner. What are you going to do? You are going to settle the retiring partner. How will you settle? It will be given in the question. Okay, if it is not given in the question, you will always take it as loan. You will transfer it to partner's loan account. Now pay it immediately or treat it as loan. Pay it immediately means what? Retiring partner's capital account debited to bank account. Retiring partner's capital account debited to bank account. So bank account you are going to credit and retiring partner's capital account balance reduces. If you are not going to pay it immediately, that means if it is not told in the question what to do, then you will always go and take it as retiring partner's capital account debited to retiring partner's loan account. You will transfer it to loan. Sir, I'm having my confidence at all-time low. When it's near to exam, I might fumble, but your class helped me a lot, but still I have a bit of tension. See, tension is not going to give us extra marks. Is it going to give us extra marks? So it is easy to tell actually, but just remember, don't take so much tension, guys. It's just an exam. Okay, it's not end of life. Go with a very chill mindset to exam. When you go with chill mindset to exam, what you have studied like 1-2 months ago also, it will be fresh in your memory. If you go with a very loaded brain, that time when you go there, no, you're like thinking that you'll make mistake. It is like going to a cricket match, thinking that when you're playing the ball outside the off stump, it will edge. That time it will edge only. If you're thinking that you are going to middle the ball, then you will hit a boundary or you will hit a six. So you just have to stay like calm. Okay, just think that you will crack it. See, nothing if you don't worry too much also that MCQs are there. No, those MCQs itself will help you clear the exams. Just focus on those MCQs. 30 marks you do well, you'll naturally go ahead with the confidence and then you can crack the exams. Just don't take tension. Never give up till the last moment. Keep your confidence high. Just think that someday, some alternative you will find and you will crack this exam. Okay, if it doesn't happen, it's not the end of the world. Then you know where to correct and always focus on the next attempt. Don't worry, guys. Exam is close. Never give up. Just go. Right. Will all chapters be completed by today? No. If it is not completed by today, tomorrow we will not be going live. We will be going live day after tomorrow. And most probably day after tomorrow live will be including accounting standards, because today we will be requiring for partnership only and for other chapters. Day after tomorrow we will be going. Tomorrow we are not going live because I think 3 back-to-back days it's too much. Let's take 1 day break in between. And day after tomorrow we'll go live and we'll finish off the remaining chapters. I hope it's clear, guys. Yes. Now, settle the retiring partner. Settle the retiring partner we already discussed. Now, there is one small section of Partnership Act, section 37 of Partnership Act. That is, if at all the partner is not settled, then it goes into loan category. And if it goes into loan category, what to do? Now the option is with the partner. Option is given to whom? Partner. What is the option? Partner can take 6% per annum interest on whatever balance is there, or partner can take share in the profit. Partner can take what? Share in the profit. Now you have to understand one thing. If at all partner had to get 1 lakh rupees, okay, he retired and in his capital account 1 lakh rupees is there, it has to be given to him. We did not give, we transferred it to loan account. Now he can take 6%. Or this 1 lakh is also used in the business, no, because it is not given to him. So therefore what they will do, use this formula, profit into retiring partner share divided by total. Total means what? Capital plus loan. Imagine we have one A, B, C, 3 partners. A has 1 lakh, B has 2 lakhs in his capital account, and C is gone. And what happened now? C's loan is 3 lakhs. C's loan is 3 lakhs. Imagine the company made, partnership firm made profit of 50,000. Now what will you do? 50,000 profit into, what is retiring partner share? Retiring partner share is 3 lakhs divided by total. Total what you are going to do? 1 lakh plus 2 lakh plus 3 lakh. That means out of the total, how much is this percentage? 50%. Therefore, 25,000 will be his share. Now he has to decide whether he wants 25,000 or on this 3 lakhs, he will take 6%. On 3 lakhs, if you take 6%, that is going to be what? 24,000. Is it 24,000? No. Yeah. 18,000. It is going to be 18,000. So now what happens? He'll choose. Partner will choose whether he wants this 18,000 or whether he wants the 25,000. Obviously, he'll take the 25,000. Imagine next year, the profit is low. Because the profit is low, what happens next year is, he will choose the interest option. After that, yet profit is high, he'll choose the profit option. So till you settle the partner, he has the option to choose whatever it is. Now imagine in death of a partner also. In death of a partner, same option will be available if the amount is not settled, but it will be available to whom? The executor. It will be available to the executor of the deceased partner. Now, next we are going into death of a partner. Okay, death of a partner. What happens in death of a partner? This is partner leaving the partnership firm due to death. Okay, amount payable to partner by the firm to be payable to the executor. Executor is nothing but the legal heir. Okay, payable to executor. Now, they can ask a question to calculate just what is the amount that is payable to executor. What is the amount that is payable to executor? Capital account balance, whatever is there in the capital account, obviously that has to be paid. No. Can we tell that we are not paying that itself? No, that has to be paid. current account balance. Current account balance can be, how do we know what is current account, by the way? There are two ways of maintaining capital: fixed capital system and fluctuating capital system. Fixed capital system means all the transactions are entered in the current account. In capital account, only the capital introduced and capital withdrawn will be there. Okay, fluctuating capital system means what? All the transactions are entered in the capital account itself. Now, when we are talking about fluctuating capital system, there will be capital account. When there is fixed capital system, there will be current account also. So current account can have positive balance or negative balance. That means credit balance means firm has to pay to the partner, add. Debit balance means partner has to give to the firm, minus. Clear? Interest on capital. Partner died somewhere middle of the year. That time interest is there till that particular date. Interest on capital, add. Drawings. Partner before he died, he has taken some money. That money has to be returned by the partner. Drawings, minus. Interest on drawings. On the drawings, the partner has to give us money now. On the drawings, partner, if he has to give us money, that is interest on drawings, minus. Then revaluation, profit or loss. Either if it is profit, add. If it is loss, subtract. Share in reserves. Reserves are there. This partner also has to get a share in that because when he was alive, they had earned this for the partnership firm. So that you are going to add. Goodwill share. Goodwill write off. Goodwill write off, what will you do? What is there? You are going to write off that goodwill. Asset reducing is a loss. That will be minus. Goodwill share given by gaining partners. Other partners who are there, they will be gaining because this partner is leaving. That share also will be given over here. JLP or SLP share. Now, if a partner dies, the policy will give us the policy amount, and that policy amount also will be added. Clear? Profit share till the date of death. You will give them what? Profit share till the date of death. That profit share which is there till the date of death, how you are going to calculate? Now, basically, just remember, if this person died in the middle of the year, till that day we have earned profit, and till that day whatever profit we earned, that person also deserves it. So we'll calculate that share till that particular day and we'll give that profit share. Clear? And the entry for that is P&L suspense account debited to deceased partner's capital account. P&L suspense account debited to deceased partner's capital account, and from there it will be given to the executors. Now P&L suspense will be shown in the balance sheet on the asset side because it has debit balance. It will be shown on the asset side because it has debit balance. Amount payable to executor. Same logic, pay it immediately or transfer it to loan. Now whatever you are transferring to loan, okay, again the same option, section 37 of section 37 of Partnership Act comes into picture. Share in profit or interest percentage. Clear? Now next very important topic is joint life policy accounting. Joint life policy, how to do the accounting. 4-mark question, 3-mark question can be asked on this also. Now premium is paid by whom? Firm. Premium is paid by the firm. Remember this, always joint life policy, premium is paid by the firm. Now two things can be done. Treated as expense or treated as asset. If it is treated as expense, the entry is expense entry you have to pass. Joint life policy premium account debited to bank. If it is treated as asset, joint life policy account debited to bank. Joint life policy is the asset account which is debited. Simple, if I pay any amount, it can be capital expenditure or it can be revenue expenditure. If it is capital expenditure, the expense will be capitalized. That means directly asset will be debited. If it is revenue expenditure, expense only will be debited. Now, P&L account debited to joint life policy premium account. The premium gets transferred to P&L. Then, at the end of the year, JLP account must be adjusted for surrendered value. Over here, end of the account, end of the year, what we have to do? JLP account has to be adjusted for the surrender value. Now, what does it mean? Now, asset is shown as 3,000. Let's say asset is shown as 3,000, but the surrender value of the policy is only 300. So, what you will do? You will reduce the asset by 2,700 rupees and show the asset at 300 rupees only. You should show the real asset values. Okay, that problem will not be there if it is shown as expense. Clear? Now, when the amount is received, what will happen? Amount is received, bank account debited to JLP. Here also, both the cases, it will be bank account debited to JLP only, and then JLP account debited to partners capital account. JLP account debited to partners capital account. So here also you can see amount received, bank account debited to JLP, JLP account debited to partners capital account. But here you have to understand one thing. Balance what is there, that only will be shared. What does it mean? What am I trying to tell over here? Balance that is there. See over here, this is the balance sheet of the partners capital account. In the balance sheet, already JLP is there. In the balance sheet, when already JLP is there and it is showing 1,000. If JLP is there in the balance sheet, it's showing 1,000. That means what? The JLP is treated as asset. JLP is treated as asset. That's why it is in the balance sheet. Now, if they tell amount received from JLP. Amount received from JLP. Okay, if they tell 1200 is received from JLP. Now what you will do? Imagine the JLP account. In JLP account, there is 1000 rupees on the debit side and bank account debited 1200 to JLP account 1200. That means only 200 is the profit which will go to partner's capital account. Okay. Now imagine the situation is in the balance sheet there is no word called JLP only. There is no JLP. And if they tell you that amount received from JLP is 1200, amount received from JLP is 1200. That means if JLP is there but not there in the balance sheet, that means the JLP was treated as what? Expense. So therefore, whatever 1200 you get, you will pass the entry now JLP 1200 bank account debited to JLP. So full 1200 will now go to partner's capital account. Is this clear? This is what you have to do. If you see the JLP in the balance sheet, then whatever amount you receive, difference only is profit. If you don't see JLP in the balance sheet, then whatever amount you receive, entire amount is profit, transfer it to partner's capital account. That's it. Now we're going to the next topic, small, sweet and simple topic called as dissolution of partnership. One of the easy parts of partnership it is. Now, what is dissolution? What is dissolution? Closing, shutting the partnership firm. Okay, accounting, close the books. Now, steps to be followed. Steps to be followed. First, what will you do? Transfer all assets and liabilities, okay, to realization account at book value. This step actually, when we are solving problems, we call it as closing the balance sheet or shutting the balance sheet or emptying the balance sheet step. Just empty everything from the balance sheet and transfer it to realization account. Transfer assets and liabilities except cash and bank to realization account. Why cash and bank? Because when we sell assets, we'll get money. When we have to pay liabilities, we need money. So the cash and bank account is kept separately. Now, first entry is what? Realization account debited to asset account. Why? Asset is having debit balance. So to remove the debit balance, you are going to credit it. Then liabilities account debited to realization account. Liabilities account have credit balance. To remove that liability, what we are going to do? We are going to debit it. Then asset taken over by partner. If asset is taken over by partner, partner took the asset. But where is the asset sitting right now? Asset is sitting inside the realization account. So now you will pass the entry partner's capital account debited to realization account. At what value? At agreed value. Book value might be 1000, but partner told I'll take this asset at 800 rupees. You will pass this entry at 800 rupees only. Partner's capital account debited to realization account. Now, liability settled by partner. If liability is settled by partner, that means where is the liability sitting now? It is inside realization. Everything is inside realization. Now you will pass the entry realization account debited to partner's capital account. Now if you are getting confused with this entry anytime, just think like this. Asset is taken by partner. That means partner, we gave him money. How did we give? In the form of asset. So partner's capital account debited. Liability taken over by partner. That means partner paid the liability or partner took the responsibility of the liability. So now you have to pay the money to the partner. So realization account debited to partner's capital account. Realization account debited to partner's capital account. Here we are crediting because we have to give him money. Here we are debiting because we have already given him money. Sale of assets. When we sell assets, what we will get? Money. Bank account debited to realization account at sale value. Settlement of liabilities. When we settle liabilities, what goes away? Money. Realization account debited to bank account at what value? Settled value. Close the realization account. When you close the realization account, either you will have a profit or you will have a loss. Realization account, if the credit balance is more, if credit balance is more, you will pass the entry realization account debited to partner's capital account profit sharing ratio. If debit balance is more, then you will pass the entry partner's capital account debited to realization account at PSR, profit sharing ratio. This is the loss. Credit balance is more means what? Realization profit. So you remove the profit by debiting it. And debit balance is more means what? Realization loss. Remove the loss by crediting it and transfer it to partner's capital. Close the books. What you're going to do? Close the books. Now simple, if partner has credit balance, that means he has to get money. Partner's capital account debited to bank account. If partner has debit balance, that means he has to give us money. Bank account debited to partner's capital account. Here we have a small fight between two people called as Garner versus Murray rule. Garner versus Murray rule. This rule will be applicable only when the partner is insolvent. If a partner is insolvent and his capital account has debit balance, then that loss will be borne by other solvent partners in capital issue. One partner is there. Insolvent means what? The partner does not have money. If the partner does not have money, then what you're going to do? That loss, that means that debit balance which is there, no, in the partner's capital account, this debit balance somebody has to bear. If partner was solvent, you tell that partner only, please bring money. Because if there is debit balance in your capital account, that means you owe us. Owe us means home partnership firm. But if the partner does not have money, what you will do now? This money will be contributed by other partners in their profit sharing, in their capital ratio. In their capital ratio. Which other partners? Other solvent partners. It will be contributed by other solvent partners. Note, if all partners are insolvent, if all the partners are insolvent, then creditors lose money. Simple, no? One partner ran away. Yeah, one partner ran away. Who will contribute now? Other two partners. If two partners ran away, at least that last partner will contribute. All the three partners ran away. Now who will contribute? Nothing. The creditors will come, see the close the shutter and go home. So who lost money here? Creditor only lost money, no. So therefore it is creditor who is going to lose money. When all partners are insolvent, you will pass this entry like this. Creditor account debited, creditor gone. To bank account, how much money is there? That much we will give. Whatever we can't give creditor is always good for us. That good thing is called as deficiency. Clear? When we have to get money, it is bad for us. That bad thing is called as bad debts. Now deficiency account debited to partner's capital account. Why? Whatever this partner could not bring, no, that got adjusted with that fellow. Imagine partner had to bring 3 rupees. Why partner has to bring 3 rupees? To pay the creditor over there. Now if partner does not bring 3 rupees, that got adjusted with whom? It got adjusted with the creditor over there. Creditor lost money. No, if I don't bring money, somebody is going to lose the money, that is creditor. Amount to be compensated to partner who was admitted, who had given amount towards goodwill on admission. Now this is one small point which is there towards the end of the partnership concept area of your study material. Now see, one partner was there. He was admitted, and when he was admitted, no, we told him, you know what, our partnership, a crazy reputation is it has. Bring goodwill. We told him, bring goodwill share. Without goodwill share, I'll not let you. He's like, no, I'm not bringing goodwill share and all. I'm bringing only capital. Remember what we'll do if he brings only capital also. If he brings only capital also, I'll remove from his capital share only. So therefore, now what happens? You told me there is reputation that this and all. Now we are going into dissolution. Don't you think it's unfair for that person who just got admitted into partnership? So old partner's capital account debited to new partner's capital account. Now we are compensating him because he was admitted and he gave goodwill share. Now old partners will reverse that and give him his goodwill share back. This is on dissolution. Okay, now non-applicability, you see, non-applicability of what? Garner versus Murray. Non-applicability of Garner versus Murray. Now, dissolution due to death of partner. One person, he was insolvent, but it was dissolution because of that partner, and that partner only knew the entire business. We don't know anything else. So now there is no Garner versus Murray applicability. Dissolution due to fraud of new partner. Now fraud of new partner, will we tell that boss, we will contribute for your loss? No. Agreement was there for no refund. First only they made agreement, there is no Garner versus Murray. Clear? Now next, piecemeal distribution. What is this piecemeal distribution? Now evening, now you are having your meal. Imagine there is a pizza over here. Pizza is kept over here, and this pizza, will you take this full pizza and put it into your mouth directly? Full pizza like this, you will pour it inside and it will go straight to your stomach. Is it possible? No, right? You will eat part by part, right? That is called as piecemeal distribution. Same way in dissolution, do you think all the assets in our partnership firm will get sold in one day itself? Is it possible? No, it is not possible. So therefore, distribution of cash to partners in parts is called as piecemeal. And here we have two methods, that is called as maximum loss method and higher relative capital method. Maximum loss method means the partners are negative people. They are thinking that whatever money is going to come, this is the last time we are going to get money. After that, any of our assets will not get sold only. Higher relative capital means based on the profit sharing ratio, whoever has higher capital, that partner will be given money first. Remaining partners will be given money later. Now, order of payment. Whenever there is a realization situation, order of payment. First, whom you are going to pay? First, you are going to pay realization expense. Obviously, lawyer and whoever agent you are going to hire, you are supposed to make payment to them. Outsiders liability. Outsiders who are their creditors, bank OD, bills payable, you will pay all of them next. Then insiders liability. Who are the insiders? The partner's loan which is there, you will pay that next. Then partners capital account. Partners capital account, what is going to happen? Piecemeal distribution. Partners capital account, piecemeal distribution. Clear? So any of these people don't know what on earth is piecemeal distribution. Piecemeal distribution concept applies only when you are paying the money to partner. So here first you will clear the realization expenses, then you will clear the outsiders liability, then you will clear the insiders liability, that means partners loan which is there, then ultimately you will pay the partners capital account in piecemeal distribution. That might be maximum loss method or higher relative capital method. Now maximum loss method, every installment to be treated as the last installment. You follow these steps, automatically you will be able to solve any maximum loss method question. Sir, will they ask piecemeal distribution question? It's really time consuming. It is, I agree completely with you that it's really time consuming, but will they ask that? I can't tell you. Okay, but for 14 marks, they might not ask. Are you getting my point? Because 14 marks, they might want to test you on admission, retirement, death, or amalgamation and all those things, right? But for 14 marks, they might not ask. If they ask for 14 marks, even though it is time consuming, that is the easiest. If they ask for 14 marks and it is piecemeal distribution, even though it is time consuming, that is the easiest. I hope you got your answer, guys. Let's go further. Now, every installment to be treated as the last installment. Compute maximum loss. Now you know what happened now. Partner A, B, C. A has to get 10,000, B has to get 5,000 and C has to get 5,000. Now, how much we have to pay the partners? 20,000. Imagine I got 2,000 rupees. I got 2,000 rupees. Now what I will tell? Oh, maximum loss is 18,000. Now I will share this maximum loss to all the partners. Then whatever remaining amount is there, that is the amount that is going to be distributed, and that is the 2,000 rupees which we have in our pocket. Next, step 2. Distribute maximum loss to partners in profit sharing ratio. That is what I told. Amount payable to partner minus amount available. That one will automatically get the maximum loss distributed to the partners in their profit sharing ratio. Step 3. Deduct maximum loss from amount payable to partner. Whatever amount you are supposed to pay, no, you just distribute it, no, deduct it. That time you will get, if any, that time you will get the balance. But when you're getting balance, if at all, worst case scenario, if any partner goes into negative, adjust it in capital ratio. Why? Going into negative means insolvent. Insolvent means Garner versus Murray. That time you will use capital ratio and you will adjust it. That means one partner goes into negative, other partners who are positive will bear it. Now, step 5. Balance amount is paid. Balance amount is amount payable to partner minus the maximum loss which you just distributed. That is the steps which you are going to follow. Next, higher relative capital method. Partner who has higher capital is to be paid first. Higher capital means we are just not going to see the number and tell higher capital. Okay, how we are going to do this? Computation of HRC. Divide the partner's capital by profit sharing ratio. Now what I'll do, I'll just take some random number to explain to you. Otherwise it doesn't make sense, only these steps and all. So I'll take one. Where did you go? Where are your friends? They're having dinner and coming now. Okay. Now see over here. Higher relative capital. Higher relative capital. If I tell that there is partner A, B, C and their profit sharing ratio is 2:2:1. Imagine the profit sharing ratio is 2:2:1. And I am telling that their balance payable is 40,000, 25,000 and 10,000. 40,000, 25,000 and 10,000. Now I'll teach you how to calculate higher relative capital in one shot. Clear? Now you go straight and check my steps, what I have written over there. Divide the partner's capital by PSR. So now I will just write PSR over here. And then I'll write 2, 2 and 1. 2, 2 and 1. Then I'll divide. How I'll divide is 40,000 divided by 2. That makes it 20,000. 25,000 divided by 2. That makes it 12,500. 10,000 divided by 1. This one you can use calculator fast and tell me how much is it? 10,000. Clear? Now this is the situation. Now you got this answer. Okay, this is step 1. Just leave it here only. Go straight to step 2. What does step 2 tell us? Keeping the partner's capital as base, who has the least resultant amount, compute the required capital. Who has the least resultant amount over here? C has the least resultant amount, 10,000. Don't keep 10,000 as the base. Keep his capital as the base. Luckily, his capital is also 10,000 only. So now you will keep 10,000 as the base. C share is 1 by 5. For 1 by 5, if the capital is 10,000, what is the total capital? That means what is the total capital? 50,000. Now you got the required capital. Now see next step. Distribute required capital in PSR. Distribute required capital in PSR. This 50,000 you are going to distribute in the, I am even calculating. 20,000, 20,000 and 10,000. If I distribute this in the profit sharing ratio of 2:2:1, you are getting 20, 20 and 10. Next step. Next step. HRC. HRC is actual capital minus required capital. Now I am getting the HRC. Who is the HRC? Now see over here. How much is the actual capital? 40. How much is the required capital? 20. That means what is the higher relative capital? 20. How much is the actual capital? 25. How much is the required capital? 20. That means how much is the higher relative capital? 5. How much is the actual capital? 10. How much is the required capital? 10. That means how much is the higher relative capital? 0. Clear till here? Now what we are going to do? A and B 20,000, 5,000. A and B 20,000, 5,000. That means I have to pay A and B first, then I have to pay C. Now imagine I got 1,000. Who I will give? Will I give to A or will I give to B? You can't decide that. You feel that it is 20,000 and 5,000, so you will give to A. How much you will give to A? Till his 20,000 gets over? No. Now you have to go and see. Repeat the steps till one partner has higher relative capital. If you have watched WWE, have you watched WWE? In that there is one match called as last man standing match. Okay, like that this is. Last man, whoever the last person is there, that person is higher relative capital. Now you see profit sharing ratio. What is the profit? Same steps again. What is the profit sharing ratio? 2:2. Last person is not there, eliminated. Now you are dividing by that. When you divide, you are getting 20,000. You can use calculator for this. 10,000. And here it is 5,000 divided by 2. That means it is 2,500. Keeping the least number as the base. Who is the least person here? 2,500. But you are not keeping 2,500 as the base. You are keeping this capital as the base. So therefore 5,000 is for 2 by 4 ratio. How much is 1? How much is 1? Basically 10,000. And this 10,000 will be distributed in the profit sharing ratio, which is 2:2 only. So 5,000 over here and 5,000 over here. How much is the capital here? 20. How much is required? 5. That means 15,000. How much is the capital over here? 5. Sorry, how much is the capital over here? Yes, 5. And how much is required? 5. So 0. Now you see what has happened over here. Remember, when money comes, first you are going to give this 15,000. First you are going to give this 15,000. Then what you are going to do? Now, understand this. First 15,000 will go to A. Then what you will do? Then you will give to A and B. But how much? Out of this 20, 15 is paid, no? So out of the 20, how much is remaining? 5 is there. So next what you are going to do? Next. You are going to pay 5,000 to A and 5,000 to B. Okay. Then last, third option, what you are going to do? Pay all in profit sharing ratio of 2:2:1. Once you pay these people's higher relative capital, done. No, after that you don't have any higher relative capital. No, nobody has higher relative capital. So what you'll do, you'll pay everybody in their profit sharing ratio of 2:2:1. So higher relative capital is telling, based on the profit sharing ratio, if anybody has extra capital, first you pay them. Then we will think about paying anybody else. Done now? Everybody? Yes. Do not skip any part of partnership. I'm telling you. 100%, 100 times they have asked questions from partnership. 14 marks. Yesterday we saw 4, 5 is partnership. Now, and when we see the questions, you will understand maybe out of 5 attempts, 1 attempt would be a little tricky. Other than that, everything will be simple only. Let's go further, guys. Done. Amalgamation of partnership firms. Amalgamation of partnership firms. What is this? We have a partnership firm, 3 people are there. There is one sole proprietor over here. Now this sole proprietor is taken over by the partnership. That also can happen. Okay, there is a partnership firm over here. There is a partnership firm over here. Both are going to be merged into one new partnership firm. That also can happen. Here what we have to do, close the books of the firm. Close the books of the firm means what? Same dissolution you have to do. One firm will get dissolved, the other one will take over this one. So now here you have to remember, transfer assets and liabilities to realization account. Realization account debited to asset account at book value. Just now which we saw for dissolution. Liabilities account debited to realization account at book value. This also which we saw in dissolution. Asset taken over by partner. Partner's capital account debited to realization account at agreed value. This also repeat telecast. Then liabilities taken over by partner. Realization account debited to partner's capital account. This is also at settled value. This is also repeat telecast. Asset taken over by new firm. Sorry, asset not taken over by new firm. Now new firm will take everything, assets and liabilities. If it is not taken over by them, what we will do? We will sell it off. So bank account debited to realization account at sale value. Liabilities, if they are telling, no, we don't want to pay this liability, you only settle this liability. Realization account debited to bank account. This will be at value settled. This will be at what? Value settled. Now, realization expenses. What happens in realization expenses? Realization account debited to bank. What is this realization expenses? I have to pay the lawyer, agent, CA and all those things I have to pay. So realization account debited to bank account. PC. PC is what? Purchase consideration. Who has to pay? New firm has to pay to the old firm. So new firm account debited to new firm account debited to realization account. Why new firm is debited? Because new firm has to give us money, so they become receivable for us. For us, they are a receivable. Now, PC, assets taken over by new firm minus liability taken over by new firm. This is called as net asset method. Asset taken over by liabilities taken over at agreed value. Agreed value. Clear? Now, what is this agreed value? Your land might be 1,000 in the books, but they are like, no. You might tell, no. Value of the land is 5,000, so you have to pay me 5,000. So these are the agreed values which are there. Then finally, partner's capital account you debit and credit the new firm account. Why you are crediting new firm account? From here, partner's capital account, whatever is there, it is just transferred to the new firm. It is just transferred to the new firm. Clear? Now, opening entries. Opening entries you are going to pass in which firm? In the new firm you are going to pass. From here, assets and liabilities went. If assets and liability went from here, where will it go? It will go into their books. So asset account debited, goodwill account debited, liability account debited, liability account credited, capital reserve credited, and partner's capital account is credited. What is this goodwill and capital reserve? Imagine your PC is greater than asset minus liability. That means you paid more money or you agreed to pay more than your net assets. That time it is goodwill. Goodwill is debited. If PC is less than asset minus liability, that means you are going to pay less, but you will get higher value. That is good for you. That's a good profit. Will it happen every day? No. This is capital reserve. This is capital reserve. Clear? Done. That is it, guys. Then after that, it's departmental accounts. That should be it with the concepts of partnership. Few questions only you have on partnership. We have to solve the partnership questions. Then we have to think where we are today. Then we have to think. What man, Pawan? What word? ASMR. There's huge market for that, right?
Sometimes I used to hear it at sleep.
Are you serious?
Yes.
Why?
Sometimes I'll not feel sleepy, I'll not get sleep.
That will make you sleep.
Yeah.
I didn't marathon till 12:30. You don't need anything to make you sleep after that.
That's true.
That is better option, I feel. No need of ASMR and all. Yes, let's go further, guys. We'll solve the questions of partnership. Every single attempt there is a partnership question. For sure, for 14 marks, Then it can be higher, lower, whatever it is, it can be there. Okay, we have to analyze the partnership questions which are there. This is the most recent one, December 2025. Now, 14 marks. If at all there is one more question later for partnership, that is usually the small question where they'll ask you goodwill distribution or PSR calculation or something like that. The balance sheet of Amit, Bhushan and Charan, whose share profits and losses in the ratio of 3:2:1. What is this? Old profit sharing ratio. Clear? Now, I'll go a little slow on the partnership questions so that the concepts of partnership are revised. So even if worst case scenario you are skipping the partnership chapter, at least revise these questions and go, so that some part of the question at least you can crack and you can come out with some marks. Instead of leaving that partnership for 0 there, you can come out with some marks. But worst case scenario, that is. Okay, I would never suggest you to skip partnership, because they also know most of them are skipping partnership. So they will give easy question for partnership only. Simple. No. Now imagine if I know that I'm going to keep one hole over here. I'm going to make one hole, and I know that you will see that hole and you will jump over it. Then why I will make a big hole? I will make a small hole. I will not put too much effort into digging and all that. But I know that you are not going to see. You will fall. That I will make a proper effort to ensure that you fall. That is the institute's logic. If they know that you are going to skip a topic, why they have to break their head and make a complicated question? Anyways, many are skipping that. They will make complicated question where you are expecting to score marks. There nobody is skipping. There everybody wants to score. There they make complicated question. So partnership comes easy. Just focus on that. On 1/4/2024, capital of Amit, Bhushan, Charan. These are the capital account balances. Current account of Bhushan. Current account. Okay, current account is there because maybe they are following fixed capital method. Then creditors, machinery, furniture, debtors minus provision for doubtful debts. Net amount is there on the outside. Stock, cash account, current account of Charan. Why current account of Charan is there sitting this side? That means this current account is having debit balance and this current account is having credit balance. Now, Dev is admitted as partner for 1/5 share in the profits or loss. New partner is being admitted. Till now, we feel that this is an admission question. Now, following are agreed upon. Profit loss sharing ratio among the old partners will be equal. Among old partners will be equal. 1/5 is given to this guy. That means only 4/5 is remaining. And this 4/5 between the old partners will be equal. That means this 4/5 has to be divided in the ratio of 1:1:1. Clear? Now see what will happen over here. 1/5 into 1/3. That makes it 1/15. So for Amit, Banu and C, or somebody from C and somebody from D, will be 1/15, 1/15, 1/15, and this fellow will get 1/5. So therefore 1/5 into 3 will make it 3/15. So therefore into 3 will make it 3/15. Therefore the ratio will be 1:1:1:3. Correct? No? That fellow's share was how much? Oh, sorry. What 1/15? This is 4/5. 4/5 into 1/3. So there, that will make it 4/15, 4/15, 4/15. And this fellow will be 1/5. So then this fellow will become 3/15. Now it makes sense. 4:4:4:4:3. 4:4:4:3. This will be the new profit sharing ratio. Clear? This will be the new profit sharing ratio. Now, Dev brings in 1,50,000 as capital but is unable to bring the required amount of goodwill. No problem. Don't bring. We will still take it. We'll still take from the capital account. Okay. Goodwill of the firm is valued at 60,000. Now, goodwill of the firm is 60,000. Goodwill of the firm. But Dev will not pay full 60,000. No. What is Dev's share there? What is Dev's share? We don't know. We have to calculate. But we cannot just worry about Dev. We have other people also here. A, B, C, D. Now what is going to happen over here? What is A share? Admission partner
admission partner module, last question it is. Yes, that is what I'm telling. That is what I'm telling. It is the last question of module. They are giving easy questions. Why will they break their head? Please study partnership. That's all. Okay. What is A? What is A's old share? Old share is 3 to 2 to 1. So 3 by 6, 2 by 6, 1 by 6, 0. New share is 4 by 15, 4 by 15, 4 by 15, and 3 by 15. Clear? Why are we doing this? Because goodwill distribution will be done only in the sacrificing ratio. Now, 3 by 6 and 4 by 15. What is the LCM between 15 and 6 now? 30. 6 5s are, so 3 5s are 15. 15 minus 15 2s are, so 8. So 15 minus 8 will be 7 by 30. And here it will be 30 again. So this will be what? 2 5s are 10. 10 minus 8. It will be 2 by 30. And this will be 30 again. So 5 minus 4. No, 5 minus 8 only. 5 minus 8 only. It will be minus 3 by 30. And this fellow will go straight like that. So this will be what? Into minus 6 by 30. Into 2. 3 by 15. 6 by 30. Minus 6 by 30. So what has happened over here? If you would not do this, no? If you would not do this, you would think that D is the person who is going to gain. D has to give. Actually, no. See who has to give. A is sacrificing. B is sacrificing. C is gaining. D is gaining. Are you getting this? So now what is the total goodwill? 60,000. 60,000 into 7 divided by 30. That means 14,000 has to be given to A. And 60,000 into 2 divided by 30. That means 4,000 has to be given to B. And 60,000 into 3 divided by 30. That means 6,000 has to be given by pay, receive, receive. And here 60,000 into 6 by 30, that is 12,000. 12,000 has to be paid. 12 plus 6 18, 14 plus 4 18. Is this clear? This is the situation of goodwill. Now, don't take anything for granted and tell that this person is the admitting partner, so this person only has to give money. Nothing. Now, see, one of the old partner also has to give money. Next, assets and liabilities have to be revalued as follows. This is the entire revaluation point which we have to see. Then necessary adjustments regarding goodwill and profit or loss on revaluation are to be made through partner's current account. We saw that and we understood that first only from the question. It is decided that the revalued figures of asset including goodwill and liabilities will not appear in the balance sheet of the new firm. What does it mean? Yesterday late night, good morning message, yesterday's. What is it? Memorandum revaluation account. After telling you revaluation blah blah blah, if they tell you revaluation will not be done, all figures will be shown at the old figures only. It is decided that revalued figures including goodwill will not appear in the balance sheet. That means you have to reverse the revaluation memorandum revaluation account. Capital account of the old partners in the new firm should be proportionate to the new profit sharing ratio, taking Dev's capital as the base. Take the new partner's capital as the base and calculate the capital. The existing partners will not bring cash for future capital. Will not bring cash. That means how will you make it balance? By adjusting through current account. Okay. The necessary adjustments are to be made through partner's current account. Prepare partner's capital account and current account and balance sheet of the new firm after admission. Now, first thing we have to prepare is 555 partners capital account, partners. Food will be there like this. Okay. You can eat food like this also. Otherwise, you can eat like this also. That is what the suggested answer is doing. Partners capital account, debit side. Partners capital account, credit side. Partners current account, debit side. Partners current account, credit side. What we should tell? What we should tell? Balance sheet after. Okay, luckily this they didn't tell. Balance sheet, liability side. Balance sheet, asset side. This they didn't do it. Okay. Now, we have they prepared revaluation account for us? No, there is no revaluation account. They've directly given the journal entry to adjust the profit on revaluation. So this one we have to do. Okay, because it is memorandum revaluation account, you have to do this particular thing. Let's check this out right now. Yesterday only we were praising them that they improved. They're like, why did you praise us? Memorandum revaluation account.
They showed their brain maybe.
What is this?
They showed their intelligence.
Just when we spoke. Memorandum revaluation account. Now you go and check. One point is there. One full paragraph is there about revaluation. Machinery became 216. Machinery became what? 2,16,000. Go and check how much was the machinery. 150. Machinery has increased. That means 216 minus 150. That means 66,000 increase. So 66,000 increase means what you will write? By machinery. By machinery 66,000. And over here, next you can see that machinery done furniture 128. How much is furniture now? 150. That means it is going to decrease. So you are going to write to furniture 22,000 because furniture is an asset. Asset has to be credited if it is going to reduce. Next, after that you have provision for doubtful debts at 10% on debtors. Provision for doubtful debts. How much is the debtor value? 80,000. 80,000 into 10% will be how much? 8,000. But we already have provision of 4,000. We have to create provision for only 4 more thousand. There's a provision at 8%. So you have to create provision for 4 more thousand. So we'll write by to PDD 4,000. Provision is a liability, so you have to credit the liability. Now you are saying 66,000 minus 22,000 minus 4,000. How much profit we have? 40,000. This 40,000 will go to whom? Partners current account. Partners current account. Which current account? A, B, C. What was their profit sharing ratio? Old profit sharing ratio 3:2:1. So 40,000 into 3 by 6, 40,000 into 2 by 6, 40,000 into 1 by 6.
20,000.
What?
20,000. 20,000.
That only. 20,000, 13,333, 6,667. 40,000 divided by 6. 6,667, right? Yes, this should be it. Now what you're going to do? They said they don't want to show any of the values at the original values. So what you'll do? You'll reverse by furniture 22,000. Then you'll write by PDD 4,000. Then you'll write to machinery 66,000. Now that time you got profit, so now you will get loss by partners current account. There will be A, B, C, D. 4 people. New partner also will come in. Okay, A, B, C, D. What is the new profit sharing ratio which we already calculated and kept? It is 4:4:4:3. So 40,000 into 4 by 15. 40,000 into 4 by 15. 40,000 into 4 by 15. And then finally it is 40,000 into 3 by 15. Into 4 divided by 15. 10,600 and okay. 10,667. How much?
8,000.
8,000. That means one person you have to make it 6. 10,666. One person. Any one person you make it. Why? 1.
40,000 one is.
Yeah. One person you have to make it 6 because 7, 7, 14, 14 plus 6, 20. Okay, so that should be it. This is the situation. Now you go and see what they have done directly. Adjustment of goodwill, new profit sharing ratio sorted 4:4:3. Okay, have they shown any sacrificing ratio anywhere?
Yes.
Yes. Sacrificing ratio. Over here you can see 7 by 30, 2 by 30, minus 3 by 30 and minus 6 by 30 which we had calculated. That is sorted. This much is finished. Now adjustment of goodwill we will see. We have not seen goodwill yet. We can finish the goodwill part also because we have written and kept the goodwill part. See over here. 40,000 they said 14,000 receive, 4,000 receive, 6,000 pay, 12,000 pay. whoever is paying their capital account, sorry, their current account should be debited. 6 and 12 should be debited. So you can see over here, C's current account debited 6,000, D's current account debited 12,000, to A, to B. This effect should be there in the current account because we are preparing ultimately partner's current account. Partner's current account, C and D are giving. So in the current account, you can see on the debit side, C and D, it's there. Goodwill 6,000 and 12,000. And these people are getting, so it is there 14,000 and 4,000. Okay, 14,000 and 4,000. That's it. Okay, that is about goodwill. Now, revaluation, we have already done. See, increase in machinery, blah, 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 blah. Then, net effect you see. Profit is 40,000. Net effect. Net effect, how they are getting, you have to give the net effect. You can actually give, without net effect also you can give. But because you are seeing this, you shouldn't panic later. Now, without net effect means what? I will transfer this to partner's capital account. I will transfer this to partner's capital account. Sorry, here it is current account. So here 20,000 will be credited to partner. Here 10,667 will be debited to partner. 9,333. Can you see this? 20,000. What we are going to do? 20,000 credit. 10,667 debit. Here it is debit means there it is credit. Here credit means there it is debited. So 20,000 minus 10,667. That means 9,333 debit or credit. Debit or credit. 9,333 is credit. Why? Because credit is more. So therefore, can you see 9,333 to Amit credited. And here 13,333 credit and 10,667 debit. 13,333 2,666. Okay, that 1 rupee they adjusted it. Bhushan. We adjusted with last person, no, they adjusted with Bhushan. So 2,667 is there over here. Then here 6,667 is credit and 10,666 is debit. 6667 minus 10,666, that means 3,999 it is. Okay, 4,000. 4,000. They rounded off the numbers. Okay, 4,000. So here what happened over here? You can see the last person is 8,000. Last person is anyways 8,000. So where we took, see where we gave 1 rupee extra, no. We took 1 rupee, no. Here they made it 7. That's why we got round number. And here they made that this person 6. Clear? So I hope it is clear that anybody you can take 1 rupee or adjust 1 rupee because ultimately someone has to take that bear. Okay, now this is the situation. Now what you can do in the exam, if you can't do this also, all this you credit. All that you debit to partner's capital account. Net effect will happen automatically. Okay. Yeah, in partner's current account. The net effect will happen automatically. The net effect journal entry creation is not required. So now, because they have done this, we'll see this only. Charan and Dev 4,000, 8,000 debit. You'll go to Charan's current account now. 4,000, 8,000 debit. And the other person you can see 9,333, 2,667 credit. Clear? Now, go to the question. Here one thing we have to see. Amit, Bhushan and Charan. This is their capital account balance. So you'll go and see balance brought down. Balance brought down. Then you can see one partner had current account balance. How much is it? 16,000. So you can see that is Bhushan. Bhushan only is having credit side 16,000. One other partner had debit balance 10,000. That was Charan. Charan you can see debit side 2 balance brought down. Is it clear? Any doubts with this? Now, what else is remaining? We have already treated the profit sharing ratio done. Dev has to bring, 1,50,000. Dev has to bring. For bringing, what should be the entry? Bank account debited to capital account. So you can see in Dev's capital account, 1,50,000 is there on the credit side. Then after that, that is also done. Premium of goodwill is also done. Who has to give goodwill? Who has to take goodwill? Now that also we have seen already in the current account. Then machinery revaluation effect done. Necessary adjustment of goodwill and that this has to be done to current account. That also we have seen. Memorandum revaluation also we have seen. Capital of old partner to be capital of partners to be made proportionate. This is the most important part right now. Now based on what they said, based on Dev's capital as the base. How much is Dev's capital? Dev's capital is 1,50,000, keeping this partner's capital as the base. Dev's capital is the base, and what is Dev's share? 3 by 15. Dev's share is 3 by 15. So 1,50,000 is the capital for 3 by 15. 1,50,000 is the capital for 3 by 15. What should be the total capital? 1,50,000 into 15 divided by 3. 7,50,000. And this 7,50,000 should be shared between all the partners in their profit sharing ratio. 7,50,000 into 4 by 15. That means, can you see the balance carried down? Balance carried down 2 lakh, 2 lakh, 2 lakh, and for this person it is 1,50,000. Right now, what is the partner's capital account balance? 180. But how much should be there? 2 lakhs. That means they have to bring money usually, but they said they will not bring 1 rupee also. From where we will take this 20,000? From current account. So in current account debited, transfer to capital account. Here how much we require? 2 lakh. But how much is there? 160. Usually you would have written by bank, but now you are writing by partner's current account. Here how much is there? 2 lakh we require, but 140 is there. So 60,000. So what we will do now? You will remove from partner's current account. You will remove from partner's current account. With that, can you see partner's capital account? Everything is discussed and sorted. Partner's current account, everything is there. Only balance carried down you have to do. Balance carried down, whatever is there. This I'm not going to calculate and show you. Balance carried down, you know, you have to use the calculator. But whatever balance carried down is there, no, that will go to balance sheet. Okay. Now here you are writing by balance. Okay, here you are writing by balance carried down. Okay, now randomly they have written, because the debit side and credit side is on opposite sides. By balance carried down 3333. Okay, now in the balance sheet, if you see 3333, okay, it is there over here. Actually, it is 2 balance carried down. I don't know what logic this is. 2 balance carried down. No, because on the debit side you are writing 2 balance carried down, which will go to the credit side later, and it will be written by balance brought down. 3333, that is there on the credit side. And here you are supposed to write by balance carried down, which will later go to the debit side and will be 2 balance brought down, which is 17,333, 80,000 and 20,000. Can you see all those sitting on the asset side over here? And the capital which we saw 20, 20, 20, that is 2 lakh, 2 lakh, 2 lakh and 1,50,000 is also there. Once you finish till here, no, job done. You know what? All this is copy paste. Except cash, all this is copy paste from the old balance sheet only. You know why? We did revaluation, we reversed revaluation. We did revaluation and reverse revaluation. You can cross check in the question. Can you see over here in the balance sheet? This is 150. Here also 150. There it was 150. Here also 150. Okay, 150. And stock was 210. Here also it is 210. Debtor is 76. Now also it is 76. Only cash will change. Cash was how much there? Cash was 20,000. Now what happened? 20,000 plus new partner brought 1,50,000. That means totally 2,10,000. Sorry, 1,70,000 in the balance sheet. If they tell memorandum revaluation, adjustment in partner's capital account you have to do. But after that, new balance sheet will be what? Same as old balance sheet. In the old new balance sheet, what will change? The partner's capital account will change. Partner's current account balances will change. This much is the only change that is going to happen. Clear? It was an easy admission question. Making capital proportionate is a very regular adjustment in the study material. That was December 2025. Let's go into June. Partnership. 14 marks only. Smaller than the question which we just saw at least. June. Okay. Now, fifth question, it is, we'll see how much calculation is done, how much is not done. A and B are partners sharing profits and losses in the ratio of 3:2. That means this is the old profit sharing ratio. Their financial position as at 31st March 2025 was as follows. Now here when the financial position is like this, what we are going to worry? Yes. Now sundry creditors, A's capital, B's capital, cash in hand, sundry debtors, they are given balance minus provision, stock in trade, fixtures, profit and loss. Why profit and loss is sitting over here? Because the profit and loss has debit balance. There is a debit balance. Now on 1st April 2025, C is admitted under the following terms. Now go to the end and see what they ask. Revaluation account, partners capital account and new balance sheet. Now Simple. We'll try to figure out things first from here itself. A's capital account and B's capital account should be there in the balance sheet as should be there in the capital account as balance brought down. So can you see the balance brought down? 24,000 and 60,000 balance brought down in the capital account. Next, after that, immediately we saw that there is a loss. This loss, will we put it on the head of the new partner? No, it will be borne by the old partner. If at all I would see general reserve over here, wouldn't I distribute to the old partners? Like that only I'll distribute this also to the old partners. 3:2 ratio. So 8,000 into 3 by 5. How much is it? 4,800. It should be debited to partner's capital account because it's loss share. So 4,800, 3,200. Is this clear till here? Now after that, new profit sharing ratio is given in the question only. 5:3:2. So you don't have to bother about it. 5:3:2 is given in the question. But what you will have to do is the sacrificing ratio. They directly give the sacrificing ratio in the question as solution as 1:1. Who will calculate it? Now 5:3:2. Who are the partners now? A, B, C. What is the old ratio? 3 by 5. 3 by 5, 2 by 5 and 0. What is the new ratio? New ratio is 5:3:2. That means 5 by 10, 3 by 10 and 2 by 10. So LCM over here is 10. So 6 minus 5 is equal to 1 by 10. LCM over here is 10. So 4 minus 3 is equal to 1 by 10. And this is going to be minus 2 by 10. Minus 2 by 10, that means this person is sacrificing, this person is sacrificing. Can you see the sacrifices in the ratio 1:1? That is why in the solution directly they have told sacrificing ratio is 1:1. Clear? Now, let's proceed further. Goodwill is valued as 16,000. C brings in cash for goodwill, half retained in the business. What does it mean? Half retained in the business means what? He brings goodwill, half is kept means other half where it went? Withdrawn by the old partners. It is withdrawn by the old partners. Now, you have to understand one thing. 16,000 if it is his goodwill share, I mean total goodwill, 16,000 into what is his share of profits? 2 by 10. 16,000 into 2 by 10 will make it 3,200. He is going to bring 3,200. So let's make that entry for him bringing 3,200. You can see the partner's capital account by, okay, now what they did, they didn't make him bring and they didn't make them distribute. So directly they have passed the entry by cash account 1,600, 1,600. Why? The sacrificing ratio was 1:1. 1:1. Actually, what is the correct way to treat it? You'll write by bank account, put it into C, then from C's capital account to A and B's capital account goodwill. That is what was done in the previous suggested answers which we saw. Okay, now they have done directly, but you don't do it. You do it in the normal way only. By bank, you put it into the partner's capital account and from there you give the goodwill treatment entry. Clear? You can't keep switching methods now every single question. Next, after that, 4,000 bad debts are written off. Revaluation account they had asked you to prepare. Bad debts written off. So what will you do? 4,000 to sundry debtors account. To sundry debtors account. Revaluation account debited to debtors account. Then after that, provision for bad debts to be raised to 10%. Go and see how much is the provision for bad debt. Now 46,000 into 10%. That makes it 4,600. Now provision is how much? 2,000. Wait. Just now we did one bad debt. No. 46,000 minus 4,000. We have 42,000 into 10%. That makes it 4,200. We already have existing provision of 2,000. So 2,200 is the new provision that is created. Revaluation account debited to provision for doubtful debts. Next, after that, you can see stock in trade is revalued at 28. Right now, what is the stock? 21,500. 28,000 minus 21,500, 6,500. Stock is going to increase. So what will you write over here? By stock in trade. That stock is debited and here it is credited. Profit. Then after that, you have fixtures and fittings are reduced to 300. Reduced to 300. How much is the fixtures now? 500. Reduced to 300. That means how much reduced? 200 reduced. So you'll write over here furniture and fittings will be credited, revaluation will be debited. Then after that, C is to bring cash to make his capital equal to 1/5 of the combined adjusted capital of A and B. Combined adjusted capital of A and B. Now that we will see. This is a point that we have to see at the end. Right now we don't know anything about it. First we have to calculate the revaluation profit. When we do that, balancing figure came to 100. It will be given to A and B. In what ratio? In their old ratio. Their old ratio was 3:2. Can you see it is distributed in their old ratio of 3:2, which is 60 and 40. Now that will go to the partner's capital account 60 and 40. That will go to partner's capital account 60 and 40. Is this clear till here? All the things are done except for making that capital proportionate. Before that, whatever goodwill share came, they said only half is going to be retained in the business. That means other half is going to be withdrawn. So 1,600, these people got it. They will take 800 and go. So partner's capital account debited to cash or bank account. Clear till here? Now you have to make the capital proportionate. See the point what they told about capital proportionate. They said that C is to bring cash to make his capital equal to 1/5 of the combined adjusted capital of A and B. Adjusted capital. After all this, whatever capital is there in A and B, no, C will bring 1/5 of that. Now you have to calculate what is the capital. This is the balancing figure. This is the balancing figure of A and B. Now, because all the other things are discussed, 20,060 plus 57,640, you are getting 77,100. Sorry, 20,060 plus 57,640 divided by 77,700 you are getting. This total capital is 77,700. They said whatever is the total capital over there, 1/5 will be brought by whom? It will be brought by C. So can you see 15,540 is the amount that is brought. So cash account or bank account debited to partner's capital account. With that we are done. Now you know that this will be the balance of C and this is the balance of the other partners. Same balance as what you are seeing will be there in the partner's capital account. Okay, then you go and check the old balance sheet. In the old balance sheet, did you have creditors? Did you touch the creditors? No. 20,000 as it is. In the old balance sheet, you had cash. Cash, what happened now? For this 30,000, you got first goodwill. You got 1,600 goodwill. No. So 3,200. Then 800 is taken. No. Minus 800. Sorry, minus 1,600. Then the new partner brought some money. No, how much money was brought? 15,540. So plus 15,540. So 30,000 plus 3,200 minus 1,600 plus 15,540, 47,140. Can you see the cash balance? 47,140. Next, after that, you have sundry debtors. Sundry debtors, what happened? 46,000 was there. Out of 46,000, 4,000 meant. Now you have 42,000. And then minus provision is 4,200. In that 2,000 was already there, 2,200 we created. This is the final accounts point. You should not have any problem with this. 42,000 minus 4,200, that will be 37,800. Can you see the 42,000 minus 4,200 over here? Yes, that should be it. And then after that, you have stock in trade. Stock, what did we do? Stock. Did we change the stock? Yes, revalued at 28. So the new value directly 28. Furniture and fittings is revalued to 300. That means new value is 300. Can you see it should tally? There should not be any problem with the balance sheet tallying. 14 marks question they asked in June 2025. Clear? This is it. Next, we will go into the next one. December 2024. December 2024. Can you see a 14 mark question in December 2024? Small, sweet and simple question again. 6 plus 8. They gave you the breakdown also. That means they're telling for this 6 and for this balance sheet 8. Clear? Now, partnership question. Question number 5. Okay. Have they given the balance sheet? Where is the balance sheet? Balance sheet they've given. Because it is company, they've given in the Schedule 3 format. Okay, they've given in the Schedule 3 format because it is conversion of partnership firm into company. Now, drink some water. Buyer started. Online guys, are you there? Watching live people. What?
Delhi.
Delhi there is a. Is it when? 21 did
That one woman from third floor, she jumped with the child.
survived or dead?
They will.
Hotel people only would have put the fire. You never know. Can't make out whether he's fighting or talking normally, right?
Not audible for them.
So he's shouting and talking.
We have three more.
Yeah.
After that, I think we can complete some one
Yeah, we can complete. We have time.
two chapters.
Yeah. Because insurance claimant or every exam they haven't asked. Yes, let's go into next question. Yes, sir. Yes. Santoshan is telling yes, sir. Raylink agreed to purchase the business of a firm consisting of two brothers, A. Ray and S. Ray, as on 31st March 2024. Balance sheet of the firm on that day was as follows: capital A. Ray, S. Ray. General reserve, creditors, okay, leasehold premises, furniture, plant and machinery, furniture, stock in trade, debtors, and cash. The company agreed to take over assets and liabilities. Okay, take over the liabilities and all assets with the exception of cash. Cash they are not taking; they are leaving here only. Remaining everything is taken over. The agreed purchase price being 4,50,000 to be satisfied as to 1/4 in cash and 3/4 by issue of fully paid shares of 10 each at agreed value of 12.5 per share. What they are doing? They are actually giving 4,50,000. This 4,50,000 is what? Purchase consideration. 4,50,000 is purchase consideration. And how they are giving this 4,50,000? They said that this 4,50,000 will be given 1/4 in cash and 3/4 in shares. So 4,50,000 divided by 4, that means it is 1,12,500 will be given in cash and 3,37,500 will be given in shares. 3,37,500 will be given in shares. This is the logic. Correct? Now, after that, what we are going to see, if that is going to happen, the next thing you have to see over here is the shares are of 12.5. That means 3,37,500 divided by 12.5. 337,500 divided by 12.5. It is basically 27,000 shares are issued. In the new company, they are going to get 27,000 shares. Company made the following revaluation of the assets taken over when bringing them to books. Revaluation is done. That means these are the agreed values of the assets. Agreed value is this: leasehold premises, plant and machinery, furniture and fixtures, stock in trade, and debtors. Now you are required to pass journal entries to record the acquisition of the business in the books of the company. So in whose books we are passing the entries? In the company's books we are passing the entry. Company is going to take over the assets. First asset that the company is going to take over is 1,55,000 of leasehold premises. So see the entry over here: leasehold premises account debited. Next thing that they are going to take is plant and machinery of 62,500. Asset comes in, so 62,500 debited. The next thing they are going to take is furniture and fixtures debited. That is also an asset coming in. Furniture and fixtures 12,500. Stock in trade 1,45,000. So 1,45,000, that also is debited. Everything assets and liabilities they are taking over. Then Debtors 1,25,000, so 1,25,000 debited. Clear? Now this is credited to something called as business purchase. They purchase the business over here to business purchase. Next you see business purchase account debited. To what are they taking over? Creditors are there? No, creditors they are taking 1 lakh. Okay, 1 lakh. Business purchase account debited to creditors. Then what will happen? Net you see what they are getting. 5 lakh assets they are getting and 1 lakh liabilities they are getting. That means 4 lakh is what they are getting as net assets. Net assets they are getting 4 lakhs. But for getting this net asset as 4 lakh, they are paying how much? 4 lakh 50. Extra 50,000 which they are paying, 50,000 is considered as goodwill. 50,000 extra which they are paying is goodwill. Now see, business purchase is gone. 4 lakh 50,000. 4 lakh you got business. Goodwill 50,000. To whom? We have to pay that firm. No. Who is that firm? A Ray and S Ray. We are going to pay A Ray and S Ray. Is this clear till here? Now what you are going to do after that? How are you going to pay them? A Ray and S Ray debited. Remember we had noted down we are going to give 1,12,500 cash. So to cash account or bank account 1,12,500. Then how are you going to give? Don't go and write to equity share capital 3,37,500. No, they are going to give 27,000 shares. 27,000 shares into 10 rupees equity share capital. 27,000 shares into 10 rupees is equity share capital. 27,000 shares into 2.5. 67,500 is going to securities premium. Entries to be supported by narration that you already know. This is the entry for taking over the assets and liability. Simple. Assets and you can actually even club these 2 entries. Actually, if you want, you can club these 3 entries also. You don't have to introduce one character called as business purchase. All 3 you can club. Assets taken over debited, liabilities taken over credited, and then to that partnership firm that is credited, and then finally the differential figure is the goodwill. Okay, then you are going to settle them by giving this. This is PC settlement entry. Okay, then after that balance sheet. In balance sheet, what will happen? This leasehold premises, plant and machinery, furniture and fixtures, all 3 are called as property, plant and equipment. So 1,55,000 plus 62,500 plus 12,500, you will see 2,30,000 as property, plant and equipment. Clear? After that, stock in trade. Stock in trade in the balance sheet will go under current assets under inventories. Can you see inventories over here? 1,45,000. Then debtors will go into the current asset. Under that, you will show it under trade receivable 1,25,000. Then you see over here, what did you take over? Creditors. Creditors will go into current liabilities, and under current liabilities will go into trade payable. Trade payable 1 lakh. Clear? Then after that, goodwill. Goodwill will go into intangible asset. Go into the balance sheet. You can see goodwill, intangible asset, intangible asset. Where is it? Here, 50,000. Then after that, you see you have made payment, right? Did you have money? It's a new company. You know from where money came. So this will create a bank OD situation. You can see short-term borrowings, bank OD 1,12,500. Then after that, can you see over here equity share capital? So share capital 2,70,000. Then can you see 67,500 is securities premium? Securities premium will go into reserves and surplus. Done. Actually, this was the easiest of the partnership questions which came in all these attempts. But you know why? This was the toughest for all the students. Because this part they skip. Conversion of partnership firm into company and all, no, they skip that. See what is that? Take over the assets. Everything is given. Just calculate and you will get the answer. This is a 14 mark easy gift that they have given in the exams. Next we'll go into June. June 2024. Fifth question. This is small question. What?
Us to write journal of the
They can.
firm, no?
There you are getting rid of things.
We will
Dissolution will happen.
revaluation account we will add.
No, realization account will prepare. It will be a, what do you say, emptying the balance sheet situation. Like dissolution will be for them. There it will be like dissolution, but even PC is there. Like in,
Then you will show the book value. as the-
it's like basically in the books of selling company in amalgamation. Okay, now June 2024, 5. Done. Wow. What a small solution by the institute. Very good. Okay.
Here is backward.
Huh? We are going backwards, right? Now, fifth question, X, Y, and Z. Z. Z, no Z and all. Okay, X, Y, and Z were partner sharing profit. We are Indians. They have looted our country for many years. So we have to kill their language. Okay. Profit and losses in the ratio of 3:2:1. The firm's balance sheet as on 31st March 2023 is as follows. This is the old profit sharing ratio, that is 3:2:1. Now, creditors, bills payable, general reserve, capital, cash in hand, cash at bank, debtors, provision for bad debt, you're getting net amount, bills receivable, stock in trade, investment, furniture, land and building. Sorted till here? Now, Y retired on 1st April 2023 and it was agreed that he should be paid all his dues in full on that day. So Y is retiring. On that day, whatever is there, entire amount has to be settled. For this purpose, goodwill was to be calculated on the basis of 4 years purchase of super profit method. Goodwill you have to compute. Other information are given below. Average capital employed is given. Average capital employed was 26,10,000. Net profit during the last 3 years. Why we need to calculate under super profit? We need average profit. Okay, average profit. Now, net profit of the firm, rate of interest expected from capital having regard to the risk involved is 10%. That is nothing but big words, but NRR. Okay, fair remuneration of partner for their services is 1,20,000 per annum. That means profit is before remuneration. You have to remove the remuneration. Till here, I think the 4 points which they gave is for our goodwill calculation. Average profit 630 plus 540 plus 675. 630 plus 540 plus 675 divided by 3. How much you are getting? 6,15,000. 6,15,000. But this 6,15,000 is before remuneration. So minus the remuneration. How much is the remuneration? 1,20,000. Sorry, 1,20,000. How many partners are there? 3 partners into 3. This is 3,60,000. So 6,15,000 minus 3,60,000. 2,55,000 is the average profit. This is the average profit. Clear? Now what you have to minus from this? From this you are going to subtract normal profit. Normal profit is nothing but capital employed into NRR. 26,10,000 into 10%. That will be 2 lakh. I made a mistake. They said fair remuneration to the partners. They didn't tell fair remuneration to the partner. It is not for all the 3 partners. All 3 partners together it is 1,20,000. So this is 1,20,000 over here. So 6,15,000 minus 1,20,000, that means 4,95,000. And here it is 2,61,000. 2,61,000. 2,34,000. What is this 2,34,000? Super profit. It is super profit. Now go and check. They said for goodwill will be calculated on the basis of 4 years purchase of super profit. So goodwill is equal to 2,34,000 into 4. 9,36,000 is the goodwill of the firm. Goodwill of the firm. Now let's go and check if they have at least calculated the goodwill of the firm. Oh, yay! One line answer. 9,36,000. Okay, directly they got 9,36,000. Yippee. Okay, now what we are supposed to do now? This goodwill has to be given to the from the sacrificing partner to the gaining partner. Anywhere in the question, did they see? First question is you are required to calculate the goodwill and show its treatment. Now later in the question, we found that the new profit sharing ratio is 5:3. To do anything with goodwill, I need the sacrificing ratio now. To do anything with goodwill, I need the sacrificing ratio. I'll just bring in the calculation sheet. We'll calculate. Okay. Now, see the question. What is the old ratio? 3:2:1. So you will write X, Y and Z. 3/6, 2/6, 1/6, minus. Now you will go and see what is the new ratio. New ratio is given 5:3 between x and y only because z has retired. So 5/8, 3/8, and here it is going to be 0. So therefore 6 and 8, it is obviously going to be 6 and 8, I think 48. No, 24. You can take 24. 24 is the LCM because it's divisible by both. So now 6 fours are, so 3 fours are 12. 8 threes are, 5 threes are 15. Minus 3/24. Here 24 again, 6 fours are, so 8. 8 threes are, so 9. So minus 1/24. And 1/6 is basically 1/6 minus 0. You can use a calculator for this. 1/6 minus 0, you'll get how much? Oh, 1/6 only into 4. That will become 4/24. Can you see this fellow is gaining, this fellow is gaining, this fellow is sacrificing. Did we just calculate the goodwill over here? Goodwill of the firm is 9,36,000. So 9,36,000 for Z, how much we have to give now? 4/24 or just 1/6. So 9,36,000 divided by 6. So you are going to give Z 1,56,000. Do you agree that for Z we have to give 1,56,000? Yes, 1,56,000 for Z only. Now this Z 1,56,000, who will give? It will be given by X and Y in the ratio of 3:1. 39,000. 1,17,000. So do you agree that X will give, Y will give, and it will be given to Z? So what is the entry for this? X capital account debited, Y's capital account debited to Z's capital account. What has happened? X capital account debited, Z's capital account debited to Y's capital account. 9,36,000 into 4/24. 1/6. 9,36,000 divided by 6. It's 1,56,000 only. Any profit sharing ratio difference? 1/6. 1/6. 9,36,000 into 3/12. How did they take 1/3? They have taken 1/3 for Y. Good morning to all of us. Good morning to all of us. Y has retired. Everyone is nicely like, yes sir, yes sir. That only 24 only, LCM 24. This is 24, 8 minus 9. Everything we have done. Okay. So X we can keep just like that. X we can keep just like that. Who is retiring is Y, not Z. Now Y is returning, so here it is 0 and here it is minus 3/8. 3/8. It is X and Z in the ratio of 3/8. Wait, maybe, yeah, we are right. Always, okay, institute is wrong. We are right. Institute is wrong because we saw this X and Y in the new firm will be 5:3. But we are also we didn't notice this or pay attention much over here. They told Y retired, but here they told between X and Y. It is not X and Y. It is X and Z. If we do this, it is two things can happen. Only two types of students will be there. One who saw that and ignored this. Other who saw this and ignored that. Now both will come out of the exam hall and ask, did you get 9,36,000 goodwill? Yes. Yes. Both will go home happily. Okay. But then after the distribution, one person will do one thing, one person will do other thing. Now 5:3, guys. It's actually not student's fault also. Here they wrote X and Y. It is X and Z actually. So 5:3. So now recompute everything. This will become 24. So 6 fours are, so 4. 8 threes are, so therefore minus 9. It will become minus 5/24. And here it will be 2/6. That means it will become 8/24. So therefore you can see that this is sacrifice. Sorry, this is gain and this is sacrifice. The retiring partner is Y over here. 9,36,000 is the goodwill, right? 9,36,000 is the goodwill. So now what happens? Whom we have to give? We have to give Y. 9,36,000 into 8/24. 9,36,000 into 2 divided by 6, 3,12,000. That's how the number was different there, 3,12,000. And this will be given by X and Z in the ratio of 3:5. 3,12,000 into 3 by 8, 1,17,000. 1,95,000. 1,95,000. Clear? Now 1,17,000 debited, 1,95,000 debited to Y's capital account 3,12,000. Okay. I hope you understood what was the situation over there. Error over there. Now calculate profit or loss on revaluation of assets and liabilities and show its adjustment among partners. Okay, revaluation account they have asked you to prepare. Now stock and furniture to be depreciated by 10%. We'll go in order. All these points are done because this was everything related to goodwill. Now we have to prepare the revaluation account. Revaluation account. Now you can go and see over here what has happened. Yeah. First thing, stock and furniture to be depreciated by 10%. Go and check how much is the stock here. 3,15,000. So it has to be depreciated. So to stock account 31,500. Then they said that what is the other one? Stock and furniture. Furniture is right now sitting at what value? 4,20,000. So you'll write to furniture account 42,000. Both of them have been debited. Both of them have been credited to reduce it. Then they said this point is done. Provision of 5% on debtors to be created for doubtful debts and a provision for liability of 18,000 is to be created against bills discounted. So you'll create one provision that is directly 18,000 and then you will check the PDD how much you have to create. How much PDD you have to create? You have to create a PDD of 5% on debtors. 5% on debtors. Go and check how much is the debtors. 8,70,000. 8,70,000 into 5%. That means it's going to be 43,500. But right now we already have a provision of 30,000. That means 13,500 you're going to create. So 2 PDD 13,500. That is 43,500 minus existing PDD of 30,000. Then after that we are going to go to the next thing over there. Value of land and building is appreciated by 2,35,000. Directly they told by 2,35,000. So you'll go and write by land and building account 2,35,000. 2,35,000. Next, after that, there is a situation. Investment is to be taken at its market value. Go and check how much is the investment right now. 4,10,000. Right? How much is it in the books? 3,75,000. That means 35,000. We have to increase the investment. So here you will write by investment 35,000. By investment it's going to be 35,000. Okay, that should be it. So this point is done. This point is done. Due to revaluation, the value of assets and liabilities are not to be altered. That means memorandum revaluation again. Okay, memorandum revaluation again. But now we'll calculate for once what is the profit or loss. 2,35,000 plus 35,000 minus 31,500 minus 42,000 minus 18,000 minus 13,500. How much are you getting? 1,65,000. Can you see the revaluation profit is 1,65,000? Did everybody get 1,65,000? Yes. So this should be given to whom? It should be given to the old partners X, Y and Z. So you'll write over here to partners capital account. We have X, Y and Z. And what was their profit sharing ratio? Their profit sharing ratio was 3:2:1. 1,65,000 divided by 27,500, 55,000 and this is 82,500. Correct? Now whatever we did, what we should do, we should reverse it. So what we will write over here, buy stock 31,500. Then we'll write buy furniture 42,000. And here next one 18,000. And next one 13,500. And here we will reverse 2,35,000. And here we will reverse 35,000. Now what we will have? We will have a loss. Two partners capital account. Now this loss will go between X and Z. X and Z 1,65,000, right? Loss into the new ratio. What is the new ratio between them? 5:3. So into 5 by 8 and the next person it will be into 3 by 8. Oh, wait, here no. By partners capital account it's a loss. So X and Z. So 1,65,000 into 5 by 8 and other person into 3 by 8. 1,65,000 into 5 by 8 is how much? 1,03,125. 61,875. Correct? Now, what is the question asked in the exam? They said calculate profit or loss on revaluation. That we did, and show the adjustment entry among the partners. Did we discuss it that time once? This adjustment entry here, this person has to be, this person is credited, partner is credited, and here this partner is debited. That means 103,125 minus 82,500. That means what is the net effect there? 20,625. Can you see 20,625 debit? To partner X it is debit. Not getting it? No, debit is more, no. Credit is this, debit is more. So here, this person has to be credited for say 55,000, that's it. No debit for Y. So directly you will go and credit Y for 55,000. Then the next partner, if you see 27,500 credit, but 61,875 is debit. So 61,875 minus 27,500. 34,375 is debit. This is the next question that they asked in the exam to show the effect of this particular thing. Next, after that, if you see revaluation done, due to revaluation, this is also done. In order to meet Y's obligation, X and Z to bring in additional capital of 350 and 7,20,000. You have to pay that person immediately, so they're going to bring money. Okay. Profit and loss sharing ratio is done. Now, first question and second question in the exam we have answered. Show the balances of partners' capital account after Y's retirement. After Y's retirement. Now, balance. No partners capital account and all. How we got, God alone knows. We should understand. They should understand. They understood. We understood. Okay. So, partners capital account. Partners capital account. Entire thing I'm preparing. X, Y, Z. X, Y, Z. By balance brought down. By balance brought down. Go and check what is the balance over here. X, Y and Z. 9,70,000, 7,40,000, 3,80,000. 9,70,000, 7,40,000, 3,80,000. 3,80,000. Clear? Then after that, do we have any reserves over here? Yes, 5,10,000 is the reserves. 5,10,000 in the ratio of 3:2:1. So therefore it becomes 2,55,000. 1,70,000. 85,000. Just check if you're getting that number. Yes, you should get that number. 5,10,000. Reserves are distributed. Done. After reserves distribution, what did we discuss next about goodwill? So go and check what is the goodwill situation over here. For goodwill, we already passed the entry and kept it aside. No. X capital account debited, Z capital account debited, and Y's capital account will be credited. So here we will put 3,12,000, the goodwill share, and X and Z, 1,17,000 and 1,95,000. 1,17,000 and 1,95,000. Goodwill share, that was after goodwill. The next thing that we saw was revaluation profit adjustment. This partner X is going to be debited 20,625. 20,625 debit, and then you can see Y is credited 55,000. Y 55,000 credit. Then you can see Z is debited. We already saw this calculation that time. 34,375. 34,375 debit for Z. Clear? After that particular thing, after the revaluation, then there is only one thing that we had discussed, that these partners are going to bring money. 3,50,000 and 7,20,000. So you can see over here 3,50,000 X has brought in and Z has brought in 7,20,000. 3,50,000 and 7,20,000. This is the situation right now. After that, what do you have to do? Done, no? You have to send the Y. Y you have to send. Y is gone. Now check for, okay, check for what? X. X is 9,70,000 plus 2,55,000 plus 3,50,000 minus 1,17,000 minus 20,625. How much is the value? 14,37,000. 375. What did they tell? Calculate, show the balance of partners after Y's retirement. Y is retiring, okay. And whatever is required to be paid to Y. See, goodwill is given, revaluation profit is given, and then profit or loss you can see. Prepare firm's balance sheet also they have asked. Random number, right?
They both will share the amount given to be Y and it will be also.
They put the same numbers into the balance sheet also. Problem is, see, this is the problem. Why we are getting differential amount is this. See, general reserve still sitting here. Yeah, we shared the general reserve and general reserve should be shared. Okay, general reserve should be shared because if you are keeping 510 over here, that means we are telling that that person, that Y is there. No, we are sending that person without even giving the general reserve because that person has worked hard for this reserve creation. Okay, this is the mistake because of which you are getting difference. If you want, you can see what was the general reserve situation over here. 255, right? So remove that 255 and calculate 970 plus 350 minus 1,17,000 minus 20,625. 11,82,375. Oh, still not getting it. Okay. 11,82,000. 18,000. They are getting 18,625. They have done something, but balance sheet will tell. You know why? Wait. I'll tell you one thing. Okay. Calculate partner's capital account as per the correct calculation only. And we'll see two balance carried down. 9,70,000 plus 255 plus 350 minus 1,17,000 minus 20,625. 20,625. 14,37,375. And here we have 3,80,000 plus 85,000 plus 720 minus 195 minus 34,375. 9,55,625. For Z. Y it is 7,40,000 plus 170 plus 312 plus 55,000. 12,77,000. This will be to bank account. To bank account. This is the payment. Okay, so this 12,77,000 you're going to make payment. So bank balance in the question originally was how much bank balance? Bank balance was 2,48,000. Can you see? Cash remained same. Bank balance has changed. So 2,48,000 is the bank balance. Plus, how much money did they both bring in? They brought 350 and 720. So plus 3,50,000 plus 7,20,000. 248 plus 350 plus 720. 13,18,000 minus, we have to just pay, no? We just saw the payment now. 12,77,000. 12,77,000. 41,000. Bank balance is matching. Okay, bank balance is matching. 41,000. Next, what we have to do, the partner's capital account. What is the partner's capital account? 14,37,375, 955, 625. 14,37,375. 14,37,375, and here we have 955, 625. 955, 625. Okay. Now, if you total this one, and it will be equal to, it should be equal to this one. 11, 18, 625 plus 764, 375 plus 5,10,000 minus 14,37, 375. Are you getting this number? Is the left hand side and right hand side correct? This is the correct answer. Why? How can you still keep the general reserve even after the retiring partner has gone? Retiring partner is gone, no. So you prepare the partner's capital account with the general reserve distribution only. Don't keep the general reserve still. It doesn't make sense, no. You're telling that retiring partner also was there. When he was there, we took his help also and we earned the profit. Then we sent him without giving that. Remember, one of the rules of retirement is what? You have to give the general reserve to the retiring partner. Okay, rest of the assets and all we don't have to check only because all the assets and liabilities revaluation was done and revaluation was reversed, so balance sheet will tally. The only thing is cash at bank, we understood how it is. And here general reserve is not there, so this is the partner's capital account. Clear? This is one of the questions which was there in June 2024. Last question from partnership, December 2023. Incomplete records and all we finished. We'll go into this particular question. A and B were carrying on business.
We also didn't get that like 80 when we excluded capital reserve, I mean general reserve from here.
11,18,625.
We got 11,81, including the general reserve.
Now then that means it's going to be, we'll see Z, 3,80,000 plus 8,500.
If we remove 8,000,
No, that is it. 3,80,000 plus 85,000. We should remove that. 3,80,000 plus 7,20,000 minus 195 minus 34,375. 870,625. So you're getting 870,625 without the general reserve, and here you're getting 970 plus 350 minus 1,17,000 minus 20,625. 11,82,375. 11,82,375 plus 870,625 is 20,53,000. And here 118,625. Sorry, 1118,625 plus 764,375 is 18,83,000. How much was the general reserve in the question? 5,10,000 only. Some circles they have done. Okay. 20,53,000 minus 18,83,000. 1,70,000 difference. That is Y's share. What they did, Y's share of general reserve. Y's share of general reserve they've removed from these both partners and given it to Y. Now, what is the ratio there? We have to calculate 5:3, right? So in 5:3 ratio, they have given that 1,70,000 of Y, which anywhere in the study material they wouldn't have done, but suddenly they decided to do it directly in the exam. So 1,70,000 into 5 by 8. No, 1,70,000 into 3 by 8. I'll tell you why. Just check this once. 1182,375. It will match. It is 3 by 8, not 5 by 8. You know why? New profit sharing ratio is 5 by 8. But remember, we had calculated that the sacrificing ratio. No, where did we calculate that sacrificing ratio? Yeah, sacrificing ratio is 3:5. It is 3:5. So if you want to calculate and reconcile this for our satisfaction, 1,70,000 in the ratio of 3:5 they have given. 3:5. So that time you will get 1,70,000 into 3 by 5. 3 by 8. 1,70,000 into 3 by 8. You will get 63,750. Can you see now it will be matching? What?
The amount.
The other one you're telling. 1 lakh? Now check. 764 plus 764,375 plus 106,250. That will be 870,625. And here it's 1118,625 plus 63,750 will give you 1182,375. Basically, what they did, they have just distributed the general reserve from these two partners itself. But usually the general reserve becomes fully empty. It goes to every single partner. Ultimate effect is same, because partner will, if at all this treatment is done, the partner's capital account balance will be remaining less. But 5,10,000 is sitting over here. Ultimately, it go to these two people only, in the end of the day. Okay, so but follow the regular method. Don't follow this.
If we follow our method, then general reserve will not be there.
Not be there at all in the balance sheet, because it would have been distributed to all the partners. Anywhere it is not there, that general reserve should be distributed only to this person. Okay. And in the question also they didn't tell maintain general reserve and all that stuff. Yes.
If they would have told, then we will just remove Y's value from general reserve.
Distributed. 1,70,000 will remove Y's this thing, and we will distribute it to the others in their sacrificing ratio. In the sacrificing ratio. 5. Question number 5 of December 2023. Okay, something at least they have given. So we are little safe. One line I can see, one line answers are there. Okay. Now we'll go to the end of the question. They asked you to calculate 4 things. 1, 2, 3, 4. Okay. A and B were carrying on business as equal partners. The firm's balance sheet as on 31st of March 2022 was as follows. Capital account A, B, bank loan, current liabilities, sundry creditors, bills payable, leasehold building, plant and machinery, furniture, stock, book debts, cash at bank. Clear? Now, business was carried on till 30th June 2023. Where is the starting point here? 31st December 2022. Till 30th June they have carried on. That means for 6 months they have carried on. The partners withdrew in equal amounts half the amount of profit made during the period of 6 months from January to June 2023 after charging depreciation on leasehold building, plant and machinery, furniture. Meanwhile, sundry creditors were reduced by 15,000, bills payable by 2,500, bank loan by 20,000. On 30th June, stock was valued at 7,09,000, book debts were 75,000, cash at bank by 2,500. On 30th June, the firm sold the business to a limited company for 4 lakh rupees payable in equity shares of 10 each. PC is directly known over here. This is the PC. Now, partners decided to take shares in the profit sharing ratio, any difference to be settled in cash. Now, you are required to prepare statement of net assets on 30th June. On 30th June, you are required to prepare the statement of net assets. Now, what and all you have over here? Leasehold building. What happened on 30th June? 10% per annum. So, therefore, 80,000 minus 5% will get subtracted because it's only half year. So, 76,000 is the value on the 30th June. So, 30th June value we want 1,80,000 is the plant and machinery. 10% is per annum. So, minus 5%. 1,71,000. And furniture it is minus 10%, 5%. That means 19,000. Stock, what did they tell for stock? Stock they told over here, the stock valued at 7,09,000. Stock was valued at 7,09,000. $60,000 to 7,09,000 in 6 months. Okay, they multiplied, I think. It kept eggs. Okay, 7,09,000. Looks like there is some typo in the question paper itself. We'll see. If it doesn't match, we will go forward to next chapter itself. Book debts were 75,000. We'll not sit and do reconciliation now. Book debts 75,000. And cash balance also they said. Cash balance is how much? 2,500. Cash balance is 2,500. Then what we have? We have sundry creditors at 15,000. Sundry creditors were at 15,000. Reduced by 15,000. So it is going to be 55,000 sundry creditors and bills payable by 2,500. So bills payable will be 7,500. And then they said bank loan will be reduced by 20,000. Reduced by 20,000. That means it is going to be 20,000 the new bank loan. Now here they said valued at. Okay, there they didn't tell reduced and all, fine. Now take your calculator carefully. 76,000 plus 1,71,000 plus 19,000 plus 7,09,000 plus 75,000 plus 2,500 minus 20,000 minus 55,000 minus 7,500. 9,70,000. Did you get the net assets as 9,70,000 everyone? 9,70,000. Simply you guys were making fun of the institute. See over here. 9,70,000 only. 9,70,000 only. That means that stock, I don't know how it jumped from 60,000 to 7,09,000 stock in 6 months. Okay, I think it was gold. Gold or silver in last 1 year, no, like that. Okay, then net profit earned during the period 1/1/2023 to 36/2023. You know everything that is there. Okay, all the things you have taken care of. 9,73,000. What was the capital over here? 1,38,000, 1,52,000. So 9,73,000 is the net assets. If you take, 70, yeah. What I told 9,73, yeah. 9,70,000. So 9,70,000 is the net assets, but over here, what is the asset side total? You can just take the asset side total, 76,000 plus 171 plus 19 plus 7,09,000 plus 75,000 plus 2,500, 1052, 500, correct? So here also the asset should be 1052, 500. And here from that you are removing the new assets, the new liabilities, 20,000 minus 55,000 minus 7,500, 9,70,000. That means what should be the partner's capital? 9,70,000. Partner's capital should be 9,70,000. Now here what is the partner's capital right now? 1,38,000 plus 1,52,000. How much is it? 2,90,000. That much partner's capital has increased. But that is not the net profit, but that is the increase in the partner's capital, 290 and 970. How much is the increase? 6,80,000. We'll go and write that. So 6,80,000 is the increase in partner's capital. But that is not the net profit. Why it is not the net profit? Because they told in the question that partners withdrew in equal amounts half of the profit during the period. Half the profit, whatever was there, that was withdrawn. That means what is remaining in the partner's capital is the other half. That means half we know into 2 if you do, you'll get 13,60,000. This is the profit that is earned. When they made this profit got added to their partner's capital account, and in that half they withdrew, so only 6,80,000 was remaining in the partner's capital account. That is why we are getting the difference of 6,80,000 over there. Yes, after that what did they ask you to prepare? They asked you to prepare statement done, this one done, realization account and partner's capital account. Realization account, what you will do, you will empty all the things from the question right into the realization account. So you can see over here, first item, plant, leasehold building. You have to remove the new values. Don't go and remove the old values now. New values which is there on 36, not which is there on the starting of the year, 76,000. So we'll write over here. Can you see 76,000? Then here, can you see 171? Can you see 19 also? Can you see the stock of 7,09,000? Can you see the book debts of 75,000? Can you see the bank balance transferred to the new company? Everything is there over here. Liabilities 20, 55, 7,500 should be transferred to realization account, 20, 55 and 7,500. Then you remember that when there is a purchase consideration is also transferred to realization account. And here they told that the purchase consideration is 4 lakhs. So that new company's account, whatever the new company's account, new company's name is there, okay, transfer it by dash 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 limited, dot 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 limited, they have written, okay, 4 lakhs. 4 lakhs transferred over here. Done. Now what will happen? A's capital, B's capital. Can you see they decided to take the shares in their profit sharing ratio? What was their profit sharing ratio? Nowhere in this planet Earth it was told. It is told here, equal partners. That is why, because of that only, this, whatever the balance is there, no loss on realization. Can you see it is shared equally? Done. Finished balancing figure. Just divide equally to A's capital and B's capital. After that, they also told you to prepare partner's capital account. Partner's capital account, you can see in the question itself, what is the balance in the partner's capital account? 138 and 152. So I'm writing over here 138, 152. 138, 152. Then remember the profit I calculated and told you that it was 13,60,000. 13,60,000 profit will be shared between these partners equally, in the ratio of 1/2, 1/2. So 680, 680. Then whatever 680, 680 was there, they have withdrawn. No, half the amount they have withdrawn. So can you see drawings? 3,40,000 and 3,40,000. And just now we found out the realization loss, 285 and 285, the realization loss. Now whatever 4 lakhs we got from the purchasing company, that 4 lakh will be distributed to both the partners equally. So you can see over here 2 lakh is distributed to both the partners equally. Then final settlement is, can you see there is a shortage? If you only the red things, if you take in your calculator, 138 plus 680 minus 285 minus 340 minus 2 lakhs. Can you see that means there 7,000 is more. 7,000 is less. 7,000 is less in his capital account. That means this fellow has to get 7,000. Which side is more, guys? Credit side is more, no? Sorry, debit side is more, no? So debit side is more means what? He has to bring money. So he'll bring 7,000. Same way that other person will have credit side more. because only two partners are remaining. Everybody went. Two partners are remaining. So this fellow 7,000 more. If you check the other side, obviously there will be a credit balance 152 plus 680 minus 285 minus 340 minus 2 lakhs. Can you see 7,000 balance is there? That means one person will bring 7,000, other person will get that 7,000. That should be it, the closing situation of this partner's capital account. Okay, that is it with our partnership discussion. That should be done. Next thing we are going to look into is departmental accounts. Let's take a small break after partnership. 10 minutes will take.
Rashid sir is coming and telling 7. I don't know what. Welcome back. Welcome back. Welcome back. Welcome back. Welcome back.
Let's go into the next thing, guys. Breakdown. Departmental accounts. Another small topic that might not be that frequently asked, but we have to study everything. We don't know when what will be asked. Departmental accounts. Look into the business from micro angle. Departmental accounts is what? Looking into the business from a smaller micro angle. That is, for example, there is a company Ram and Co. If they are manufacturing mobile, TV and AC. Now, if I just tell you the total profit, you will not know what is happening. Okay. Now, when I tell you that mobile profit is 5 crores, TV 1 crore and AC is 4 crores. Now you know that the actual situation is here 6 crores, here there is 4 crores. That means profit is 2 crores. Profit is 2 crores. So now what you have to understand? You have to understand one thing, that whatever happens, if I change things in my AC department, if this profit keeps reducing, the overall profit of the business keeps increasing. That is the reason. Looking at the business from the micro angle, financial statement will not give you details of all these things. Now, distribution of expenses. One thing you have to understand. If it's rent in the question, you will distribute in what situation? Floor area. If it is electricity, it is based on lighting points or unit consumed. All those things will be given in the question. If it is advertisement, it will be based on sales. Carriage inward. Carriage inward is basically goods coming in. It will be in the ratio of purchases. Carriage outward will be in the ratio of sales. Discount allowed will be based on credit sales or sales. Okay, discount received will be credit purchases or overall purchases. Salary or wages will be based on number of employees. Stock reserve is one of the most important thing, which you'll also see in our branch accounts. So now stock reserve is one department transfers goods to another department at invoice price. There is department A, department B. Department A has transferred to department B at invoice price. That much is not enough for us to tell stock reserve. And the receiving department which is there. No, who is the receiving department? Department B still has these goods in closing stock. Still has these goods in what? Closing stock. Once you turn it and see. And remember the Tadoba story example. Oh, you were there that day when I told. Oh, you didn't tell that I told that tiger is a.
Yeah, I was there.
Huh? Now I feel what that tiger felt. Same thing I'm feeling. Like nicely they're drinking one, cutting chai over there.
See, oh, nice.
Yes. So if one department transfers goods to another department at invoice price, okay, that is cost plus profit, and the receiving department still has the goods in closing stock. That time only that will be unrealized profit, or it's also called as stock reserve. Now you have to understand this very, very clearly. Department A, Department B. Cost is 100, selling price is 120. Department A has transferred to Department B. So for Department A, it is sales of 120. For Department B, it is purchase of 120. For Department A, 20 rupees will be shown as profit. For Department B, 120 will be sitting in closing stock. Now, for the business, 20 rupees is profit and there is 120 in closing stock now. But this 20 rupees for the business is unrealized profit. Why? Because profit didn't go anywhere. It didn't go anywhere. Profit is sitting here only because stock is still here. For the business, both are same, no. So therefore, this 20 will be considered as unrealized profit. And that time you have to create something called as stock reserve, which we also saw in consignment. When the goods were sent at invoice price, closing stock was sitting at invoice price. In consignment, we saw that there was stock reserve creation. Same logic over here as well. Stock reserve, what will you do? You will remove from the department who made the profit. That means who sent the goods. Whoever sent the goods from their department, you'll remove the profit. Okay, now if half the goods are still in stock, half the profit is unrealized profit. So half the profit you will create stock reserve. If 25% of the goods are still in stock, then 25% of the profit will be unrealized profit. You will create unrealized profit of 15. Is it clear till here? Now stock reserve. Entry is P&L account debited to stock reserve. But P&L account, whose P&L account? The department that sent goods. From their P&L you'll remove. Or if they tell you the combined P&L or consolidated P&L, then from the overall P&L you'll remove. And whatever stock reserve is there, it will be subtracted from the stock. It's a liability, it will be subtracted from the stock, which is an asset. Previous year stock reserve. Last year unrealized profit. That means this year it is realized profit. So stock reserve account debited to P&L. Stock reserve you'll remove and you'll transfer it to P&L. Is this clear till here? So this year you are removing from P&L and keeping it aside, telling that we did not realize this profit yet. Last year whatever you kept aside, you are transferring it to P&L. That should be it with departmental accounts. Now we'll go and check. Not many questions are there on departmental accounts, but whatever is there, we should try and finish it off. NPO is done. No, lease is pending. Lease will do with accounting standards only. Incomplete records, partnership, branch accounts they asked. Usually when branch accounts is asked, they don't ask departmental accounts. Then we will check the next one. Here consignment, NPO. Okay, NPO is at the end. That subscription question, that's not a problem. 4, 5. That's it. 6 is consignment, which we already solved. 7 is AS. In June 2025, let's see anything at the starting. Insurance claim and branch. That means if branch is there, departmental accounts will not be there. December 2024, you have hire purchase asked. Bills of exchange was asked. Insurance claim and branch. Then June 2024, incomplete records, branch, insurance claim. And finally we have December 2023. I think there one question should be there if I'm not wrong. Is it there? No. Lease, incomplete records and branch, everywhere branch only. So basically the moral of the story is it is not asked for a very long time. That means 100% it can be asked in the next attempt. Okay. Every time we thought that only, but they are asking branch only. Departmental in MCQs. Now see, same thing someone would have thought, no, looking at the 4 attempts paper, that incomplete records is coming for 14 marks. And suddenly this time, Bambo they gave no, NPO 7 marks and incomplete records only 7 marks. So don't skip it, it's easy. At least the study material problems you do and go. Okay, of departmental accounts. 7 illustrations only are there, so easily it can be. In that first 3 will be basics. Just distributing only in that. Unrealized profit and all will come only for the 4th one or something. Yes, insurance claim, pakka question. Almost every time there is a question from insurance claim. There are 2 things over here. Insurance claim. Full focus, I think 7 marks for sure, almost 4 out of 5 times they've asked. Insurance claim. Online people, good morning. Yes. Sir, what do you think, sir? Which type of partnership sum they will ask based on previous year question pattern? If I knew that right.
Day after tomorrow, June 25, June 26.
Huh? June 26. Huh?
June 26.
Not 26, it's 15. I think. Why June 26 we have to go to? Oh, June 26 attempt. See, I don't know which one. What can I tell? Okay, if I knew, then I would have just released it to all the students. so that everyone would benefit. But when you release it to everyone, no, then they will change the paper itself. So we actually don't know this, but study everything. That's all. Okay, insurance claim. Insurance claim. Now, insurance claim, there are many types of insurances. Life insurance, vehicle insurance, health insurance, marine insurance, transit insurance, fire insurance. None of them we are going to bother about. When we go into group 2 corporate accounting, there you will see the insurance company's financial statement we are supposed to prepare. Now, we are only focused on fire insurance over here. Imagine there is a small building and it catches fire. If it catches fire, what can happen? You can lose the stock which is there. You can lose the assets which are there. You can lose the people who are there inside, and you can also lose the profit. So there can be loss of stock, loss of assets, loss of people, and loss of profit. Now, loss of stock and loss of profit. Two things only we are going to cover over here. Loss of asset and all, nothing. You'll get the compensation, nothing to compute over here. You know the plant and machinery was this much, you'll get the amount. Loss of people, it's almost becoming a life insurance situation that you will get the money. So the chapter covers loss of stock and loss of profit. Clear? Now, loss of stock. Loss of stock. Whenever there is a loss of stock, you will prepare memorandum trading account. Why you will prepare memorandum trading account? To see how much stock was there on the date of fire. Main thing is what? First I should know how much stock was there on the date of fire. So prepare memorandum trading account from the date of previous year end till the date of fire, from last year end to the date of fire. That means indirectly we are trying to tell you that from the starting of the year till the date of fire, you prepare the memorandum trading account. Now, trading account, you know the format already. 2 opening stock. Now, how will I get this opening stock? Closing stock of previous year will be the opening stock in this. Then 2 purchases. How will I get the purchases? This year till the date of fire, this purchases should be given in the question. Otherwise, from where we will get to know this purchase? Then 2 direct expenses. This year till the date of fire, whatever direct expenses are there should be given in the question. Then here, by sales. This year till the date of fire, whatever sale is made, that also will be available in the question. Then usually in my trading account, gross profit is the balancing figure. If gross profit is the balancing figure, closing stock should be there. But we started preparing this trading account to tell that what should be the closing stock on the date of fire. So closing stock on the date of fire should be the balancing figure. How will you calculate gross profit? Sales, you know, multiply the gross profit rate into sales. That time you will get the gross profit, and closing stock will be the balancing figure. You know, you are like, sir, what if we don't know the gross profit rate? Simple. Then you have an extra step. If you don't know gross profit rate, you have to prepare last year's trading account, find the gross profit, take the gross profit ratio. So gross profit given in the question. If it is not given in the question, prepare trading account of previous year and find the gross profit percentage. Now you got the gross profit divided by sales into 100. Now sometimes they will tell in the question, compared to last year, this year gross profit was 2% more. Then whatever you found 2% more, you take as a gross profit, or 2% less, 1% less, whatever it is. Now what did you get? Did you get loss of stock by fire? No, you got only the closing stock on the date of fire. Now God is with you, no. God is little at least with you. So that time what happens? Everything closing stock will not go away by fire. Little at least will be saved. That is called as stock salvaged. That is called as stock salvaged or stock saved. So whatever closing stock is there over here, from that you will subtract the stock salvaged. Then from that you will subtract the savings. If they tell there was some savings because of this fire, and to that you will add the additional expenses. Additional expenses are what? Firefighting expenses. To save this much stock, I had to pay some money to the firefighters. So that you will add, and this will be your loss of stock by fire. This will be your loss of stock by fire. So basically in the memorandum trading account, what you are seeing, that is not the loss of stock by fire. That is the closing stock on the date of fire. On the date of fire, this much was there. Then when you remove the salvaged, savings and add the additional things, that time you will get the loss of stock by fire. Computation of claim. In this, the major player is average clause. The biggest player over here is average clause. What is average clause? Average clause is not an accounting terminology. Average clause is it is a terminology which is put by the insurance companies in the contract. They put a contract in the contract. They put it as average clause. Now tell me one thing. Imagine always in your closing stock you have 1 lakh. Always you have how much? 1 lakh in your closing stock. 1 lakh is always there. Usually it is there 1 lakh. Now, tell me one thing. If I tell you, go and take one insurance policy for loss of stock. Now you will tell, hey, nothing will happen to my company. My business will not catch fire. Everybody will think like that only, no? They'll think our business, nothing will happen. But after it happens, what to do? So you will tell, okay, take. Now you'll be like, for 1 lakh, usually my closing stock is 1 lakh. For 1 lakh, no, I have to pay premium of 1,500. Let's say 1,500. I don't want to pay 1,500. This is too much for me. So I'll do one thing. I will take policy only for 50,000. I'll take policy only for 50,000 and I will pay 750 rupees premium. Fine. Worst case scenario, if something happens, at least half the stock is covered. Now that is why insurance companies started putting this clause called as average clause. Now for them it is loss of revenue. No. Now you are having so much stock, but you are not getting it fully insured. If you are not getting it fully insured, I will not give you full claim. That is the logic of average clause. Applicable only if there is underinsurance. Underinsurance means what? Insurance policy amount is less. Closing stock on the date of fire which you got in the memorandum trading account is more. Insurance policy amount is less and closing stock on the date of fire is more. That is why you prepare the memorandum trading account, one of the reasons. Now, after that, if this happens, straight away, what you will do? Claim as per average clause will be loss of stock by fire. Whatever you lost, you will not get the claim. Loss of stock by fire into policy amount divided by closing stock on the date of fire. Loss of stock by fire into policy amount divided by closing stock on the date of fire. Closing stock on the date of fire, you will be getting policy amount also will be given in the question. Loss of stock by fire also, you only computed. Clear? This is if there is underinsurance. If there is no underinsurance, what you will do? No underinsurance. Loss amount or policy amount. Whichever is less will be the claim. If there is underinsurance, you have to follow this formula. Now, simple. If you want to follow this formula, you know it is underinsurance. No. You know it is underinsurance. What is the lower amount? Policy amount. Lower amount divided by higher amount. Because you want ratio, no. So, lower amount divided by higher amount. What is the higher amount? Closing stock on the date of fire. So, policy amount divided by closing stock on the date of fire into loss of stock by fire. That should be it. Now, you go into the next topic, that is loss of profit. What is loss of profit? Now, if the fire occurs, okay, next few months, 2 months, 3 months, 4 months, 5 months, you will be busy trying to bring your business back to normal. You will not be able to focus on business. You will be trying to bring the business back to where it was. So, insurance company compensating for loss of profit during the period affected by fire. 3 months, 4 months, 5 months, 6 months, 7 months, 8 months, 9 months, 10 months, anything you can be affected by fire. That time you will lose profit. I will give you that. What is loss of stock? On the date of fire, there was something, you lost it, I'll give you money. What is loss of profit? From the date of fire, few months, your profit was affected, I will give you money. That is loss of profit. Computation of claim for loss of profit. How will you compute the claim for loss of profit? First one. Step 1, always identify the period for the claim. Identify the period because there is a terminology called as indemnity period over here. Now, period affected by fire or indemnity period as per policy. In the policy, they will tell, we will cover for 6 months. Imagine you are affected for 4 months, then the policy will be, claim will be given only for 4 months. In the policy, they told, we will cover you for 6 months. And imagine you are affected for 8 months, that time how much you will get the claim for? Only 6 months. So 6 months, 5 months, how much claim you will get? 5 months. 6 months, 8 months, how much claim you will get? 6 months. So basically whichever is less. Next, after that you will calculate gross profit percentage. Now this gross profit percentage and what we saw in loss of stock is not same. They have a different methodology to calculate gross profit percentage over here. In reverse calculation, this is net profit of previous year plus insured standing charges. What is this insured standing charges? Insured standing charges means expenses which are going to be compensated by the insurance company. Insurance company will be like, oh boss, you have salary, electricity, that, this, blah, 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 all those expenses. If at all there is a fire, I feel that this and all can be avoided. So I will not give you money for those things. Only things which I feel is unavoidable, those are the standing charges for which I'll give you money. So to net profit, if you add the expenses, what you will get? You will get the gross profit. So that divided by sales of previous year, you will get the gross profit percentage. So what is the formula here in loss of profit? Net profit of previous financial year plus insured standing charges of previous financial year divided by total sales of last financial year. That time you will get the, into 100, you will get the gross profit percentage. Now compute standard sales. Step 3 is what? compute standard sales. What is standard sales? Standard, like feel the word, you'll understand that and you'll never forget it only. Standard means what? Every year it should have been same. That means sales during the same period last year. Sales during the same period last year. During the previous year, during the same period of current year which is affected by fire. Here, January to March fire. So last year, January to March. That is called as standard sales. Okay, fire occurred. Affected period is 1/7/2024 to 39/2024. That means last year 1/7/2023 to 39/2023 is called as standard sales. Now, step 4. Compute short sales. What is short sales? Standard sales minus actual sales. Standard sales minus actual sales during the affected period. That will give you the short sales. That will give you what? Short sales. Now remember one thing. Standard sales, any sales which you are seeing, no standard sales, actual sales and all which you are seeing, if there is a trend, they'll tell you 10% more, 5% more, you have to add that. Okay, imagine I tell you, last year I was making 1 lakh. But this year, if there was no fire, I would not, if there was no fire, I would not make 1 lakh. I would be making 1,20,000. Are you getting my point? Now, because of fire, did I lose 1 lakh or did I lose 1,20,000? I lost the opportunity to sell how much? 1,20,000. Clear? Now, short sales. After short sales, 1 second, please. Okay, after short sales, what is? Yeah. After short sales, the next thing that we have to compute is loss of profit. Now you know how much sales you lost. Short sales is nothing but shortage of sales. So you know how much sales you lost. So now you need to know how much profit you lost. You calculated gross profit percentage and kept. So short sales into gross profit percentage. Step 4 into step 2. Short sales into gross profit percentage. This is your loss of profit. Now you're like, okay, done, finished. I got my amount of loss of profit. But no, there is one more thing called as additional expenses. Additional expenses, there is a methodology to calculate that. Additional expenses claim. 3, lowest of the 3, like how you do in DT and no least of the following. First one is actual additional expenses. Second one is gross profit percentage into additional sales due to additional expenses. They'll tell you in the question, if not for the additional expenses, our sales would have been only 20,000. Now, how much is our sales during this affected period? 80,000. That means this 60,000 I made because I spent this additional expense. On that additional sales, you multiply the gross profit percentage. That is your option number 2. Option number 3 is what? A formula. Additional expenses into annual turnover. What is annual turnover in loss of profit? Annual turnover is not last financial year and all. Annual turnover means here fire happened, before fire 12 months. Annual turnover means here there was a fire incident, before fire 12 months is called as annual turnover. So gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. You have to memorize this. So gross profit on annual turnover divided by gross profit on annual turnover into uninsured standing charges plus uninsured standing charges. You will get that, multiply that into additional expenses. Whichever is less, that will be your claim that you are going to get for the additional expenses that you have spent. Now, annual turnover is last 12 months turnover before fire. Total claim you see. Loss of profit you calculated in step 5. Additional expenses you calculated in step 6. Savings, if any, if it is there, that you are going to minus. These two you'll add and savings you'll minus. You'll get the loss of profit. Now, if there is a trend, they'll only tell in the question. There is a trend. 10% more is there. Okay. Standard turnover and annual turnover must be adjusted for the trend. If they tell 10%, add 10% to standard turnover, add 10% to annual turnover also. Clear? Under insurance. Here also situation is under insurance only. In loss of stock, tell me for under insurance what you told. In loss of stock for under insurance, you told policy amount is this, stock is this. Now what you will tell? Policy amount is this, gross profit on annual turnover is this. You are going to compare with what? What profit you could have lost. In the loss of stock, what you compared? What stock you could have lost. So therefore here it is policy amount is less than gross profit on annual turnover, then there is going to be average clause. Same thing, total loss into policy amount divided by gross profit on annual turnover. There what used to happen, this used to be loss of stock into policy amount divided by closing stock on the date of fire. So basically this is loss into policy amount divided by what was the total amount that you could have lost. Done. That's it. That should be it with the insurance claim. Now we have to solve problems. Did they ask this time? Yes. For how much marks? Only 7. 7 marks only. 6B. This time also branch. Huh? Every time we are expecting that the departmental will come and branch is coming up. 6B, 6B, 6B. Okay. Now, a fire occurred in the premises of Bright on 25th May 2024. As a result of fire, sales were adversely affected up to 30th September 2024. That means what are they talking about? Loss of profit, because they said sales will be affected for some time. Firm had taken loss of profit policy with an average clause of 3,40,000. Policy amount, 3 lakh, my bad, 50,000, 3,50,000. Having an indemnity period of 5 months. But you are affected for how many months here? June, July, August, September. 4 months and few days. So it's going to be the time period which is there only. There is an upward trend of 10% in sales. So you have to add this 10% wherever you find sales. Firm incurred an additional expenditure of 30,000 to maintain the sales. That means they are telling, if at all this 30,000 was not there, I would get no sales only. To get sales only, I spend this 30,000. Okay. There was a savings of 5,000 in the insured standing charges. Following information was available. Actual turnover from 25th May to 30th September 2024. This is the sales during the affected period. Sales during the affected period. Turnover from 25th May to 30th September 2023. That means last year, same time. Last year, same time is called as standard sales. Now, gross profit for last financial year is given 2 lakhs. Insured standing charges is given 1,75,000. Total standing charges for the last financial year is also given 3 lakhs. Okay, turnover for the last financial year is also given. Turnover for 1 year, that is, this is the basically annual turnover. Clear, you are required to calculate the loss of profit claim assuming the entire sales during the interrupted period were due to additional expense. Very clearly they told us. So what and all we need to calculate? First step. What is my first step? Indemnity period. Now tell me, what is my indemnity period? Indemnity period, we know it is from 25th of May to 30th of September. Okay, sorted. That is within the 5 months which is there in the question. Then second, what do we need? Gross profit rate. Gross profit rate, how we are going to calculate? Gross profit of net profit of last year, that is 2 lakhs plus insured standing charges. How much is the insured standing charges? 1,75,000. Okay, divided by no, both together divided by the turnover of last financial year, that is 15 lakhs. Okay, 15 lakhs. So 3,75,000 divided by 15 lakhs. How much are you getting? 25% is your gross profit rate. Rate of gross profit. Can you see 25% over here? 25% rate of gross profit. Then after that, what do we do? Next thing, standard sales. Standard sales. What is the standard sales given in the question? Standard sales is 6 lakhs. During this affected last year same time we had made 6 lakhs. Okay, from that what we are going to subtract? Actual sales. What is the actual sales? Actual sales during the affected period is 1,75,000. 1,75,000. When we remove that, you are getting 4,25,000. This is what? Short sales. 4,25,000 is your short sales. Now, short sales, we can't take 4,25,000 because there was a trend in the question. How much is the trend? Upward trend of 10%. So, plus 10%. 4,25,000 plus 10%, 4,67,500. This is your short sales. This is your. Wait. We should have. We made a mistake here. It should have added here only, no? Standard sales plus 10%. Not to the difference. Standard sales plus 10%, 6,60,000. Now it should be correct. 660 minus 175. 4,85,000. Yes. 4,85,000. You can't add to the difference. You should add to the standard sales and then subtract the actual sales. So 6,60, 4,85,000. Can you see the short sales is 4,85,000? That means 4,85,000 into 25%. Into 25%, that is 1,21,250. This is our loss of profit. This is how much? Our loss of profit. But for that, you have to add the additional expenses and all those things. So now loss of profit 1,21,250. Additional expenses. How will you calculate additional expenses? First option is what? Least of the following. How much is the additional expenses? First one is 30,000. What you have spent? 30,000. Clear? Second option for additional expenses is what? gross profit rate 25% into actual extra sales which you made because of additional expense. They said everything is made of because of additional expense only. What is the sales that you made during this period? 1,75,000. 25% of 1,75,000. 1,75,000 into 25%. 43,750. Third one is what? You have to take that formula. Now first you have to take the additional expenses 30,000 into, first we'll write one annual turnover and keep over here. Annual turnover they are given in the question. Annual turnover is 14 lakhs. But we don't want 14 lakhs. We want 14 lakhs plus 10%. That last year it was 14 lakhs. 14 lakhs plus 10% is going to make it 15 lakh 40,000. 15 lakh 40,000 is the annual turnover. Clear? On that, what is the gross profit? 25%. Into 25%, you're getting 3,85,000. 3,85,000 is the gross profit. Clear? Now, into gross profit on annual turnover divided by gross profit on annual turnover plus the uninsured standing charges. What is the uninsured standing charges over here? 1,25,000. Insured is given, total is given. Insured is given 175, total is 300. So plus 1,25,000. So 385 plus 125, and here it's going to be 385 divided by this into 30,000. You're getting 22,647. 22,647. Which is the least among the three now? 22,647. Just remember the formula. Additional expenses into gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. And gross profit on annual turnover, when you're taking annual turnover, increase it by the trend, then only you take the gross profit on that. 22,647. Can you see 22,647 over here? The least among the three is 22,647. 43,750 and all we got already. Okay, now what is the next thing? Nothing. The savings which is there. How much savings they said? 5,000. Just minus that 5,000. You will get 138,987. 138,987. Now this is the amount. Now claim. Claim you can't do directly. Average clause will be applicable. How do you know that average clause is applicable? Because see over here, my gross profit on annual turnover is 385. Maximum I could lose was 385. But I took a policy for how much? 350. So therefore, it will be loss of profit 138,987. This will be 138,897 into policy amount was 350 divided by what we could lose was 385. So 350 divided by 385 into 138,897. 1,26,270. 1,26,270. Here you go. Okay, this is your solution. Alternative solution and all they have given. 1,26,136. What did they change there? 485, 121, 250. 14 plus 385. Gross claim. They got 22,500 net profit plus insured standing charges divided by net profit. Okay, random formula. This we don't use only anywhere. The actual formula only gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. Okay, don't bother about this. This is the answer 126,270. So they're using alternative solution. Huh? They're using this formula. Actual additional expenses into net profit plus insured standing charges divided by net profit plus all standing charges. Okay, but anyway, suggested answer they're considering the regular one also. Right? Anyways, you can try both of those, no problem. Next, June 2025. One more insurance claim, 3 marks. Third question, 7 marks. 3A. 3A. Okay. Now, on 30th March 2025, fire occurred in the premises of Rajesh Company. The concern had taken an insurance policy for 1,20,000 subject to the average clause. Okay, subject to average clause. From the books of accounts, the following particulars are available relating to the period 1st January to 30th March. Now they have given you the time period before 30th March. That means they're talking about loss of stock. If they give you after 30th March, that means it would have been loss of profit. Stock as per balance sheet on 31st December 2024. Last year's opening stock. This is 191,200. It will go straight into your memorandum trading account. Can you see last year's 191,200? You have prepared a memorandum trading account. Now, after that, you have purchases including purchase of machinery. Purchase of machinery will not go to trading account. So this will be 340 minus 60, 280 only will be there in the memorandum trading account. Next, wages including 6,000 for installation of machinery. That is again capitalized item. So only 94,000 should be there. 94,000 is going to be your wages. Then after that, sales including goods sold on approval basis amounting to 99,000, 5,50,000. No approval has been received in respect of 2/3 of the goods which are sold on approval. Now this is the careful thing you have to be. Now how much is the sales actually? Sales is 5,50,000. They are telling what? 99,000 is sold on approval basis, and in that no approval has been received for 2/3 of the goods. If 2/3 you did not receive approval, that means 1/3 you have received approval, and 1/3 if it is received approval, it is sale only. 2/3 if it is not received, that means it should be reversed from sale. So what you will do? 99,000 into 2 by 3, that means 66,000 it should be. 5,50,000 minus 5,50,000 minus 66,000, that will give you 4,84,000. Can you see the sale affected over here? Now you can't stop there. Sale of goods on approval or return basis, if you reverse the sale, no. If you timestamps, madam, this is going live. What? We will put the timestamps after the live ends. Okay. What should I tell? Madam, it's live. The time is 11:58. Sorry, 11:38 p.m. It's Wednesday, June 3rd. We are live. We are live on YouTube. Okay. Okay, timestamps. We will do that. Okay, once the live ends, that time we can do. Now, if I put timestamps, I'll be doing time travel. Okay, that we cannot do right now. We'll focus on CMA Inter. Sir, you look sleepy. Should I sleep? Okay, let's continue. Now, sales 4,84,000. You got this? Okay, 4,84,000. Now, if you stop here, no, there is one problem. If you remove from sales, when you take balancing figure, everything will be added to closing stock. So when you remove from sales, you want closing stock, yes, but you want the closing stock which is sitting in your godown, which is sitting there where you are waiting for approval. That will not get burnt down, no, when your godown is burnt. So that you have to remove. Closing stock with customer you have to remove. But the closing stock with customer is how much? 66,000. You can't take 66,000 and all. Gross profit rate is 20% on sales. Remove 20%. Only closing stock will be taken at cost. So 66,000 minus 20%. 66,000 minus 20%. 52,800. The entry for this closing stock on approval basis account debited to trading account, that is memorandum trading account, 52,800. Now you know the sales. On that you can calculate 20%. So 4,84,000 into 20%. See, gross profit you will get automatically. When you get gross profit, you got the closing stock 125,200. Balancing figure. This is the balancing figure 125,200. And this 125,200 is what? It is the closing stock on the date of fire. Closing stock on the date of fire, not loss of stock by fire. Now closing stock on the date of fire is 125,200. Stock salvage is there 24,600. Remove the stock salvage. Now what you get is the loss of stock by fire. Now you have to compare one thing. Go and see how much was the policy. Policy was 120. But how much you had here? 125. That means there is under insurance. If there is under insurance, what you will do? 1,600,000 into policy amount 1,20,000 divided by 125,200 will give you 96,422. Are you getting that? 120 divided by 125,200 into 100,600. 96,422. Yes, that should be your answer for loss of stock. Loss of stock. Clear? Closing stock on approval basis. Now see, closing stock on approval, how it works is, let's say there is one guy. Okay, he sold goods and he sold goods on 1st of February. I think that space wouldn't be enough here. I'll just show it over here. Yes. Now, there is one guy who has sold goods on 1st of February to one more guy, 1st of February, and they have given them 3 months time. 3 months time to accept or reject. Now, when it is on 1st of February, what you will do? You will pass the entry debtor account debited to sales account. Debtor account debited to sales account. You will pass the entry. On if accepted. If it is accepted by the year end. Before year end, if it is accepted, no entry. Why no entry? Because it is already recorded as sales. And now, if it is burnt also, no problem because it is already sales. Sale is considered. But one more thing what you have to understand is if rejected, what you will do? You will reverse this entry. Sales account debited to debtor account. Sales account debited to debtor account. Clear? This is the situation for the current year. On year end date. On what man, are you feeling deja vu? Deja vu you are feeling. Okay, on year end date. On year end date, what you will do? If it is not accepted, not rejected. If it is not accepted or not rejected, that time what you will do? You will still reverse it because it is not this year, you will reverse it. So when you are reversing, you will pass the entry sales account debited to debtor. Sales account debited to debtor. When sales account debited to debtor you pass, it is reversed. Then next year what happens? Now if you remove from sales, where is the stock? Somewhere the stock should be there. No, if you take it as sales, the stock is there. If you reverse the sale, stock should come back to your books. So you'll pass the entry closing stock on approval account debited to trading account. Clear? This entry will be at cost. Because closing stock always recorded at cost. Now, next year I'm not going to write. If it is accepted next year, sale entry. If it is rejected next year, don't bother because you already reversed it. Now the question is in this one, or not that one, which is the one? June 25, right? Yeah. In this question, next year, next year if it is accepted, you will pass the sale entry again, debtor account debited to sale. If it is rejected, don't worry because you already reversed the sales. Now in fire insurance, how it can effective is, they are telling you here, okay, can you see here, sales, in that sales, 99,000 is there. In that 99,000, 2/3 of the goods are still not accepted, but not rejected also. Not accepted. No approval is received means accepted, accepted or not rejected. Okay, but here what is the problem is 1/3 is accepted. No, that is sale. Okay, out of that 99,000, 2/3 you have to reverse the sale now. So that is 66,000. When you reverse that 66,000 from sale, sale is only 4,84,000. But whatever you reversed, did it come and sit in your go down? If it came and sat in your go down, then when you calculate balancing figure, you would get it over here. But if you do just like this, you will take this as the balancing figure. You will be telling the wrong loss of stock, wrong closing stock on the date of fire. You know why? Because this 66,000, whatever cost is there, that is not in your go down. It didn't get burned down. It is there safe. So therefore, from this, what you will remove the profit percentage. I think 20 they said. That time you will get 52,800. Closing stock on the date of fire. So closing stock account debited to trading account. That time balance only is sitting in your go down. Did you get it? Okay. Now 125,200. I think you got 96,422. That should be it. June 2025 done. Next we will go into December 2024. Insurance claim. Question number 6B. 6B. Yeah. Now, on 10th December 2024, fire occurred in the premises of Chandu. All stock except to the extent of 28,800 were destroyed. That means they're talking somewhere about stock. Now, what is this all stock except 28,800 means? Salvage value. This 28,800 is the salvage value. Okay, Chandu values the stock at cost less 10%. Chandu has one unique method. Okay, he wants to show the stock at cost less 10%. Now tell me one thing, what is the problem in these kind of questions? You have to reverse the stock and show the correct stock. But if you don't show the correct stock, I'll tell you what will happen. You will be showing the cost at a stock at less than 10%. So you will be showing the lesser value to the insurance company. So you will get lesser claim. So you have to bring it back to stock and then show it to the insurance company. Sir, deja vu, that too within the same day. Santoshini is also telling deja vu. Okay. Now, stock was insured for 1 lakh. What is this 1 lakh policy amount? From the following information, ascertain the amount of claim to be lodged with Chandu. Is it loss of stock or loss of profit? Loss of stock. Now, stock on 1st April 2023. When did the fire occur? 10th December. This is last year opening. Purchases during last year. Sales during last year. Stock during last closing stock. Okay, then this is the purchases and sales up to the date of fire. What is missing? Percentage. When we don't have the gross profit percentage, we have to prepare last year's trading account. Now, last year's trading account, did they prepare? Yes, luckily, trading account of last year. Now, see the fun over here. Opening stock is how much? 144. I don't want 144 because 144 is cost less 10%. So, does it mean that I can, wait. Does it mean I can add 10% back? No. Okay, this is 90. We have to calculate how much is 100. So 144,000 divided by 90%, you'll get 1,60,000. That is the opening stock. Then last year's purchases 560. Last year's sales 8 lakhs. Last year's sales is 8 lakhs. Then what you have to see, last year's stock, that is also cost less 10%. So this is 90. How much is 100? So obviously it will be 1 lakh only. 1 lakh. Now the balancing figure what you are getting is gross profit. You got the gross profit 1,80,000 divided by sales. Sales is 8 lakh into 100. Are you getting 22.5%? 22.5%. Why did we do last year's trading account? Because without that you will not be able to calculate. So 22.5% you got. Now what will you do? Memorandum trading account. Last year's closing stock straight away comes to opening stock over here. And during the affected period, they said this is the purchases, 5,84,000. And during the affected period, they said this is the sales. Put it into the memorandum trading account, 6,40,000. Moment you got 6,40,000, you can calculate 22.5% of that. You will get 1,44,000 as the gross profit. Now the balancing figure is the closing stock, that is 1,88,000. 1,88,000 is the closing stock. Clear till here? This is not the loss of stock by fire. This is the closing stock on the date of fire. From that you remove the stock salvage which is sitting over here 28,800. That time you will get 1,59,200. 1,59,200. Now always under insurance you have to check what is the policy amount in this question. Policy amount is 1 lakh. How much was the closing stock on the date of fire? 1,88,000. So clearly we know it is under insurance. So 1,59,200 into 1 lakh divided by 1,88,000. 84,681. Done. Okay. This is your December 24. We have a couple more question papers for insurance claim. We'll go into June 24 now. June 24 insurance claim. Where are you? Here you are. Now we'll see in June 24 answer paper. Insurance claim. Where are you? Here we are. Insurance claim. Where are you? Here we are. 7 marks. Write one line and get 7 marks. What a beautiful exam. So easy to score. Correct? So we can't even see that. So we have to solve this. Huh? Yeah. Hey, digital, no.
Video part is to save
Digital
it.
also they will make what the computer heat for the
That's it. They don't want. Yeah, next level. But they improved. We saw the recent papers. Complete solutions are there.
working notes also below there.
Working notes also they have given properly. Someone is asking something. Sir, this video will be uploaded in this channel. Yes, it will be uploaded. Right now it is getting recorded. Okay, it will be uploaded. You will find it as soon as the recording is done. You go to the live tab, you will find it over there. Okay, don't worry. From the following information, ascertain consequential loss claim. Consequential loss claim means loss of profit. Okay, financial year ends on 31st March with the sales of 25 lakhs. Last year's sales, that is last year's sales. Date of fire is 1st September. Following. Sorry, interruption period is 1st September to 1st February. September, October. 1 second, guys. Let me drink some water. 6 months, huh? This is also matching with 6 months. So our policy is exactly like how much we want. Okay. 6 months. Net profit is 2,75,000 plus insured standing charges of 3 lakhs. So first step for me is always what? Gross profit percentage. So what I will do, net profit of the last year is 2,75,000. So 2,75,000 plus 3 lakhs. Remember the formula, net profit of previous year plus insured standing charges divided by the sales of last year. The sales of last year is how much? 25 lakhs divided by 25 lakhs. 2,75,000 plus 3 lakhs divided by 25 lakhs into 100, you are getting 23%. Now, somewhere towards the end of the question, they gave one circus over here. Special circumstances, clause stipulated, increase in turnover 10%, for standard and annual increase 10%, increase in gross profit percentage 2. Now, don't make the mistake of adding 2%. It's just add the 2 and then you will get the new percentage, that is 25%. Sir, in this session is hire purchase covered? No, not yet. I don't think we'll be able to cover also hire purchase today. It will be covered in the next session, which is day after tomorrow. Okay, it will be in the next session, which is day after tomorrow, 25%. Clear? And that will be the last session, which will cover hire purchase. It will cover branch accounts, lease and accounting standards. That will be the last session of for June 2026 exam. 2026. Middle of the night, we don't know where we are. Okay, so 25% is the gross profit percentage. Now, after that, uninsured standing charges 50,000. Uninsured standing charges is what? 50,000. Sum insured is 6,16,000. This is the policy amount. Uninsured standing charges we will need later when we are calculating additional expenses and all that. Standard turnover for corresponding months, 1st September for the preceding year. That means standard turnover they gave, that is last year 7 lakh. Yeah, other than the last year in this at the same time. So standard sales will be 7,50,000 plus 10%. That makes it 8,25,000. Why 10%? They only told there is a trend of 10%. 8,25,000. Okay. Turnover in the interruption period. This year they have told what is the actual sales minus actual sales. That will be 2,25,000. That is basically 6 lakhs. We got our short sales. What was the shortage of sales? 6 lakhs. Now, when we got shortage of sales, directly we can multiply into 25%. You got your loss of profit. 1,50,000. Loss of profit is ready. Now we have to go further. Yes, annual turnover they have given 28 lakhs, but we don't want annual turnover like this. Plus 10% you have to add to that. 28 lakhs plus 10%, 30 lakh. Sorry, 28 lakh plus 30 lakh 80,000. 30 lakh 80,000. This is your annual turnover. Incurred additional expenses amounting to 50,000 with the saving of insured standing charges of 14,000. Savings we'll see later. Now there is an additional expenses of 50,000. Reduced turnover avoided through additional expenses is 1,50,000. How much sales we avoided? Reduction how much we avoided? 1,50,000. Now the additional expenses, you'll see how it works. Plus additional expenses. First option is the actual. How much was the actual? 50,000. Additional expenses is 50,000. This is the actual. What is the second one that we have? We have the other one is gross profit percentage, that is 25% into gross profit on annual turnover and all. We didn't calculate yet, but we'll calculate what is the what is the sales that we got because of this expense. 150 into 1,50,000. 25% into 1,50,000. 1,50,000 into 25%. 37,500. 37,500. Law marathon is there. It's already there, guys, on this thing. Please go and watch. Why not tomorrow, sir? We just want one break to survive, guys. We have been doing this crazy session, so just to survive, we are taking a break tomorrow. Day after tomorrow, we'll finish it off. Revise all these chapters. Same time for last live session. Yes, same time. It will start at 8:30. At what time will the session happen day after tomorrow, sir? How much time it will take to complete the session? Day after tomorrow is till we complete. Okay, 8:30 we'll start till we complete. If we finish early, we'll go early. If we finish late, we'll keep going till we finish. Okay, 37,500 is the additional expenses which we have. Then how much is the additional expense here? 50,000. But we have to calculate one thing now. What is the annual turnover? We said annual turnover. We calculated and kept 30 lakh 80,000. 30 lakh 80,000. On that you have to calculate 25%. This will be the gross profit on annual turnover, which will be 7,70,000. 7,70,000. Clear up? So now remember the formula. 50,000. Did I take one extra zero? Yes. 50,000 into 7,70,000 divided by 7,70,000 plus uninsured standing charges, which is given in the question only. Uninsured standing charges. 50,000 sitting in middle here. Yes, 50,000 plus 50,000. So 7,70,000 divided by 8,20,000 into 50,000. You're getting 46,951. 46,951. Tell me which is the least among the following over here. 37,500. So take the additional expenses as 37,500. And what is the savings that is given in the question? Savings with the savings of 14,000. So you will take that 14,000 savings to the outer column. Now 1,50,000 plus 37,500 minus 14,000. So you have 1,73,500. 1,73,500. This is your loss of profit. Now go and check. Your gross profit on annual turnover was 770. But how much was your policy amount? Your policy amount was 6,16,000. That means, do you agree that there is an underinsurance now? 6,16,000. So underinsurance is there. So what you will do? 1,73,500 into 6,16,000 divided by 7,70,000. 6,16,000 divided by 7,70,000 into 173,500. 1,38,800 is your loss of profit. 1,38,800, 1,73,500 total loss of profit. Clear? That should be it with the June 24 question which was there. We'll go into the last insurance claim question, that is December 2023 question paper. Insurance claim. Yeah, here it is. 6B again. 6B. One line. Because it is a claim for loss by fire. Huh? Or that because round off. That for 40 paise they didn't have to tell or and all. We only would have rounded it off. Okay, that much effort they didn't have to put after putting so much effort into writing one line. Okay, so here. This is not profit, this is loss of stock. Yes. Insurance claim. On 1st April 2023, the stock of Hariprasad was destroyed by fire, but sufficient records were saved from which the following particulars were associated. Okay, the following ascertained. Following particulars were ascertained. Stock at cost on 1st January 2022 was 1,47,000. Stock last year, yes, and last year's closing stock also is there. Purchases of last year is also there, and sales of last year is also there. Full last year information till here. Calendar year, yes. And purchase of these 3 months till the date of fire, and sales of these 3 months till the date of fire. Now, actually, this is directly from study material only. This abnormal loss question. This is in valuing the stock for the balance sheet on 31st December 2022, 4,600 had been written off on certain stock, which was a poor selling line having a cost of 13,800. When did they write off? Last year. Okay. A portion of these goods were sold in March 2023 at a loss of 500 on original cost of 6,000, and remainder of this stock was now estimated to be worth its original cost. Subject to the above exception, gross profit has remained at a uniform rate throughout the year. This we have to see what it is. Value of stock salvaged, policy amount also is given, subject to average clause. What would be the amount of claim for loss by fire? First we have to prepare what? Last year's trading account. Correct? Previous year's trading account you have to do, then only you will get the gross profit rate. So trading account of previous year. Okay, whatever the date. In the exam you don't write previous year, write the exact year only. Stock. What is the opening stock? 1,47,000. Opening stock is 1,47,000. So I am going to write 2 opening stock 1,47,000. And what is the closing stock? By closing stock, they have told that the closing stock 1,59,200. But I can't take 1,59,200 because they said this was after 4,600 had been written off on that stock. Written off. So 1,59,200 plus 4,600. 4,600. 159,200 plus 4,600, you are getting 163,800. This is your closing stock. Why did we do this? Because they had written off last year. We are bringing it back to cost. We want to know the actual cost. What is there? 163,800. Then you have purchases of last year, 7,96,000. And then we have sales of last year. Sales of last year, that is 9,74,000. 9,74,000. I don't think there is anything else that is related to last year. So now you will calculate 9,74,000 plus 163,800 minus 147,000 minus 796,000. 1,94,800 is last year's gross profit. We want the gross profit rate. 194,800 divided by 9,74,000 into 100. Are you getting correct? 20%? 20%. 20% is your gross profit rate. Normally this is 20%. But one exception is there. Normally this is 20%. Clear? Now what I have to prepare? Memorandum trading account. I have to prepare the memorandum trading account. One thing I know already in the memorandum trading account, opening stock, which came directly from there, 1,63,800. Now what I know? Purchases. How much is the purchase? 3,24,000. Yes. 2 purchases, 3,24,000. Next, what we need? Sales. How much is the sales? Sales is 4,62,400. 4,62,400. So I'm writing over here by sales 4,62,400. I think in study material in some of the questions they make one separate column for abnormal and make one separate column for normal and all. Without that also you can solve it. So directly I'm taking 4,62,400. Now what I need? I only need to fill the gross profit over here. If I fill the gross profit, I will get the closing stock, which will be the balancing figure. Now, see the other way I'm going to solve now. 4,62,400. I think even iPad is telling good night. Good morning, yes. Oh, 12:05, yes, good morning. Now, see over here, what is the sales? 4,62,400. Now you're like, sir, why are you doing all this circus? Directly for this 4,62,400, can't we apply 20%? No, we can't. Why we can't apply 20% is because in this, everything is not sold at a profit percentage of 20%. Okay. There is an abnormal sales as well as normal sales. So now what Where did he go? Oh, magic. I think ghost. Now suddenly you'll hear some. Huh? Bhaiya will come with.
Bhaiya will be like he will Chandram.
Imagine if something happens, first Bhaiya will be running. Because maybe in his area he has not seen these kind of ghosts and all. No. In South Indian movies we have seen no this kind of ghosts.
Bhaiya will also can't run now. He should open. He will go inside that room, storeroom.
He will hide there. And without him we can't go out. Yes, 4,62,400 is the sale. Now in this there is two things. One is abnormal sales and there is normal sales. This kind of a question is the actual tricky question which is there about loss of stock. So don't skip that. Now they said last year it was reduced. Okay, everything is fine. A portion of these goods were sold in the current year at a loss of 500 on the original cost of 6,900. Original cost is 6,900, but we sold it at what? Loss. So if we have sold it at loss, abnormal sale is 6,900 minus 500 rupees loss. So therefore abnormal sale is how much? 6,400. If that is abnormal, everything else is normal sales. So 462,400 minus 6,400, are you getting 4,56,000? Did you get this? They said it is sold at a loss on original cost. Original cost is 6,900. From that you remove 500. That time you will get the abnormal sales. That abnormal sales you remove from the total sales. That time you will get the normal sales. Normal sales, did you make normal profit? And on that, what was the profit percentage? 20%. So 4,56,000 into 20%, 91,200. Now, can we put this 91,200 into trading account? No, because that is normal profit. We had one abnormal loss also, no. So 91,200 and this 500, if you remove, you will get 90,700. That is the gross profit. So 90,700 you will put over here as gross profit. 90,700. 163,800 plus 324,000 plus 9,700 minus 462,400. Are you getting 1,16,100? Someone is telling, good morning, sir. Yes, good morning, good morning. 1,16,100. That is the closing stock on the date of fire. We want what? Loss of stock. Correct. So closing stock on date of fire, that we already calculated. 1,16,100 minus savings or salvage. How much was the salvage in this question? 11,600. 11,600. 11,600. How much are you getting? 116,100 minus 11,600. 1,04,500. 1,04,500. Now go and check on the balance sheet date. On the date of fire, what was the closing stock? 1,16,100. But what is the policy we have taken? 1 lakh. So clearly we know that there is under insurance. So what you will do? 1,04,500 into 1 lakh was the policy divided by 1,16,100. 1 lakh divided by 1,16,100 into 1,04,500. 90,008. Sorry, 90,000. No. 90,008.6 or 90,009. We should not neglect the effort. 90,008.6 or 90,009. Yes. Then they made 0. 1 paise. In the middle of the night for 1 paise we are not going to fight now. Okay, 90,009. Okay, this is how it is, but at least the recent ones are better. So even the recent MTPs also full answers are there. Yes, with that we are done with the insurance claim. We have one session remaining. In the next session we are going to cover branch accounts, hire purchase, and accounting, lease and accounting standards. Yes, that's it, guys. See you. Bye bye. Online, offline, everyone. Good morning. Yes. Let's start with something that is frequently asked in every single attempt, that is branch accounts. Now, in branch accounts, we have two types of branches. We have two types of branches, that is inland branch and foreign branch. In inland branch, we have couple of branches, that is dependent branch and independent branch. In the independent branch, what happens in dependent branches? Goods can be sent at cost, goods can be sent at invoice price. And when goods are sent at cost or invoice price, there are three methods which we have to learn. That is debtors method, stock and debtors method, trading and P&L method. Hello, online, everyone. Yes, hello, let's begin. Good morning. Yes, debtors method, stock and debtors method, and trading and P&L method. Now, all this is prepared by whom? It is prepared by head office. Why is it prepared by head office? Because it is a dependent branch. That means it's completely dependent on what the head office is going to say, that only they are going to do. So completely books of accounts are also prepared by head office. Now you have debtors method, stock and debtors method, trading and P&L method. What is the ultimate goal of preparing all this? To find the profit of the branch. Why head office is doing all this hard work? To find the profit of the branch. Clear? Now first thing is debtors method. In debtors method, in the books of head office. In the books of head office. Everything is in the books of head office till we go into independent branch. Then after that, this side we even have foreign branch that is also there. Okay. So now debtors method, goods sent by head office to branch. If we have people who have already watched the consignment part of this chapter, I mean this subject, you would have already seen certain things which are very similar over here in debtors method. Goods sent by head office to branch at cost. Okay, it is sent at what? At cost. So the entry will be branch account debited. Why? It is an expense now for us. Branch account debited. Branch account debited to goods sent to branch. Branch account debited to goods sent to branch. Clear? Next, if goods are returned by the branch, what happens? Just the reversal entry. Goods sent to branch account debited to branch account. Now, goods sent to branch by head office. Imagine it is at invoice price. Now, what you will do? Branch account debited to goods sent to branch. This will be at invoice price only. Just like consignment, this is reversal of loading effect now. You will pass the reversal entry. Goods sent to branch account debited to branch account. Goods returned by branch at invoice price. If goods are returned by branch at invoice price. Now what happens? Goods sent to branch account debited to branch, you will record it at invoice price. Then just pass the reversal entry again. Branch account debited to goods sent to branch account. Clear? Just ensure that whatever entries you are passing it at invoice price and that gets reversed. Okay, the loading effect gets reversed. Cash sales at branch. Cash sales at branch, no entry. Why? It's a dependent branch and it is debtors method. In debtors method, what we do? We record only the transactions between head office and branch. Only head office and branch. Cash sales at branch is a transaction between branch and its customer. So there is not going to be any entry in the books of head office which they are going to pass. Credit sales at branch. Again, no entry. Why? It's a transaction between branch and customer. Amount received from debtors. Amount received from debtors also no entry. Why? Because who received the money? Debtors received the money. Branch received the money from debtors. So for this also there is not going to be any single entry. Bad debts, discount allowed. For this also there is no entry because it's a transaction between branch and the customer. Sales return, no entry. Why no entry? Because customer returned the goods to branch. That is why no entry for that as well. Amount sent by branch to head office. Amount sent by branch to head office. So what should be the entry over here? Bank account debited to branch account. Head office got the money, so bank account debited. Who gave the money? Branch account. Now, expenses of branch paid by branch. If expenses of branch are paid by the branch itself, what entry to pass? No entry for that. Because again, it's not a transaction between head office and branch. Expenses of branch, if it is paid by head office, there should be an entry. Branch account debited because it's an expense or we have to get the money from them to bank account. Close GSTB account. GSTB is goods sent to branch account. Whatever is there in goods sent to branch account, it will be transferred to trading account. It will be transferred to trading account because for the head office, when they give the goods to branch, for head office, it is like sales. That is why it is credited to trading account. Now, next thing that we have to know is the closing stock effect. Closing stock effect, if the closing stock is at cost, nothing, no problem at all, nothing extra to worry about. If it is at invoice price, then you have to create stock reserve. Exactly like what you used to do in consignment. You have to create stock reserve, branch account debited to stock reserve account. That means this stock reserve is a liability which will reduce the value of the stock. The value of the stock is right now at invoice price. By creating an opposite effect, it will reduce the value of the stock to cost. Okay, this is exact same entry which we used to do even in consignment account. Next, opening stock. Opening stock, same. If it is at cost, no problem. If it is at invoice price, what will you do? Last year unrealized profit means this year realized profit. So you'll reverse the stock reserve and put the profit to branch account. This year unrealized profit means you'll remove from branch account and you'll keep the profit asset. Clear? So if you learn this particular point, same thing will help you even in the consignment account. There also stock reserve point is there whenever goods are sent at invoice price. Now next, stock and debtors method. Here the rule is simple. In the debtors method, what was the rule? The rule was simple. You are going to record the transactions only between head office and branch. But here in stock and debtors method, just record all the transactions. Record every single transaction. Ledgers to be maintained. What are the ledgers we are going to maintain? Branch stock account, branch debtors account, branch cash account, branch expenses account, branch asset account, branch P&L account, branch adjustment account. These are the ledgers we are maintaining specifically for the branch. Sir, can you repeat the closing stock invoice price? Simple. Closing stock is at invoice price. That means in the closing stock there is profit already recognized. That means this is unrealized profit. This same unrealized profit concept we have seen in consignment chapter also. We have seen it in departmental accounts chapter also. Now unrealized profit means what? Head office sent goods to branch and head office sent goods to branch at invoice price. But branch did not sell yet. Because branch did not sell yet, in the closing stock it is sitting at invoice price. So, where is the stock? Here only. Where is the profit recognized? Here only. So, for the company, overall company, what happens? It is the profit which is not yet earned. That's why it's called as unrealized profit. So, we have to remove it from the profit. So, what we have to do? We have to debit branch account. All the profits and losses of the branch is sitting in the branch account. So, you are debiting branch account and you are creating a liability. Liability to reduce the asset. Liability to reduce the asset. Asset is sitting at invoice price, so we want to reduce the asset, so we create a stock reserve. Now last year also we would have created some stock reserve just like this. So last year's stock reserve is this year's realized profit. So we reverse this entry which is sitting as a part of opening stock. I hope this part is clear, guys. Yes. Now these are the ledgers you are going to maintain in stock and debtors method. Branch adjustment account will be there only when goods are sent at invoice price. If it's sent at invoice price, branch adjustment account will be there. Now, what you have to understand is when goods are sent by head office to branch, if it is at cost, simple. Now everything will be recorded. Like how we told no entry in the previous situation. No, there is no entry over here. Everything will be recorded. Here, if goods are sent by head office to branch at cost, what will you do? Branch stock account debited because branch got the stock balance increases. Okay, to goods sent to branch. Head office sent the goods. Branch stock account debited to goods sent to branch account. Now, goods are returned by branch to head office. If goods are returned by the branch to head office, what should be the effect? Goods sent to branch account debited to branch stock account. You are just reversing whatever you had passed the entry when you sent the goods. Now, next, goods sent to branch by head office. If it is at invoice price, simple. Whenever the head office sent goods to branch at invoice price, there is one extra account that will come into picture. That is the branch adjustment account. The extra account is what? The branch adjustment account. So, branch stock account debited at invoice price to goods sent to branch. This will be at cost. To branch adjustment account. This will be at profit. Now, goods returned by branch. If goods returned by branch, what will you do? The profit which you recognize, reverse, branch adjustment account debited. Goods sent to branch, reverse, and then branch stock also reduces. Cash sales at branch. If it is cash sales at branch, what will you do? Branch got the money, branch cash account debited. Debtors reduces, stock reduces, So branch cash account debited to branch stock account. If credit sales at branch, what happens? Debtors increases, so branch debtors account debited to branch stock account. Amount received from debtors, branch cash account debited because cash increases, branch debtors credited because debtors decreases. Bad debts or discount allowed. If there is bad debts or discount allowed, bad debts and discount allowed are what? Expenses only, no. So branch expenses account debited to branch debtors. Branch expenses account debited to branch debtors. Expense increases, debtors decreases. Now sales return. Sales return, what happens? Customer gave the goods back. Branch stock account debited. Stock increases. Debtors decreases. Clear? Amount sent by branch to head office. Branch will send the money back to head office because it's a dependent branch. No, they can't keep money with them. They will give the money back to head office. If that is the case, bank account debited. Bank account debited to branch cash account. Bank account debited to branch cash account. Branch cash increases. Sorry, branch cash decreases. Our money increases. So here we are not going to write head office bank account because we are already sitting in head office only. So bank account debited to branch cash account. Expenses of branch paid by branch. Expenses of branch paid by branch. Branch expenses account debited to branch cash account. Branch expenses debited, branch cash credited. Expenses of branch paid by head office. What should be the entry? Branch expenses account debited to bank account. Branch expenses debited, bank account credited because money goes down. Close GSTB. The goods sent to branch which is there as usual, transfer it to trading account. Closing stock, now same logic but different accounting methodology. So what we are going to do, if the closing stock is at cost, no problem. If closing stock is at invoice price, closing balance of branch adjustment account will be the closing stock. So closing balance of branch adjustment account, see earlier in debtors method what you used to do, here we will write by closing stock. That time here we will write to stock reserve. So the net effect is created. Here what we are going to do, the branch stock account will be there. Here we are writing by balance carried down. So therefore opposite effect has to be created. So you'll write here in branch adjustment account, you will write to balance carried down. You'll write to balance carried down on the left hand side. That should be the effect. Clear? Now, same thing you'll do opening stock. If opening balance of branch adjustment is there. Now opening stock, what will happen? Branch stock will look like this. Branch stock account, you will write to balance brought down. To balance brought down. So what will you do now? Opposite effect you have to give. In branch adjustment account, you will write by balance brought down. This is the opposite effect. So same thing used to happen inside the consignment ledger or the branch ledger, branch debtors account debtors method, but now the same thing is happening in opposite ledgers. Clear? Now closing. Branch stock account. How will you close a stock account? Balance carried down. If there is profit or loss, transfer it to branch P&L. If there is difference in branch stock account, just transfer it to branch P&L. Branch debtors account, balance carried down. Branch cash account, don't write balance carried down because it's a dependent branch. Transfer that amount to head office. Now, bank account debited to branch cash account. That's the entry for transferring. Bank account debited because head office is getting money. Branch cash reduces. Branch asset. Very rarely there will be branch asset. If it is there, that also balance carried down. Branch expenses account. Transfer to branch P&L. If there is any branch expenses, transfer to branch P&L. Branch P&L account, what will you do? Transfer profit or loss to P&L account. Now, from expenses, it will not go to P&L, it will go to branch P&L. From branch P&L, the profit or loss where will it go? It will go to head office P&L, but we are already sitting in head office account only. So it will go to P&L account. Branch adjustment account is basically balance carried on. We already discussed what is the balance. It's nothing but the stock reserve. GSTB account will be transferred to trading account as always. Last method is trading and P&L method. This you don't even have to worry. It is basically prepare a trading and P&L for whom? For a branch. By whom? Head office. In whose books? Head office. Clear? Yes. Next we go into independent branch. In independent branch, what happens? Head office will record their transactions. Branch will record their transactions. There is no conflict of interest over here. We are recording our transactions. They are recording their transactions. That means if at all I send goods to them or they give me money, branch account for us will be a debtor because I will send goods. Head office account will be creditor. In the head office books, branch is a debtor. In the branch books, head office is a creditor. Now it should show same amount. If I am telling you that I have to pay you 100 rupees, you should tell that. You should get 100 rupees. The debtor and creditor situation should match. If it is not matching, what does it mean? There is some difference, there is some error which we have to reconcile. So now it should show the same amount. If there is any difference, rectify. Okay, end of the year. Head office, what they do, they add all the branch records to its books. Okay, what branch will do? They will transfer all the records to head office and close their books. Now, what will head office do? Branch trading account, branch P&L account, to branch expenses, all the expenses they will take over, and branch income account debited to branch trading and branch P&L. How will these people close their books? They'll close their books by removing liability, income, assets, expenses, everything they'll remove from their books. Okay, not necessarily that they can ask a question on that. That's just to understand what the structure is. And same thing, branch asset and branch liabilities will come into the balance sheet of the head office. Now, head office, imagine they have branch 1 and branch 2. Now, and branch 1 is sending goods to branch 2. That time there is no entry between branch 1 and branch 2. The entry will be routed through the head office only. If branch 1 is sending goods to branch 2, it will not look like this. It will be as if branch 1 is sending goods to head office and head office is sending the goods to branch 2. In books, in reality, goods will just go from here to there. Clear? Foreign branch. Foreign branch means what? Branch which is not within the country where the head office is situated. Home currency. Now we need to know what is home currency. Home currency means what? Currency, we are not telling rupees. Home currency means currency of the country where the head office is situated. Foreign currency is what? Any currency other than home currency. So for us, if it is in India, home currency will be rupee. Any other currency other than rupee will be foreign currency. Now spot rate. Spot rate means what? Today's rate. Okay, current rate. Closing rate means what? Rate on the date of balance sheet. Opening rate means what? Rate on the date of last year's balance sheet. That means this year's opening rate, it is closing rate of previous balance sheet. Average rate is nothing but opening rate plus closing rate divided by 2. Now, foreign branch, what they will do? Obviously, they'll maintain books. You cannot tell no that foreign branch is not maintaining books. Obviously, there some local law will be there. They have to follow that. So, foreign branch will maintain the books. Books will be maintained in foreign currency. Now, branch will give the trial balance to head office. And then what will happen? Trial balance will be in foreign currency. And then head office to convert it into home currency. So, branch will give the trial balance in foreign currency. Now that foreign currency, we have to convert it into home currency. Then whatever is there, we'll add it to our books. Clear? If branch gives me trial balance in dollar, can I add it to my financial statement which is sitting in rupees? It's not possible. Now, rules to convert. Okay, rules to convert. Simple. If actual rate is given, always actual rate. If actual rate is given, what you're going to do? Always you're going to follow actual rate. If actual rate is not given, then we think about the rules. Now, balance sheet items, monetary items, that is debtor, creditor, bills receivable, bills payable, cash, bank, etc. All this closing rate. Okay, monetary items, what you're going to do? Closing rate. What is monetary items? Monetary items means items which can be expressed in terms of money. Exactly. Non-monetary items like fixed asset and all which are there, actual rate or average rate. If actual rate is there, actual rate. If it's not there, just take the average rate and multiply. Stock. End of the year, we are calculating closing stock, so closing rate. Incomes and expenses. If there are incomes and expenses, you take actual rate, but obviously you will not have actual rate for everything, so you can take the average rate. Difference in trial balance after conversion, whatever is there, debit or credit to P&L, that is called as forex difference. If there is any difference, just transfer it to P&L. Is this clear? This is the concept of branch. Now almost multiple attempts they have asked branch accounts, so let's go and check the questions of branch accounts, then we can go further into AS. Branch. See, 7-mark question in branch. From the following particulars of Delta Limited, prepare Patna branch account in the books of head office, assuming that the sales at branch are on cash basis. So, question number 6A, right? So, where is it? Yes. Patna branch account, they have asked. Branch account, one ledger. That means they are following which method? When they tell only one ledger, it is obviously debtors method. Debtors method. Clear? Closing stock could not be ascertained, but it is known that the branch usually sells at cost plus 20%. Branch manager is entitled to a commission of 5% of the profits before charging. Before charging. So no need to do 5 divided by 105. Directly you can multiply 5 into 100. Okay, so 5 divided by 100. Now, prepare the branch account. That is which branch you are preparing in the books of Delta Limited. That is the head office. Okay, in the books of Mumbai head office, Patna branch account. Mumbai head office, but you are preparing Patna branch account. Now, one by one, opening stock at branch. So what will you do? You'll go to the branch account and you'll write to balance brought down. Now you can see over here, balance brought down 30,000. Can you see balance brought down 30,000? Next, after that, goods sent to branch 90,000. What should be the entry? Branch account debited to goods sent to branch account. Branch account debited to goods sent to branch account. They recorded at cost only. If it was invoice price, you would have to reverse the situation. Now, sales. What will be the entry? They sold the goods. No entry actually. They sold the goods. No, head office sold the goods. No entry. But we are assuming that they are sending the money. They are not keeping the money. That's why the entry is by bank account. That means bank account debited to branch account. For selling, there is no entry. After selling, they get the money. It is cash sale. They will give the money. For that, the entry is there. Bank account debited to branch account. Next, expenses at branch, salary and other expenses. Who is paying these expenses? Head office only will pay the expenses. So branch account debited to, see, bank account, salary and other expenses. Next, after that, they said closing stock is not ascertained, but a branch usually sells at cost plus 20%. Cost plus 20%. So now what we can do? We can calculate this thing, profit. So now understand this, branch closing stock you have to find. Branch closing stock you have to find. Now branch profit before commission. How will you find this branch profit before commission? 1,20,000. Correct. Cost plus 20% is what branch usually sells. Okay, branch usually sells at cost plus 20%. Now what you will do? You know the opening stock already. Opening stock plus, that is 30,000, plus goods which we received. Goods which we received is 90,000. Okay, so totally the branch has stock of 1,20,000. When they have the stock at 1,20,000, we have to understand one thing, that how much they sold. 1,20,000. They sold 1,20,000, but that is the selling price. I want the cost which I gave them. So 1,20,000, it is at cost plus 20%. So therefore cost plus 20%. So this will become 1,20,000 into 20 divided by 120. How much are you getting? 20,000. Remove that 20,000. That means 1 lakh gone from here. That means how much is the closing stock that is remaining? 20,000 is the closing stock. Opening stock plus purchases minus closing stock is what I did. Sorry, opening stock plus purchases minus cost of goods sold is what I did. So now you have 20,000 as the closing stock. Clear? You got 20,000. Now obviously this is the balancing figure 6,000. This 6,000 will come down, and then we are going to calculate the manager's commission. You don't have to worry. That also 5% on net profit before charging commission, they said. So directly we'll do 6,000 into 5 divided by 100. That makes it 300. This is the manager's commission, and balance is the profit which will go to general P&L. General P&L means what? Head office P&L only, because in whose P&L we are already, we are sitting in head office P&L. Yes, that should be it with that particular question of branch account, which was there in December 2025. We'll go into June 2025 now. The branch account question. Yes, here it is. 3B. Yes. Now, Suman Limited invoices goods to its branch at cost plus 33.33%. From the following particulars, prepare branch stock account, branch stock adjustment account, branch P&L account in the books of head office. That means which method is this? It is not debtors method, it is stock and debtors method. Clear? Now 3 ledgers they have asked. Branch stock account, branch adjustment account and branch P&L account. 3 things. Now let's start, and always in these kind of questions you should go in the order of the question only. Now, stock at commencement at branch at invoice price. This is that invoice price. What is the profit percentage? Cost plus 33.33%. So, to balance brought down 3,60,000. If this is that invoice price, on this, what is the profit percentage? 33.33% is on cost. So, therefore, this will be 25% on sales. 25% on sales, 3,60,000 into 25%. 3,60,000 into 25%, 90,000. Can you see in the branch adjustment account there is buy stock reserve 90,000? That is the opening balance, or last year's unrealized profit is this year's realized profit. Next, after that we go further. Stock at the close at branch at invoice price 2,88,000. So what will you do? Go to branch account and write by balance. Where is it? Yeah, by balance carried down invoice price. Can you see 2,88,000 over there sitting? Now if that is at 2,88,000, then what will you do? 2,88,000 into 25%, again 72,000 should be there. Now stock reserve account, actually there is 72,000 right now. It is showing 84 because there is some more adjustments coming up. So 70,000 we know. Next, goods sent to branch during the year at invoice price, including goods invoiced at 48,000 but not yet received. Before the closing, we send some goods which is not yet received. If it is not yet received, it is in transit. That is also like closing stock, only closing stock which didn't reach there. Okay, so therefore, can you see here, buy goods in transit 48,000. Can you see in hand, in transit 48,000. On that 48,000, when you take 25%, that is also at invoice price, you'll get 12,000. So 72,000 plus 12,000. Can you see your unrealized profit? That is 84,000. Unrealized profit is sitting at 84,000. Next, after that, return of goods to head office invoice price. We are returning the goods. Okay, wait. First, let's send the goods 24 lakhs. 24 lakhs goods sent to branch at invoice price. So what should be the entry? Branch account debited to goods sent to branch account. Branch account debited to goods sent to branch account. 24 lakhs. Now what is going to happen? You have to reverse the effect, no? See the reversal effect, 24 lakh into 25%. Sorry, 24 lakh is not into 25% divided by 3. Goods sent to branch, where is it? 8 lakhs. By goods sent to branch, 5 lakh 70 it seems. Wow. Okay, let's just keep that pending, assuming that there is some difference. Return is there. Return is there. That's why all that circus was happening. So 1,20,000 return. Return of goods, what will you do? Buy goods sent to branch. Alignment issues are there in this solution. Now buy goods sent to branch. Can you see the reversal there? 1,20,000. So 24 lakh minus 1,20,000. If you divide by 3, still you are not getting there 5 lakh 70. Okay, this is the goods sent to branch. No. If this is that invoice price, then yeah, 33%. No, yes, yeah, it will not. It's not matching with the suggested answers. Yeah, but here it is 5 lakh 70,000. That's what I'm telling. You should do 33% only because it's at selling price. Now, credit sales at branch. Credit sales at branch. What should be the entry? Credit sales at branch. Branch debtors account debited to branch stock account. Branch debtors to branch stock account 1,20,000. Whatever is sorted, we will see. Invoice value of goods pilfered. Goods pilfered means what? Abnormal loss. It has gone. So what will you do now when goods have lost? Invoice value 18,000 is the cost portion. Okay, 6,000 will be the profit portion. 24,000. 25% is the profit in that. So 18,000, what you are doing? Branch adjustment account. Okay. 1 second. First of all, get ready with the alignments. This is branch adjustment. This is branch P&L. Okay. Profit portion, remove it from branch adjustment. Cost portion is abnormal loss. That's why it is debited to branch P&L. Do we have branch P&L? Yes. 18,000 abnormal loss is debited to branch P&L. Then after that, what is going to happen? Normal loss at branch, invoice price 36,000. Normal branch, what will you do with this normal branch? Branch adjustment account, invoice price, normal loss. Remove the loss. Branch adjustment was sitting with all the profit. No, 36,000. That also is removed. Next, cash sales at branch. What is the entry for cash sales at branch? Branch cash account debited to branch stock account. Stock went. So here branch cash to branch stock 21,60,000. Suman closed the books on 31st of March 2025. There is no adjustment only which can trouble us. Okay, only thing is the suggested answers can trouble us. That's all. Okay, what is the situation here? 24 lakh goods sent to branch during the year. 24 lakh at invoice price. This is at invoice price. So what will you do here? You should actually write like this. Balancing figure we'll see later. Actually, it should be written like this. Branch account debited, branch stock account debited to goods sent to branch account. 24 lakh is at invoice price. So 24 lakh into only 75% we want, that is 18 lakhs. Then you are supposed to write to to branch adjustment account. Branch adjustment account will be 6 lakhs. Branch adjustment account will be 6 lakhs. Now 1,20,000. Now, okay, now the 5,70,000 will make sense to you because because the returns you have to minus. Returns we have to minus, but it is not to be presented like this. Don't present it like this. Show 6 lakhs over here. Okay, show 6 lakhs over here. Then what you are going to do here when you are passing returns, no 1,20,000. This return should be written like this: by goods sent to branch account 90,000, by branch adjustment account 30,000. So here you will write to branch stock account 30,000. Clear? Are you getting this? Now see, entry should actually be like this. When you send the goods, branch stock account debited at what price? Invoice price. To goods sent to branch account at what price? Cost. Then to branch adjustment account. This is the profit portion. Okay, so what they have done, they have clubbed everything and put, and directly they have put by goods into branch over there. So don't do that. Separate it and put it when you are putting it into the branch stock account, and here also separate it and put it. That's why you got 6, and here 30 comes. That time you will automatically get the 5,70,000. Is this clear? Now, when you do all that, there is a balance. There is this ledger is not tallying. You can check 21,60,000 plus 120 plus 120 plus 6,000 plus 18,000 plus 36,000 plus 288 plus 48 minus 3,60,000 minus 18 lakhs minus 6 lakhs. So there is a 36,000 surplus. So you transfer the surplus to branch adjustment account. You can transfer, or directly branch P&L also you can transfer. So if you transfer to branch adjustment, that 36,000 comes and sits over here. That time what happens? 90,000 plus 6 lakh plus 36,000 minus 6,000 minus 36,000 minus 84,000 minus 30,000. You will get 5,70,000 as the profit which is sitting in branch adjustment. That will come to branch P&L. In branch P&L there was 18,000 of loss. When you remove that, whatever is there, that goes to head office P&L. We are already in head office P&L, so it goes to the P&L account, just the P&L account. Instead of writing net profit, you will write to P&L account. Is this clear? Okay. Goods sent to branch. Whenever there is goods sent to branch, just remember you have to reverse the effect. But how you will reverse? By putting it into a different ledger, that is branch adjustment account. Clear? That is June 2025. After that, what we have? December 2024. In December 2024 also there is a question 6A. 6A. Yes, this is the Surat branch account. Now, Adiraj Limited Noida started a branch in Surat on 1st April 2023, to which goods were sent at 20% above cost. The branch makes both cash and credit sales. It is the policy to meet branch expenses from branch cash and remit the balance money to head office. Branch does not maintain double entry system of accounting, and necessary accounts relating to branch are maintained by head office. Show the Surat branch account in the books of Noida head office to determine the profit or loss. They said branch account. When they are telling branch account, that means one ledger. If it is one ledger, which method is this? It is debtors method, only one ledger. So now what will you do? Cost of goods sent to Noida branch. Cost of goods sent to Noida branch, 50,000. But you will add 20% profit to that. That time that becomes 60,000. So just understand over here, branch account debited to goods sent to branch 60,000. But it is at invoice price. So immediately what will you do? Reverse the effect. By goods sent to branch account 10,000. You are removing the profit portion which is there over there. Next, goods received by branch till 31st March 54,000. How much we sent actually? 60,000. How much they received there? 54,000. That means 6,000 is what? Goods which are still in transit. Goods are sitting in transit. That means it should be part of the closing stock. In closing stock, whenever we are buy goods in transit. Can you see the goods in transit over there 6,000? But this is at invoice price. This is at invoice price. Now I should reverse that profit portion. Wherever you record anything at invoice price, immediately you have to reverse the opposite effect over there. So 6,000 into 20 divided by 120. That makes it 1,000. 6,000 into 20 divided by 120, that is 1,000. 20% was on cost. This is selling price over here. Next, after that, credit sales for the year. What should be the entry for credit sales? Nothing. It's a transaction between branch and customer. So you're not going to pass any entry. Can you see any entry over here? 58,000? No. Next, after that, closing debtors 20,800. We want the closing balance of debtors. By balance carried forward or carried down, you'll write 20,800. Next, bad debts. Bad debts also no entry. Why? It's a transaction between the branch and the customer. Cash remitted to head office. They sent money, we will take it. What should be the entry? Bank account debited to branch account. So you'll write over here bank account debited to branch account 43,000. Next, cash in hand at the branch at the end of the year. Closing balance of cash. You'll write by balance carried down and write branch cash 2,000. Next, after that, cash remitted by head office to branch during the year. Who sent money to whom? Head office sent the money to branch. So branch account debited to, didn't pass an entry. Here it is. Branch account debited to bank account 3,000. Next, after that, closing stock at branch 6,000 at invoice price. Closing stock at branch 6,000. Can you see branch stock account 6,000? But whenever the stock is at invoice price, so what we should do? We should create stock reserve. So this will also be 6,000 into 20 divided by 120 to stock reserve 1,000. After that, expenses incurred by branch. Ignore. Why are you worried about that? Expenses incurred by branch is a transaction between branch and its customers. So we don't have to worry about anything. So straight away, balancing figure, whatever is there is the profit. It will go to P&L. This was the 7-mark question which was there in December 2024. June 2024. June 2024 branch. 6A. Till now 4 out of 4 we have seen branch in every single exam. Now, Ranu Stores of Jaipur has a retail branch at Kota. The books are invoiced to the branch at selling price, which is obtained by adding 50% on cost price. That means profit portion is what? 50% on cost. All expenses are paid by head office. The particulars are as follows. End of the question, you can see you are required to prepare branch stock account, branch debtors account, goods sent to branch account, branch expenses account, branch adjustment account, branch stock reserve account in the books of head office. All these ledgers you are supposed to prepare. Now, one by one. First, balance on 1st April 2022. Stock at invoice price. Where will this be sitting? It will be sitting in the branch stock account. In branch stock account, can you see balance brought down 1,20,000? 1,20,000, but this is at invoice price. If it is at invoice price, what happens? The opposite effect has to be there. It will be there in the branch adjustment account. And what is the profit portion? 50% on cost. So this will be basically 1,20,000 into 50 divided by 150. So you can see over here by stock reserve or by balance brought down, it is 40,000. Can you see branch stock reserve also they asked? Stock reserve to branch adjustment account. Can you see this effect over here? Okay, 40,000. Then next after that, debtors also have an opening balance that is 43,200. Go to branch debtors and see what is the opening balance? 43,200. Next they said goods sent to branch at invoice price. Goods sent to branch at invoice price. What should we do from this? Remove the profit first. How much is it? 18 lakhs into 50 divided by 150. That means 6 lakh will just be the profit portion. Now you have to see the entry. Branch account debited to branch stock account debited to goods sent to branch. They are following this reversal entry effect only. They are not showing it separately. 18 lakhs. And then what you are going to do? 18 lakhs is the goods sent to branch. Now see the branch adjustment account over here. In the branch adjustment account, 6 lakhs should be there. I think there is a return. So they are showing the net effect. You should not show the net effect actually. You should show the gross effect only, and returns you should put on the opposite side. So 6 lakhs is there over here. Then goods returned by branch at invoice price. Goods returned by branch, can you see an opposite effect of 24,000 over here? Now on 24,000, 50 divided by 150, how much is it? 8,000 is the profit portion. That is what it was 6 lakh minus 8,000. Can you see the net effect of 5,92,000 you're getting? Okay, pass the gross effect actually. That's what is the correct methodology. Okay, next after that we have cash sales. What should be the entry for cash sales? Branch cash account debited to branch stock account. Do we have branch cash to prepare? They didn't ask us to prepare branch cash, did they? No, directly here branch stock account 72,000 you can see. Then credit sales. What is the entry for credit sales? Branch debtors account debited to branch debtors account debited to branch stock account. You can see the branch debtors 16,32,000 and here you can see branch debtors 16,32,000 credited to stock account. Next, goods returned by debtors. If goods are returned by debtors, stock increases. So branch stock account debited to branch debtors account. Branch stock account debited to branch debtors account. Next, after that, cash received from debtors. What is the entry for cash received from debtors? Branch cash account debited to branch debtors account. You can see here by branch cash 15,60,000. Next, you have discount allowed to debtors. Discount allowed to debtors is an expense. So what will you write? Branch expenses account debited. They asked us to prepare that. Branch expenses account debited to branch debtors account 12,000. Next, after that you have bad debt. Bad debt is also an expense. So branch expenses account debited 2,400 to branch debtors 2,400. Sir, suggest me which chapter is easy in FA so it will come in exam so I can focus on that. Incomplete records 14 marks, partnership 14 marks, 28 marks. Sure shot it will come in the exam. Yes, let's continue. But you have to study that, that's all. Branch expenses paid by head office. Rent, salary, miscellaneous expenses. Who is paying all this? 19,200 plus 1,01,000 plus 6,000. 1,26,200. Entry is branch expenses account debited to bank account. See, branch expenses account debited to bank account. Next, after that you have balance on 31st March, closing balance. Stock is sitting at 199,200. Go to the branch stock account. You can see the closing balance at 199,200. 199,200 is at invoice price. So 199,200 into 50 divided by 150. 66,400 is the branch adjustment closing balance. Go to branch adjustment. Can you see 66,400 stock reserve closing balance over here? And that same thing will be there in the branch stock reserve account also, because simply they asked us to create one extra ledger over here. Okay, stock reserve account. Stock reserve is a liability. See, opening balance brought down, closing balance carried down. Okay, opening balance, it's a liability. No, so opening balance will be credit balance and closing balance we're carrying. From where we are getting this created? From the branch adjustment account, 66,400. Then they said debtors closing balance 88,800. Go and check what is the debtors closing balance, 88,800. Then after that there is nothing. So now you have to close one by one. See, debtor will automatically balance because all the information was given. Now here, when you are checking this branch stock, now this time you are getting a difference. This is a shortage. If the debit side is more, it is shortage. If the credit side is more, it is called a surplus. Take this 4,800 and transfer it to branch adjustment account. You got it over here. Now what you are going to do after that? 1,40,600. Branch expenses, whatever was there, it is transferred to branch adjustment. Actually, normally every other question in study material, this has gone to branch P&L. It has gone to branch P&L, but they have transferred it to branch adjustment. No problem, because ultimate profit will not change, because from branch adjustment also balance goes to branch P&L, expense also goes to branch P&L. There it would have set off, because they didn't ask branch P&L. Here only they have set off in the suggested answers. Clear? So expense got adjusted over here, and the net whatever is there profit, this will go to P&L. 420,400, 420,200. Is this clear? Okay, extra ledger they can ask in the exam, that is branch P&L. That time put the expense to branch P&L, don't adjust it with branch adjustment account. Clear? Next, last, December 2023. One branch accounts question is there. It will be reduced, but in the P&L the profit will be same. No, but we don't know. No, this is just suggested answer. With so many mistakes which are there in suggested answer, do you think this is the answer key? What if? But we can't think of that what if now, because you know, in in the study material, they didn't follow one method. Some places they transfer directly, some places they have adjusted. Okay, alternative solutions will be there in their answer key. Okay, their answer key obviously they'll present this or this. Otherwise, it's unfair for all the students. No, because they do. There is no way we can understand that whether they are expecting this or that, because both are correct treatments. But what is the absolute correct treatment? Transferring to branch P&L and then calculating the profit over there. In this question, maybe they didn't do that because they didn't ask branch P&L. So without asking branch P&L, somehow we have to find the branch profit. No, that is why they did like this. Yes. So December 2023, there is one branch question again. Yes. December 2023. 6A. What did we expect? What did we expect? Nothing. Now, X Limited has a retail branch at Puri. Goods are sold at 60% profit on cost. The wholesale price is cost plus 40%. Goods are invoiced from Delhi head office to branch at Puri at wholesale price. From the following particulars, ascertain the profit at head office and branch for the year ended. Now, we have to understand one thing. If I take cost as 100, okay, wholesale price is cost plus 40%. So I take 40 on that. This is, when that time I get 140. This is the wholesale price. Clear? But retail price is already told, that is 160. That means here one more profit is added, 20. Okay, 120. Now you have to understand certain things very clearly. Head office is giving to branch at what price? 140. Head office is giving to branch at 140 at wholesale price. Branch is selling at what price? 160. Branch is selling at what price? 160. So in the branch, stock is sitting at what price? 140 or 160? 140. Are you getting this? See, this is in wholesale profit and retail profit methods. No, the very important thing is to understand who is sending at what price. Head office to branch is sending at what price? 140. Branch customer is selling at 160. So in head office, stock will be sitting at what price? At 100. Obviously cost. But branch cost is what? 140. So branch stock will be sitting at 140. Clear? Now, they asked you to create the stock, purchase, goods into branch, sales, expenses. Sales at head office are made only on wholesale basis and that at branch to customers only at retail price. Stock at head office is valued at invoice price. We are sending the goods at invoice price. Invoice price is what? Nothing but our 140 over here. In this case, it is 140. They want to know only the branch profit and head office profit. Okay, there are multiple ways to do it. You can just prepare head office trading account. Okay, branch trading account. Head office trading account, branch trading account. You just want the profit. No, ultimately stock. Can you see the opening stock at head office? 7 lakhs. Opening stock where? At head office. Okay. So you can write over here 2 balance brought down 7 lakhs. There is no opening stock at branch. Purchases head office, how much? 42 lakhs. So we'll write 2 purchases 42 lakhs. Then after that, goods sent to branch at invoice price. Goods sent to branch at what invoice price? 15 lakh 12,000. 15 lakh 12,000. So what will happen over here? Here in head office, I will write by GSTB account 15 lakh 12,000, because for head office it is like a sale. For branch it is like a purchase. So you will write to GSTB 15 lakh 12,000. I hope it's clear. And obviously I will record the sale here at my selling price, that is 15 lakh 12,000, and here I'll record it at my cost, that is 15 lakh 12,000. Next, after that, what is going to happen? Sales. Both the places you are going to record the sales. So here you'll write the sales. Okay, that is 42 lakh 84,000. And here you are going to write the sales. That is 14 lakh 40,000. Next, there is stock on 31st of March 2023. Closing stock. So here you will write by closing stock. How much is the closing stock? 16,80,000. And here also you will write by closing stock. What is the closing stock over here? 2,52,000. And don't forget, this is at invoice price. This is at invoice price. Next, expenses 80,000, 40,000. Okay, trading and P&L together and preparing. So you'll write two expenses 80,000 and two expenses 40,000. That's it. Now what happens over here? If you check 15,12,000 plus 42,84,000 plus 16,80,000. 1512 plus 4284 plus 1680 minus 7 lakhs minus 42 lakhs minus 80,000. 24,96,000. Can you see what you are getting over here? 21,44,000. Why? Because of stock reserve. There is a stock reserve, no? You can't take directly, no. Closing stock, yeah, that fellow is showing his closing stock at what price? 2,50,000 at invoice price. So therefore, the stock reserve will go from whose ledger? It will go from head office, because they are showing it at their cost, our selling price. So who has to remove the profit now? Head office. So you'll write to stock reserve, which is 2,52,000 into what? 40 divided by 140. How much? 72,000. Now 1512 plus 4284 plus 1680 minus 7 lakhs minus 42 lakhs minus 80,000 minus 72,000. 24,24,000 actually should be the profit. 24,24,000. We'll check what is the situation for branch. Branch, it is 1,44,000. Sorry, 14,40,000 plus 252 minus 1512 minus 40,000. How much are you getting here? 1,40,000. This is the profit. Is it matching? This is matching. 21,44,000 it seems. 21,44,000. There is no way that one can match and one cannot match. 24,24 minus 21 lakh. 24,24 minus 21 lakh. 40,000. 2,84,000. Okay, I'm guaranteeing that is some typo only, because if one profit is matching when all the transactions are put, how the other profit cannot match? Okay, so 1,40,000. This is correct. So this also should be correct only. 24,20,000. In? No, because in head office, no, it will not be at invoice price. My own goods, I will not show it at invoice price. No, that is completely wrong if I am showing it at invoice price. My own goods will always be at cost. Their goods are sitting at invoice price. Therefore, I am removing the stock reserve. Clear? If at all you do that also, no. On this also you have to reverse. On this also you have to reverse. Now 16,80,000 minus 7 lakh. I think they would have done that only. Yeah? What is the profit percentage? 40. 40 divided by 140. That only, no, 2,80,000 difference. This can never be at invoice price, no. If it is at invoice price, it doesn't make sense. No, you are going against the accounting standard, because it should be at cost. What they have done is that only. Because of this sentence, see, stock at head office is also valued at invoice price. How can stock at our own stock you are showing at invoice price? That is cost or NRV, whichever is less is the formula, and you are showing at higher than cost. Did you get my point? Okay, the difference is that only 280, but it shouldn't be done like that. But as we see, you can see this is December 23. As you come closer, such kind of errors are not there, so it should be better off. Okay. Yes, that should be it with the branch. Let's go into accounting standards. Next thing that we have to discuss is accounting standards, and accounting standards we will be discussing along with lease, because lease is also an accounting standard only. So accounting standards, whatever is part of our syllabus plus lease we will discuss. Then after that we will go on solving all the problems which are there of accounting standards.
Higher purchase, you have to do self-study. I'm only doing accounting standards. Lease I'll do. Because lease is a accounting standard only. I don't know why separate chapter is there for lease. Which one? Yeah. Higher purchase, I think in 5 attempts, one question they have asked. 2 questions they have asked. One was your attempt only. You remember so well. One was your attempt only, is it? That is what I am telling. But people are skipping that. Admission? Oh, is it?
In exam, like none of them know how to. My mother's she said that the won't come skip that. When they go and it's a compulsory thing. It need to solve. It's very 15 marks. They will solve. Mental thing, I need to solve that sum. Not sitting and solving. Finally got carried.
That's because of the CMA question, no?
No, I admission also retirement.
Did some mixture. Nice upma you made and came over there. There you have the marks for Puma. Yes. Actually, the double entry system of accounting, if you follow, no. When you put one place, you have to enter it in the other place. If you follow that in partnership properly, you can make minor mistakes, but there cannot be any major mistakes. Yes. So let's begin, guys. The last topic of discussion, that is accounting standards plus lease in this marathon. So once we finish that, whatever time it is, we go. It might be early, it might be late, but whatever time it is, we'll go that time. First, accounting standard. The marks are not little less okay from accounting standards. If you think that it is something to be skipped, around 14 marks. Anywhere, it will be there. One more question will be there. Yes. AS1, disclosure of accounting policies. Accounting standard 1, disclosure of accounting policies. Obviously, it's the base of all accounting standards. Okay. This standard doesn't tell which accounting policy to follow, but tells to disclose whatever accounting policy you follow. They are not telling do that, do this. Whichever accounting policy you want, you follow, but disclose it. Now, where to disclose? All significant accounting policies adopted in the preparation and presentation of financial statement should be disclosed. When you're preparing financial statement and when you're presenting financial statement, whatever accounting policies are there, everything should be disclosed. Where are you going to disclose? In notes to accounts. In notes to accounts, you're going to disclose. The disclosure of significant accounting policies should form part of financial statements. It should normally be disclosed at one place, that is notes to account. Notes to account says after your financial statement, extra information, whatever you want, you can disclose it over there. Fundamental accounting assumptions. This is something that is there in accounting standard 1. What is fundamental accounting assumptions? When you are preparing financial statement, you are always assuming that there is going concern. What is going concern? That means business will continue. There is no indication or intention for us to close down the business. Next one is consistency. What is consistency? Whatever accounting policies you are going to follow, please follow it consistently over a period of time. Don't change from year to year, then it becomes tough for people to compare. Then you have accrual. That's the most important thing, because of it so many chapters we saw. What is accrual? The transactions are recorded as and when they happen. It is not necessarily recorded when the amount is received or when the amount is paid. Next, we have conditions about fundamental accounting assumptions. What are the conditions about fundamental accounting assumptions? The conditions are, it is assumed by the reader that it is always followed. We don't have to open our mouth, hold mic and tell fundamental accounting assumptions are followed. Nothing. It is assumed that it is always followed. If you don't follow, tell. So disclosure to be made if any fundamental accounting assumption is not followed. Selection of an accounting policy. How are you going to select an accounting policy? There are 3 points to be considered. Okay, first one is substance over form. Substance over form means what?
truth over legal form. Now, hire purchase is a self-study chapter for you guys that I'm not doing. But in hire purchase, what you have to understand is, in hire purchase, owner is hire purchaser. Till you pay the last installment, okay, who will be the owner till you pay the last installment? Hire seller only will be the, sorry, not hire purchaser, hire seller will be the owner. Now, that is why in hire purchase you have these topics where if you don't what do you say, pay the installment, there is a topic called as repossession. He can just come in, take one tempo and go away. Okay, so therefore just remember, there what happened? Who is the owner? Hire seller. But who is passing depreciation entries? Hire purchaser. That is called as substance over form. Okay, truth over the legal form. That means legally one person might be the owner, but who is enjoying the benefits of that asset? Whoever is enjoying, that person is recording the depreciation. So you have to see the substance over the form. Now, for example, you might have one land. Land might belong to your father, but on that you have constructed a building and you are using it for your business. Now, can you tell that land belongs to father, so building is also belonging to father? No, you are using it for your business, so it is going to be taken as your building in books of accounts. Now, materiality. What is materiality? Don't give all the information that is required, that is there with you. Give the information only to the reader that is going to help him take some decisions. Some random information and all what you have, everything you cannot dump on the reader. Information that helps the reader in decision making. Prudence. Prudence is our conservatism. What we are going to do, provide for foreseeable losses, but do not record future profits. Now, change in accounting policy. Enterprise can change its accounting policy only when any of the three conditions are satisfied. Required by statute or law. If some law is telling change the accounting policy, then you have to change the accounting policy. For the purpose of compliance with an accounting standard, some accounting standard is telling this is the accounting policy, then you have to change from your existing accounting policy to the policy which we require. For more appropriate presentation of financial statement, you feel that your financial statement will be showing a better presentation and it is the apt presentation for the reader, you will change the accounting policy. Note, such change affects the financial statement of either current period or later years. If you change the policy, it can affect you today or it can also keep affecting you in future years also. Imagine you change the policy of paying pension. It will not affect you today. It will affect you every year till future also. But it should be disclosed in the current period. Whenever you change, disclose it. Now, disclosure of change in accounting policy. Material in current period. Material in current period means what? It is affecting current period. Now, do you know the amount? Amount is ascertainable. If you know the amount should be disclosed. If you don't know the amount, then facts should be disclosed that you are unable to quantify the effect. Something you changed, okay, it is affecting current period, amount is not there, so you are going to state the fact that something is changed and you are going to disclose that particular item over there. Now, not material in current period but affects future period. It's not going to affect us today. Imagine pension policy changes, it will not affect us today, but it will affect us someday in the future. Fact of such change affecting the future period must be disclosed in the current period. Clear? Done and dusted. That's it. That is our first standard, that is AS1. Next standard that I'm going into is AS10, property, plant and equipment. What happens in property, plant and equipment? Meaning of PPE. Very simple standard AS10. What is PPE? What is PPE? PPE is nothing but, earlier we used to call this as fixed asset. So this is nothing but tangible items. PPE is tangible items held for use in production and supply of goods and services. You are having some asset, you are having some machinery which you are using to produce the goods or services, or you are using the machinery to supply the goods or services. Imagine you have one truck. Are you going to produce any goods with this truck? No, but whatever goods you produce, you will keep it on this truck and you will supply it. Imagine you have one machinery, plant and machinery. Are you going to supply anything with this? No, you are going to produce the goods with this. Now imagine you have one mic, you are a singer and you have one mic. Now are you going to produce any goods with this mic? No, you are going to supply the services to this mic. So whatever is going to help you to produce goods and services, that is going to be considered as property, plant and equipment. Now administrative purpose. Now imagine you have one laptop. You have one laptop. Are you going to produce any goods with it? Are you going to produce any service with it? No, you are using it for administrative purpose. Maybe you will use this laptop and you will pass the journal entries as per AS10. Correct? So that is also considered as property, plant, equipment. Rental to others. You have one building. In that, no factory is there, no administration is happening, nothing is produced, no services are produced, no services are given. So, but this building you are giving it on rent. That time that building will be considered as property, plant and equipment. Clear? Now, expected to be used for more than one accounting period. That's the more important point. No, if you just have the property, plant and equipment, not enough. If it's going to give you future economic benefit, then only it will be considered. Now, recognition of PPE. When will you recognize the PPE? PPE shall be recognized only if both conditions are satisfied. First condition, cost can be measured reliably. You should know the cost. Imagine your friend gifted you one Mercedes car that you don't know the cost only. Sandosh only gifted you the Mercedes car. So can you take that into the books? No. Cost should be measured reliably. It is probable that future economic benefit will flow to the enterprise. Just having the asset is not important. That should give you future economic benefit. Imagine you purchased 1 crore ka machine. As soon as you purchase, no, government banned that machine. Can you show that as machine in the books? No, it will directly go to P&L. When you can't show something as asset, it will go to P&L as expense. Clear? Now, initial measurement of cost, PPE, it will be shown at cost. Now see the first thing, purchase price. What you paid for purchasing, that should be the purchase price, minus trade discount. Ignore cash discount. Why this ignore cash discount? Cash discount will not affect the asset. Cash discount will affect the debtor or creditor. Clear? So directly trade discount minus plus non-refundable duties and taxes. What is non-refundable duties and taxes? Can somebody tell me what is non-refundable duties and taxes? When I purchase the asset, I am going to pay some tax. Let's say I am going to pay some GST. But this GST, ITC is available. So what happens if ITC is available? That time I will claim it back later. So therefore, if it is refundable, don't add. Why to add? It's not your expense only. But if it is non-refundable, if ITC is not available, block credit. In such case, what will you do? That is not refundable. So that means it went from your pocket. It will not come back into your pocket. Therefore, that time you will add it over here. Plus transportation cost. The cost that is required to bring that machine from there till here, that is also part of the asset, added. Handling, loading and unloading cost. Someone unloaded the machine from there and kept it inside your factory. That is also added. Insurance on purchase. From there till here, it is coming on the way. We don't know what is going to happen. We have taken one insurance. That is also added. Plus brokerage to buying agent. One agent was there who helped me find this particular machine. That is also added. These are the things which are added. Just remember one thing. Because you decided to purchase the machine, whatever extra cost was there, everything is added. Self-constructed. That means you only are going to manufacture. Direct material, one chapter of costing. Direct labor, another chapter of costing. Other direct cost in production overhead, another chapter of costing done. 3 chapters of costing. Material, labor and overhead added. Architect is going to draw the diagram and give it to you. That also added. Site preparation cost. Your site is looking like this. Can you construct building on that? No. You have to level that land and then you are going to construct. So that also is added. Installation cost. You have a machinery. You are going to install it. That is also added. Cost of trial run. What is this cost of trial run? After the asset is ready, you can't start using it directly. You want to run it for 2 days and see how it is working. During that time, whatever electricity or etc. you have spent, that is also added. Minus sales proceeds from units during the trial run. You have the machine. Okay, for 2 days, you are simply trying the machine, how it is going to work. Okay, whatever is happening during those 2 days, whatever you are manufacturing, right, you are giving it at a very consistent price. That is going to be considered as income for you. So that is going to be subtracted over here. Then present value of dismantling and decommissioning. If you know already that after 5 years, you have to dismantle this machine. After 5 years, there is already some cost. You can't take that cost over here. So you will take the present value of that cost and add it. Present value of restoration cost. After 5 years, you know, when you remove the machinery, the land will be uneven again. So you have to restore the land to its normal situation. This is like staying in the PG. When giving the PG back, you have to restore it back in the original condition and give. So you know it is in the future. Today you are calculating. So you will bring it to the present and add the present value. Any other directly attributable cost. This is how you calculate the cost of the PPE. Now, items ignored while calculating cost. You have to ignore certain items when you are calculating cost. That you have to remember. Okay, what are the things that you are going to add? Tax, if credit is available. Remember, I told you if credit is not available, it is going to be added. Next, office and selling administration overhead. Office and selling distribution overhead. Is it a direct expense? No. Somebody will be sitting and passing entry. Somebody will be selling some goods. It has no connection with the asset which we are purchasing. Ignore. Abnormal loss. Ignore. If when bringing the machinery, no. some wall was there, directly you scraped it to the wall and brought it, full machinery is damaged, abnormal loss, under your control. Ignore means what? It will not be added to the PP. Whatever cannot be added to PP, where it will go straight to P&L as expense. Clear? Advertisement cost for new product. Imagine you constructed one building. Okay, is building a PP? One new showroom you constructed. Is showroom a PP? Is it a property, plant and equipment? Yes. Now you want to inaugurate this building. To inaugurate this building, what you did? You called Virat Kohli. Okay, you called Virat Kohli for inauguration, and you have to pay 1 crore rupees for that inauguration. Okay, much more than that. It is 1 crore consistent price for us. Okay, so 1 crore we have to pay for that inauguration. Now, tell me one thing. Without calling any celebrity, can we start using the building? Yes. So this is basically marketing. This is basically marketing or advertisement. It cannot be added to the cost of the PP. Interest cost, unless if allowed under AS16. AS16 also we have. Okay. Interest cost. What happens in interest cost? If it is related to a qualifying asset, it will be added to the cost of the asset. Otherwise, it will not be added. So usually interest will not be added. But if at all asset is taking some time for it to be ready, during the construction time, whatever interest is there, that will be added to the cost of the asset. Okay, relocation of staff cost. If I am telling, I am shifting, because you brought one new machinery, I am shifting the staff from that location to this location. Will that be added to the cost of the asset? No. Operating losses, loss and all you cannot add to the machinery. Imagine you purchase new machinery, first 2-3 months you are having loss. That loss you cannot put it to asset. No, it should be taken into P&L. Training of staff cost. You should have hired good staff who know already. After that you are training them. That is just employee benefit expense. It will not be added to asset. Inauguration cost we already discussed. Now income during the construction of PPE. Not directly attributable, transfer to P&L, directly attributable, reduced from the cost of the PPE. So when you're constructing the building, some scrap and all is there that you are going to sell, that you reduce from the cost of the building. When you're constructing the building, outside area is remaining. So you thought, now I don't need that outside area, construction is going on. So I just gave it as parking for some 10 cars. Now is that directly related to the construction? No. That you take it as other income in the P&L, don't reduce it from the construction. Clear? Next. PP acquired on deferred payment. Deferred payment means what? I purchased the asset, I am going to pay the amount in installments. If I am paying the amount in installments, in that installment, interest also will be included. That interest cost will not be added, because AS16 when it comes only it will be added, otherwise it will not be added. Deferred payment, payment beyond normal credit period. Recognition of PP. PP is recorded at normal purchase price. PP is recorded at what? Normal purchase price, which is the cash price. If normal purchase price is not given, present value of future cash flow. If you don't know the normal purchase price, somebody gave you asset, you are going to pay installment. They don't know, we don't know what is the value on it, which is hypothetical situation, not possible. But if you don't know, the standard tells if you don't know the value, you know the EMI that you are going to pay in future. Take the present value of that EMI, that will be the cost. Clear? Interest. Total cash outflow minus normal purchase price. Whatever interest is there, it will be transferred to P&L over the credit period. It cannot be added to the cost of the PPE. Now, sir, with this marathon and revision, exemption is possible? Yes. Revision, that important keyword you have added, revision, yes. Because this is just revision, right? With this marathon and revision, yes, 100% it is possible. You saw the questions, okay? Yes, PP acquired in exchange of asset. PP acquired in exchange of asset means what? I give one PP and I acquire another PP. Now here, transaction has commercial substance. Transaction has commercial substance means what? I have one plant and machinery. I am giving this plant and machinery and I am acquiring one more plant and machinery. I am giving one plant and machinery and taking one more plant and machinery. Now here what you have to understand is, recognize the PP acquired at. Main thing, what is commercial substance? Commercial substance means if I am giving you one bike and taking one more bike in exchange, and that bike also is giving you same mileage as the old bike, then it doesn't make sense, no. It is not having any commercial substance. But imagine I am giving my old bike and I am getting a new bike, and new bike is giving me 5 kilometers extra mileage than old bike. That is called as a transaction which has commercial substance. That means in this exchange transaction, the new asset which is coming, you should give you some extra benefit. Extra benefit always can happen because of two things. What is that? You are getting more units, or your income is increasing, or your old cost is decreasing. Either cost is decreasing or income is increasing, which will be determined as extra benefit. Now, fair value of asset given up. Now you want to recognize the PP, no? what will you do? Old asset, what value you gave up, that asset ka fair value. Fair value means what? Existing value today. That value only will be taken as the value of the new asset. Or what will you do? Fair value of the asset acquired. New asset, what you are taking, what is the market value of that asset, that you will take. If both are not available, what to do? Carrying amount of the asset given up. WDV of the asset which went will be taken as the value of the asset which is coming in. Now, transaction lacks commercial substance. Commercial substance means what? You are giving and no extra benefit. You are exchanging, you are getting, but same benefit you are getting. That time, carrying amount of asset given up, no loss or gain. If there is no extra benefit, you cannot calculate profit or loss on this transaction. So what is there in the books, that only will continue. Now, PP acquired, exchange of asset, journal entry. PP acquired in exchange and cash is given. When you exchange only asset, no, sometimes you have to pay money also, the differential amount. So PP account debited, above amount. Above amount means what? What you decided above? Fair value of the asset given up, fair value of the asset acquired, or the WDV of the asset given up. So that amount plus cash. Imagine you are paying 10 rupees cash. The above amount what you decided was 100. 10 rupees cash you are going to pay. So now 110 will be the value of the asset. To cash 10, to asset 100. The asset which went, old one. Okay, it can be 100. If at all it is not 100 and it is anything else, the profit or loss will go to P&L. Now, if PP is acquired and exchange and cash is received, if they are giving us cash, then whatever value you are determining for the asset, you are getting money, right? So from that asset, remove the money amount and only the net amount will be taken as the asset. Cash account debited to asset account. Clear? Now note, has commercial substance means what? PP acquisition affects cash flow of the entity. Cash flow when it can affect only if there is extra benefit. Lacks commercial substance means what? PP acquisition doesn't affect the cash flow of the entity. Clear? In AS10, one more thing that we have is depreciation. Depreciation is also part of AS10. Start. When will depreciation start? When the asset is ready for use. Put to use is irrelevant. In direct tax, put to use is irrelevant. In direct tax, put to use for more than 180 days, less than 180 days is what we are going to see. But here we don't care about put to use. We care about ready for use. Asset is ready, depreciation starts. Component wise depreciation. What is component wise depreciation? You have a car. So if you are having a car and there is engine. Okay, so now if there is engine, what will happen? Earlier, full car was taken as 1 unit. Now, AS10 is giving you benefit that if you want to do, you can do component-wise depreciation. That is, tire, let's say 2 years useful life. Engine, let's say 10 years useful life. Body of the car, let's say 4 years useful life. Like this, if you want to do component-wise, break it down into smaller parts, and if you want to calculate depreciation, that is allowed and that can be done. Now, land, there is no depreciation. Building, always there is depreciation. End. When will the depreciation end? PP is sold. Obviously, depreciation will stop. We saw this in depreciation topic itself. Or PP is held for sale, whichever is earlier. Held for sale means what? I am selling this calculator. If I am selling this calculator, when I sell this calculator, depreciation on this calculator will stop. Or I took this calculator and kept it in the side and told I want to sell this calculator. I will use a new calculator from today. That means, am I using this for the business? No. That time only depreciation will stop. Whichever happens first, that time depreciation will stop. Methods of depreciation, you have SLM, WDV, units of production method. Multiple methods we saw in depreciation unit, that is for sole proprietor. Accounting standard applicable for companies. So here only these 3 methods are used. Change in method of depreciation. Prospective effect. What is prospective effect? You will change the method of depreciation only from the date, only from that day you will follow the new method. You will never give retrospective effect. That means just because you change the method of depreciation today, 10 years ago what depreciation was there, you will not start changing that. Okay, considered as change in accounting estimate. Component accounting. Component means part of the PP with significant cost, depreciation to be charged for each component. We already discussed the component wise that in that car example. Subsequent measurement of PP. How will you show the PP? You can always show it at cost model. If it is at cost, no problem. Or you can use the revaluation model. That means you can revalue the assets. When you are revaluing, simple. If you increase the asset, what will happen? You will credit the revaluation reserve. Not revaluation account, revaluation reserve. What is revaluation reserve? Not the revaluation account which we saw in partnership. In partnership, we open a temporary account called as revaluation account and profit or loss is transferred to partners. In the books, after admission, after retirement, after death and all, when we saw the balance sheet, no. In that balance sheet, did we see revaluation account? No. It was already empty because we transferred the profit to partners. Now, this is revaluation reserve. After revaluation, it will be shown as reserves and surplus in the balance sheet. Clear? This is for companies. Don't interconnect the topics to everything that we saw till now was sole proprietor. Now, or partnership or any other than companies. Now, decrease. If the asset value is decreasing, now don't tell me, oh sir, asset value was increasing. No, that time we put the profit to revaluation reserve. Asset value is decreasing. Now I will debit it to revaluation reserve. There should be revaluation reserve. No, there should be a reserve note to debit it. So now debit it to P&L. Clear? Increase, credit revaluation reserve. Subsequent decrease. What does it mean? Once you increased it, now the value after 2 years is decreasing. That time debit revaluation reserve. How much is there? Only that much. Extra whatever is there, that you are going to debit to P&L. That you are going to debit to P&L. Decrease will be debited to P&L. Now subsequent increase. Subsequent increase means what? You debited to P&L. Subsequently, if the asset value is going up, last time there was loss, no. Asset value went up is profit, no. Put that profit back to P&L. How much loss you created, that much you recognize. Okay, credit P&L, and after that extra profit what you get, that always credited to revaluation reserve. Revaluation to be made for the entire class of assets. What does it mean? This class of asset concept is exactly like the block of asset which is there in DT. Block of asset means what? Group of assets which are having similar depreciation rate and similar function. So same thing here also. One group of assets are there. There you don't put the revaluation for only one. You have to revaluation or you have to revalue all the assets in that group. Now, building, when I tell, I have two types of building: factory building, office building. Office building I am doing revaluation. Factory building I am not doing. Is it fine? Yes. But in factory building, I have 3 buildings. One I am doing revaluation, 2 I am showing at cost model. Is it fine? No. Clear? In a group, you should apply it for the entire group. Building is not a group. Factory building depreciates faster, office building depreciates slower. That is why they are separately categorized. Even when you're talking about vehicle, commercial vehicle is different, passenger vehicle is different. Clear? That is your accounting standard. Biological assets. Now, there is one small concept called as bearer plant. Okay, bearer plant. Imagine you have one tree and in that apples are growing. Okay, now this apple is used, here only you have one factory, and this apple is used in the factory for production of apple juice. Clear? Now that time they are allowing that this tree can be taken as bearer plant. That means it can be taken as property, plant and equipment. Now, but the thing is what, when you take this as property, plant and equipment, you need to measure it at cost. That means whatever you have spent, you have to keep a track of that. And one point they said, the plant itself should not be sold. That means the tree itself should not be sold as a product. That means, will you cut the tree? Only in the case of end days, when the tree is not giving you, that means a scrap sale, that is fine. So basic things like palak, all those things, what you'll do, you'll cut and that only you'll sell. No, that is not possible with this. So bearer plant can be there. Other than that, biological asset, that is livestock and all, is not taken as asset itself. Okay, now AS11. Effect of changes in foreign exchange rate. Effect of changes in what? Foreign exchange rate. Now this standard has 3 parts. Part 1, accounting for foreign exchange transactions. Then converting financial statements of foreign operations. Converting financial statement of foreign operations, that we saw already in branch accounts, foreign branch part. Now part 3, accounting for foreign exchange contracts, which are called as forward contracts. Okay, 3 parts are there. In that we have to cover part 1 and part 3. Part 2, fresh, we have just covered in branch accounts, foreign branch. How to convert the foreign branch trial balance into home currency. No.
Yes, AS11 now. Let's start with AS11. There are certain terminologies that we have to understand and remember. Okay, first one, reporting currency. What is reporting currency? It is the currency of the country whose financial statements are reported. For us, it is Indian National Rupee. Foreign currency, currency other than reporting currency, which we saw in branch accounts also. Exchange rate, it is the rate at which two currencies are exchanged. From foreign currency to home currency, if I tell $1 is equal to 60, which is very imaginary figure right now, but okay. Forward rate. What is forward rate? It is a predetermined exchange rate for settlement at a future date. Today only if I am telling, after 3 months, I will come and I will buy dollars from you. Today you agreed that okay, I will give it at 100 rupees. Fine, this is a rate which we have agreed today. Clear? Closing rate, exchange rate as a balance sheet rate. Monetary items. What are monetary items? Items which can be expressed in terms of money. That means assets to be received, liabilities to be paid, which are fixed and determinable. Cash, bank balance, debtors, creditors, etc. Non-monetary items. What are non-monetary items? Assets and liabilities other than monetary items, that its value is not fixed and determinable. Fixed assets, inventory, investments, all are non-monetary items. First we saw it in branch accounts and we came over here. Accounting of foreign currency transactions. You have to be a little careful. How to account for foreign currency transactions? Meaning, transaction in foreign currency. First, there is one point called as initial recognition. What is initial recognition? Just now I purchased it. I want to recognize it, but I purchased it, let's say, at $10,000. How will I recognize it now? Convert it from $10,000 into rupees based on the rate that is applicable today. So initial recognition in foreign currency is to be recorded in reporting currency in the books of accounts. Rate to be considered, rate at the spot exchange rate, that is rate prevailing on the date of transaction. Today whatever rate is there, at that rate we'll convert that dollar into rupee and record it in the books. Now subsequent measurement, valuation on balance sheet date. What is this valuation on balance sheet date? There is possibility that few transactions still outstanding on balance sheet date. What are the transactions which are outstanding on the balance sheet date? Debtors, creditors, loan and all, if it is outstanding on the balance sheet date. Now following treatment to be done. Monetary items, apply closing rate and restate the amount. Monetary items. What are monetary items? Debtors, creditors, loan and all, if it is there, restate it. Because imagine I took $10,000 from you. On balance sheet date, rate has gone up. Does it mean that I have to spend more money to return that $10,000 to you? So therefore, restate it. Non-monetary items, if items are shown at historical cost, show at original cost only. So if you have fixed asset and all, it is shown at historical cost, ignore it, let it be at that value itself. But if items are carried at fair value, that is basically stock at all, it's carried at fair value, then apply closing rate and restate the amount. Treatment of exchange rate difference. Exchange difference can arise due to during and whatever is there, it transferred to P&L. But how can the exchange rate be there? Initial recognition at one rate and restated at different rate. So initial recognition and balance sheet date. Another that what can happen? Initial recognition immediately settled. So initial recognition and settlement, different rates. Or balance sheet date we did something, restating we did something, and the settlement date the rate has changed. So difference between the balance sheet date and settlement date. Now note, MCA notification. One small notification is there, can be asked in MCQs. If exchange difference arise on long-term foreign currency, you took loan, that is a long-term foreign currency, monetary items which are related to acquisition of a depreciable asset. Difference can be added or deducted from the cost of the asset. It is an option, not compulsory. So what we are trying to tell over here, if exchange difference is there because of long-term non-monetary assets. Now exchange difference usually goes to P&L, but you're taking loan and buying depreciable asset. What they told is, because you're taking loan and buying depreciable asset, you can add it to the asset or subtract it from the asset. Forward exchange contract. Forward exchange contract is a very small point. Now, not much is discussed over here. They just told you about forward exchange, what it can be used. Don't worry, when you go to your CMA final, there is a topic called as SFM. Full subject we will be discussing much about forward exchange contract. Now, done due to fluctuation risk in exchange rate. Hedging. What is hedging? Protecting yourself from risk. You know that you have to pay your creditor after 2 months $2,000. So you are scared that the price will go up. So today only you entered into a contract with them. Okay, this is the process to reduce the losses. Spot rate minus forward rate. You agreed for a rate. If there is profit or loss, okay, recognize it today itself. Over the life of the premium or life of the contract, you'll recognize 2 months are falling into this year, 1 month is falling into next year. What will you do? 2 months profit you'll recognize here and 1 month profit will recognize in the next period.
Hello, sir. Instead of coming to class, sitting online and telling hello, okay. Yes, let's continue. On cancellation of the contract, profit and loss should be recognized. Speculation. Now, what is speculation? I don't have anything to pay to anyone, but I know that foreign currency rates will be fluctuating. So simply I entered into forward contract thinking that I can make profit. So whenever if you make profit, that time you recognize. If there is loss, recognize. Not a process to reduce losses. Attempt to make profit using changing rates in the market. Premium or discount on the contract is ignored. On maturity of the contract, profit or loss to be ignored. Clear? This is the situation. Now, AS12. The next accounting standard that we are going to see is accounting for government grants. It's a very simple standard that is there. Now, meaning, what is government grant? Help that you're getting from government. It's also called as subsidy. Government grants are grants which government gives to certain entities. Is it given to everybody? No. For some people only who are eligible for it. Obviously, if you are eligible, will they come searching for you and give you? No. Okay, you have to apply for it based on some preconditions. Fulfill some conditions, apply for it, take the grant. Now, non-applicability, government assistance other than government grant. Government is helping you, but not by giving you money. Government is telling, don't pay tax for next 3 years. This is the assistance that they are giving. They are not giving you any grant. That will not be applicable over here. Government participation in the ownership. What is government doing? Government is telling, boss, take the money, give me shares. That became government company now. So that is not considered over here. Types of grants which we have. Bailout grant. Bailout grant means what? Government is trying to bail you out. Bail you out of what? Trouble. So bank account debited to P&L account. You are in loss. Companies grant given to companies who are under loss. Okay, you are under loss. So what will happen now? To pull you out of loss, government is giving you money. So bank account debited to P&L. Next, income grant. What is income grant? In the nature of reward. You are doing good, so I am going to give you a gift. So that time what happens? This is also benefit for you. It will go to P&L. Bank account debited to P&L. Expense grant. Expense grant means what? They are not giving you just like that. They are telling, take this, use this only to pay your rent. So now what happens? To meet specific expenses. Until government grant is not used, show it as liability. Don't you think it's an advance that you got? So when you get the money, you will pass the entry bank account debited to deferred government grant as a liability. You will keep it aside. Then later when you spend the money, you will pass the entry expense account debited to bank account. Expense account debited to bank account. Then what will you do? P&L account debited to expense account. You will pass the entry P&L account debited to expense account. Later what will you do? Now this expense should not go from your pocket, no, because government has given you money. You will pass the entry deferred GG account debited to P&L account. Now the P&L debit and P&L credit offset each other because government gave you the money. Next, non-monetary grant, asset received free of cost. Government gave you asset for free, but still show the asset in the books. But at what value you can show? You cannot show it at market value and all. You will show it at a nominal value of 1, 10, 100. Just bring the asset into books and asset account will be debited. Capital reserve will be credited. If you don't record this even at 1 rupee, then the asset will not come into books itself. Non-monetary grant, asset received at concessional rate. If asset is received at concessional rate, what will happen? Record at concessional rate. Whatever the price is there, record it at that price. Grant received as promoter's contribution. If the grant is received as promoter's contribution, what will you do? Credit it to capital reserve. You will credit it to capital reserve. Grant for depreciable asset. Method 1. When it is depreciable asset only, there is a twist. There are 2 methods. Method 1 is whatever you receive, reduce the asset. Method 2 is whatever you receive, don't reduce the asset, keep it separate as a deferred government grant. Now, method 1, bank account debited to asset account, depreciation to be charged on the balance value. Method 2, what you're going to do, bank account debited to deferred GG. That means, imagine cost of the asset is 100. Okay. And government grant received is 40. And scrap value is 20. Scrap value is 20 and we are taking useful life as, let's say, 4 years. Useful life is 4 years. Now tell me one thing. First, when I get the asset, what I'll do? I'll pass the entry. Sorry, we'll start from asset itself, not the grant. First, when I purchase the asset, what I'll do? Asset account debited 100. Asset account debited 100 to bank account 100. Then I got the government grant. Under method 1, I'll record first. When I get the government grant, what I'll do? I'll pass the entry bank account debited. Bank account debited 40 to what? Asset account. Bank account debited 40 to asset account. I'll reduce the asset itself. Now, after that, you have to understand one thing. Depreciation will be there every year. So, depreciation account debited to asset account. Depreciation account debited to asset account. Cost of the asset was 100. From that 40 I got from the government itself, and the scrap value is 20 divided by how many years? 4 years. So 100 minus 40, 60, 60 minus 20, 40. So 10 will be the depreciation for each year. And you know the depreciation will go to P&L. So the next entry will be P&L account debited to depreciation. Now imagine you are following method 2. Method 2, when you're getting the money, you will write bank account debited 40 to deferred GG. Bank account debited 40 to deferred GG account 40. You'll keep the money asset. You'll not touch the asset itself. Now, what will be the depreciation then? Depreciation account debited to asset account. That time you will do 100 minus. You received government grant, but you did not reduce it from the asset. So 100 minus 20, that is the scrap value, divided by 4 years. 80 divided by 4 years, depreciation will be how much? 20. Now what will you do? 20 is the depreciation, but this deferred GG, what will you do? Every year you transfer little to P&L. So you'll pass the entry deferred government grant account debited 10 to P&L 10. How 10? 40 divided by 4 years. 10 will be transferred to P&L. Now see the net effect. Here also the P&L was debited for how much? Depreciation 10. Now here what happens? Depreciation became 20, but P&L got an income over here 10. So net effect on the P&L will still be 10. This is how it works when it is a depreciable asset. Now the next thing that they can test you in government grants is refund of government grants. Refund of government grants, what happens? To be treated as extraordinary item. Refund is to be treated as what? Extraordinary item, because it is not normal. You getting the money from the government is normal because you are supposed to get it. If you are not following rules and you have returned the money to the government, that is considered as extraordinary item. Reversal of the above treatment in the case of refund. Whatever you did above, no, that only will be reversed. Imagine you had credited the P&L, now you will debit the P&L. If capital reserve was credited, now you will debit capital reserve. If grant was deducted from the cost of the asset, you deducted it from the cost of the asset, now you add it back to the cost of the asset. But if the grant was credited to deferred government grant, now you will reverse the deferred government grant to the extent available. Now imagine you got 40, you put it into deferred government grant. First year you remove 10 and put it to P&L. Second year you remove 10 and put it to P&L. Third year you remove 10 and put it to P&L. Now fourth year you are supposed to refund the government grant. Now can you take 40 from deferred government grant? No, there is no 40 in deferred government grant. So what will you do? 10 you take from here, 30 you take from P&L. Clear? Yes, that is your standard. We'll go into the next accounting standard, that is 16, borrowing cost. Next accounting standard, that is borrowing cost. I think after AS 16 we have AS 22. After that we have AS 19, which is leases. Leases AS 19. So with that we should be done, and then we should solve all the examination questions which are there. Yes, AS 16, borrowing cost. What is this borrowing cost? Borrowing cost is cost of borrowing. Okay, you took loan, along with loan, whatever extra charges came, that also is borrowing cost only. For example, interest you have to pay, that is borrowing cost. When you took the loan, you have to pay some processing charges, that is borrowing cost. You have to pay the agent commission, that is borrowing cost. Then you are closing the loan early, pre-closure charges, that is borrowing cost. You are paying penalty, that is also borrowing cost. Now, borrowing costs are interest and other costs incurred by an enterprise in connection with the borrowing of funds. Rule. Understand the rule over here. Borrowing cost related to qualifying asset to be capitalized till the asset is ready for use. Which borrowing cost? Borrowing cost related to qualifying asset only to be capitalized till the asset is ready for use. What on earth is this qualifying asset? Asset which takes time to be ready for its intended use. Now, an asset that necessarily takes substantial period of time to get ready for its intended use or sale. Asset is taking time. That is, if you are constructing building, that is qualifying asset. If you purchase the building, it is not qualifying asset. Asset is already ready. If you are manufacturing the, let's say, one plant and machinery, that is qualifying asset. If you are constructing the, if you are buying the plant and machinery, that is not qualifying asset. Now, borrowing costs are capitalized as a part of cost of qualifying asset when it is probable that they will result in future economic benefit. They are telling you are constructing one building, interest on loan is there, add it to the building only when you are sure that building will give you future economic benefit. If imagine what you are constructing that is not going to give you future economic benefit, then why you are going to add more and more things to that asset? Now, Other borrowing costs are recognized as an expense. You know that when AS 16 is not there, whatever borrowing cost is interest. Interest on loan will always go to P&L. Now, borrowing cost eligible for capitalization. Now, simple. If the borrowing cost is on qualifying asset, capitalize. Other than qualifying asset, it will be debited to P&L. Okay. Now, commencement of capitalization. What is commencement of capitalization? Commencement of capitalization means when can we start capitalizing? When can we start capitalizing? You can start capitalizing when three conditions are to be fulfilled. First one, all below conditions satisfied. Expenditure for acquisition, construction, production of qualifying asset is being incurred. That means building is getting constructed. Building should be constructed. It is going on. Construction is going on. That means on that you are spending money. That is the first condition. Borrowing cost should be incurred. Building you are spending money, but there is no loan only. What will you capitalize? So first loan should be there. Interest should be being incurred, and then expenditure should be being incurred. Now that time you can capitalize it. Now the third point you see, activities that are necessary to prepare the asset are in progress. That means expenditure over. Then suddenly you had one land. Someone came and told that is my land. So because of that, what happens? Some legal battle you are having. Because of that legal battle, you can't continue the activities only. If you can't continue the activities, the capitalization of borrowing cost will stop there itself. If you can't capitalize, borrowing cost will not stop. Only capitalization stops. So that borrowing cost will go to P&L as expense. Now, suspension of capitalization. Suspension means what? Temporary stop. Someone is telling hello. Yes, hello. Good morning. Yes, borrowing cost may be incurred during an extended period in which activities necessary to prepare an asset for its intended use or sale are interrupted. What are they telling? Now you are having one building. Okay, you are having one building. Construction is going on and work is interrupted. That is not under your control. Something happened, some heavy cyclone or something for 3 months. Because of that, you can't continue the work itself. That time, capital loan will not stop. No, loan will be there. So interest on loan will still be there. Don't capitalize it. Take that interest to the P&L. Clear? Such costs are cost of holding partially completed asset and do not qualify for capitalization. They are telling now what you are paying is for holding this under construction building. This is not for constructing the building. Now, capitalization of borrowing cost is not normally suspended during the period substantial technical and administrative work is being carried out. That means what did you do? Heavy cyclone. So what you did? You stayed inside the building only. Inside the building you did painting. Full 3 months you were doing painting, all painting work you finished. Now you're doing some work, no. So capitalization will continue. Sometimes when you're constructing, it is part of the process to stop. When you're constructing asset, after some slab and all is over, can you construct like that only? No, slab will fall that time. So some 30 days, remember people will be putting water and all to the wall. That is part of the process. So therefore, capitalization of borrowing cost is also not suspended when a temporary delay is necessary part of the process for getting that asset ready for its intended use or sale. Now, cessation of capitalization. What is cessation of capitalization? When can it stop? Capitalization when it can stop, cease. When it can cease. Capitalization of borrowing cost should cease when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are completed. That means, basically, in short, if I have to tell you, when I will stop, when the asset is ready for its use. When the asset is ready for its use, that time capitalization will stop. Now, types of borrowing. Two types of borrowing I have: specific borrowing and general borrowing. What is specific borrowing? That means loan was borrowed for this only. That means whatever borrowing cost is there, add it. If it is general borrowing, what is it? Loan was borrowed for so many things. In that, one of the thing is this qualifying asset. How much is apportioned to that? That only you take. But imagine I have two loans, 2 lakh at 10%, which is 20,000. And I have one more loan, 4 lakh at 5%. That is also 20,000. Now what will I do? How much money I have spent on qualifying asset? I will apply the weighted average rate. So 20 plus 20 becomes 40, and this loan is 6 lakhs. So 40,000 divided by 6 lakhs gives you 6.67%. So you will take the 6.67% and multiply into how much money you have spent on the qualifying asset. That time you will get the amount of borrowing cost to be capitalized. Whatever borrowing cost you cannot capitalize, if you can't capitalize something, that will always be debited to P&L. Clear? For general borrowing only, you have to calculate this weighted average rate of borrowing. Now, next, small, sweet and simple standard. AS22, accounting for taxes on income. Accounting for what? Taxes on income. Now, this standard, by the way, this standard direct connection with tax you have. So, some of the things you have to know tax to understand this particular standard. This standard prescribes the accounting treatment for taxes on income and follows the concept of matching the tax and revenue. Timing difference and permanent difference. Two things are there which are very, very critical over here. Now in income tax, we follow so many deductions and all. Those deductions are not available sometimes in accounts. Or in accounts, whatever expense is there, you will subtract. But in income tax, it will be like you can take this expense only next year. Or you didn't pay the TDS on time, so you cannot take the expense in this year. All this can happen. This will create a difference. If at all the difference is getting created today, but it will get reversed in the next year or the year after, that is called as timing difference. If the reverse is getting, if the difference is getting created today, but it is never going to reverse, that is called as permanent difference. Permanent difference, we are not going to bother on in this particular standard. We are only focused on timing difference. Only timing difference will create deferred tax asset or deferred tax liability. Now, taxable income sometimes significantly differs from accounting income. Tax income and accounting income are different. One simple, basic thing we know already: depreciation. As per account something else, as per taxation something else. There is a concept called as additional depreciation in taxation that is not there in accounts. Extra 20% you'll get in the first year. You're not going to get that. You'll follow uniform method over here. Then in taxation there is some 43B, section 43B in taxation. That means if you pay the interest before the due date for filing the return of income, you will get it in this year. If you miss it, you will get the expense in next year. Clear? List of expenses are given in 43B, where if you pay within the due date for return filing, you can still claim in this year. If you don't pay, you will pay in next year. Now, for example, there is also a section where they tell that if TDS is not, tax is not deducted when making payment, then it will be disallowed. It will be allowed when next year when you make the payment. But in accounts, all those things are not there. Expense are, you will record the expense. Simple. So this can create a difference. This is called as timing difference. Firstly, there are differences between items of revenue and expense as appearing in the statement of P&L and items considered as revenue and expense for the tax purpose known as permanent difference. Permanent difference and all you are going to ignore. Why? It will never reverse, so there is no point of accounting. Secondly, there are differences between accounting in respect of a particular item of revenue or expense as recognized in the statement of P&L and corresponding amount which is recognized known as timing difference. Both we have to learn. Timing difference and permanent difference. Definition. First one, accounting income. What do you think accounting income is? What you are seeing in your financial statement. Okay. Net profit or loss for the period as reported in the statement of P&L before deducting income tax or adding income tax saving. Obviously, this is nothing but PBT. Why? Tax now we are calculating in this particular standard. Taxable income. Taxable income, where do you find? As per income tax laws, the total income in your computing, whatever you get, that is taxable income. Is the amount of income or loss for a period determined in accordance with tax laws based upon which income tax payable or recoverable is determined. Now, tax expense or tax savings. Tax expense means what? You have to pay. Tax savings means what? It's a refund situation. Is the aggregate. This is basically current tax plus or minus deferred tax. Current tax plus or minus deferred tax. Current tax means what? Amount of income tax determined to be payable or recoverable in respect of taxable income for a period. Okay, it is determined to be payable or recoverable. Now, deferred tax means what? It is the tax effect on timing difference. Deferred tax is the tax effect on timing difference. The difference between taxable income and accounting income can be classified into permanent difference and timing difference. Timing difference is what? Difference which create in one period but it will reverse in another period. Originate in one period and are capable of reversal in one or more subsequent periods. Permanent difference means what? Difference will get created today, but it will never get reversed in the future at any point of time. Originate in one period, do not reverse subsequently. Recognition. Tax expense for the period comprising of current tax and deferred tax should be included in the determination of net profit or loss for the period. So when you're calculating tax expense, when you're calculating profit, tax should be there in your profit calculation. Clear? Now, permanent difference do not result in deferred tax asset or deferred tax liability. If there is a permanent difference, that will not create deferred tax asset or liability. What will create deferred tax asset or liability? Only timing difference. Tax effect of timing difference are included in tax expense in the statement of P&L and deferred tax asset or deferred tax liability in the balance sheet. Now, simple. The rule is very simple. If accounting income, as per accounts, income is more than taxable income. Okay, therefore you are paying less tax. If you are paying less tax, that means today less tax, in future there will be more tax. In future you are going to pay more tax. In future, if you're going to pay more tax, that is a liability, that will be deferred tax liability. When it reverses, deferred tax liability gone. But if at all the situation is ulta, that means as per taxation, income is more. If income is more, that means you are going to pay more tax. And today, if you pay more tax in future, you will pay less tax. In future, if you're going to pay less tax, good, that is deferred tax asset. Deferred tax assets are created when tax as per IT is paid more than tax as per accounting. As per tax IT, it is more. That means today you pay more, in future it will get reversed. Deferred tax liabilities are created when tax as per IT is paid less than the tax as per accounting. Tax expense is always current tax plus or minus deferred tax. Now, reassessment of unrecognized deferred tax asset. Deferred tax, they told one thing. Now, you're telling deferred tax asset. What is deferred tax asset? If you pay more today, in future I will get to pay less tax. In future, for you to pay less tax, there should be taxable income, no? If in future there is no taxable income only, then what less tax are you going to pay? So they said one thing, follow prudence. Whenever you are going to recognize deferred tax asset, if you feel in future there is no income, don't recognize that deferred tax asset itself. Now, you did not recognize this year because future was little doubtful. Next year when you are recognizing, you feel there is future you are going to get some profit. That time whatever deferred tax asset which was not created, no, reassess that. At this every balance sheet date you are going to reassess. Next year if you feel income is there, that time recognize the deferred tax asset. Now, at each balance sheet date, an enterprise reassesses the unrecognized balance sheet deferred tax assets. Enterprise recognized previously unrecognized deferred tax asset to the extent it has become reasonably certain. To the extent that it become reasonably certain. Now you feel there is income, you recognize the deferred tax asset, as the case may be that sufficient future taxable income will be available against which such deferred tax asset can be realized. Clear? Now, measurement. Simple. One rule you have to remember. Current tax, you will follow current rate. Deferred tax is for future. No. So you will follow the newly enacted tax rates which are applicable for the future. Now, current tax should be measured at the amount expected to be paid or recovered from the taxation authorities using applicable tax rate and tax laws. Deferred tax asset and liability are usually measured using the tax rate and tax laws that have been enacted. That means the future rates. Deferred tax asset and liability should not be discounted to the present value. Don't worry, it's in the future, but present value concept is not applicable over here. Offset DTA and DTL. Can you offset DTA and DTL? Yes, you can offset DTA and DTL because usually we are preparing for the same business. Notes. Tax holiday. What is tax holiday? You don't have to pay tax. Now imagine tax holiday is there for 1, 2, 3 years. That time whatever deferred tax is getting created in this 3 years and it is getting reversed also in this 3 years, don't bother about it. Whatever deferred tax is getting created and it is reversing outside the tax holiday period, that only you are going to create. What is minimum alternative tax? MAT. What is MAT? It's like the income tax AMT which you have. Alternative minimum tax is there. MAT is applicable for companies. Now what government is telling, they're playing a smart game. They're like, you have loss. Wait. I'll calculate profit in a different way, which is called as book profit. On book profit, how much tax you have to pay? This much. Okay, now you have to pay this tax. Even though you have loss, you have to pay this tax. But in future, whenever there is a situation that your actual tax is more, MAT is less. That I remember that you paid extra in the past, that I will give you as MAT credit. This also can be asked, which is a little rare, but it can be asked. Now, one more thing that can be asked, I want to tell you, there is a concept in income tax called as carry forward and set off of losses. Now, if you set off, what will happen? Imagine you have loss of 1 lakh. You can carry it forward. That means you will create deferred tax asset. Why you will create deferred tax asset? Because when this loss is carried forward, in future it will get set off with your income. That means in future you have to pay less tax. Yes. The last thing that we have to discuss is AS19 lease. After that, we'll start solving problems. They didn't call it as AS19 in the study material. They just told leases. That's it. No. Yes. AS19 guys, lease basically, it's not defined as AS19 in your material. Leases. Lease is an agreement whereby lessor lets out its asset to lessee for receipt of periodic lease rental. Lease means what? Lessor is person who is giving the asset on lease. He is giving it to whoever wants to use it. Okay, this is called as lease. Includes even hire purchase agreements. Now, finance lease means what? Finance lease, it is usually all risks and rewards of ownership are substantially transferred. That means even though I am the owner, you are enjoying the asset more than the actual owner. So indicators of finance lease are there, which can be asked as a theoretical question. Indicators of finance lease: transfer of ownership of asset to lessee at the end of lease term. Okay, lessee has the option to purchase the asset at the end of lease. Two things: automatically after the lease is over, it becomes yours, or automatically no, after the lease is over, you get a chance to buy that asset. Now, lease term is for major part of economic life. Life of the asset is 6 years. Out of that, 4 years are given on lease. That means majority part who is enjoying? You. So that will be considered as finance lease. At beginning of the lease, present value of lease payment recovers substantial portion of the asset. That means I am saying, oh, today the market value of the asset is 10 lakhs. Lease rent that I am paying is this. If I calculate present value of that lease rent, no, it is coming up to 9,50,000. That means almost it's like I am buying the asset only. So it will be considered as finance lease. Leased asset is of specialized nature. That means specialized nature asset. Nobody can use it other than this. If you return it, that is waste for me. I'll scrap it and sell it. Operating lease is other than finance lease. What you're staying in PG, no, that is operating lease. That is not finance lease. Accounting treatment for finance lease. In the books of lessee, initial recognition. Lessee is whom? The person who gave the asset or person who took the asset? Person who took the asset. Lessee. Now, recognition of leased asset and corresponding liability will be made as follows. So, what you're going to do when you take the asset on lease? Okay, wait, we'll see if there is a charts for this, which makes it simpler. Yeah, lease. We'll read from here. Yeah, sale and leaseback also we have to understand because there are some questions on sale and leaseback. Yes, we'll read the lease part from here so that it becomes simple. Now, lease. Long-term rental contract. Finance lease, operating lease. Two things are there. Okay, lessor is the one who gave the asset, lessee is the one who took the asset. Finance lease, when substantial risk and reward of ownership is transferred to lessee. See, at the end of lease term, lessee becomes owner. At the end of lease term, lessee has the option to buy the asset. Major portion of the economic life is covered by lease. Present value of minimum lease payment is almost equal to fair value of the asset. Asset is of specialized nature. This we already saw. Finance lease. When we are talking about finance lease, lessee has to record the asset. No, they are not asking journal entries in lease usually. They are just asking values. So lessee has to record the asset. What will lessee do? Lease rent. Lease rent what I am supposed to pay plus guaranteed residual value. What is this guaranteed residual value? Guaranteed residual value means lessee is telling, boss, 5 years I'll pay lease rent. After 5 years, no, you know what I have to do? You give me that asset. I'll pay you 30,000 for that asset. So whatever lease rent I'm paying for 5 years plus the 30,000 that I have agreed to pay you, that is called as guaranteed residual value. That is what is the value from lessee's point of view. From lessor point of view, how will he calculate? Lease rent, he'll get the lease rent plus guaranteed residual value. Whatever this fellow guaranteed, he will get it. Plus, what is there? Unguaranteed residual value also. Sorry, guaranteed residual value by others also is there. This fellow also has guaranteed. Somebody else also has guaranteed. Imagine there are 3 houses. 1, 2, 3. There are 3 houses. Now, what happens when there are 3 houses? Okay, 3 houses also are given on lease. When 3 houses are also given on lease, this person told at the end of the lease term, this person told at the end of lease term, 1 house I want. So, guaranteed residual value by whom? The lessee. Then one more house, some random person who is there, that fellow told, don't worry, when the lease gets over, come to me, I will buy that house. So, guaranteed residual value by whom? Outsider. Then there is a third house which nobody has given any guarantee. That is called as unguaranteed residual value. Now, accounting you have to understand. In the books of lessee, in the books of lessor. In the books of lessee. For lessee, what is happening? Asset is coming in. Asset account debited. Did you pay a single rupee? Did you pay a single rupee? No. So, lease account credited. That means it's a liability. This will be recorded at what value? Fair value of the asset. That is today's value. That is obviously given in the question only, fair value of the asset. Or present value of MLP from lessee's point of view, present value of minimum lease payment from lessee's point of view. How will you get the minimum lease payment? This is the minimum lease payment from lessee's point of view. Take the present value of that. Whichever is less will be considered as the value of the lease. Clear? Next, what we are going to see in the books of lessor. For lessor, what is happening? Asset is going out and a receivable is created. Lessee is a receivable person for the lessor. So now recorded at what value? Recorded at present value of gross investment. What is gross investment? Gross investment is minimum lease payment from lessor point of view, which we saw over here and kept it. This is the minimum lease payment from lessor point of view, plus unguaranteed residual value, other scrap value, which nobody guaranteed, but we know somebody will pay the money. Now the next thing what you have to understand, at the end of each year, what will happen? For lessee, it is interest expense. For lessor, it is interest income. If they ask, just remember this. Usually they don't ask this part, they ask only computation. Now, every year what will happen? Lessee will pay the rent, so that's why bank account is credited. Lessor will get the rent, that's why bank account is debited. Depreciation is only in the books of lessee. This is what we were discussing in AS1, that is substance over form. Who is the owner? Lessor. But who is charging depreciation? Lessee. Clear? Interest and depreciation are expenses which are going to P&L, and this fellow interest is an income which is going to P&L. Now one more topic is there in lease, that is sale and lease back. Okay, they can ask sale and lease back over here. Now see what happened over here. SRH and CSK is there. Now you sold one asset. Okay, then you're taking that same asset back on lease and you're paying lease rent. What is the logic? Suddenly you needed money. Okay, suddenly you needed money. You don't know what to do only, but you have a building. You sold that building only. With the condition you sold that building, telling that I'll sell the building to you, but without the building, what I'll do? I can't do business on the road, no? So I need the building. So I told you, I will sell the building to you. You give me money. Then I will take that building only back on rent. Sale and lease back, they can ask question. What they ask, profit or loss on sale. Profit or loss on sale. Usually they ask operating lease, but we'll cover both. If it is finance lease, now see, sir, why are we discussing profit or loss on sale in lease? Profit or loss on sale should be covered in AS10 PP. If you sell the asset, profit. But this profit or loss on sale is not a normal profit or loss. Here the profit or loss is happening because of what? You are selling with the condition that you will take it back on lease. If the lease back is finance lease, then what you will do? Amortize over lease term. Amortize over lease term means what? Imagine the WDV is 50, sale value is 80. WDV 50, sale value 80. That means you are selling at profit. If you are selling at profit, lease term is 3 years. This profit 30 is there. No, don't record today only. Spread it across 3 years and transfer it to P&L. Now, if it is operating lease you have to be a little careful. Sale value is equal to fair value. What is fair value? Today's market value. You sold at exactly the market value which is there in today. So when you have sold at exactly market value, recognize now. Recognize now means what? Whatever profit is there, recognize it today only. You sold at exactly market value, no. So there is no uneven or abnormal profit over here. Sale value is 80, WDV is 50, fair value is 80. You sold at the fair value only, profit will be credited to P&L. Sale value is less than fair value. That means market value is 80, but I was not able to sell at 80. This is also recognized now. Imagine you have land. They will negotiate and you will sell it at little less than the market value. So here also, whatever profit you get, it will be credited to P&L. The major thing is over here. When the sale value is greater than fair value, you are selling it at higher than market value. Why did this happen? This is an abnormal situation. Why? You told, boss, you pay higher amount today and buy the asset. I will pay higher lease rent and compensate you. That can happen only if there is lease. No, if there was no lease, can you tell that buyer? Buyer, please pay higher amount and buy the asset? No, he will not agree only. So if the sale value is greater than fair value, sale value minus fair value. That means that extra what you are paying more than market, that will be amortized over the lease term because it's an abnormal profit. But the fair value minus WDV, that means compared to market value, whatever you are, market value and the WDV difference which is there, that will be recognized now. See, if I take this example, market value is 80, WDV is 50, sale value is 90. Can you see I sold it at extra 10 over here? This extra 10 which is there, that will be amortized over 3 years. But can you see compared to market, the 30 rupees normal profit which I should have made, that I will recognize today itself. That should be recognized today itself. That should not be any problem. This is the lease discussion. We have to solve some problems also, starting with the first exam itself. All this we have seen. We have to go towards that one question number, which will have only A's, 7. 7 and also 1 in 8. Tala Ferraris. We'll take a small break. Back in 10 minutes. Once we finish A's questions, that's it for the day. 1 hour will be required. Yeah. Every attempt 5 questions they're asking from A's, and that also they're repeating. If you see model test paper, without knowing A's also you can go and write. If you finish in half an hour, good, we'll go. If you finish in 10 minutes, we'll go in 10 minutes. If you finish in 5 minutes, we'll go in 5 minutes. You are required to ascertain the amount at which the machinery should be capitalized. They are telling what is the cost of the machinery that should be shown. Okay. Now, Alpha Limited contracted with the supplier to purchase machinery which is to be installed in one of its department in 3 months' time. When are they installing? 3 months later. Special foundations were required for the machinery which were to be prepared within the supply lead time. Cost of the site preparation and laying foundation. Should we capitalize it? Site preparation we should capitalize 1,40,000, that is added 1,40,000. Next, these activities were supervised by a technician during this entire period who is employed for this purpose, 45,000 per month. Don't get confused, 45,000 is per month. We are taking how many months to do this work? 3 months, 1,35,000. Add 1,35,000. Next, machine was purchased for 1 crore 58 lakhs. Obviously, that is going to be capitalized 1 crore 58 lakhs. Then, and 50,000 transportation charges were incurred to bring the machinery. Transportation charges. Is it necessary to bring it over here? Yes. Add 50,000 also add. Now, architect was appointed 30,000 to supervise the machinery installation. This is also required. What? No, I don't want. Okay, 30,000. Okay, now, because you did into 3 over here, don't do into 3. This is not per month. This is total 30,000. Add 30,000 over here. This is the total cost of the machinery. Done. Amount to be capitalized. Everything had to be added. 1 was into 3. That's all. That is what I'm telling. Next. We'll go to the next one. This also say explain the treatment of this expenditure as per the provisions of AS10. Neon Enterprises operates a major chain of restaurants located in different cities. The companies have acquired new restaurant located in Chandigarh. They have different restaurants in different places. Chandigarh, they have acquired one new place. The new restaurant requires significant renovation expenditure. Management expects that renovation will last for 3 months' time, during which the restaurant will be closed. It is taking how many months? 3 months. During that time, restaurant will be closed. Management has prepared the following budget. Salary of staff in the preparation of a restaurant before its opening, 7,50,000. Construction and remodeling, 30 lakhs. Will it be capitalized? Obviously. You are preparing it ready. See, the restaurant cannot be opened without incurring the construction and remodeling cost of 30 lakhs, and thus the expenditure should be considered as part of the asset. However, cost of salary which is there in preparation of 7,50,000 before its opening are in the nature of operating expenditure that would be incurred even if the restaurant was open, and these costs are not necessary for bringing the restaurant to the present location and condition. Only 7,50,000 will be treated as expense. 30 lakh will be capitalized. What is the logic? 30 lakh you're spending on remodeling. No, that is necessary to bring the asset for its intended use or sale. Salary, even if the restaurant was not there, also you would, if the construction was not happening, also you will pay the salary to the staff whom you have. So that is considered as expense. That is it. Then, one more set of questions. Raj Company, now see, determine the treatment of borrowing cost in the books of accounts. Raj Company has taken a loan of $20,000 at the beginning of the financial year for a specific project at an interest rate of 6% per annum, payable annually. On the day of taking the loan, the exchange rate between currencies was $48 for 48 rupees for $1. Exchange rate at the closing was 50. The corresponding amount that would have been borrowed in Indian rupees is 11%. I think the same question is there in study material, if I am not wrong. Determine the treatment of borrowing cost. Now see over here, B1. How much is the interest for the period? We borrowed how much loan? $20,000. $20,000 into, what was the rate on that day? It was, financial year was 50. Closing. End of the year it was 50 into 6%. How much is the interest rate? 60 rupees. I mean, sorry, 60,000. Now, exchange loss on principal amount. Principal amount, what happened to principal amount? 48 was the principal amount, that has gone to 50. When I borrowed, no, rate was 48. Now what has happened to the rate? Rate has touched 50. Because the rate has touched 50, extra 2 rupees per dollar I have to pay. So 20,000 into 2 rupees, 40,000 is my loss. Interest that would have resulted if the loan was taken in Indian currency. Now we are checking, what if I would not take the loan there and I would take the loan in Indian currency? 20,000. When I took the loan, how much was the rate? 48. So 20,000 into 48 into 11%. 1,05,600. Is it 1,05,600? 20,000 into 48 into 11%. 1,05,600. Now, what is the difference between 1,05,600 and 60,000? What is 60,000? Interest in India minus interest in US. 45,600. So therefore, what you are going to do in the above case, 40,000 is less than 45,600. Therefore, entire exchange difference, whatever is there, should be taken as borrowing cost. So total borrowing cost will be 60 plus 41 lakh. What is the 60 plus 40? 60 is because you are paying interest and the exchange difference. Your principal amount also went up. That is also borrowing cost. So total 1 lakh will be taken as borrowing cost. Is this clear till here? Yes. One more question we have on yes. This state how the interest on institution term loan to be accounted. Now, Rohini Limited has obtained the loan from an institution for 500 lakhs for modernization and renovation of its plant and machinery. Modernization and renovation of plant and machinery means what? It is a qualifying asset because you are taking some time to make that asset ready. Installation of plant and machinery amounting to 320 lakhs was completed on 31st March and 50 lakhs was advanced to supplier. Advance to supplier is not a qualifying asset. It is not qualifying asset. But 320 lakhs, is it a qualifying asset? It is a qualifying asset. Now, and then their balance 130 lakhs have been used for working capital requirement. Working capital requirements mean day-to-day expenses. That is also not a qualifying asset. Not qualifying asset. The total interest paid on the above loan amounted to 65 lakhs. How much did you pay? 65 lakhs. But 65 lakhs you paid for your total loan. How much did you use out of that for qualifying asset? Only 320 lakhs. So 320 divided by 500. 320 divided by 500 into 65 lakhs. 41.6 lakhs will be capitalized. See, 41.6 lakhs will be capitalized. What about the balance amount? What you spent for, oh, see, this is wrong, okay? Advance to supplier for additional asset itself. That is not a qualifying asset. How can that be qualifying asset? This should go to this column, that is P&L. Working capital anyway is not a qualifying asset. Clear? This was your question from borrowing cost. We have one more question over here directly from does this amount to change in accounting policy? Can the company change the method of accounting? HIL Limited was making provision for non-moving stock based on no issue having occurred in the last 12 months up to 31st of March 2024. Company now wants to make provision based on technical evaluation during the year ending 31st March 2025. So what they were doing, they were following one method for valuing the stock. Now they changed the method of valuing the stock. Total value of stock is 120. Provision based on technical evaluation is 3, but provision based on last 12 months is 4. They are asking, does this amount to change in accounting policy? No. Decision for making provision for non-moving inventory on the basis of technical evaluation does not amount to change in accounting policy. Why does it not change in accounting policy? Because what happened? We thought it will be 3, now it became 4. Accounting policy of a company may require the provision for non-moving inventory should be made out of the basis for making provision will not constitute accounting policy. That means just if you change the provision amount, that is actually if you think deep, it is change in accounting estimate and it is not change in accounting policy. The method of estimating the amount of provision may be changed in case of more prudent estimate can be made. So what did you change? You changed just the amount. Last year you thought it is 3, now you made it 4. In the given case, considering the total value of inventory, change in the amount required of provision for non-moving from 4 to 3 is also not material. Disclosure can be made of such amount in the following lines. They told how to disclose it. The language you have to read and write that same language. You are just going to tell, basically story you are going to tell. You have changed from this method to this method and because of that there is change in profit. Can the company change the method of accounting? A2B, that is partnership. Okay, we can ignore that. Can the company change the method of accounting? They have not answered that only. Yeah? if you want, you can write here. Company can change the method of accounting if it is required by statute or law, if it is required by AS, or for better preparation of better presentation of financial statements. Okay, that should be it. That was your question on AS. See, easy questions are asked. Okay, just finish all the study material AS questions and go to the exam. Few will repeat in that. It's easy, 4, 5 marks. If you get, there'll be a big boost. Now, June 777. Color for a reason. See the question. Okay, there is nothing for me to explain in this question because of the way they are asking the question. Beautifully, they are asking the question. See this. What is the basic difference between accounting standards and Ind AS? Theory, straight away. And there are many carved out questions they are asking. Accounting standard this one, Ind AS this one. 7 marks. List out the comparative provision difference between AS 23 and AS 16. AS 16 is what is there? Ind AS. The Ind AS 16 is similar to this only. 7 marks. Now, explain in short the relevant disclosure of accounting policy as per AS1. Disclosure of accounting policy, tell in short. What will you tell? Substance over form, prudence, all those things you will write. Then you will write about materiality, then you will write about going concern, then you will write about consistency, all those things you will write. Kannan Limited has provided the following information. Depreciation as per accounting records, depreciation as per tax records. Okay, there is one AS22 question. Now see, unamortized preliminary expense as per tax records. Now, there is adequate evidence, blah, 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 blah. Calculate the deferred tax rate is 50%. Now, see over here. How much is the depreciation as per accounts? 250. How much is the depreciation as per taxation? 550. As per taxation, depreciation is more. What is the difference between these two numbers? 3 lakhs. If depreciation is more, that means income is less. If income is less, tax is less. If today tax is less, in future tax will be more. So into 50%, that means 1,50,000 will be deferred tax liability. Clear? Unamortized preliminary expense. Unamortized preliminary expense means what? We did not take this preliminary expense in tax. We did not take this means what? 40,000 into 50%, you will get 20,000. You did not take it today, but in future you will take it. When you take it in future, you will get a tax benefit. So this is a deferred tax asset. So you can see over here. Have they even computed? Yes. 1,50,000 deferred tax liability. 20,000 deferred tax asset. Net effect is deferred tax liability of 1,30,000. See the questions. You are skipping all these areas which is actually gold. See here. Profit and loss is a point statement, whereas balance sheet is a period statement. Do you agree? Give reasons. They are asking this kind of question. Profit and loss is a point statement means what? It is prepared for a period. Correct? Balance sheet is a period statement means what? Ulta they have given. Balance sheet is a point statement on that day. P&L is a period statement. So you have to write that. Do you agree? No. Then give reasons. Okay. NPO, one small subscription question is there. I think you can be able to manage that. June 25 done. December 2024. 7th question. In context of AS11, what do you mean by integral foreign operation? State how the following items of integral foreign operation translated. Now, integral foreign operation means it's like a dependent branch, but in foreign branches. That means it works like an extension of the same branch. Now, conversion, we learned the conversion. Salary and wages, when you translate it, that means convert it. What rate we are supposed to take? We are supposed to take actual rate. Incomes and expenses, you are supposed to take actual rate. If actual rate is not there, that time you will take the average rate. Depreciation on furniture, what will you do? That also you will take actual rate. If that is not there, you will use the average rate. Machinery carried at fair value. See, machinery carried at fair value. Then you cannot take actual rate and all. You are going to take the closing rate. You're going to take the closing rate. 7A. Salary. Average rate may also be applied. Depreciation. It should be translated using the existing rate on the date, that is actual rate what is there. If you don't know what to do, you have to use average rate only. Machinery carried at fair value. This will be whatever exchange rate is existing on the date of valuation, that is the closing rate. Next, now see the questions that they are asking. While carrying AS22, what is accounting income? Did we see in that theory what we saw? What is accounting income? Income as per the financial statement which is there. It is the net profit or loss for the period as reported in the statement of P&L before deducting income tax. Remember in the side I wrote PBT over there. That exact definition they asked, tax expense or after adding income tax savings. Then taxable income. What is taxable income? Calculated as per tax provisions. Tax income is the amount of income tax for the period determined in accordance with the tax laws based upon which income tax payable is determined. Then tax expense or tax savings. Tax expense. How do you get tax expense? Current tax plus deferred tax is the aggregate of current tax and deferred tax charged or credited to the statement of P&L. Exact same words copy paste. Now after that they said as per AS12 explain the treatment of the following. A firm acquired fixed asset of 850 lakhs on which government grant received was 40%. What will you do? 850 into 40%, 85, 170, 340. 340 is the government grant. You have two options, reduce from the asset or treat it as deferred government grant. Total is 340. In the balance sheet, the asset will be shown net 510. This will be depreciated over the life of the asset. Reduce it and then depreciate it. Capital subsidy received from central government for setting up a plant in notified backward region. Total plant is 900 lakhs. Subsidy received is 250 lakhs. What is this? This is promoters' contribution. They're giving you money to start the business. 250 lakhs will be added to capital reserve. Promoters' contribution. Clear? Then 225 lakhs received from local authority for providing medical facilities. Actually, you should keep it separate. When the amount is spent, you should transfer it to P&L. In case of revenue grant, should be shown in the P&L account. However, if the medical facilities are to be provided over a period of more than 1 year, it may be treated as deferred income. Do you remember deferred this thing, government grant? Then taken into P&L on systematic basis. That means if it is not spent, keep it aside. After it is spent, transfer it to P&L. Next, list out the comparative provisions. Almost every time they're asking one question for just differences. Some 4 or 5 tables are there in the study material. Those tables, the differences, if you study, at least one will be there in the exam. Briefly explain. In this introduction, answer the following questions. Okay, general questions. They have asked profit earned on sale of asset. What should be the accounting treatment of this profit? Why is the full cost of asset not treated as expense in the year of its purchase? Why it is going to be used for more than 1 year? Why profit earned on sale of fixed asset? What should be the accounting treatment? What will you do? You will transfer it to P&L. Do you think that the convention or conservatism results creation of secret reserve? No, conservatism doesn't create secret reserve. It is providing for future losses. Goods worth rupees 1 lakh were burnt by fire and a claim of 70,000 has been accepted by the insurance company. How will you record in the final accounts? What will you do? 1 lakh is burnt by fire, 70,000 you will get from insurance company. That means 30,000 will be taken as loss in the P&L. State with reasons whether the following statement is true. Provision for discount on debtors is calculated after deducting the provision for doubtful debts from the debtors. Yes, because after you remove all the doubtful people, then only the remaining people are sure short people. On that you will create provision for discount on debtors. And don't skip this also. Just read this also. Partnership 1 4 mark question will be there. That means partnership also 14 plus 4 18 marks. It is there for sure. Yes, that was December 2024. Huh? Second question now. December 2024. Second question. Where? Not there, no. We solved all this. I think it was some other question. I think AS10 only was asked. Now we'll go to June. June 24. See, studying the concepts of AS will take some time because it's theory. You have to read it. But the kind of questions they are asking, that is not actually tough. So it is easy marks in that last two sections of the question paper. No, easily scoreable it is. 7A. Rukmani Limited has made a right issue of shares in 2022. In the offer document to its members, it has projected a surplus of 60 crores during the accounting year ended 31st March 2023. The draft results of the year prepared hitherto following accounting policy, the present of pursual of the board of directors showed a deficit of 15 crores. The board, in consultation with the managing director, decided on the following. General question. It is not even completely accounting standard. Now, what they told when we issued shares, no, we told them, boss, we will be making 60 crore profit. What did we end up making? 15 crore loss. We ended up making 15 crore loss. Now, something we should do, no setting to change this. So now, starting point will be your 15 crore loss. Did they show it? No. Okay, let's say 15 crore is a loss. Now, value year-end inventory at works cost of 75 crores instead of following the method of inventory valuation of 45 crores prime cost. Prime cost 45 crores it was showing. So they decided, let's change the inventory value itself. Inventory value will increase by 30. If in closing stock increases, what will happen to profit? Profit also will increase. 30 crores, 30 crores. Thereby profit for the year is increased by 30 crores. Closing stock increases, profit increases. What are they trying to do? They are trying to make some book changes so that the profit, overall profit can increase, because we had promised them that there is 60 crores, but we got a deficit of 15 crores. Not to provide for after sales expenses during the warranty period. Till last year, provision of 2% on sale was used to be made under the concept of matching cost and revenue, and actual expense used to be charged against the provision. Board now decided to account for the expense as and when actually incurred. Sales during the year is 900 crores. 900 into 2%. 18 crores. What did they do? Last year and all, we used to create provision. Now they decided, let's not create provision this year. If you don't create provision, what will happen? That much amount will be saved in the P&L. So now you are going to reverse that 18 crores. See, profit is going to be increased by 18 crores. That would not have been in the case of the previous policy continuing. So we are changing policies so that we can increase the profit. Next, provide for permanent fall in the value of investments on which fall had taken place over the last 5 years, provision of 15 crores. Now you have to create the provision. Investment has fallen, so you are creating the provision. Company decided, so therefore profit, so the provision so made has reduced the profit disclosed by 15 crores. So they said, currently we have some policies. If you change the policies, what will happen? The profit will increase or decrease. What is the objective of accounting standard 10 as per AS 10? Which are the included in the bearer plan or not? We discussed bearer plan just at the end of AS 10. Then AS 12, they have asked one question. State the provisions of AS 12 relating to presentation of government grants in financial statements. These kind of theory questions are there, and you're telling AS should be skipped. See, they just asked, tell about the government grants in the financial statements. Tell about expense grant, income grant, and the grant received in the nature of promoter's contribution, grant received for depreciable asset. If it is received for depreciable asset, reduced from the cost of the asset. If it is received for depreciable asset, you can also show it as deferred government grant. Show the treatment of expense grant. All those things you just write. 5-mark question they're asking. That is June 2024. Last December 2023. December 2023. Yes. Okay, yes answers and all they give. This much paragraph answer and all you can't write in the exam. It's just that they copy paste it from study material directly like that. That's all. Okay. Now, ABC is setting up a new refinery outside the city limits. In order to facilitate the construction of the refinery and its operations, ABC is required to incur expenditure on the construction development of railway siding, road and bridge. Though ABC incurs or contributes to the expenditure on the construction development, it will not have the ownership rights of these items, and they are also available for use of other entities and public at large. What they are telling, we have to transport goods, so we are constructing one railway track they were constructing, and that we are not using, we are using, letting the public also to use. Whether ABC can capitalize the expenditure incurred on these items as property, plant, and equipment? If yes, how should these items depreciated presented in the financial statement? Is it a property, plant, and equipment? Is it going to give you benefit for more than 12 months? See, AS10, it is probable that future economic benefit will flow to the entity and cost of the item can be measured reliably. Should be allocated and capitalized as part of the items of property, plant, and equipment. Why? You have one railway track, which will help your movement of goods fast, and this railway track, will you keep it for 8 months and remove it after 8 months? Guys, CMA Inter going on, guys. See Inter, you can go to the other channel. Okay, you'll find it over there. Yes, so that should be it, capitalized as a part of PP. Next, ABC Limited has received the following grants from the government. They have received following grants from the government. Now, 20 lakhs received for immediate startup of business without any condition. What is this? Grant in the nature of promoter's contribution. Directly it should be going into capital reserve. Directly it should be going into capital reserve, not available. Where did they write? Copy pasting things directly from the study material. See, this should be recognized in statement of P&L itself, as there was no condition attached. What condition will be there? They are giving you money for what? Starting the business, right? Immediate startup. So therefore, this will be credited to capital reserve, not P&L, capital reserve. 50 lakh received for research and development of drugs required for the treatment of cardiovascular diseases with following condition. Drugs should be available to the public at 20% cheaper from current market price, and drugs should be in accordance with the quality prescribed by the World Health Organization. Why are they giving this 50 lakhs? For research, right? So 50 lakhs, you are going to keep it as deferred GG. After amount is spent. After amount is spent, if you fulfill the conditions, that time it will be credited to P&L. Transfer the amount to P&L. Now, 2 acres of land received for setup of plant. It is received for free, right? But still you will record it. Record at what value? Record at nominal value. Nominal value means not market value. Nominal value of rupees 1, 10, so on. 2 lakhs received for purchase of machinery of 10 lakhs. Useful life of the machinery is 5 years. Depreciation of the machinery should be charged on straight-line basis. How much you received? What is the cost of the machinery? Cost of the machinery is 10 lakhs. Government grant you received is 2 lakhs. So therefore 8 lakhs. Now this 8 lakhs will be divided by 5 years. So 8 divided by 5, every year depreciation will be 1.6 per year. Then next one is partnership. This is chapter 1. See, full disclosure, consistency, materiality, conservatism. Explain the methods, criteria for selection and application of accounting policy. What is the methods and criteria? Substance over form, prudence, materiality. 5 mark questions. Yes, guys, that's it. You know the blueprint. You know, in college and all, school and all, they should give blueprint. No, like that. Actually, you know the blueprint. You just have to study and finish it. So this is our discussion. No, sir, I am from current accounts. You are taking up in Chennai. We'll speak tomorrow. Why you are coming here and putting comment, man? If you are speaking tomorrow, come tomorrow only and speak. No. Face to face, yes. Okay, fine. We'll talk tomorrow. Okay, guys. So this is your CMA Inter Financial Accounting Marathon. That should be it. Please study. Okay, 100% you can clear, because you can see that the questions that they are asking are not like, they're not merging 2-3 concepts and asking this chapter fully, this chapter. Okay, and especially AS, they know, you know, there is a strong reason why they are asking AS questions like that. The reason why they are asking AS questions like that is because you are going to be cost and management accountants. So your costing is the core, accounts is not the core. So they don't want you to like go deep into accounting standards. So they just want you to have an idea. When the client comes and talks to you, you should have an idea about accounting standards. That's why they are just asking basic. As you go further, what is going to get trickier or harder is your costing, management accounting, those topics. So accounts is just that you should know it. Okay, so that is why they are not testing like very hard things or very tough things. They are not testing. When you go to corporate accounting, that is in group 2, there are some corporate stuff which they are testing, like cash flow statement and all, they want you to know. But again, at a very light level only they are keeping it. So please do not waste your time. You have few days left for the exam. Okay, wish you all the best. It shouldn't be a problem to clear these exams. Okay, next time we should meet only in CMA. No group 2 and all. Directly we should meet in CMA final classes only. Okay, we should not meet in inter classes. It is 100% possible. Just keep that confidence. Okay, just keep that confidence. I know sometimes, when you study for these professional exams, no, especially like sitting late night for many hours and all studying, that time your self doubt will start. Self doubt. Oh, like what am I doing in life? Is it possible? Especially when you come close and when you fail, no, you'll be like, is it possible? Am I made for this? Okay, just get over it. See, basically, I can just give you motivation, but thing is, the logic is simple. Okay, in life, when you fail, there will be very few people with you, and when you pass, there will be 100 people asking for treat. There will be 100 people asking for treat. Now remember the people who were there. If at all you failed, when you failed, who were there with you? Remember those people. When you pass, those are the people who you need to treat. That's it. That's it. Rest of them just remembered you because of your success. Okay. Others, those people were not there with you during your failure. So during your failure, it is basically 5 people will tell you you can do it, but ultimately you only have to do it. You have to stand. People might be there to carry you, but you have to stand. That effort of standing you should take. See, in this day and age, no, a professional degree will give great benefit. It will give you great benefit for your resume, for your CV, for your career, everything. So, but please put in that effort. Okay, at least some few hours of your time. If you're a working professional, little time at least you try to spare. I know it will be a huge sacrifice because when you're working, your mind will be there also. You have to study also. But try to get this clear, because if you're a working professional, no, it will boost your career there as well. Okay, one extra degree will be very good. But yeah, self doubt will be there. Okay, it's a very hard phase. Like when you're sitting for exams and you're thinking, "Ayo, what am I doing? Okay, one more year. Should I spend on this or should I go and work?" See, simple. If you're thinking that you are going to work, you think like this: do you have financial trouble at home? If you have financial trouble at home, that means you have to feed your family. Then I am telling you, I can't stop you, no. I can't tell you, leave your family, let them starve, you sit and study. I can't do that. In that case, you have to go and support your family, you have to go and work. If your family can survive, okay, and if their family can sponsor your basic necessities, not your luxuries and all, okay, your basic necessities, if your family can sponsor, then ask your family for 1 year, 1.5 years, 2 years, whatever it is required to complete this course. I'm not talking about CMA Inter, I'm talking about the entire CMA. Okay, ask your family to sponsor for that time. Sit and study. Sit and study. If you are feeling like, that I don't feel like taking money from parents at this time, consider it as a loan. When you start earning, repay it. When you start earning, it is repaid. Instead of that, going for any small jobs right now, thinking that you have to earn because you have reached a certain age, you are doing the wrong decision, because with that job, studying will be a little difficult. Now you're actually wasting few more attempts, and when it goes few more attempts further, now 1 more year later will be worse. The mindset will be worse now. Now you will feel even more late it has become. So instead of that, today is never late. Future can be late. So today, put your best effort and ensure that you clear. Okay. The same thing. Ask your family for some time. Tell that you are going to put all your effort and study. Okay. If you feel like that obligation and all that, consider it as a loan and give the money back to them when you start earning. And trust me, when you get this professional degree, what you are going to earn will be good enough, or easily you can repay whatever the amount it is. Okay. So wish you all the best, guys. Finish your exams and let's meet in the next level of CMA. That should be the goal. Okay, all the best. Bye-bye. Good night, good morning, everything. We are here at 11:35. Today, first day, we didn't get to say good morning, right? Yes. Good night, guys. See you. Bye-bye.